€22 billion, resetting the EV business, facing higher cost, muted EV sales. Of course, that's the theme there. Watching the banking sector, Sabadell, front and centre. We spoke about the handover of the leadership of that business, the TSB sale. We'll watch that one at the start of trade. And SocGen unveiling a buyback, profits beating. We had profits missing over at Orsted in the wind sector, but they're reinstating their dividend. We'll see what that does to the share price. Guy.
Lots to fold into this session. Let's get it going. It's time for the opening trade. This is what the early numbers look like. We're expecting the FTSE 100 to be under a little bit more pressure than most this morning. It opens in the red. It's down by 0.2%. We'll wait and see exactly what happens with the oil price today. That can be critical for the London market. But you've also got a gilt story that we're going to get to in just a moment as well. Stock 600 fairly flat as we open up for trade this Friday across Europe. It's going to be interesting to see what the CAC does, the DAX, the SMI. The DAX on the auto sector story. I know Stellantis isn't there, but it's going to be something that we're going to watch out for very carefully. The IBEX is down by 0.5%. The banking sector front and centre there as well. We'll give the CAC just a second to see if it opens. Looks like it could take a little longer, maybe to get it going this morning. That could be a Stellantis story. We'll come back to that in just a moment. Tom, what do you got on sectors?
Top sectors right now: construction up 0.8%. Energy, to your point about oil, up 0.7%. Brent is currently up 1.1% at $68 a barrel. We watch, of course, the talks that are underway between the Iranians and the US. So energy is there. Utilities up just 0.1%. On the downside, biggest losses coming through. Basic resources, we kind of saw this one coming given the pressure on iron ore and also the breakdown of the deal between Glencore and Rio Tinto. Currently down 1.1%. Basic resources off. And financial services as well. We've got the Anthropic news in terms of a further update there. Financial services down 0.7%, Anna.
I'm interested in the move higher in the construction sector. Vinci is a big mover there, up by 5.4%. And this was a story that started yesterday, really. We had some of the infrastructure companies in Europe doing really well, benefiting from the data center story. So again, this is another sort of incongruity of the markets, that we can celebrate those companies that are set to benefit from the data center build out, such as Vinci, up by nearly 5% this morning. And at the same time, we can worry about all that spend on data centers over in the United States. I'm not sure if those two things fit together, but that's where we are right now, it seems, on markets.
I'm still waiting for a price on Stellantis. It is yet to open. The expectation is that it is going to be softer on the back of what we are seeing. In terms of what the biggest percentage drop is this morning, it's Sabadell.
Yeah.
Which is interesting. An interesting time to exit the business, you could argue, for the current CEO handing over to the new one. But Sabadell is down circa 6% on the back of what we've seen this morning.
Yeah, really interesting conversation about AI being the future there, but at the same time,
not my future.
Yeah, handing over to new leadership. And we got a price on the TSB from our conversation, didn't we? The price
3.3 billion euros.
Yes,
yeah,
so
what was the price?
Maybe new information to the markets. Just digesting it this morning. Let us talk about where we are in these markets in a bit more detail. It's been, it's been a busy week. Let's talk to Madison Fowler, JP Morgan Private Bank Global Investment Strategist, who's with us this Friday. Madison, good morning to you. Taking a while for things to settle down this morning. The London market underperforms a little bit. Stock 600 actually down now by around 0.3%. NASDAQ futures down 0.6%. So a sense that we're still in this slightly nervous environment where we're asking a lot of questions of tech and asking a lot of questions of the themes that have done well around metals as well. As we go further into February, Madison, how are you thinking about the investment climate at the moment?
So I do think that, as we've experienced these first 5 weeks of the year, there's been a sense of recalibration and a testing of investor resolve, and there's certainly been an amalgamation of risks that we've faced, whether that's geopolitical tensions, questioning around, the sustainability of AI spending and disruption around business models, central bank divergence, questions around growth. So there's certainly a lot to, I think, latch onto and create a sense of worry. But I do think that's why when we put together our year ahead outlook, it was called both promise and pressure, which is, I think, a cognizance and a realization that there are challenges and there are pressure points, and we need to be aware of them as investors. But at the same time, some of those challenges are also opening up a lot of opportunities, especially for active managers. And so I would say that the punchline is that we are constructive, but not complacent to the risks.
Okay, so if you're constructive, which of these do you not buy into then? Coming out of big tech because we're worried about CapEx, coming out of software because we're worried about software, coming out of gold and precious metals, silver and the like, because they've just gone up too far. I mean, do you like any of those things despite the volatility we've seen this week?
I do. So I think what we're looking at right now is kind of a flush out around some of the worries when you had, I think, really a two-part problem, especially when it came to tech. One was the question around the monetization timeline around all this big tech spending. And the second thing was the more recent questions around business model risk and disruption risk. And so I think that some of that was probably necessary just from an investor discernment standpoint. And I think that that level of scrutiny is actually a healthy thing. I do think when it comes to tech, what we want to be focused on is who are the companies that are producing high quality earnings growth and who is showing that they have the propensity to monetize that. And then when it comes to commodities, I do think that there is, again, a flush out of some of that speculative buying. But when it comes to gold in particular, I think that remains a really crucial diversifier for us in portfolios, given the fact that we think that all of the structural dynamics are there, not just from a uncertainty risk premium, but also from structural central bank buying and the fact that retail activity does not look stretched at present.
How are you starting to factor in some of the expected updates that come through from the Anthropics and the OpenAIs of the world? So Anthropic with this new model that's targeting financial services, the London Stock Exchange Group is down about 17% year to date. It's down about 5% today. We're down to focus on a single name, but we can expect more updates from these big models as they lead up to their IPOs. How do you strategize around that? How do you invest around that story?
And I think this is where the active management conversation comes in as well. Again, because our call has always been to invest across the entire AI value chain, so a sense of diversification as a result of some of this disruption. I would also just signpost that this process of creative disruption is commonplace throughout history. So, for instance,
is this an overreaction that what we're seeing right now for names like the London Stock Exchange and others that face this upcoming threat? Do you see this as an overreaction, as maybe a buying opportunity?
I wouldn't necessarily say it's an overreaction. I think it's a sense of market scrutiny of figuring out which companies can provide that longer-standing, high-quality profitability. And I think that through that level of questioning, there are some companies that are quality companies that might get hit in the process, and that's where the active managers step in. But I do think that this also, again, signifies that creative disruption is relentless in this type of environment.
Do you think active managers can pick winners in the tech space at the moment?
I do. I think that when there's more dispersion, that opens up further opportunities for active managers. But at the same time, of course, you're not going to get every call right. But I do think if you're focusing on those areas, for instance, that are more, if you're just talking about the software space, horizontally integrated versus vertically integrated, and so they have more deep competitive moats as opposed to being more AI wrappers, then that, I think, is a more prudent place to be when you're trying to position within the AI space.
Active has had a really tough time. It's not great. It hasn't had a great track record recently over the last few years of outperforming the index. Is this going to be the year? It sounds like you're suggesting this is going to be the year in which active outperforms index.
So I think the last few years, you didn't have the best setup for active managers, to your point. You had, interest rates that were quite low, which made it difficult to even earn a return on cash if you're a hedge fund manager. And then at the same time, you had higher correlation, less dispersion. And so when we think about active management, that kind of, alpha winter that we were feeling over the last few years, I think has certainly shifted quite a bit. But I would just stress there is huge dispersion between even, active managers. And so that's why that manager selection conversation is really important.
We're seeing big moves in the auto sector this morning, Madison, distracted by a 14% drop in Stellantis, for example. There was a sense some time ago that maybe the auto sector was drawing a line in the sand, that it could bounce off, that it had restructured a little bit. This sector for you still troubled? I mean, this is to do with rising costs and EVs not living up to expectation in terms of the sales numbers. What do you think of the sector as a whole?
I think it's still finding its footing and finding its way, because not only are there the issues that you called out, but there's also I think large change within the competitive landscape between, for instance, Europe and China. Exactly, and then in addition to that, you've had a number of years of manufacturing malaise within Germany, and we are actually starting to see the inflection points of that moving higher. So I think there's a case to be made for stabilization, but our areas of focus when it comes to, cyclical sector exposure are more in the, security theme of industrials.
In terms of what happens next, I hear a lot about diversification. Is diversification going to allow me to outperform this year, or is it going to continue to be an underperforming strategy because there are going to be core areas of the market that do better than others? Over the last few years, if you've diversified, you've underperformed because big tech has done well. Is that era now over? Is diversification no longer a losing strategy? And does it matter what I diversify into? How broad does my diversification need to be?
It, of course, matters what you diversify into. And I think at the same time, what I would say is with any diversification strategy, the aim is not to be the top performing asset, because ultimately
you can't be.
You can't be. That's just how the math works out. And so when I think about diversification, I think that I want to be prepared for a range of different scenarios. So I want to be positioning for upside in our base case, which means an allocation towards equities broadly. To your point on concentration risk, we are starting to see the earnings growth gap narrow between the Magnificent Seven and the rest of everything else. But at the same time, thinking about the other scenarios, fixed income offers you carry. Elevated yields also means that in a downturn, bonds protect you. But then in a volatile,
are we sure about that? Are the bonds going to protect us? Because they seem to over the last few days. And is that trade back?
I think that fixed income can offer you carry in the type of environment that we are in. And I think in a scenario in which you see a global growth downturn, yes, we would expect that bond yields would fall and protect investors in that type of environment. But if you were to see an environment in which inflation is structurally higher and more volatile, which is also something that we think will take place over the course of the next 10 to 15 years, bonds might not be enough, which is why we're very much focused on commodities like gold, real assets like infrastructure, and also hedge funds for uncorrelated returns.
Guys like a Roman centurion looking for a shield.
But that's what everybody's looking for at the moment. Yeah. Trying to figure out. There's been a rotation out of tech into
gold's going to work. Oh, hang on, maybe not.
Gold
Treasury's going to work.
Any other ideas? Bitcoin.
There's been a big conversation about diversifying into Chinese tech because of valuations. Well, HS Tech, that index has fallen 20% now from October.
It's a bear market.
So it's into a bear market. So so what happened to that? What happened to that trade?
Diversify? Yeah, are all these things. This is the challenge that everybody's facing at the moment. Is that all of the things that we thought were going to be diversifiers are now seeing massive volatility. So how is the diversification strategy working?
Sure. So I think, for starters, we are shifting into a little bit more of a volatile environment. Yep. In any given year, volatility is to be expected. The average, S&P 500 year sees a drawdown of 14.5%, but the average calendar year is still up 75% of the time. So I think that makes the case for staying invested. When it comes to where to diversify, I think different areas of the market provide exposure to different things. So gold can be a diversifier in the sense that it can act as an inflation hedge. It can be an uncorrelated asset. When you're talking about China tech, that's a growth story. So that's a little bit different. You want to be exposed to the competition between U.S. and China. And I also think that within that, you're positioning for an environment where China as a broad economy might not be on its upswing just yet, but China tech offers opportunity.
Yeah. Madison, quickly before we.
Sorry, it's the correlations that matter.
Yes, the correlations. I wonder what the correlations are between the politics of the UK and what's happening in the gilt markets and UK assets. Do we start to price in? Should investors start to price in more risk premium? Do you expect that to be priced in on the threats around the Prime Minister Keir Starmer and his political position?
I have seen, bond markets over the course of the last few years certainly react to political uncertainty, and it's not just a UK phenomenon. And we've seen it in the US, we've seen it in Japan, we've seen it in France, and a lot of that happens on the longer end of the yield curve. So that element of uncertainty, whether it's from a political catalyst, whether it's from fiscal and debt issues, whether it's from geopolitics, that tends to happen on the longer end of the curve, which is why you've seen 30-year yields rise.
Are you worried about the UK?
I think that the UK, from a growth perspective, has certainly had more of a mixed run over the course of the last few years. When we look forward, I do think that there has been a shift towards more fiscal conservatism, which we certainly saw that markets reacted positively to in the last budget. But I do think that, like the conversation for any economy, they're trying to solve the productivity problem. And I think that's something the UK is focused on, too.
It's great to see you. Thanks for stopping by to see us. Busy morning. Busy week. Madison Fowler, Global Investment Strategist at JP Morgan Private Bank. Core 6 looks like this morning. This is where we're seeing some of the action. Chips are down. The ASML story is there, down 0.6%. Luxury is also not having a great morning. Defense is bouncing back. Rheinmetall had a tough day yesterday. You're seeking a little safety maybe in Nestle. Down in Verve this morning, up 0.6%. If you're looking for the biggest points drags this morning, these are they. Stellantis, SocGen, and interestingly, Danone is down as well when I bring up that Nestle story. But let's start with SocGen with Jennifer Creary.
That's right. We're having a look at SocGen today, really slumping on the open. That's despite the French lender announcing a beat on fourth quarter earnings, but probably not enough to assuage investor concerns over some of its cost-cutting measures, including cutting jobs and selling assets. Those shares are down on the open. Next up, we're moving over to Sabadell. Sabadell falling as well, 3.6%. Of course, that comes after the news that the CEO is leaving the bank. He's being replaced, but also fourth quarter earnings coming out, probably not enough again to boost investor confidence. Next up, we're flipping over to Rio Tinto. The big news coming out yesterday that Rio Tinto and Glencore talks have fallen through to create the world's largest mining company. Those shares really getting hammered in the open. And also we've got Stellantis as well, the car maker falling double digits this morning. That's after it announced it was taking 200 billion euros in write-downs as struggles with weaker EV sales and higher costs. Next up, we've also got Lotus Bakeries full year earnings beat analyst estimates. Those shares rising on the open, rising more than 2% off of the back of that. Back to you.
Cakes and waffles, gingerbread, cookies and snacks. Apparently, that's what they make. That's just got me ready for a second breakfast, I think it would be at this point, Tom.
Yeah, nice timing. Thanks for that. Now just focused on my hunger.
I have two breakfasts.
It's a double breakfast. It's a double breakfast Friday.
On a Friday, for
Yeah.
sure.
Right, Jennifer Crew, thank you very much indeed. Coming up, talks to create the world's largest how do I segue from double breakfast to the largest mining company, and talks there collapsing what would have been the largest mining company. We're going to take a look at where that leaves Rio Tinto and Glencore. The backstory to this and the Bloomberg reporting has been fascinating. It's well worth a read. The wider industry, we're going to get the details next. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Welcome back. 8:19 here in London, Friday the 6th of February. We made it to Friday, everybody. And the Stoxx 600 in Europe is down by 0.1%. The DAX is pretty flat. The CAC 40 and the FTSE 100 actually both kind of on a par, down by around 0.3%. Real weakness coming through in the auto sector because of the Stellantis story. And basic resources, once again, an area of weakness. Yesterday, we saw Glencore down substantially within that sector. But once again, we've got basic resources on the back foot. Guy.
Let's talk about what is happening. We're going to talk metals. We're going to do it in 2 different ways. The first thing we're going to do is talk about what is happening with the company story. Merger talks between Glencore and Rio collapsing after the 2 companies failed to agree on a price, or Glencore failed to agree on a price, but I guess it takes 2 to tango. The deal would have created the world's largest mining company. What happens now? Let's find out. Martin Ritchie joins us, our metals and mining reporter. They keep trying, and it keeps not working. Why does it keep not working?
Yes, they have been trying or talking about combining these 2 companies for a long time, and it went right down to the wire yesterday. There was a deadline for them to extend talks, but it looks like just ahead of that, they decided this wasn't going to work. Glencore, according to our reporting, at least demanding at least a 40% share of the combined company, and this just wasn't going to fly with Rio Tinto. It's an interesting combination because on the one hand, Rio really wants more copper. It's a very experienced mining company, both in building mines and operating mines. Glencore has got very good assets, especially in Latin America, but they're not, a lot of them aren't developed yet. They're future assets. They give optionality for the future. And so bringing the 2 companies together was supposed to kind of unlock that, all that value over the future. I think the sticking point is really that Glencore is wanting a sort of a hefty valuation right now for that optionality that lies well in the future, whereas Rio Tinto, possibly with an eye on its existing shareholders, not so willing to come up for that kind of short-term deal. So it could still happen. They can still start talking again in the future, but for now, it's again delayed, and it points to the kind of difficulties of these big merger transactions that the mining companies are trying to do.
Well, on that point then, Martin, does this open the door? Is there a view that BHP could now make a play for Glencore?
It's the obvious thing that people are discussing. BHP obviously also wants a big copper deal. It's tried last year with the attempt to take over Anglo American, which also ended up with BHP backing off. The problem here is it's the obvious suitor, but the problem is if Rio has backed away, then BHP's shareholders would be saying, well, why would we be able to pay that kind of valuation as well? And it's a complex transaction, which BHP walked away from another sort of difficult layered transaction last year. So again, it doesn't seem like straightforward, certainly, and it would be, I guess, on the surprising side if they were to do that.
Martin, we've talked before about how your presence on TV often indicates there's something exciting happening with precious metals. There has been. I can see that silver is actually up by 3.6%, which is pretty tame for silver these days, but it was down by 10 during the Asia session, wasn't it? I mean, what is happening? What is the latest news driver?
Let me be frank and ignore that tiny little move up for silver today, because what we've seen really in context in the last few days is a kind of sell-off across metals, both base metals and precious. They've come down from really elevated levels. We had that whole kind of manic trading around the world, people buying into metals here in China, a lot of trading interest, and I think that some of the air has come out of that balloon, as it were, and we're starting to come back down to earth a bit. And it's certainly on say copper or silver. A lot of analysts are saying the valuations previously were really too high, but perhaps in gold there may be a sense that this is a dip that some analysts say is maybe an opportunity to buy some of those structural drivers for gold, for example, central bank buying, weaker dollar, etc., may still be in place in the coming year.
Okay. Martin Ritchie, Bloomberg's very own lagging or leading indicator when it comes to precious metals, also our mining reporter. Thank you, Martin, for that update. Let's get to what's happening, talking of volatility, in Bitcoin, bouncing back after falling to a fresh low of $60,000 in a volatile trading session. The cryptocurrency slumping to more than half its value from those all-time highs in October. Let's bring in our senior editor for digital currencies, Ana Herrera. Anna, what's going on? What are the factors leading to the downside for Bitcoin? Help us understand what's at play here.
It's hard to know with Bitcoin as usual. So obviously, like one of the big things we've been talking about that's very different is that the environment seems to be supportive compared to other times, right? Like in general, right? We haven't seen big exchanges crash. Regulation is okay. But obviously, Bitcoin being Bitcoin, it acts in ways that are very hard to determine for us normal humans. One of the things that we've noticed is that there's been a sort of lack of a clear narrative. For years we thought Bitcoin was digital gold, was a hedge against inflation. It's really not behaved in those ways. It's more behaving like a risk asset, which probably it is, right? So it fell when other tech stocks were falling, and now it's bouncing back a bit. We've been told it's because 60,000 is a key level. And one of the reasons why it's cascading and falling very quickly is because crypto exchanges have this mechanism where margin positions get liquidated after they hit certain thresholds. So the more it falls, the more it falls. And liquidity has been thin since October when we had a big crash, which means that moves are even more pronounced than usual.
How are we feeling about Michael Saylor?
I mean, we should ask we should ask how he's feeling. I mean, one thing with crypto is that people that bought early and that are believers, it's still very much an ideological asset. I think
he's underwater now. Yeah, so is family Trump, right? Who've tried to cash in on this whole thing.
So I've been covering this asset for like 13 years, 15 years. So it's quick to think, oh, they're done. It's going to spiral quickly. We went from 70 to 60, and then they always bounce back. So I think maybe that's what they'd answer is like, wait, we'll talk again in a year.
Yeah.
Anna, thank you very much. Anna Herrera with the latest on the trends in cryptocurrencies. More on the markets when we come back. This is Bloomberg.
The problem we've got as an industry is when the government's overtax, and let's say they tax at 30 or 40% of net gaming revenue, what happens is it starts making it uneconomical for the regulated operators like ourselves. And then the customers land up going to the black market, and the black market don't pay tax, do whatever, and there's no customer, there's no responsible gaming, and the fiscals of these governments don't collect any money. So it's finding a balance between overtaxing and then not regulating. Anything from 15 to 25% of the net gaming revenue paid on tax is probably the right number. And when you start going above that, the metrics start becoming a bit more complicated for lots of the operators.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance. Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Ahmed, only on Bloomberg.
Good morning. This is the opening trade. Welcome back. We are 30 minutes into today's session. You're seeing European stocks down 0.3% after losses of around 1% yesterday. We're focusing on the auto sector, the biggest losses coming through there. That is weighing on the CAC current over in France, with Stellantis tumbling on the back of a change around its plans on EVs. Down 0.5% on that benchmark over in France. The DAX in Germany down 29 points. Here in the UK, the FTSE 100 down 0.4%, and across the benchmark, losses of 0.3. It's the earnings story. It's the tech story. Guy, what are you seeing?
2-to-1 down. That's the ratio. 194 up, 395 down. Volume is actually reasonable. There's a lot of earnings to price in. There's obviously the kind of the structural story. There's the tech story. There's all kinds of other factors we need to fold into these markets as well. So that's the kind of internal picture. Single stocks. Let's talk about where we are leading. Vinci is up. EBIT beat. The numbers look good. Novo is bouncing back as well, up by 4.83%. It got hit hard earlier on this week on copycat therapies around weight loss pills. Allsted is also up on the back of its numbers this morning. That's where the gainers are coming through this morning. Reasonably eclectic mix on the upside. The downside is really interesting. Stellantis taking a huge charge relating to EV, getting absolutely battered this morning. The stock is down by nearly 20% on Stellantis this morning. This is one of the world's biggest car companies, has just lost 20% of its value. SocGen is down by 2.83%. Those two stocks really weighing on the French market. But I'm going to add another one in as well. Danone is down 2.51%. The reason for that, we are back to the baby milk story and what is happening there. That is a stock that is under pressure as a result of what is going on there. It's interesting that Nestle is actually tracking a little higher this morning. But French stocks, Stellantis, SocGen and Danone, all under pressure this morning, Anna.
Guy, let's get an update on some of the other political news flow we need to be aware of this morning. Japanese voters go to the polls on Sunday for a lower house election that's a high-stakes gamble for Prime Minister Sanae Takaichi. She's seeking to shore up her coalition's majority in a vote set to have wide-ranging implications for markets and regional security. The U.S. virtual embassy in Iran has issued a security alert urging American citizens to leave Iran now and not rely on the U.S. government's help to do so. It comes ahead of planned talks in Oman due to take place today between Iran and the United States. Iran said the negotiations could be the first stage of a longer diplomatic process, signaling there won't be a quick resolution to escalating tensions with the United States. Bloomberg has calculated that the 4 biggest US tech companies are planning to spend $650 billion on capital expenditure just this year. Each of those companies' estimated outlays would set a high watermark for capital spending by any single corporation in any of the past 10 years. An incredible uplift year on year. And once again, capital expenditure to the fore then, Tom.
Yeah, and sticking with that theme then, Amazon shares slumping after the company announced plans to spend $200 billion this year on data centers, chips and other equipment.
When I look at this, what's happening, it's kind of unbelievable if you look at the demand of what you're seeing already with AI. But the lion's share of that demand is still yet to come in the middle of that barbell, and that will come over time.
Let's bring in Matt Bloxham, Bloomberg Intelligence Senior Analyst. So we saw the shares selling off under pressure on the back of this. $200 billion on CapEx. So beating, at least in terms of their forecasts, in terms of what they plan to spend, coming in much higher than many of the other big tech companies so far. They have $250 billion in terms of a sales backlog. So why are investors so concerned?
Because that sales backlog will probably play out over a number of years. And a lot of this investment, if you think about chips and the pace at which NVIDIA and others come out with the next generation of their technology, how quickly do you need to amortize those chips before you're investing another tens of billions of dollars in the next technology? So some of this investment is going into long duration physical infrastructure like the data centers and the power to deliver it, but a lot of it is going into that kind of much shorter duration technology. And I think people just don't know what the kind of the mismatch is between that investment and the pace at which revenue is coming in.
It's so weird. There's two stories. There's the kind of we're spending too much on AI, and then there's the AI is going to change everything narrative. Both seem to be represented this week and current and having an impact. And Anthropic is the kind of the latter story. Earlier on this week, it was going to become my lawyer. Now it's going to become my financial advisor and my financial analyst. How significant is this?
It is pretty significant. And obviously, those two truths can coexist, that we're spending too much and AI is going to change everything, and we've seen that kind of cycle before. Companies spend too much because their competitors are spending too much. And they all have to just kind of do it, otherwise it's a kind of mission critical risk for your business. Anthropic's taken a very different path to OpenAI and Google in the focus of their technology, made it much more about being an enterprise robust product and looking at specific verticals within that and making a product that really kind of stands up to the kind of tests of kind of day-to-day use, and obviously the financial markets and not just investors and analysts, but anybody working in a company that's kind of got an analytical or financial kind of role. It's a hugely complex task and very well suited to the kind of things you can do with AI. And so they've kind of really found a sweet spot for that and are kind of doubling down on their investments there. They've got something like 300,000 enterprise customers. The feedback is really good. Even Microsoft has integrated this into Excel, the most popular productivity software on the planet. And it's more popular than their Copilot.
Yeah, and that goes to the question we can't answer right now. To what extent are these competitors versus sort of a symbiotic relationship between software companies and the likes of Anthropic making these AI tools? Matt Bloxham, thank you very much. Matt Bloxham, Bloomberg Intelligence Senior Analyst. Now, sticking with this theme, we spoke to our guests this week about the software slump and the shifting impact of AI.
Nobody is vibe coding their payroll. That is a future we're not going to live in. The market has overreacted to the perception that vibe coding is going to cause enterprises to rip and replace their SaaS spend. They're just not.
If we look at the overall economy, those jobs will be redeployed in other activities because the AI will also generate totally new activities. I mean, let's go back. It's what the internet did. It's whatever, all of these things that we've seen, it leads to a change.
The impact of technology and AI to our society, to our business is going to be very profound. And, I wouldn't say that the market is overvaluating that. But from a financial standpoint of view, I do believe that there is some reconciliations to be done.
The transformative power in this is very substantive.
For the good or for the bad?
Well, I think for the good
and the bad, but I think AI needs to be regulated.
So it's powering AI from grid to core. That's where we see tremendous growth potential. It's going up quarter after quarter. It's for us the biggest growth driver in the history of the company.
Using AI will help us to invest cheaper and have a better outcome.
With lower headcount.
Exactly. Less hiring or effectively and increasing the revenues faster.
AI has an impact, yes. We are still not, and many others are not able to measure that precisely, but there's a lot of automation. And again, one transformation is about aligning common business models, having common tech platforms at scale.
So many interesting conversations attacking AI from different directions. Let's focus in on the software story. We are joined now by Anne Witty-Bahaguna, Global Co-Chief Investment Officer at Northern Trust Asset Management. Anne Witty, nice to speak to you this morning. So, I mean, the story of this week, or the news story around AI this week, has been around software, what Anthropic is doing, these plugins, and what they can do to all kinds of white-collar parts of the economy. What is the context around that software story that you think is important as we think about how substantial a shake-up this could be?
Sure. First, thank you for having me. Yes, this week has been about Anthropic and the impact on the software industry from a very macro perspective, which is sort of where I am most of the time. This is sort of the disruption we were waiting for. All of last year was, why are we spending so much money? Why are we doing so much capital spending? What is it having an impact on? And now with the coding news, the replacement of analysts, hopefully not all of us, the news is really beginning to show us that it is disruptive. It will change the dynamics in the economy, not something to be afraid of, but there will be winners and losers. And for the first time this week, it's been about differentiating the winners from the losers.
You see that, do you, differentiation? Because sometimes it looks kind of indiscriminate, or at least by a sector. There's a legal plugin, sell anything that has a legal business. There's something to do with financial services, analytics, sell things that do that. Without asking, does this AI tool really replace or complement the things that these other companies produce?
It's been this indiscriminate, in my opinion. So what I have seen so far is that, very hard to say at this early stage if we know exactly who the winners are, exactly who the losers are. But we've seen companies with 45, 50% margins, really strong stream of billions and billions of dollars of earnings, absolutely smashed in valuations, halved in valuations. And I can see the differentiation on more on the macro level than on the micro level. In other words, you're right. There are many companies, good ones, that are being sold. The differentiation I'm seeing is really in stocks versus what's happening to the credit of that company. In other words, we're seeing the stock of a company valuation cut in half. But because the balance sheet is good, you're seeing their credits not blowing out. So there has been clearly a very small move in credit also, but nothing to the extent we have seen in the equity market. And I think that distinction is important because ultimately it's the bond market that gets it right.
It's interesting that you tie this to credit, and so I just wonder how much confidence you have that story maintains. Or are we getting to a point where there's going to be a moment where people have to unwind their leverage and we get something that breaks? Are we getting closer to a point where something breaks?
So we have seen that in the credit store, and Tommy, in the credit market also, I'm talking about what I can see, which is in the public markets. You have seen the response in the companies which have that leverage you're talking about, which is predominantly in the private market. So because there we don't have the transparency on who owns what, how much software exposure do they have, what type of software exposure do they have in the venture space, in private equity, in private credit, that's where you're seeing the likes of some of the BDCs getting crushed. Because
so you're concerned about what's happening in the private.
I am concerned about what's happening in the private. But what I'm seeing is that I'm actually getting some confidence by looking at the actual credits, because some of this infrastructure spend and data center spend has been funded in the public markets also. And in the public markets, we're not seeing that bloodbath on the credit side. So that's giving us some hope that this is still a not a contagion, not a thing that's spreading through the financial markets. It's limited to a reaction to this is happening. Let's now sharpen our pencils and look very carefully at which companies are going to win this and which companies are not.
How do you think sentiment is today versus a week ago versus 2 weeks ago?
Oh, it's absolutely short right now in the markets, right? And that's why, to Anna's point, you see so much indiscriminate spending. But this is where you need your active managers to go and say, this company has solid revenues over 3 years. They're not going to be decimated. Sure, there'll be some earnings.
Do you think they know? Do you think they have enough visibility to
on
know
the public
the answers
side,
to that question?
on the public side, they do. And on the private side, you have to know your managers very well also. Not the companies per se, but your managers' ability to make those.
The pace of disruption is enormous. How can I predict what these companies are doing and what their revenues are going to be looking like and what their margins are going to be when things are changing as fast as they are in terms of demand for their services?
So that goes into how diversified and how, I think your analyst was talking about how deeply embedded they are in their enterprise. So there are companies which are small players, which can be easily unplugged from your enterprise. And there are companies which are deeply embedded into your enterprise, which have more than one function for you, more than just the coding function.
Sure.
And those are likely to maintain their earnings. Sure, there will be a hit to those earnings. And right now, the companies are not quite sure, to your point.
Precisely, and we can quantify that at this point, can't we?
Not really, so that's why the valuation's getting crashed.
So, but active managers...
Active managers can, good ones.
They can, even with the volatility and the uncertainty at the moment, you're confident that they have the ability to
I am fairly certain that's what the analysts do. That's what they look at 3 years out, not a week or two. And in a week and two, you'll see the managers just sell based on valuations.
They're armed with some new AI tools now as well, so maybe they can do it even better and even quicker. So that'll be great and witty.
With such conviction.
We've talked about de-dollarization and how that's either a theme or completely exaggerated or probably somewhere, some more nuanced picture in there. You are seeing some modest rise in hedging activity around that currency exposure. Tell us a little bit about that, what you're seeing and what you're not.
Sure. So this started again on our last year, right? We saw a 10% decline in dollar versus its major trading partners. And then because of some of the geopolitics news coming from the U.S. this year in January, all of January, every weekend, we saw some prominent pension funds actually come out and say that they are withdrawing from their allocations to the U.S. markets. But those are very few anecdotes.
With symbolism.
So I would say yes, but I would say broadly we're not seeing massive outflow outside, foreign investors pulling out of the U.S. In the equity space, it's still 68% of the global indices.
Is hedging the FX more important than it was?
Hedging the FX was actually, very helpful to clients because they could see their equity allocations go down, and then if there was a sell-off like now and dollar, benefits anytime there's a sell-off like that, their unhedged positions actually gave them better returns. But now equity investors are beginning to hedge again.
Okay, how to hedge, how to find some defence in a volatile environment for the markets more broadly. Thank you very much indeed for the analysis, particularly with the lens on what's happening in the tech space. Anne Bahaguna, Global Co-Chief Investment Officer at Northern Trust Asset Management. Coming up, for how many, this is a tough one, for how many years has Minal Bathwal, a macro hedge fund manager at Brevin Howard, been on a winning run? The answer when we come back. This is Bloomberg.
would say that there's maybe a little bit of a bubble in AI. When you have companies with market caps of $5 trillion, you don't see any bubble there at all?
Whenever we have an acceleration in technology and people get excited about it, you have significant capital formation around new companies that are trying to capitalize on that opportunity. And, you know, we've seen this before through history, and you're seeing it now. It won't be a straight line. The opportunity set with AI is enormous. There will be winners and losers. And it's hard to pick the winners and losers now. And certainly a lot of the capital that's being deployed will not produce adequate returns, and a bunch of the capital that's being deployed will actually not produce any returns. But it's hard, it's hard to call the timing on these things. And the thing I'd point to just from a historical lens is in the fall of 1996, Alan Greenspan talked about irrational exuberance in stock markets, and the NASDAQ was at 1,300. And the NASDAQ peaked 3.5 years later at over 5,000. So, these things can go on for a long time, but ultimately, there are adjustments, there will be drawdowns, there'll be rebalancing, and just, it's hard to call it because the technology trend and the investment is real.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Bonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
Welcome back. Now, before the break, we asked, for how many years has Minal Bathwell, a macro hedge fund manager at Brevan Howard, been on a winning run? It's quite the winning streak, in fact, because the answer is 18 years. Bathwell has quietly become one of the world's most successful macro hedge fund managers and hasn't had a single down year since he started managing money during the 2008 financial crisis. The fund manager's winning run has secured him a place among the 5 biggest generators of investment profits in the history of Bevan Howard, a $35 billion hedge fund giant. Not a bad streak. Anna.
Some big numbers. Let's talk about what lies ahead for the weekend, and that's politics in Japan. Japanese voters go to the polls on Sunday for a lower house election that's a high-stakes gamble for Prime Minister Sanae Takaichi. She's seeking to shore up her coalition's majority in a vote set to have wide-ranging implications.
Just 3 months into the job, Prime Minister Sanae Takaichi dissolved Japan's lower house, calling a fresh vote for February 8th. Coming from a string of election setbacks for the ruling Liberal Democratic Party, Takaichi is aiming to capitalize on high public support and increase her majority in the more powerful lower house. Some recent polls show an approval rating of more than 60%.
I think Takaichi is really in an extremely enviable position. I mean, her support rates have been consistently extremely high, and I think that's going to do quite a lot for her in this election.
A stronger mandate would make it easier for Takaichi to push through her agenda, including higher defense spending and the largest supplemental budget since the pandemic. But the road to victory might not be straightforward. The LDP's alliance with Komeito fractured last year, ending a 26-year political partnership. The realignment injects new uncertainty into Japan's electoral dynamics. Voters, though, are more focused on the cost of living. Inflation has stayed above the Bank of Japan's 2% target for more than 3 years. The stakes are high. An increased majority would give Takaichi a green light to pursue what supporters call a more assertive Japan, with higher defense spending and state-led investment. But a loss of seats would be a self-inflicted wound for the new prime minister, who has said she would step down as party leader if that happens. Ariel Buzetto, Bloomberg, Tokyo.
What does it mean for Japanese equities? What does it mean for the BOJ? What does it mean for the yen? All critical factors as we work our way through this weekend. Joining us now, Bloomberg M-Live's Adam Linton. What's the market set up for when it comes to Japan and this election?
I think ultimately, given the polling, I think the consensus now is that she will ultimately expand to a slim majority. And I think, for dollar-yen, I think what's been interesting is that we saw those rate checks a couple of weeks ago, and that knocked dollar-yen sharply lower. And at that point, I'm of the view that that would have been the time to do intervention, because you could have easily sent dollar-yen into the 140s at some point. However, though, markets have kind of been cynical as to whether they actually follow through for the intervention, since Scott Bessent relatively cool on the prospect of joint intervention, and we've kind of risen 4 handles. So, there's a worse entry point for Japanese officials to intervene than they had done. And if, we do get another rate check after the election, if the yen does really start to sell off, I think the market's going to be a lot more cynical as to whether they'll actually follow through an intervention. And also as well, they'll probably need a softer dollar in order to get the maximum bang for their buck. But, that opportunity does look as if it has potentially faded a bit, and they're leaving themselves a bit of a hostage to fortune. We're still awaiting US CPI data. If that comes in soft, yes, it could be back on the table. But, it's not a favourable setup for those who are looking to be short dollar-yen at the moment.
If we do get softer dollar, we can get a stronger euro. And euro strength has been there, and we've seen that be impacted the corporates, certainly in 2025. Christine Lagarde didn't seem to be too concerned about the strength of the euro yesterday. What stood out to you? How clear is the path ahead for the eurozone, for the ECB, and whether or not there is going to have to be an FX take at least, or maybe some kind of verbal jawboning of the single currency?
Yeah, she was definitely a lot less, cool on the idea than she could have been, because obviously, we were hit with like 120 last week, and that's, that's kind of a line in the sand that ECB officials have drawn because of those comments from Louis de Guindos last year. But we've pulled back about, 2 handles since then, so there wasn't really that urgency for her to kind of say too much. But ultimately, euro-dollar, it's decoupled from rate differentials, and even if they cut, there isn't really too much they can really do about it. But I would say as well, euro-dollar, it's a relatively crude way to assess the strength of a currency. Yeah. On the ECB website, they cover the nominal effective exchange rate, and that's not really showing anything that remarkable at the moment. So I don't think there's really much urgency at these levels for policymakers to step in.
Very briefly on the gilt markets, how much risk premium is priced in with the politics?
I think it's increasing yesterday. Today, I think we have kind of stabilised a bit. I think betting markets are positioning for Starmer to leave at some point, but there hasn't really been any follow through from some of the stories that we've seen early in the week. So I think that premium has receded, but I think ultimately we're headed for a steeper curve. We've had Danish Bank of England and politics risks.
Anna Linton, thank you very much indeed. Bloomberg M Live, of course. Here's what else to think about for this weekend then. Tuning in for the Winter Olympics. Do you watch the Winter Olympics or the rugby? Because the rugby,
it's a big weekend coming up. Fantastic.
Guy Johnson's a massive. I don't know if anyone missed
Guy Johnson's been getting messages. How can you avoid?
It was on the television last night downstairs, and I'm like, I've got to go to bed. I saw Dupont. He was looking pretty good. I'm a bit nervous. Anyway, there's Milan. We're waiting for the start of the Winter Olympics. It's the Super Bowl.
Is that the main stadium?
Yeah.
Big sporting event going on somewhere in America as well, I hear. Is it sport? Is it entertainment? Is it an advertising event? It seems to be all of those things. And a gaming
at the same
event,
time.
Increasingly.
And the halftime, apparently, the
halftime show is going to be amazing. You always want to watch that. The ads are always amazing as well.
We'll be asleep then, probably. But yes, we'll...
Stellantis, before we go.
Stellantis is down really hard. But what is interesting about Stellantis is that it's down nearly 20%, but it's dropping the same number of points as SAP and Roche, basically. Yeah. That's amazing. They're only down kind of circa 1%. Tells you something about the European auto industry. Anyway, Pulse is up next. Have a fantastic weekend, everybody. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Amazon's plan for $200 billion in capex this year spooks investors in a week when big tech announced spending plans without parallel this century. Bitcoin bounces after its biggest one-day drop in more than 3 years. It's now down around 50% since its all-time high in October. Plus, talks between the U.S. and Iran get underway in Oman, but Tehran warns it will be the start of a very long process. So it has been quite a week in the markets. Let's get straight to it. If you look at U.S. stocks, they seem to be poised to extend their worst sell-off in months. There are fears over the disruptive impact of artificial intelligence, and that seems to be staying left, right, and center. Again, it's a little bit different to some of the previous pullbacks because this was not a story about valuation. It's really about how some of these companies will change when AI is more introduced. Amazon slumping after announcing plans to spend $200 billion this year on building out AI infrastructure. Again, it's a pretty sharp increase from what we knew before, and all of this is also playing out in European markets. Now, the other big story is, of course, we'll speak to Anna Herrera talking about Bitcoin. When you look at, for example, the CAC 40, but the FTSE, they have seen quite a lot of turmoil in the last couple of weeks. Today, they're down between 0.3 and 0.6%. So we're, of course, on Amazon watch. Amazon tumbling pre-market trading after announcing plans to spend $200 billion this year. So let's look at Amazon to see exactly what it's doing in today's trading session. This is pre-market down 9.4%. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, it's been a pretty bruising week for tech with a $1 trillion software sell-off, a sharp fall in big tech despite solid revenue growth. Now, huge capex spending has also been a big concern, and this week's spending announcements have done nothing to allay those fears. Now, this week alone, 4 of the biggest U.S. tech companies announced combined spending plans for the year of around $650 billion. Now, $200 billion of that alone is Amazon. So we're now joined by Matt Bloxham, technology analyst at Bloomberg Intelligence. Matt, thank you so much for joining us. I mean, it's been quite a week, but actually it's been a week also because it's business models, right? So you look at all the industries and the companies, and suddenly you have these AI models going after some of the legal companies. So where does it end? Are we going to see like industry by industry fall as AI gets rolled out?
Yeah, I don't think there is an ending, to be honest. It's a kind of evolution. I think this is like an overwhelming time for investors. The pace of change and the complexity of the change that's being fueled by technology, and particularly AI, is incredible. And I think, you know, when we look at previous cycles, certainly my experience as an analyst, some particular event comes along, it causes a bit of a disruption, but you have time as an analyst and investors to kind of think about it, process it, figure out what's really going to happen. I think the frequency of changes and the significance of them is unprecedented, and it's kind of really creating this kind of, you know, risk-off moment. You know, I think perhaps it was almost inevitable that Amazon put out a $200 billion capex number, given what we had seen from Alphabet and others. I think there is some flex in those numbers. And I think, you know, there is clearly a lot for these companies to prove in terms of whether this level of investment is justified and whether they can really make the return on investment that they need to justify. I think there is a stronger sense that, you know, we've kind of gone a bit too far, and they really don't have much of a choice. You know, if one goes big on capex, you have to follow, because if you don't, you're essentially kind of giving up on future market opportunity. But we've seen this cycle before, and when you get into these cycles, you know, when you look in hindsight, quite often companies did spend too much, but you know, they didn't have another choice, and so there's some forgiveness there, but it affects the multiples.
Matt, I mean, the other thing is that, you know, Anthropic basically pushed into legal services. Now, anyone who is close to the legal profession kind of saw it coming, right? We knew that it was going to be disrupted, but the market tanks, and now they're trying to do the same for financial analysts. Again, what are they rolling out next?
We'll have to see, but you know, I think the kind of optionality on what they've kind of produced is kind of fairly limitless, because it's kind of quite a kind of generic set of capabilities which can then be tailored to different industries. But you know, they have done a very specific investment and training and focus around anything to do with both the financial service industry, but also the kind of financial analysis discipline. So that's not just for analysts and investors; that's for accountants. In corporates with kind of complex number crunching to do. It's a big opportunity. They'd be much more focused on the enterprise opportunity than, say, ChatGPT or OpenAI or Google. I think that's paying dividends for them. They've got 300,000 enterprise customers. The feedback on the product is incredibly good. Even Microsoft has integrated the Claude assistant into Excel alongside Copilot, and I think it's the Claude assistant that's more popular and effective than the Copilot.
So interesting. Matt, thank you so much. Matt Bloxham, a very busy man this week at Bloomberg Intelligence, senior analyst. Now, this week has seen huge levels of market volatility with some of Wall Street's favorite trades. Again, tech stocks, gold, and cryptocurrencies collapsing. For a good conversation on the market moves ahead, we're joined by Isabel Mateos-Hilago, Group Chief Economist at BNP Paribas, and Luis Costa, Global Head of Emerging Market Strategy at Citi. So thank you both for joining us. Isabel, I know you're also a big thinker on some of this research AI. I mean, as an economy, we spoke to Governor Bailey yesterday. I mean, he didn't really have the template of actually what this means, but we're seeing it playing out in the markets. So how much of a disruption do you think we'll see in the short term?
Well, it's a huge disruption, but as you say, nobody has the roadmap of exactly how it's going to pan out. One thing that's very clear is that, you know, 99% of the time, people think of it as a weakness that households in Europe have much less exposure to the stock market. Well, at a time like this, you're thinking actually this means that the European economy is much more insulated from any blowback from this large market correction that we're seeing in the US. Whereas in the US, if this continues for long, you're going to start, you know, having questions raised about the wealth effect that has driven growth so powerfully last year. Does it go into reverse? But beyond that, I think what's very interesting, and it's been the process in pretty much every technological innovation. At first, there's a broad-based enthusiasm, there's only winners, and now we're into the phase where people start to realize, okay, there are going to be winners and there are going to be losers. And the net effect of that, we're going to figure it out as we go along.
But it does feel like they then bounce back, and we've seen that also in, you know, you have a sell-off, there's a bit of panic, but then after 2-3 days, we're just washed with so much cash that everything kind of goes goes back to levels that we see 4 or 5 weeks ago.
Absolutely. We are kind of, in this struggle between the cyclicality and the externalities, right? The extraordinary factors. I mean, we are in this problem, which is not necessarily a problem, at this stage of the AI cycle, which is a stage that we are going to have a lot more scrutiny into how they are funding the capex. We are already looking at the cumulative capex as a percentage of GDP. We are comparing to other bubbles in time, the housing bubbles from the 90s in the US, the telco bubble. I mean, we're comparing, and the numbers are significant. And considering especially that we are kind of, it's early innings in the AI cycle. This can go up far longer, right? So I think that's a problem. But then we have the cyclicality. The cyclicality is actually positive. The U.S. is resurging. Europe is on a much better footing in terms of growth, right? You've got better stability in emerging market currencies. There's growth coming out of emerging markets, and we're actually having, upgrading growth estimates, out of many parts of EM. So, and the carry is still in the system, right? So essentially...
But, Louis, no one talks about debt. This is why, we're so focused on some of the, the short-term concern that actually there's a huge debt problem at some time. When this comes to roost, what happens to some?
Well, and it goes back to my point in terms of the stage we are in this cycle here. We are looking at not only the capex, the 600 billion, right, as a percentage of GDP, and what that means to the sector in terms of revenues, but how they are funding that. And we are seeing that many AI-related names are actually funding via bond offerings. So the bond offerings are getting larger, right? The equity offerings are getting larger. So that's the start. It's not necessarily funded by cash anymore. And I think that's why this is triggering a lot more scrutiny from investors. And it's right. So that's the right moment here. So it's going to be more volatile. Is it a bubble burst moment? We don't think so.
Yeah, but the impact, what's systemic actually in this AI spending or valuation is very difficult to know, because that would translate directly into the economies. And also, how do you view debt right now?
Yeah, so actually what was interesting of the two central bank meetings yesterday is that, these were two meetings happening in Europe. You had the Bank of England and the ECB, and both of them mentioned AI and the investment boom around that as one of the factors of optimism around the growth outlook, right? And that's
for productivity especially.
Well, for both. Certainly in the case of Europe, what you're seeing in the industrial production data is the construction boom around data centers. So, so far people have focused on it as a US story, but actually it's happening also in Europe and in the UK. And then there's the hope that it delivers productivity, but we don't know. And back to your debt point, and that's true both at the sovereign level and frankly at the company level. But if you can get that extra lift of productivity, which we don't know how quickly it will come, we don't know how big, but certainly in every previous technological revolution, it did happen, and that will help improve the debt dynamics, everything else equal. So I think there's lots of reasons to be optimistic, but are there going to be bumps on the road? Yeah, probably.
One of the things that actually Clara Lombardelli was asked in the press conference yesterday, which I think was a smart way of looking at it, is can you really explain the interest rate differential between Europe and the UK given the economies right now? Because it's quite a big gap.
It's a big gap, and people look at this from the Eurozone and look, and certainly from the standpoint of France, where there's been a lot of turmoil because of political uncertainty, and people look at that and see, that's the benefit of being in the Euro, because you get a lot more risk premium on the UK, because it's just a completely different political setup. It's true when you look just at the macro data, it's hard to explain the differential in interest rates.
Louise, emerging markets were really stellar last year. There was so much concern about tariffs and the fact that actually it was a lot of the emerging economies that would suffer. Is this thanks to dollar, or is it really some of the structural reforms also put in place?
I would say 70-75% dollar. That's why we are not bailing out of EM assets at the moment, definitely, for sure. But we do believe that the dollar story will tend to be a little bit more sticky, right, compared to the big dollar slides we had in Q3, for example, last year, right after Liberation Week, right? So I think that's the story now is going to be a little bit more stable in terms of dollar. And it goes back to my cyclicality comment, right? I mean, the U.S. is actually, you're actually seeing from the economic surprise index performance, U.S. continues to surprise to the upside, right? So you've got reasons, cyclical reasons to be more involved in U.S. assets. But then you have the extraordinary factors, which is volatility in Trump policy, geopolitics, right? I mean, there's so many extraordinary factors that we're actually becoming more common and more regular nowadays, right? But we continue to like, in emerging markets, there's growth. You've got real yield, so inflation is stable, and you've got very, sustainable real yields, and growth is back in the system.
Does the dollar weaken from here? I mean, it's actually incredible to think that it was exactly a week ago that we got the nomination of Kevin Warsh, and since it feels like 55 other news stories in terms of financial and central bank took the lead. So does that have an impact on, does he have to gain market credibility? What does that mean for dollar? And actually, could there be spillover effects?
That has consumed 75% of my time this week, talking to clients, following strategists and economists within Citi. And we do think that, there's so many question marks that I still believe that this is going to be a lot less hawkish, especially when it comes to balance sheet tightening, if compared to everything he's written in the past and all market expectations, given, of course, that we know what was he like as a Fed member. So, man, I think that the story is quite different. We are dealing with a U.S. administration which wants to engineer more growth. And that's the story. And then we're talking about volatility of economic policy out of the U.S., capping the dollar bid, so that has actually capped any resurgence on the dollar. And I think that it's not that the White House loves the weaker dollar. The White House loves to engineer growth now, and that's the political story ahead of midterm elections. And so we do have dollar implications of that, and the dollar implications are actually good for them. So I think that it's very complex, and we continue to believe that obviously many question marks in terms of and it's not only Mr. Walsh, but how his ideas are going to be bought by the rest of the board, right? I think so. You've got quite a few interesting questions here.
Yeah, and Isabel, it's quite difficult to see. President Trump said that basically Kevin Warsh promised him not to hike. That's one. Unclear whether there's a promise of maybe to cut sooner than the rest of the committee is ready. But how's this playing out in the economy?
So I would say first interesting point. I think this week is the first market sell-off event where you actually saw the dollar rally, which we used to be the standard pattern, but
back
somehow
to normal.
back to normal. So maybe that's thanks to Kevin Warsh. I don't know. Look, when it comes to the impact of Kevin Warsh on the economy, well, first of all, we shouldn't get ahead of our skis. He's not going to take over until mid-May. But look, this is somebody who's been thinking about the Fed in a very institutional way. He wants regime change. He thinks about the Fed as part of the economic policy-making machinery. He's not going to do silly things in his first 6 months in office, which ruin his credibility. He's got a 4-year mandate, and the kind of things he's been talking about, like shrinking the balance sheet very meaningfully, it's not going to happen overnight. It's not going to happen this year. So that's the first point. The second point is, when it comes to monetary policy, indeed, it's a committee decision, and if the economy, the U.S. economy, remains as strong as it seemed to be in the last quarter or so, there isn't really going to be much of a case to cut interest rate. And I think, frankly, the last thing either he or even, frankly, President Trump would want is accelerating inflation into the midterms. Whereas if the Fed can deliver a credible message in Kevin Warsh through his thinking and advocacy for a smaller balance sheet, can signal to markets that we can have a more disciplined fiscal policy and get long-term rates to come down and the risk premium, the term premium to come down, then it's a win for President Trump, because households are going to be, mortgage rates are going to come down. So there are things he can do that don't involve cutting the policy rate, and that will still leave the Fed in a good place and the U.S. economy in a good place.
I guess it's about, there's an assumption that maybe we're importing a bit deflation from China. That could help if we see a bump up with tariffs, but also the big question mark about oil, right? Because we're looking at something happening possibly big in Iran. Frankly, it's unclear. We get mixed messages. But how, what are the fault lines actually for the U.S. economy? Because there are so many shocks and unknowns.
So look, the big fault line for me is the narrowness of the growth engine. It's been so much powered by, number one, investment in this AI build-up, which we now see the market seems to want to punish. So if that slows down, that it could be a problem. Number two, it's been consumption by the wealthier households driven by wealth effect. So again, you get a big lasting stock market correction. These two growth engines are gonna falter, and then all of a sudden the growth story is gone. Now, still the Fed has plenty of room to cut. President Trump has been talking about sending checks to all Americans. So I'm not sure that there's really much fiscal space, but there are levers that can be actioned. But for me, the narrowness of this growth is the main vulnerability.
Louis, very quickly, your favorite play on emerging markets?
We still love some of the currencies out there because of interest rates, because, the effect of these interest rates on the inflationary scenario. So we do like BRL, Brazil. We do like South Africa, given the metal and mining bias. We don't believe this metal and mining bias in EM is done now. In Asia, we do like Korea and Taiwan versus Thai bahts. I mean, this is a very interesting capacity to potentially sell dollars if the dollar continues to stay well behaved is immense.
Thank you both for joining us. What a great panel to get us started this Friday after quite a busy week. Isabel Mateos-Hilago, Group Chief Economist at BNP Paribas, and Louis Costa, Global Head of Emerging Market Strategy at Citi. Now, coming up, Bitcoin bounces higher as traders buy the dip, following a brutal rout for the cryptocurrency. We'll have plenty more on Bitcoin's wild week. That's next, and this is Bloomberg.
Up-to-the-minute global news whenever and wherever it happens. I'm Hazlida Amin in Davos, Switzerland, and this is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Earnings season is here.
Europe's most valuable companies kick off earnings season.
Bloomberg is first to break the numbers.
Some breaking news from First Abu Dhabi Bank.
So Shell, SAP, Total's in the mix there.
You're bringing all the fun today, Guy Johnson.
With the smartest insights.
How are you feeling going into earnings season?
We are still confident that we can deliver to that acceleration of total revenue growth.
Give me a sense of what you're most optimistic about.
I really expect a very strong Q4.
Continuing coverage on Bloomberg.
The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Japanese voters go to the polls on Sunday for a lower house election. That's a gamble for the Prime Minister, Sanae Takaishi. Now, she's seeking to shore up her coalition's majority in a vote set to have wide-ranging implications for markets and regional security. Here's what's at stake.
国民の皆様、私は本日内閣総理大臣として
Just 3 months into the job, Prime Minister Sanai Takaichi dissolved Japan's lower house, calling a fresh vote for February 8th. Coming from a string of election setbacks for the ruling Liberal Democratic Party, Takaichi is aiming to capitalize on high public support and increase her majority in the more powerful lower house. Some recent polls show an approval rating of more than 60%.
I think Takaichi is really in an extremely enviable position. I mean, her support rates have been consistently extremely high, and I think that's going to do quite a lot for her in this election.
A stronger mandate would make it easier for Takaichi to push through her agenda, including higher defense spending and the largest supplemental budget since the pandemic. But the road to victory might not be straightforward. The LDP's alliance with Komeito fractured last year, ending a 26-year political partnership. The realignment injects new uncertainty into Japan's electoral dynamics. Voters, though, are more focused on the cost of living. Inflation has stayed above the Bank of Japan's 2% target for more than 3 years, while wages lag and a weak yen pushes up import cost, giving a sense of falling living standards. To ease the pressure, Takaichi pledged to suspend the 8% sales tax on food for 2 years.
Maybe it's because of the weather, but the price of vegetables, some are just shocking, aren't they? Even things like snacks and chocolate, their prices haven't doubled yet, but they've suddenly gone up quite a bit. Same with rice.
I wish they stopped just talking about tax cuts or eliminating the consumption tax during the election season and actually put realistic measures into practice.
The stakes are high. An increased majority would give Takaichi a green light to pursue what supporters call a more assertive Japan, with higher defense spending and state-led investment. But a loss of seats would be a self-inflicted wound for the new prime minister, who has said she would step down as party leader if that happens. Even before ballots are cast, markets are reacting. The yen has wavered and the government bond yields have risen, reflecting investor unease over Japan's fiscal path.
Since October of last year, we have taken a very responsible approach to public finance, talking about responsible, sustainable, and proactive fiscal policies. We are not talking about expansionary fiscal policies, and this is demonstrated by some of the numbers that we see. So I asked the market participants to calm down.
Japanese stocks have already outperformed many of their peers as investors focus on the so-called Takaichi trade. Ariel Buzetto, Bloomberg, Tokyo.
Now, Bitcoin bouncing around $65,000, having halved in value from the all-time high in October. For more, we're joined by our senior editor for digital currencies, Ana Herrera. Ana, you have all the reasons of why this is happening. It's just really hard to understand why this is going on. Why have they been selling off?
So, we've been through this before a lot. Normally, with prior crashes, we had like really negative headlines or an exchange collapsing. In this case, that's not happening. It seems like crypto is behaving more like any other risk asset, which is very much against the narratives we've been told before. So it was a hedge against inflation, it was digital gold. In reality, it's kind of trading along, the risky stocks. So we had a very big sell down yesterday, and part of the reason why it sells off so quickly is we have leverage positions liquidating automatically on crypto exchanges. So the faster the prices drop, the faster they keep dropping. So again, the swings are always very, very volatile, and it's hard to figure out exactly pinpoint why this time.
So it means it could go either way, right?
Yeah, we're seeing it's up again.
Yeah, so that's the concern when you don't really have an underlying reason. It's also very difficult to predict. Ana, as always, thank you so much for joining us. Ana Herrera, Bloomberg senior editor for digital currencies. Coming up, Iran warns of no quick resolution as talks with the U.S. get underway. We'll have full details next, and this is Bloomberg.
have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you're good at your job, bro. Like, it's just actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Amazon's plan for $200 billion in CapEx this year spooks investors in a week when big tech announced spending plans without parallel this century. Bitcoin bounces after its biggest one-day drop in more than 3 years. It's now down 50% since its all-time high in October. Plus, nuclear talks between the U.S. and Iran take place in Oman, but Tehran warns it will be the start of a long process. Now, Iran hinted there won't be a quick resolution to escalating tensions with the U.S., and today's negotiations could be the first stage of a longer diplomatic process. Now, the two sides have been meeting in Oman today. It comes hours after the U.S. virtual embassy in Iran issued a security alert urging American citizens to leave Iran now and not rely on the U.S. government's help to do so. Well, Stuart Livingston-Wallace, Bloomberg's head of Middle East and North Africa, joins us now. Stuart, so good to speak to you. So bring us, first of all, up to date with developments that we've seen and expectations of these talks.
So we've seen, a reasonable amount of activity on the ground. We're not quite sure what's going on, but the talks started roughly about an hour and a half ago. There are early indications that at least some of the convoys may have left, but we're not sure who's in the convoys. So it's very hard to tell what's going on. What we do know is that the Iranian foreign minister is there on one side, and you have Witkoff and Kushner on the other, with that information coming from Iranian state TV. So as you say, it's the beginning of potentially a long diplomatic process. There seems to be a lot of division about what the talk should be about, or indeed what the results might look like.
So what are likely to be sticking points, and is a U.S. strike against Iran still likely?
So in terms of the sticking points, number one is the nuclear file. And really the question there is, what exactly do we mean by the nuclear file? So we're talking about the right to enrich uranium, which Iran insists that it has an absolute right to because it's a signatory to the Non-Proliferation Treaty. Are we talking about the highly enriched uranium stockpile that, certainly a lot of people think has the potential to be eventually weaponized, although Iran says and has always said clearly that it has no intention of developing nuclear weapons. And then thirdly, the question is, nuclear weapons themselves. And then you move on to the issue of ballistic missiles, which again is a very fraught topic. And finally, Iran's support for its proxies around the region, that is sort of, the likes of Hezbollah, Hamas, the Houthis, and so on. Now, Iran insists it really only wants to talk about the nuclear file. Marco Rubio said he wants to talk about all of that. All of that should be spoken about as one thing. And then, we'll see what happens going forward. So we really are at the very early stages. But again, if you look at the markets clearly are still quite nervous. We're up something like 1.5% on Brent, which is a pretty good proxy of market sentiment. But if you look at the volatility The 10-day volatility is basically at the highest that it's been since June. Now, June is a critical date because that was the last time we had this 12-day war with Iran. And so clearly there's a great deal of nervousness going into this. Whether strikes are likely, I point you to the research that came out from our own economists and analysts this morning that says, yes, it probably is. And similarly, Eurasia Group brought out a report that said, yes, it probably is still quite likely. But again, early days, we'll see what happens.
Stuart, thanks so much. Stuart Livingston Wallace there, Bloomberg's head of Middle East and North Africa. Now, whether those talks yield a solution, some might ask, what would satisfy President Trump? My next guest says Trump is a predictable negotiator, but his competitive approach can often limit conversation. Well, joining us now is Lindsay Newman, visiting research fellow at King's College London. So thank you, Professor, for joining us. First of all, I'd like to really try and start there. What do we know the U.S. administration want from Iran today?
Thank you, Francina, and thank you for having me on. What we know is that this administration is not your first Trump administration. The second Trump administration is much more activist, much more active, and much more ambitious. We've seen this throughout all of 2025 and, of course, at the start of 2026. We've been talking about Venezuela, we've moved on to Greenland, and now we're back on Iran. And what the U.S. administration is looking to see here is a quick result. They've made clear that although the Iranian delegation says that they are acting in good faith, but they will remain firm, the U.S. is not looking for sort of the beginning of a pathway of a conversation for a conversation. The U.S. is looking to deploy a range of tools all at the same time. So they have opened the diplomatic track, which is the first time, as we know, bilateral conversations have happened between the two sides since last June's, just before last June's Operation Midnight Hammer event. And simultaneously with the diplomatic track, they're also pursuing economic security levers like tariffs and sanctions, and this big question mark around the use of force and force posturing. As over the last couple of weeks, the U.S. has redeployed a massive amount of kit to the region.
Lindsay, what do you think happens next? It's frankly, on both sides, and it's unclear. There's a lot of fluctuation, whether they're still talking, whether this will, those negotiations will be shortened. But actually, everyone's downplayed expectations from these talks. So what happens next?
Yeah, Francine, that is the big question. What happens next, and what is perhaps the fallout from what happens next? We know that the U.S. administration, as I said, is deploying multiple tracks at the same time. And if any one of these tracks, so if talks do not reach some sort of clear outcome, it will start to apply pressure through these other tracks. It's already applied tariffs and sanctions on Iran over the last couple of weeks. So that really does zero in on this question of military action. As I said, there's a strike force in the area. There's Patriot missiles, air defense systems. We hear this warning for U.S. personnel in the country. And there is, as you said, pointed out, there's a lot of noise. There's so much noise happening right now in the region. The baseline scenario has to be that these talks will be unlikely to reach some sort of significant outcome, and that will then turn all eyes to the use of force. We have to think that the most recent precedent is the most relevant precedent, so that is Midnight Operation Hammer. The president came into office saying that he would be the unifier and peacemaker. He knows that the U.S. public do not want to see the U.S. engaged in another entrenched conflict anywhere in the world. Polling suggests that very few Americans are really quite supportive of the idea of using force against Iran to support the protests or even related to nuclear capabilities. So the U.S. appetite from the U.S. population perspective is low. So the president and his administration will be very careful and will be looking to conduct anything they look to conduct will be directed and surgical. He does not want to have U.S. boots on the ground there.
But, Lindsay, one of the things that we've been trying to figure out is what will China's response be? So I don't know whether China, there's no good time to do something in Taiwan, but are they thinking that actually in all of this turmoil now could be good? Would they take offense if the U.S. were to strike in Iran, or would they publicly say they're against it, but actually privately support it?
Well, we know that China has said, what they have said is that they hope that these talks today lead to a pathway for de-escalation. Indeed, for the region itself and for most major actors around the world, de-escalation is what would be the best outcome. So that, of course, is quite sensitive and quite sensible. China has not indicated any change in view around its own regional ambitions. And that is, of course, something that they have been clear about, but also is a long-standing ambition. So nothing really sort of new in the moment on that.
Do you know, Lindsay, what is the rest of the region thinking? If you look at Qatar, Turkey, there's a kind of task force also to help with Iran, but what role would they play in case there was a U.S. strike?
Yeah, we know it's very clear that the region has been urging restraint. Part of the reason that the talks were moved from Turkey originally to Oman is so that they could be more bilateral and directed rather than having multiple voices in the room. But even still, the voices in the region have been quite clear that the hope is that this will lead to a de-escalatory path. Even Israel itself reportedly weeks ago urged Trump to deploy caution when the height of the protests were underway in Iran. But again, the most likely scenario here is that these talks will not reach some sort of very concrete, tangible outcome, and the likely military operation would be directed, focused, and surgical against perhaps nuclear sites, ballistic missile sites. It doesn't mean that Iran will not seek to retaliate in response, but both sides are likely looking to avoid a regionalized escalating conflict, even though we've heard rhetoric that suggests otherwise.
Lindsay, I mean, look, we're February 6th, and it's been quite a start to the year. It started with Venezuela, then you had Greenland. I mean, do we have a better understanding of what the Trump administration's foreign policy is? You know, Venezuela, they were largely left to do what they wanted because it was kind of assumed that it was in their own backyard. But are we going to see more intervening in other parts of the world much further afield?
Yeah, Francine, I have never been of the view that this is just about the Western Hemisphere. I'm an outlier. I'm happy to be in the outlying camp on this. The Trump administration's ambitions are far-reaching, and they are wide. And the Trump doctrine, if you want to call it the Don Roe doctrine, is really about pulling all levers and walking with heavy steps. That means deploying force. That means opening diplomatic conversations where necessary, and also employing economic security tools like sanctions, tariffs, export controls. It's sort of naive to think otherwise when we see strikes on Nigeria, some Yemen, Syria, the extraction of Maduro in Venezuela, as you said, and then, of course, all the rhetoric around Greenland. Everybody needs to be prepared and aware of the ambitions of this administration. And so the foreign policy approach was laid out on day one with an America First approach that isn't the same isolationist story as it once was. This is about pursuing U.S. national security, U.S. interests globally as defined by this administration.
Lindsay, as always, thank you so much for joining us. Lindsay Newman, they're a visiting research fellow at King's College London. Some great analysis on some of the complicated dynamics that we're seeing. Now, the Bank of England governor has appeared to endorse markets betting on a 50% chance of a rate cut in March. It comes after the central bank held its benchmark rate at 3.75% in a surprise split vote. Well, I spoke with Andrew Bailey following yesterday's interest rate decision.
You may have seen it in my submission of my paragraph in the minutes. I said that I will be, I said that I think there is, a prospect of, some further cut in interest rates. And I said, I think in my last sentence, I said I'll go into each meeting asking myself that question. So, look, I think, going into March 50-50 is not a bad place to be in that sense, because in a sense markets are asking themselves the same question that I'm asking, or perhaps they're just working out what question I'm asking and, in a sense, following that. But yeah, I think that's a reasonable question to ask, because look, we've had good news. We think inflation is now going to come down to target sooner than we thought it would. I think this spring sometime. But the real question now is it going to sustain? Is it going to be sustained there? Because that's our job. And that's all to do with underlying inflation. And that's where I certainly think that we do need, we need some more evidence base to mount that. But that's the question we'll be asking ourselves.
Why have you dropped the word gradual from your formal guidance? It had been there for quite some time.
Well, I think for a couple of reasons. One, because we've made a lot of progress. And the second one, which is closely related, actually, there does come a point, if we don't get any more shocks in the world economy, that's a big if, but we don't. These are the things we don't know about, so we can't, in a sense, factor the things we don't know about in. So let's assume that's what the forecast is, we've published is really based on. Then I think we are now getting towards what I might call that neutral level of interest rates, where it will sustain inflation. It's the rate that will sustain inflation at the target. We don't know it. We don't know exactly where that is because it's a good concept, hard to translate into any precise practice.
But are we close?
Well, in a sense, we must be getting closer, but I think we are closer. So, I think the change of language is really to change the language a bit to this language we've used a few times about, it's a closer call at this point.
When you look at the shocks, I mean, you said today that the global economy has just been pretty good at weathering some of the shocks.
Yes.
But is it that we could see less shocks, or is that we're just much more adaptable?
We never know what shocks we're going to see by definition, almost. No, look, I think it is interesting that the world economy has been more resilient to all the uncertainty we've had over the last year than I think if we go back to the conversation we were having this time last year, actually, when we were doing this report this time last year. Our concerns about how the world economy was going to be affected by the news that at that point was beginning to build up, it has certainly turned out to be more resilient.
The Bank of England Governor Andrew Bailey speaking with me yesterday. Now, the stakes are high for Thailand as voters head to the polls on Sunday for a snap general election. The country's economic heft in Southeast Asia has slipped, and the vote risks putting Bangkok back on a path towards political crisis. It's the subject of the weekly documentary by Bloomberg Originals, and here's a sneak peek.
When I think of Thailand, I think of a place where modernity exists alongside tradition. But behind that postcard image of a paradise is another reality. Instability, volatility, uncertainty.
And in recent years, economic lethargy.
There's not a lot of innovation in the economy. Thailand's GDP growth has been about 2% for a while now, while neighboring countries or peer economies are growing rapidly.
Foreign investors have taken note. Or more specifically, they've taken their money.
Thailand looking to cut rates as growth falters.
No catalyst for a reversal of Thailand's fortunes.
That word, fortunes, isn't relatable to almost anyone outside Thailand's entrenched elite. According to the World Bank, Thailand has the highest level of income inequality among Asia-Pacific countries.
What's at stake is Thailand risks getting left behind in one of the world's fastest growing regions.
So we're asking, what went wrong? And can anything be done to turn things around?
Now, coming up, software stocks take a hammering. We discuss the latest AI disruption and what it means for private credit. That's next, and this is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Welcome back, everyone. Now, software stocks were at the epicenter of hundreds of billions of dollars that were wiped from companies big and small across Silicon Valley this week, knocking the value of stocks, bonds, and loans. Now, has the selling been overdone, and are the shockwaves heading for private credit? Now, these are some of the big questions in the latest piece by Paul Davies, our banking and finance columnist for Bloomberg Opinion, and John Stepek, author of the newsletter Money Distilled. First of all, yeah, I mean, great pieces, and I think everyone should go back and read them. Of course, since we've had like 55 new events. Okay, so Anthropic, first of all, it's like, okay, they're going after, the legal firms, and now it's actually, financial analysts. How problematic is that for banks, full stop?
For banks, it's, well, I guess it's yet to be seen. I mean, I don't know exactly how good this tool is going to be or what it's going to look like. I mean, there's plenty of other things that AI companies and other tech companies have been trying to develop already to kind of challenge the amount of labor, I suppose, that you need within banks and so on and so forth. But we've yet to see, I suppose, a big impact of that is probably more seen in a lack of, in a lower level of hiring so far. But banks are very cognizant of how do you keep getting talent to come into the industry if you're going to replace a lot of that early work with machines instead.
John, what was actually the sell-off that we've seen? Because people kind of brush it off and saying, oh, we've seen this before, it's, AI. But this feels different because it's going to the heart of the business models of industries and companies.
Yeah, somebody came up with a really good term for it, the SaaS-pocalypse. So that's software as a service. So all these companies that kind of offer software as a service and kind of, do things with data, the situation is that Anthropic, the proximate cause of this sell-off was Anthropic releasing this tool that was going to basically compete with kind of legal services. But this decline's been going for a while. There's been about a year's worth. They sort of peaked in summer 2025, and software stocks have gradually been selling off since then. I think the idea is basically like when the internet came along and kind of upturned, news publishing, music, high street retail. The idea is now it's the turn of legal services, possibly even medical services, financial services. And I think that's what we're seeing. And I guess the interesting question is why this week has it suddenly happened as quickly as it has. And I think that is actually, there's probably more in the macro area that's helped with that.
Yeah, and Paul, you had a great story. I mean, I'm not going to lie. So I was covering UBS in Zurich, and so we were reading the story, and I was about to interview Armadi, and I was thinking like, wow, KKR got slammed last night. Same for a lot of the private equities. I mean, this was kind of unexpected by a lot of people, and you had this brilliant column, also explaining that because we don't really know what's underneath this private equity owners, that there was maybe a lot more anxiousness out there.
Yeah, and I think one of the issues is a lot of deals in the software space were done at peak valuations in and around and after the COVID pandemic, and then we had that sharp rise in interest rates afterwards,
And then a lot of the financing for those deals ended up being done by private credit because we went through that spell. If you remember, Twitter debt was the most famous part, but there was a whole lot of leveraged finance that banks got stuck with as rates suddenly shot up. They weren't being active in funding buyouts anymore. So you have this particular vintage of overvalued deals with very private credit concentrated financing behind it as well. And that's a bit of a worry for the future because it's just going to be probably a very bad vintage.
When do we know, John, when we've fallen far enough? And I guess, again, these were meant to be quality stocks, right? So you're also upending kind of market thoughts in general.
Well, I suppose the problem is these companies, now investors are worried that these companies don't have a moat anymore. And that's the thing that makes it a quality stock. And if your moat evaporates because, AI has come along and competed it away, then that means that, it's very hard to say, well, how far should it fall? At the same time, it strikes me that this has been very indiscriminate because, it's very hard to tell the winners kind of boom like this. And I guess markets are in a kind of shoot first, ask questions later mode. You look at what's happened to the financial stocks today because of the Anthropic news about them moving into financial services. It's like, okay, but this is slightly a panic reaction. But at the same time, catching falling knives is a good way to lose your fingers.
That's a very, very graphic way of putting it.
Yes, sorry, guys.
Paul, when you look at the risk of something being systemic, I mean, there's so much money being spent. I mean, I think we calculated like $600 billion, I think, in this week alone. I mean, is there something if valuations collapse for some reason? I mean, how much does it impact private equity and banks?
Well, I mean, we've yet to see how far this is going to go. I mean, I guess there's some real odds tensions here. On the one hand, people seem to be betting that AI eats all software, and on the other hand, they're also betting that AI spending is going too far, and it's a bubble, and it's going to burst, and it's going to be wasted, and so on. So these are kind of conflicting, and I think what John was getting at earlier is there is been a lot of factors kind of turning over as well, like momentum trades in stocks have just kind of collapsed very recently, and especially this week, and growth has collapsed. And there's a lot of people are just sort of rebalancing, all of their expectations about markets. And I think, and one of the things with software particularly is people have to think about how key is it to an organization. Is it something where a company is going to be very happy to let all of its staff just make up their own code all of the time? Is what they're doing auditable? There's a lot of kind of serious stuff that people have to consider here. But, this is we could be in a very messy day today. There's a lot of kind of selling that could continue to come through. And in terms of, banks, it's where it comes into, leveraged investors and, margin calls and all of that sort of stuff. And especially in the US with a lot of very leveraged retail investors, that's where we might see some real, issues.
I know, I agree. I think the deeper issue is there's a bit of a momentum unwind, because if you look across the market, you've got Bitcoin collapse, and you've got gold sliding, you've got silver collapse, and I think an awful lot of that is to do with the kind of surprise that Wash is going to be the guy that's running the Fed. And although Wash is presumably keen on lower interest rates, there's not the same sense that he's going to be, if you like, a puppet or an ultra-easy money Fed. And I think that's still feeding through the market, because if you look at the dollar, it's bounced quite strongly. Right. And yeah, the kind of dollar debasement trade kind of peaked about a week ago, and I think that's also helping with this momentum unwind.
I had the chief economist from BNP Paribas who was saying actually the dollar has behaved like it used to this week.
Yeah, exactly.
Right? So what does that tell us also about correlations?
Well, I guess it's kind of risk off. It's a risk off trade, the dollar. The dollar gets stronger, other assets tend to get weaker. I mean, obviously, that's a gross oversimplification, but that's basically how it works. And I think that what it comes down to is people get overexcited about the end of US exceptionalism, the dollar debasement trade in particular. That started getting questioned whenever Trump nominated Kevin Walsh. And I think a lot of that is what we're seeing now, the kind of heat going out of these momentum trades, and that includes gold, silver, and AI.
Paul, in 20 seconds, what are private equity firms going to do this weekend?
Well, anybody who's not done it already is going to go through their books incredibly carefully and look and see what they've got. But we had results yesterday from KKR and Ares and Blue Owl, and they were all very sanguine about they've gone through everything already. They know what's there. They've already been selling down. It's like, it's fine.
Yeah, probably not a relaxing weekend, but hopefully you've been through the books. Paul Davies from Bloomberg Opinion, John Stepek, who writes Bloomberg's Money Distilled newsletter. Up next, Bloomberg Brief, and this is Bloomberg.
world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the U.S. or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
It's 5 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Future is higher right now. The Nasdaq 100, though, set for the worst week since April. Bitcoin bouncing back to a certain extent. This as a busy week of big tech earnings shows massive spending plans for AI. The latest from Amazon vowing $200 billion of spending this year. And indirect talks between the U.S. and Iran. Omani officials say separate talks have been had with delegations from Washington and Tehran in the last few hours. So let's take a look at this market today. Futures firmly pointed higher after a miserable session yesterday. We were down 1.4% on the Nasdaq 100 as that tech sell-off just continued. CapEx spending plans, of course, playing into it. Lack of confidence in software companies that have been doing some of this for eons, right? Will they be able to continue offering services that their clients require, or will AI just take it over? And then, of course, you had that miserable challenger job cuts situation where we saw the most layoffs since the great financial crisis, playing into the mood. That said, we do seem to be a little more risk on today with futures pointed higher, particularly for Russell 2000 futures. Perhaps that rotation just continues. Let's take a look at bonds because we are seeing the curve lower across the board, but the steepness hasn't changed. So we're all the way down to 347 on the 2-year. We're still at 485 on the 30-year, although we're about 5-6 basis points lower than we were 24 hours ago. That 2s10 spread at about 71 basis points now, the widest in about 4 years. And let's take a look at some of those particular outliers. So we have silver, for example. It was down 20% overnight in Asia, but we're bouncing back today for silver. Bitcoin as well. It got down as far as almost $60,000 a coin. We're almost back at $65,000. And then we're keeping an eye on oil as well as we hear those talks now were indirect, with Oman appearing to be mediating as opposed to direct talks between Iran and the United States. All right, let's get to some individual stocks to watch. Over to London and Chloe Melly. Chloe.
Good morning, Bonnie. Amazon is firmly in the red this morning after much higher than expected forecast for CapEx. So this, of course, echoes what we had from Alphabet yesterday and really goes to show how concerned investors are getting about how much those big tech companies are spending on AI and whether or not that will actually start paying off. And we are down almost 8% for Amazon this morning. Moving on to Stellantis, and there for the car maker, shares are also in the red after saying it expects to take charges of about 22 billion euros. This is part of a business reset to move away from electric vehicles, and the charges came in higher than analysts had expected. And this now really puts pressure on the CEO to show that the big restructuring that is ongoing is actually starting to work. And finally, Doximity, the healthcare software company, is also in the red this morning, down almost 32%. It provided an outlook that was seen as disappointing. And this is also part of this broader sell-off in software stocks that we've been talking about all week as investors try and limit their exposure to companies that they think will be really disrupted by AI.
That is some drop for Doximity. Chloe, thank you so much. Chloe Melly there. And coming up this hour, we're going to catch up with Citi's Veronica Clark on the labour market. We're not getting the NFP today, though. We'll have to wait until next Wednesday for that. A delayed jobs report will be in focus. Let's get back to these crazy markets. Nasdaq futures back in the green after US stocks posted their worst week so far in months, while the yield curve flattens very slightly off its steepest in 4 years. Let's bring in Bloomberg's Morwenna Conium to join us now. So Morwenna, this sell-off that we've seen all week, it just was like a vicious cycle. Once we saw some selling, we saw even more selling. Was it mainly the retail trade that was getting out? And should we expect some kind of risk-on move again now that we're seeing futures positive?
Well, we really are seeing a rebound in futures this morning, and also in Bitcoin and some of those commodities as well. So the tide does really seem to have turned. Whether that can be sustained, there's some dip buying going on, a sense that perhaps the pile in to sell went too far. Maybe there's still some value there. And a lot of this really speaks to the paradox around the AI trade at the moment. We've seen the sell-off in some of those software developers this week because of concerns about AI disruption. That's sort of taken a chunk out of the AI trade in general. There's also concerns about companies spending too much. We've just seen Amazon's announcement this morning, which is weighing on its shares in the pre-market. But at the same time, dip buyers are feeling, well, maybe this is actually a bit of an overreaction. There is still a lot of growth potential there. And so we're seeing that sort of starting to flip back again. And then that also feeds into the sort of risk appetite as well. It's interesting, we're seeing the commodities splitting there. We're seeing precious metals pick up a bit after their slump, whereas copper futures are still pointing lower. That benefits a lot from the AI trade too. So I think really the sort of sense of whether things have gone too far or not far enough is really what the tension is there this morning.
Yeah, I mean, Morwenna, why are the enormous CapEx plans sending markets into a tailspin? Typically, spending in an economy should be good for the economy, right? It's creating innovation, it should be creating jobs, better productivity potentially.
Well, I think it's really a case of, CapEx is good if it actually provides growth and if it also matches the profit potential. I think there's some concern that perhaps companies are spending more than the revenue would merit, and that does lend them up to margin pressure, and it also, to the other side of the industry, this AI growth is also bad for some other stocks. There is that disruption, particularly with those innovations we've seen coming out of Anthropic this week. So I think that there's just concern, and perhaps that these valuations have got overinflated as well. The amount that people are spending, does it really match the potential that's there? So it's really a case of a reassessment as to what's merited and what is hype.
Yeah, it's really messy out there at the moment. At some point, I guess, clarity will prevail. This crisis of confidence in Bitcoin, though, does it preclude it now from ever being a good hedge again, or, a store of value, or a haven?
Well, I think certainly that narrative has been disrupted. We've had reports out about the losses, actually, that those investments have sustained over the last year. We have had really quite substantial slumps, the most since back in 2022, where this trade sort of unwound. So I don't think it's ever going to be seen necessarily as that sort of pure opportunity again, but it is a very valuable, part of the market. It does attract a lot of interest, particularly when risk appetite is up. There was that political sort of charge that we saw when the Trump administration came in, and perhaps that's being lost now. So it's difficult to say, obviously, where it will be seen from here, but certainly there has been a lot of volatility, and it is trading very much as a risk sort of asset market.
Morwenna, thank you so much for joining us this morning. That is Morwenna Conium. A closer look now at tech and Amazon's big spending plan for AI. Have a listen.
When I look at this, what's happening, it's kind of unbelievable if you look at the demand of what you're seeing already with AI, but the lion's share of that demand is still yet to come in the middle of that barbell, and that will come over time.
Joining us now is Tom McKenzie, host of Bloomberg Tech Europe. So this $200 billion, it feels like everybody's been trying to one-up each other by, $10 or $20 billion, right, Tom? Is this a necessary spend for Amazon?
Yeah, it certainly feels like that, doesn't it? I mean, if we go back to, for example, the conversation that Microsoft was saying in terms of their plans for, $105 billion of spend, and then it was Meta with $135 billion, then Alphabet with $185 billion, and then Amazon says, I'll raise you and do $200 billion US dollars in terms of CapEx. So yes, we had another moment, of course, when investors started to fret about the extent and the historical nature of this spend on data centers and infrastructure that's planned now by Amazon. Of course, their spending over 2025 came in well above the estimates as well. So this is a huge commitment from Amazon. I think if you were looking for green shoots or at least some solace, then you could look at AWS, which is a key driver of profits for the company. They saw a 24% jump. That's the highest jump in growth that we've seen in about 3 years for that key part of the cloud business for Amazon. The e-commerce business came through with a beat. Advertising came through with a beat as well. And they have a backlog. And talking of Andy Jassy's comments there, they have a backlog in terms of demand for the data center part and the AI piece of about $250 billion US dollars. But to the point you were saying, this is about a time frame. They're not quite clear when that time frame comes. They know the demand is there. And that is where the anxiety lies for investors. When does it all line up in terms of the spend on CapEx that kind of aligns with that revenue stream? And Jassy says they do have the demand. How it comes through is going to be key.
So this escalating build-out and, the huge amounts of money that you just mentioned for all of those mega techs that you just mentioned, are they all competing for the same business in the end, or could they all thrive post-spending?
I think that's a good question. I mean, it's going to become differentiated. You're seeing the large language models are starting to differentiate. There's OpenAI, which is focused on the consumer. There's an Anthropic that's been very successful in terms of the enterprise piece. And then Gemini of Alphabet, of course, which is catching up very much in the consumer space as well, with also the enterprise offering. In terms of what's happening in the overall CapEx spend, $650 billion US dollars now, if you combine those four big tech companies in terms of their commitments for 2026. And in historical terms, again, we have not seen anything like that this century. You can put all the automakers in the US together, you can put all the oil companies together, you can put the Walmarts together in terms of their spend and their plans for CapEx in 2026. It's just just 1/3 of that commitment just from four tech companies. We haven't seen this arguably since the 1990s and the telecoms boom and then ultimate bust as well, at least partly, or even you could go all the way back to the railroad build out in the US as well. So it's historic what is being committed by these companies, and now they have to prove they are going to be able to monetize that. And this coming at a time when Anthropic, for example, is coming through with new products and moving into other verticals because they are also under pressure to show that they can monetize as they lead up to what is expected to be an IPO later this year. It's all very exciting and terrifying as well, potentially. Tom, thank you so much. Bloomberg's Tom McKenzie. Now to other top stories trending on the terminal this morning. A Brevin Howard fund manager has quietly become one of the world's most successful macro hedge fund managers. Singapore-based Minal Bathwal has had an 18-year winning streak, not having a single down year since he started managing money during the 2008 financial crisis. His fund has scored wins on everything from Korean interest rates to Asian currencies. Societe Generale shares declining after it reported fourth quarter results for its trading units that missed estimates. Revenue from buying and selling fixed income securities and currencies fell 30%. Equities trading fell 5.3%. Equipment industry casting a shadow over the 2026 Milano Cortina Games. The investigation is examining whether companies may have violated rules around cartels.
specifically illicit price-fixing practices, which could have led to increased resale prices within the EU market. Coming up, Oman says it held indirect talks with the US and Iran. More on what that all means next. This is Bloomberg. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
The president has obviously been quite clear in his demands of the Iranian regime. Zero nuclear capability is something he's been very explicit about, and he wants to see if a deal can be struck. And while these negotiations are taking place, I would remind the Iranian regime that the president has many options at his disposal, aside from diplomacy, as the commander-in-chief of the most powerful military.
Oman says it has had indirect talks with Iran and with the United States. Discussions focused on conditions to resume negotiations. Joining us now from Washington is Bloomberg's Kasia Klimashinska. Kasia, is this a little bit less than we were expecting? Did we know the talks were going to be indirect?
Hello. First of all, I think it's good news that the talks happened. As you said, we have this kind of a readout from Oman saying that Oman talked to both sides. No, we didn't know. We didn't expect that those would be indirect negotiations, but it sounds like that's what's needed. Oman said that it kind of tried to establish rules, lay the groundworks for the two sides to talk. And the Associated Press also reported that the U.S. delegation has most likely already left the place where the negotiations were happening in Oman. But it could be good news for the oil market. Of course, the oil market is watching it with concerns. But as long as those talks are happening, that perhaps diminishes this threat of some sort of military action from the U.S. that Caroline Levitt just mentioned at this White House briefing that you showed us.
Yeah, and if anything, you know, when President Trump suggested that there would be direct talks, it did seem surprising. So maybe this is a first step towards direct talks. Let's talk about President Trump calling for an arms treaty with Russia. What's going on there? Why did this come up now?
So this is, again, a difficult relationship between the two sides that don't necessarily talk too often, US and Russia. But there is this nuclear arms treaty called the New START that expired. It expired on Thursday, and President Trump came out on through social media saying that he wants a new agreement. It's a common strategy for Trump. He wants to throw away what's already out there and just build something new, something that will have his fingerprints all over it. He also wants China to join those nuclear arms negotiations, and China doesn't want that. So for now, Moscow said that its understanding is that there is no nuclear arms treaty binding it at the moment.
What is happening in Minnesota and with ICE and DHS more generally, Kasia? We know that 700 agents were pulled out of Minnesota. What's next?
It's a very delicate situation after, unfortunately, 2 Americans were shot by the anti-immigration officers sent by the federal government. So President Trump is very careful there. He announced the withdrawal of 700 officers in Minnesota, but at the same time, he reiterated that it's still his mission to get rid of illegal immigrants in this country, and so he will continue perhaps looking at some other cities that he didn't specify.
All right, Kasia, thank you so much. That is Bloomberg's Kasia Klimashinska for us in Washington. Let's take a look at where markets stand now, because if we look at Bitcoin, we got down to literally 60,000 and change overnight. We're back up to nearly 66,000. Dip buyers coming in, maybe that crisis of confidence or that forced selling maybe abating, we'll see. Now, gold has been volatile, but the last couple of days it's been around this level, about $4,900 an ounce. Silver, though, a lot more volatile. That was down 20% once again overnight. It's recovering today, too. And if you take a look at iron ore in Singapore, below $100. So there's just one direction of travel for iron ore, and it would seem for copper as well. Coming up, Stellantis shares plunging today on electric vehicle reset charges. More on that story next. This is Bloomberg.
What's great about it is it's a well-developed gaming ecosystem, right? So, folks know to find games there, but it's also a highly competitive gaming ecosystem. So its developedness gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned one of the big gaming areas we're going after. One of the big gaming areas we're going after now is social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are going to unleash this with a bunch of creators, and they're going to go figure out stuff that we didn't even imagine that they can do with that interactivity.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Shares of Stellantis plunging this morning, the steepest drop on record, in fact. This after the car maker said a business reset resulted in charges of around $26 billion for the second half of 2025. Bloomberg's Craig Trudell joins now with more. The CEO said the company basically overestimated the pace of the energy transition. Craig, is this reset that we're seeing not just at Stellantis but across all EV makers thanks to the Trump administration and current policies, or is it a broader lack of appetite now for EVs?
Yeah, I think it's a little bit of all the above. I also think you have to pin quite a bit of blame here on management teams, right? Where, at Stellantis under, the new CEO who's been in place for a good while now, but also his predecessor, Carlos Tavares, it has been difficult for them, right? They've had to answer to two very different administrations in the U.S. who had diametrically opposed views on the future of the auto industry. That's really difficult to run a business around. But, this is also a story of a company that was trying to become competitive in electric vehicles, investing a lot in that and getting their suppliers on board to, feed those batteries and put those EVs on the market. Now that you throw those out in response to the changes in policy, it's going to cost you a heck of a lot of money, and that's what we're seeing this morning, and also have seen at GM and Ford.
Yeah, exactly. And also what surprised me is that China is also seeing a cooling in demand for EVs. We saw, trouble with BYD, this after, a price war between the EV makers in China. So I'm wondering just, what is that broader sort of shift away from electric vehicles? Has it something to do with the difficulty of using them, charging facilities, batteries versus charging, etc., as well as everything else?
Yeah, I think we have to maybe separate China from the rest of the world to some degree, because absolutely we're seeing a slowdown there, but it's a slowdown from a really impressive high level in terms of sales. And it's a very different story in the U.S. And even, I think, Europe is somewhere in the middle. And interestingly, Stellantis has had, this approach of trying to leverage a relationship with a Chinese manufacturer called Leap Motor, that arguably is making their life difficult at some of Stellantis's brands, where if you have this new entrant with a lower cost base out of China and an ability to price very competitively, that puts a high volume manufacturer like Stellantis in this very difficult position over here in Europe. So where we've seen some pickup in demand, but still a bit of a disappointment in terms of the growth not being what policymakers hoped when they were setting these targets to phase out the combustion engine around 2035.
Yeah, that's for sure. Craig, thank you so much for the update. That is Craig Trudell there in London. Time now for your front page news. First up, the Wall Street Journal says Toyota Motors CEO is stepping down after just a short term in office. Toyota has been navigating Trump-era tariffs too and struggling to maintain market share in China. The company pointed to profitability issues in announcing the elevation of the CFO to the role effective April 1st. Next up, the New York Times leading with Trump RX. The Times reporting the site is aimed at helping patients use their own money to buy medicines, but researchers warning, however, many could pay too much if they use the site. The government website will not sell medications, but will provide an entry point for consumers to buy 43 medications, including things like insulin and GLP-1s elsewhere. And finally, the Financial Times reporting President Trump's policies are denting international travel to the U.S. The FT says the number of foreign visitors fell 4.2% in 2025. That's the first annual decline since COVID. This all as the president oversaw an expansion of immigration enforcement, mounting scrutiny at the border, and a suspension on visa issuance to 75 countries. Coming up, Citi's Veronica Clark expecting a catch-up in job growth in January, though we won't get the data until next week. More next. This is Bloomberg.
such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety, and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
It's 5:30 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Future is higher now after U.S. stocks posted their biggest sell-off in months. This as a busy week of tech earnings showed massive spending plans for AI. The latest from Amazon vowing $200 billion worth of capex this year. And indirect talks happened between the U.S. and Iran. Omani officials saying separate talks have been held with delegations from Washington and Tehran in the last few hours. So let's look at those markets. We're off our highs, but futures very definitely pointed higher. This after, of course, the Nasdaq 100 dropped 1.4% yesterday. It was a real miserable day. The Challenger layoffs report added to some angst around software companies and AI, and we had metals just bouncing around all over the place. Looks like that might come to an end today, particularly for the Russell 2000, which continues to be the beneficiary of whatever this rotation is. On the bond side of things, the curve has dropped across the board, but it's still at its steepest level in about 4 years. That 2-year yield at 3.47, the 10-year yield at 4.19. That's about a 72 basis point 2-10 spread right there. And let's take a look at some metals, because we saw silver drop 20% overnight. It's recovering again, but we're down to 73. It's like 2 steps backward, 1 step forward every morning that we come in. Bitcoin the same. We were down to $60,000 and change. We're back up to nearly 66 now. And crude oil, watching Iran, we came off a little bit, but we're putting on about 48 cents there now to almost $64 a barrel. Let's get to some individual movers now on this Friday session. Here's Chloe Melee in London.
Good morning, Bonnie. It seems the market isn't too thrilled about how much Amazon is planning to spend this year. So the forecast for CapEx came in way ahead of expectations. And just like Alphabet yesterday, we are seeing that result in quite a lot of weakness in the shares and really fueling investor concern around just how much those big tech companies are spending on AI and when we might see actually start to pay off. Moving on to Stellantis, which is also plunging this morning after announcing that it will take charges of about 22 billion euros related to a business reset to shift away from electric vehicles. And this is not the only car maker that we have seen move away from EVs, but the charges were way higher than expected from analysts. And so we are seeing quite a lot of weakness in the shares this morning. And this is really going to put pressure on the company to show when those benefits from that restructuring will actually come through. And finally, Reddit announced a $1 billion buyback and also projected very strong sales for the first quarter. And this shows how much the company is making headway in the advertising business in particular. And so this is quite a positive move for the company, up more than 9% in pre-market trading for Reddit.
Chloe, thank you so much. That is Chloe Melee there in London. The private challenger job cuts data yesterday showed the worst layoffs since the great financial crisis, casting gloom over markets. Now, Bloomberg Economics says the layoffs announced so far have been concentrated in a handful of sectors and haven't broadened enough to suggest a shift to a high firing, low hiring regime. No non-farm payrolls data today, of course, we get next Wednesday. But Veronica Clark of Citi was expecting a catch-up in job growth in January. Still, though, she sees risks for the unemployment rate tilted to the upside. And I'm pleased to say Veronica Clark joins us now. So, Veronica, we get that data next Wednesday. It's going to be a huge week, as you pointed out.
Yeah.
What is it going to mean to us next Wednesday? What will it tell us about the current state of the labour market?
Yeah, we are expecting seemingly stronger job growth in January. We're at 135,000. Obviously, would have gotten that this morning, another jobs Friday that wasn't. But I would take that number with a lot of caution. There has been a very clear pattern of residual seasonality around December, January, start of the new year, the last couple years, and we've seen this January number stronger before. If you look at claims, initial and continuing jobless claims the last few weeks, they've gotten very low. They tend to get very low around the holiday season, start of the new year. That's been a good signal for this stronger January job growth. So I think we will see that in January, but I would really caution not to interpret that as a sign that labor demand is really rebounding, because there are a lot of signs of the weakening labor market still.
Yeah, what did you make of the challenger layoffs yesterday? Did it give you pause even for that amount of enthusiasm for January?
Not necessarily for January specifically. If anything, we do see these challenger announcements tend to lead actual layoffs. When they happen, they're announced, and then they happen later. We tend to see that lead by maybe about 4 or 5 months or so. It is just a scraping essentially of all the announcements on job cuts. So you do have to take it with a grain of salt. It's not exactly hard data. You do, to believe that layoffs are picking up, you do want to see something like initial jobless claims starting to rise, maybe layoffs in the JOLTS data starting to rise more obviously than maybe we would see that in the slowing payroll job growth. And we don't really quite see those signs in the hard data yet that layoffs are picking up.
Yeah, okay, well, that might be something we have to look forward to in 3 or 4 months' time.
Right.
But does it give the Federal Reserve any ammunition for potentially thinking about another cut sooner?
Yeah, I mean, it probably doesn't right now, but it should in a way. It's been a bit surprising, I think, to hear Chair Powell and some other Fed officials talk about, being encouraged by some recent stability in the labor market. And yeah, we did have the decline in the unemployment rate in December. That will be encouraging, but that was 1 month that followed essentially 5 months where the unemployment rate was rising. And there are, as Governor Waller points out, job growth is essentially flat on the year. There are signs that this is not a healthy labor market.
Yeah, it really isn't, apparently. What about wage growth? Can that be any kind of a silver lining?
Yeah, I mean, we have seen wage growth holding up enough. We're kind of running at a normal pre-pandemic rate. But, if you're looking for signs of how labor demand is evolving versus labor supply, of course, we have had immigration changes this year. Wage growth is a good tell about, how loose or tight the labor market is. And we have seen some better measures of wage growth slowing more recently. The Atlanta Fed wage tracker, that has slowed a lot through the end of 2025. Next week, with all the data, we'll also get the employment cost index for Q4. That's the Fed's gold standard for wage growth. That is slowing. It's not particularly weak or anything, but it's certainly telling us that the labor market is not a source of inflationary pressure.
Well, we know that the Fed had been very worried about the labor market in the run-up to the holidays, let's say, and then it sort of took a back seat with everything that was going on, and it didn't seem like there was that much that was alarming out of any labor data that we were getting. But the Fed doesn't want to be behind the curve, so everybody who's waiting for the first rate cut in the second half of the year, should that not be brought forward?
Yeah, it should, in a way. I mean, we've kind of gotten to the high point of where the Fed is comfortable with the unemployment rate going. We know in their last forecast update in December, they were expecting to see something like 4.5% by the end of 2025. We got there. I think anything beyond that, yeah, you are getting more uncomfortable that this is just an unemployment rate that continues to gradually increase, and if that trend persists, at some point the level of the unemployment rate is not so low anymore.
Will the market look through what you deem to be the seasonal effects in January that we might see next week and start pricing in a third cut potentially this year?
Yeah, maybe not in that January data. It probably does take some time. Again, I think that January number will look strong because of this seasonality, but because there is this seasonality in the jobs data and the inflation data, there's also a seasonality in Fed pricing the last few years and how people are perceiving the risk of Fed cuts, where it's the start of the year, we kind of price that out, and then as we get the weaker data in the spring and those cuts back in. So maybe it takes another couple months to really get the market to price more cuts.
Does Kevin Warsh at the helm change any of this calculus?
I don't think in a dramatic way. We are expecting that he'll come in and advocate for more rate cuts. The timing of it is such that he would be joining potentially. We don't quite know how the Senate nomination process will play out, but should be joining maybe by something like the June-July meeting. That's the time of year when we have seen weaker labor market data start to show up anyway.
And it's midterm prep time.
Yeah. And so if we do see that seasonality in the jobs data, we get some weaker data, it would probably be easier to convince some of these hawks that, maybe we should be cutting a bit more. But it starts with the data. I don't think it starts with whoever the chair is.
With Kevin Warsh, yeah. Just curious about these layoffs that Challenger is telling us about, that I guess we would know about if we read every single headline, right? Are they thanks to AI?
So Challenger does do a breakdown of job cuts by reason. AI is one of the reasons that they try to pick out. There has been an increase in that as a cited reason the last couple months, last year or so. A bigger reason is still economic conditions, though. So it's certainly not all AI. If you look at something like the JOLTS data, the pullback in hiring, we have seen that very concentrated. It's broad-based, but it's been particularly pronounced in sectors like professional and business services. Maybe those are AI jobs that AI would maybe be replacing. But the pullback in hiring there also started early 2022. So probably some of this is AI, but I don't think it's all AI.
Right, and if the market really believed most of it was AI, we would not be seeing the gains that we're seeing in the Russell, right? Because some of those companies could be very much affected by AI.
Right. And those small businesses, and I don't even mean necessarily, businesses with equities, but restaurants, right? The bulk of the economy is very small businesses. Those are the businesses that we really saw the pullback in hiring first. And that, happened in 2022, 2023. Those will be more rate-sensitive businesses, people borrowing at banks. And maybe that was a good evidence that, some of this pullback in labor demand is again, not AI, but maybe a function of rates being restrictive.
All right, well, Veronica, we're not going to make you come back in next Wednesday, but we are looking forward to sharing a jobs report with you very soon. That is Veronica Clark of Citi. Now, to other top stories trending on the terminal this morning. A Brevin Howard fund manager has quietly become one of the world's most successful macro hedge fund managers. Singapore-based Minal Baswal has had an 18-year winning streak, not having a single down year since he started managing money during the 2008 financial crisis. His fund has scored wins on everything from Korean interest rates to Asian currencies. Stellantis shares plunging after it said a business reset resulted in charges of around $26 billion for the second half of 2025. CEO Antonio Filosa said that the charges largely reflect the cost of overestimating the pace of the energy transition. And work on a $16 billion Hudson River Rail tunnel is expected to come to a halt today following the Trump administration's decision to freeze its funding. The commission in charge of the project has sued the federal government in an effort to unlock more than $205 million. The tunnel construction is one of the most ambitious infrastructure projects in the United States. Coming up, Oman reporting indirect talks with the US and Iran. Latest on those negotiations. That's next. This is Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
The president has obviously been quite clear in his demands of the Iranian regime. Zero nuclear capability is something he's been very explicit about, and he wants to see if a deal can be struck. And while these negotiations are taking place, I would remind the Iranian regime that the president has many options at his disposal, aside from diplomacy, as the commander-in-chief of the most powerful military.
In the Middle East, Washington and Tehran have held indirect talks to de-escalate tensions. Oman's foreign ministry writing in a statement, quote, "The consultations focused on creating the appropriate conditions for the resumption of diplomatic and technical negotiations." Joining us now is Bloomberg's Kasia Klimashinska. So it's a start, Kasia. Apparently the US delegation has already left. It's a start, but did we expect more?
It's a surprise. As you said, those are indirect talks. So Oman met with the U.S. delegation led by Steve Witkoff, and then separately with representatives from Iran. But Iran also said before those talks even started that it won't be a major step, that those will be just some sort of broad talks, and on the top of it, indirect. We haven't heard from President Trump about those negotiations yet, so this could still come later today. He just started posting, and of course oil traders will follow it very carefully because this has been moving oil prices.
Yeah, and there wasn't even agreement before today on exactly what would be on the agenda, so I suppose this is something at least. Now, domestically, President Trump launched randomly a new website to help Americans apparently directly buy select medicines at a discount. Take a listen to this, Kasia.
We're taking the lowest price paid for drugs. We will pay equal to whatever the lowest price anywhere in the world. That's the price that you're going to be paying. It's a tremendous reduction. Drug prices in other nations will go up by doing this. They had to agree, and the reason they agreed is they used tariffs.
So it's a government website. You don't actually buy anything directly from that site. It's like an aggregator. It sort of sends you to whatever site the medication seems to be cheapest on, potentially. But many of these medications, if you have insurance, are already covered, right, Kasia? So what are researchers saying?
Yes, so this is this push from President Trump to skip the insurers to let Americans buy some medicines with their own cash, especially the medicines that are aimed to reduce obesity. So that's what you can go in there and search for. And this is this concern to increase affordability, especially of healthcare.
Yeah, you would have to wonder if it isn't going to kick people off exchanges if they suddenly think that they don't need to be insured anymore. We'll see how it pans out. What about ICE and DHS? Apparently now the White House is looking for talks with Democrats over limiting ICE.
So this is one of the objectives for the Democrats. They really want those ICE officers out of the streets, or if they are there, they should be less aggressive. They should not wear face masks. They should have body cameras. They basically want to establish some sort of rules to de-escalate the tensions in major U.S. cities between ICE and immigrants as well as Americans. So the Democrats have listed their demands. They sent the list of demands to Republicans and to the White House. And so there have to be talks between the two sides, or otherwise the funding for the Department of Homeland Security will expire.
Yeah, I think it's up on the 13th, right, which is only 7-8 days away. Kasia, we have to leave it there, but thank you so much. That is Bloomberg's Kasia Klimaszinska. Well, what a week it's been in tech. The biggest companies in the space out with massive spending plans, totaling as much as $650 billion this year as the AI race seemingly intensifies. Joining us now is Mandeep Singh of Bloomberg Intelligence. So Mandeep, just in broad strokes, we saw spending plans go up. We saw the likes of software companies sell off. Is the market, are investors getting this right? Are they interpreting everything correctly?
I don't think so. Right now, we are in that fear mode where everyone seems to be panicking about the level of capex from the hyperscalers, and also, the pace at which the disruption will come. So clearly, the LLM companies, whether it's OpenAI, Anthropic, have increased their pace of product launches. But in terms of the impact, it's too early to say, they'll be displacing any existing software. And from that perspective, when you look at these capex numbers, they're obviously 30% above consensus in a lot of cases. That makes you wonder, what is the impact down the line in terms of, what it means in 2027 and 2028, and who is going to be using all this chip capacity, and how do we even make all those chips to begin with? So I think there is a big impact in terms of what this means for wafer production, and who are the users going to be in terms of the chip capacity. And I think there are a lot of questions that need to be answered here.
Yeah, are we going to have a chip capacity mountain out there? Let's have a listen to Andy Jassy, because Amazon also announced plans to spend $200 billion this year on AI. And he spoke on the earnings call. He made it sound very palatable even. Take a listen.
When I look at this, what's happening, it's kind of unbelievable if you look at the demand of what you're seeing already with AI. But the lion's share of that demand is still yet to come in the middle of that barbell, and that will come over time.
Yeah, he seemed to act like it was a necessary amount of spending. He seemed to say that it was an extraordinary opportunity to change the size of AWS and Amazon as a whole. How would that happen, Mandeep? Walk us through that process.
A lot of the capex investments that are going this year are for future capacity. So it's not as if they are deploying, the dollars for 2026. That capacity will come online, especially for someone like NVIDIA or TSMC. TSMC really has to ramp up their fab capacity here to deliver for Amazon, for NVIDIA, for Google. And if all these companies have had such a big step up in capex, the wafer capacity is not growing, 100%. And so from that perspective, there will be lags in terms of when they will finally get the chips. So from that, I just feel like right now, everyone is going all in because they want to put pressure on the frontier labs, your OpenAI, Anthropic, in terms of what these companies can do. Remember, they have to rely on the hyperscalers. And Google obviously has that vertical integration. So they have shown the advantage they have in terms of capex efficiency and using it within their own ecosystem. But for others, it is about renting those GPUs or, the accelerator chips down the line. And it'll be interesting to see what sort of demand they'll have.
Mandeep, it feels almost like a trial, right? We've heard from the mega techs, and it's created this narrative in the market. But we haven't heard from the AppLovins and the Atlassians. They're all to come. AppLovin is reporting next week, and it's the worst performer on the NASDAQ 100 year to date. It's down shockingly. So is Atlassian and lots of other companies. Will the narrative shift once their CEOs come out and say, look, this is overblown, this is what we're doing, it's all good for everybody?
I don't think so. And see, that's the thing about this panic is everyone sort of is in that phase where there is a lot of uncertainty. And even if the management team comes out and says, we have had a great quarter, this is going to linger on for a while because people really want to see how this plays out over the next 6 months, as opposed to, making any judgments based on what the companies are reporting this quarter.
Wow. Well, it feels like there have been some judgments made already. Mandeep, thank you so much. Mandeep Singh of Bloomberg Intelligence. Coming up, no jobs report, but we still get data and Fed speak in your day ahead next. This is Bloomberg.
Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities. It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Bringing you up to the minute news whenever and wherever it happens. I'm Sherian in Seoul, and this is Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now a look at what's ahead today. Biogen and Carlyle wrapping up the week in earnings, and boy, what a week it was. Then we do get University of Michigan sentiment data out at 10 a.m. Eastern, and Fed Vice Chair Philip Jefferson is set to speak at 12 p.m. Eastern. Let's take a look at some pre-market movers. Amazon planning to spend, obviously, as you know by now, $200 billion on AI capex this year. And it is lower by about 7 to 8% on the session this morning. Stellantis down 23%. It took charges tied to the EV pullback. It said it didn't think the energy transition was going to take as long. It's also dealing with tariffs, and it's something that we're seeing across the board for EV makers. And strategy rebounding just a little bit. Bitcoin rebounded after a 50% dip from its peak. But let's take a look at Bitcoin, because if you look at the macro environment, you can see it's still below $66,000. Now, it reached as low as 60 and change, so that's something. We are seeing futures pointing higher. Maybe it's going to be a risk on Friday. We'll see. That's it for Bloomberg Brief. Surveillance is next. This is Bloomberg.
don't think the court was hurt by the perception that it was a political decision?
The court's always hurt, it seems to me, if we look political. One of my concerns, my present-day concerns, is there's too much partisanship. It's true historically that most presidents have appointed justices to the Supreme Court who are members of their own party. The partisanship should not be an overriding factor. What you look at is temperament, learning, background, reputation, whether or not you have those qualities of independence and caution that make for a good judge.
Increasingly, you see dissenting opinions in the Supreme Court aren't quite as civil as maybe you might prefer. And is that of concern to you?
Yes, it's of great concern to me that our civil discourse, our civic discourse, is not civil enough. Aristotle said that a democracy depends on an open debate where you respect the dignity of those with whom you disagree. He said democracies only live if they are sustained over a period of time by a thoughtful, rational discourse, a discourse in which you respect the dignity of those with whom you disagree.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Versace in Davos, Switzerland, and this is Bloomberg.
There is a sentiment overhang.
We're coming to a point in the AI transformation where dispersion is much greater.
The AI boom is coming.
Rotation is the new momentum trade.
I think there's a number of narratives going on, and so investors are increasingly wondering, which ones do we want to pick?
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Friday, struggling to bounce. Amazon stock plunging after pledging to spend $200 billion this year. After tech stocks posted the biggest three-day rout since Liberation Day, and weaker than expected data sent bond yields down the most in months. We begin this hour taking stock of a brutal week on Wall Street, following a rout across tech, precious metals, and crypto. A single Anthropic plug-in providing even more fuel for the software sell-off, spreading across the stocks of private market firms from Blue Owl to TPG. The risk aversion taking on a different flavor going into the weekend as several data points are poking holes in the bull case for the U.S. economy, opening the door to a conversation about rate cuts.
The anatomy of this week is notable for how varied it is. It started with what you were talking about, the rout in software stocks, the potential of Anthropic disrupting fundamental business models and potentially increasing the default risk of some of these companies. It has shifted into, well, how much can this bull market keep running if you don't have the pillars of a strong economy behind it? Yesterday, we got a 1, 2, 3 punch. We got the challenger job announcements that came out. Then we got jobless claims that were elevated at 8-week highs. And then we got the JOLTS data that came out that showed that job openings fell to the lowest level since 2020, not boding well for the U.S. economy.
Governor Waller is looking smarter and smarter by the day over the last week or so. He said this recently. There is considerable doubt about future employment growth and suggests that a substantial deterioration in the labour market is a significant risk. Now, we can have the debate about it all, but it's certainly a risk.
And he's been consistent. He has been saying this for months, and most recently saying he is still very concerned. And basically, everyone was looking for, why did this individual go out and dissent at the last meeting? Was it just because he was running to be the Fed chair? Governor Waller came out and said, no, it's because I'm concerned about the labour market, and maybe he was right.
So we got real economy concerns on top of a rout in tech stocks and massive moves in private market firms. KKR, TPG, Blackstone, Apollo, all softer this week. Check out Blue Owl, down for 11 consecutive days. We're down 15% this week alone.
And they came out and they tried to stave off some of those concerns by saying, look, software-related debt is only about 8% of our portfolio. The market's response, we don't believe you. A similar response from Ares as well. People not taking any of these assertions as fact or any kind of placation for some of the concerns. It raises this issue. How are some of these companies going to finance these very ambitious plans at a time where, yes, their cash flows are really ample, but ultimately it will come down to some of the credit financing? How willing are people to go and continue to extend that?
They're struggling to put this story to bed. Ari's saying there's a huge disconnect, the narrative is wrong. KKR's Scott Nuttall saying our level of anxiety is pretty low for them, for the management teams, but right now, if you're holding the stock, I imagine you're pretty anxious.
Blue Owl also saying their technology, that part of the portfolio, is the most pristine. Quote, we don't have red flags. We don't have yellow flags. We actually have largely green flags. Well, I'll tell you, those stocks are anything but green this week.
So here's the bounce so far this morning. Equity futures on the S&P positive by 0.5%. We'll see if this sticks. Coming up this hour, we'll catch up with Brian Levitt of Invesco on a 3-day stock market route. Sarah Kunst of Clio Capital as big tech's capex balloons. And Vivek Arya of Bank of America as chip stocks cash in on the spending boom. We begin this hour with stocks inching higher following a 3-day decline. Brian Levitt of Invesco writing the story is far from fully written. We expect leadership to rotate as the market differentiates actual earnings leverage from all the hype. Brian joins us now for more. Brian, good morning. Good to see you.
Good to see you too.
What was the last 24 hours about compared to the previous 2 days?
I would say that this is a market that's been letting off some steam, certainly in the hotter parts of the market, and primarily, I think you got to look. If you look at the broad index level, these markets are not down all that much. I mean, Nasdaq down 5% over the last 5 days isn't great. S&P a couple of percent. It's really the carnage being hit in the software stocks and some of the more speculative parts of the market. You see it in things like what happened with silver prices and Bitcoin. But the reality is, when you look at all the investment that's likely to take place, we can parse whether the big companies at the top of the S&P 500 are right to do so. But if you look at industrials, if you look at energy, if you look at the semiconductors, it's all held up fairly nicely. And it's all part of that rotation story that we're talking about, less about who's going to win in that space, because that's going to be a big investment to win in that space, versus who's going to help support this build out. That story continues to play.
That certainly felt real up until yesterday. And then the real economy scare kind of clicked in just a little bit. I don't want to overdo it, but just a little bit. A couple of data points poking holes in a bull case for the US economy. That's something we need to talk about, because people were piling into small caps. They were comfortable in the equal weight, close to all-time highs. Should they still be comfortable with those trades?
Yeah, I think so. And let's remember, we started the week with one of the great leading indicators of the economy, the Institute for Supply Management Purchasing Managers Index, which surged and climbed to 52. That's an expansion territory. We had not been there in quite a while. The new orders component particularly strong within it, and prices paid relatively flat. So that's a good leading indicator of the economy. Now, when you think about the jobs market, jobless claims rose yesterday. 250,000 is not a blowout jobless claim number. And it's also a little bit of a heads you win, tails you win type of scenario, because the weakness in the economy suggests what I've always believed is lower interest rates on the short end of the curve, which should continue to benefit lower capitalization stocks, more value-oriented stocks. So I'm not ready to say that this is a economy that's rolling over. Credit spreads continue to remain tight. Leading indicators are picking up. Inflation expectations relatively contained. I think the Fed's going to be bringing rates down towards 3%.
It might not be an economy that's rolling over, but it's a really confusing economy. And Amazon exemplifies it in a perfect way. On one hand, they were behind a significant portion of some of those job cut announcements that we got from Challenger, Gray, and Christmas yesterday. On the same level, they're going to be spending $200 billion so far this year. How important is it for us to understand exactly what they are spending this money on, to be able to infer what kind of growth and benefit to the underlying economy that actually will look like?
Yeah, it's important, but if you take each component of economic activity, you take the consumer, we have to remember that, things may be weakening a little bit. Household net worth is at an all-time high. Unemployment's relatively low. The business investment we know is going to be big, as you mentioned, and the government spend is going to be reasonable this year, not only in the United States, but many parts of the world. So in aggregate, that's a good economic backdrop. Now, when you think of this investment that's going to take place. There's a lot of parts of the economy that should benefit from it. And again, industrial's rallying, energy has been rallying, semiconductors were up 15% year to date before this week. So I think that story persists. Would I be diving back into software companies this morning after the sell? No, I'd be mindful of that. But I think the real economic story continues.
And this is arguably the main reason for the broadening out trade. The real question right now is, do you go into the hyperscalers, given the fact that their business model seems to be changing from asset light to basically glorified utilities and real estate managers?
Yeah, I mean, I would go case by case. It's certainly not a monolith. Big story last year was that only 2 of the 7 Mag 7 outperformed the market. And you're right, these stories have changed significantly. I mean, the things that we loved about some of these businesses was that they were near monopolistic, they did not have significant investment needs, and that all changes. So you got to go company by company, be far more selective, and can't say I'm just going to own the whole lot of them. There will be winners, there will be losers. Those business models have changed.
Brian, you say you're not going to wake up this morning and just go dive in and pick up some software company stock. Why not? Why isn't this a buy the dip moment?
Because for a lot of them, we still need to understand what does this really mean for the business model. And we knew all along AI is going to be quite disruptive for a lot of businesses. The question that investors should ask themselves over the next few years, is it disruptive to more businesses than it is beneficial, or is it beneficial to more businesses than it is disruptive? And I'm still in the latter camp. There is a lot of companies that are going to benefit significantly from the AI build. You're already seeing profits high with employment, profits to employment not significantly elevated. So we're in a bout right now where we're looking at the disruption, which always happens when there's technological advances, but history suggests that there's always far more beneficiaries than there are businesses that are
Slightly
disrupted.
different for you, though. A self-described FOMO guy who's not willing to lean into where the pain is right now. Is it fair to say? Bit of a change?
Bit of a change, but I'm always looking for opportunities. So I have a fear of missing out, across the broad market. And so it doesn't mean that I need to always be buying into dips or into, falling knives, just looking for where the opportunities lie. And, again, that FOMO is good. That FOMO doesn't always exist, Jonathan, most of the time, and it exists when leading indicators of the economy are improving and the Fed wants to ease. I'm definitely a FOMO guy.
At times, this has felt like a falling chainsaw and not a falling knife. Michael Arrighetti said this yesterday. If you're going to underwrite a narrative of AI disruption, you also then have to say, well, what does that mean for the productivity and margin improvement in the rest of your book? And I actually thought that was a really good point that he made just yesterday.
Well, that you could have an offset from some of the gains that you're seeing. For example, KPMG is saying, look, we're going to get lower prices because we can lower the costs of some of our accounting from AI. How much is that sort of the analog to a lot of other companies? That said, how many business models go to zero? And that is what people are scared of, and that is the reason why some of these stocks are falling out of bed. That is the reason why the loans tied to some of these software companies have fallen 10, 15 cents on the dollar in just a span of a week. This is a fear of a fundamental shift in the reality for this justification.
I'm so happy you brought up KPMG. I think it's astonishing that this Financial Times has this exclusive story that they're going to their auditor and saying, we know that AI is working. They should know, because they also are an auditor. They're an accountant, and they're saying, we need a lower price or we're actually going to dump you. And that's what's going on right now behind the scenes in corporate America and global Wall Street.
I wonder how many people read that this morning and thought, you know what, I'm going to call KPMG and ask them the same thing.
Exactly. This is the disinflationary kind of boom that people are talking about. Question is, how many business models get absolutely blown out of bed, and how many of those business models are levered?
It's a pricing power shock that we all need to navigate over the next several years and maybe beyond. Brian, it's good to see you. Thank you, sir.
Thank you.
Brian Levitt there of Invesco on this equity market. Equity futures doing just about okay. We're positive by 0.5% on the session. That is a session high. Let's get you an update on stories worldwide this morning with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Good morning, John. Thank you. Amazon shares trading lower in the pre-market. The company announcing its latest results and plans to spend $200 billion on data centers, chips, and other equipment this year. CEO Andy Jassy says the money will predominantly go to the company's cloud unit, and most of that spending will be for AI workloads. Stellantis shares plunging Italian trading. The car maker announcing it would take more than $26 billion in charges in a sweeping overhaul of its electric vehicle strategy. The write-downs follow similar moves at Ford and GM. Stellantis will incur the charges during the second half of the 2025 fiscal year. Anthropic is releasing a new version of its AI model designed to perform financial research and other workplace tasks. The company says Claude Opus 4.6 can scrutinize company data, regulatory filings, and market information to come up with detailed financial analyses. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thanks for the update. More from Vonnie in about 30 minutes' time. Up next on the program, big tech's big wipeout.
It feels like DeepSeek and Liberation Day are happening at the same time. There is a sentiment overhang, just generally speaking, and some things are just being thrown out in, in conjunction with, and might not be justified in our view.
A conversation up next with Sarah Kunst of Clio Capital, live from New York City this morning. Good morning.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
It's the bounce this morning. Let's see if it sticks. Equity futures up by 0.6% on the S&P 500. The Nasdaq up by 0.7%. The Russell up by more than 1 full percentage point in the last 24 hours. Some concerns about the real economy trade off the back of a handful of data points. It's worth passing through them. Check out the bond market. Two-year bond yields with a reset lower. We're down by 10 basis points just yesterday. This morning, we're up by 3. 347.90, still sub 350. Challenger job cuts plus jobless claims just pushing back against the enthusiasm that built after looking at the ISM manufacturing and services.
The idea was that even if you saw some sort of violent rotation in some of the tech trades, you did see the fundamental economy benefiting, if anything, from the CapEx boom that you're seeing. This really challenged it, and each data point was messy. And you could come out and you could explain why each one is inaccurate, and Stephanie Roth will do that later today. But if you look at them in aggregate, it paints a different picture than some sort of screaming stability in the U.S. economy.
Well, let's talk about another data point. $200 billion. How's that? $200 billion. The capex intentions of Amazon. Check out how the stock reacted. Down 7.7% so far this morning. Call it 7.8. Just a bit of pushback this week from the equity market.
As Lisa would say, Amazon, the CEO woke up and said, Alphabet, hold my beer, because it was insane how much they were willing to spend on capital expenditures. What is so interesting is AWS, which is really important to cloud and this whole future for AI for Amazon, did really well. Double-digit percentage. They are doing really well, but the fact that they're just spending too much, people think it's not equal to how well AWS is doing.
Down by close to 8% of the pre-market, 205.20 on Amazon. Under surveillance this morning, big tech's big wipeout.
It feels like DeepSeek and Liberation Day are happening at the same time. There is a sentiment overhang, just generally speaking, and some things are just being thrown out in, in conjunction with, and might not be justified in our view. But it's very, very tricky, and you have to be very picky in terms of your exposure when you're thinking about going in, and that doesn't mean that sentiment's going to change overnight.
Here's the latest this morning. Amazon pledging to spend big on AI this year. Investors concerned it might not pay off. Tech stocks posting their biggest three-day rout since Liberation Day. Sarah Kunst of Clio Capital writing, just because the market goes down doesn't mean it's a buy-the-dip moment. Sarah joins us now for more. Sarah, welcome to the program. We've seen these convulsions across several pockets of the market now. Crypto, precious metals, software stocks. Is this the start of something bigger?
I think it's a continuation of something bigger. The economy is not where we want it to be. Consumer sentiment is not at an all-time high. The news coming out of America right now, politically, it's stressful. And so I think you're starting to see all of that converge with a level of CapEx spending that doesn't feel sustainable, because the reality is these data centers don't really create great jobs. You're going to need a lot of AI spend, and we don't know where that's going to come from to justify filling up these data centers with chips that do depreciate in value pretty rapidly. And so I think it's all kind of coming to a head at once, but it certainly is not just starting. This is a continuation.
Well, Sarah, let's talk about the data we've seen so far this week. So ISM manufacturing was really encouraging at the start of the week. Then we had 3 data points yesterday that were much less encouraging. The Challenger job cuts, jobless claims, and then a little bit later in the morning, job openings, vacancies fell back. How much weight should we put on yesterday compared to the ISMs at the start of the week?
I think that we are in a moment, unfortunately, where we have to really, really lean heavily on that private data. The reality is that the government has sort of a narrative that they want to push that might not be sort of aligned with the reality of what we're seeing on the ground. And so, I think AI is part of the slowdown in hiring. I don't think it's the whole story. I think that the overall weakening economy is a big part of that slowdown in hiring. We've all kind of forgotten about tariffs from last April, but they are having a big impact in terms of everything from tourism dollars to tariffs. The U.S. economy isn't what it once was, and that means that you're going to see less hiring and over time, more firing.
On a fundamental level, Sarah, that would challenge the broadening out trade that some people have been really leaning into, the rotation into everything else in the economy. On the other hand, people will say, but we're looking at $650 billion being spent by 4 big companies just this year alone. It's got to go somewhere. How can you pair these stories of a question of how much a U.S. market can broaden out in the face of relatively weak economic data, and then paired with these monster CapEx programs?
Yeah, so, I think a lot of the broadening out is going to happen outside of the U.S. We're seeing a lot of non-U.S. indexes go from strength to strength. We're seeing a lot of money that's interested in tech go right now into areas like South Korea that have, a lot of similar companies. And so we're seeing money go into the Samsungs of the world, into indexes like EWY. We're seeing that FTSE 100 has been having a great year. So I think people sort of remembered that America is not the entire global stock market. It just felt that way for a decade. And we're starting to see a lot of broadening out there. And then on the CapEx spend, at the end of the day, if these companies can't show how they're going to get paid for the data centers they're building and for the chips that they're buying, it's hard to see who really benefits besides NVIDIA.
So given what we've learned this week and given the sell-off in a number of these shares, what do you do with this? What would it take for you to come back into U.S. mega cap tech other than NVIDIA?
Yeah, it's really a case by case. There are names that I think are still screamingly overvalued, the Palantirs and Teslas of the world. The valuation, the stock price just does not reflect the revenue by orders of magnitude. Those aren't names that I would buy the dip on. And then there are other names that I think are getting beaten up a little bit. I love Alphabet. I've long thought that they will be kind of the ultimate AI winner. They are, certainly spending a lot on CapEx, but they also have loads of cash on the sidelines. They have a bunch of money coming in from their advertising. They can actually make money on Gemini, unlike a lot of the other platforms, because it's already baked into existing business models they have. And so I would look at that much differently than, an Oracle, where Oracle has a lot of different irons in the fire right now, and it's hard to say, hey, is there really the focus on any one thing that's going to drive, loads of revenue in the next couple of years?
Sarah, when you mention Gemini and you basically say, unlike others, are you talking about OpenAI? Because I remember in Christmas when you joined me, you were saying how they don't really have the runway potentially for the rest of the year, and they're going to go out and they're going to fundraise. But what does this moment actually mean for a company like OpenAI that plans to IPO?
I mean, if you take the tenor of Sam Altman's tweets, he seems like he is a very stressed out man right now, and for good reason. We all saw last weekend the sort of odd dance between him and Jensen around will they, won't they with this $100 billion investment round. There's not a ton of money that has come in. The competitors, the Anthropics of the world, Gemini, are doing a very good job. We see OpenAI shifting to business models that feel not a position of strength, right? Whether it's letting adults be adults or, bringing advertising into the model when that's not something that's really core to their strengths or historically to their business proposition. What we're not seeing is loads of enterprise revenue, despite being told for years that that's where they were going to make that money. And so, yeah, there's huge concerns about how OpenAI is going to be able to afford to pay Oracle in those round-trip deals that we spent so much time talking about last year.
Sarah, you mentioned Anthropic. Let's finish on Anthropic. To what degree do you think that company right now is punching above its weight, making waves that maybe its market position doesn't actually justify?
I think that they are really focused on enterprise business. They're really focused on building, things like coding tools. Time will tell if that works or not. I sort of tune out that noise. They're not really a consumer company, and so they love to kind of be a counterpoint to OpenAI, certainly to Elon Musk and Grok, and that works well for them in the press. It probably helps them fundraise from a different sort of customer, but at the end of the day, what I think they're going to be judged on in their current trajectory is, can they get enterprise, can they get engineers to go into their work budgets and pay them for their coding tools, and if they can, that'll be a big win. We also don't know over time where Gemini is going to go in that space. If Gemini decides that they really want to take that business on head on, I think that could be really tough for Anthropic, but for now, they seem to be safe on that front.
Sarah, appreciate your thoughts. Have a good weekend. It's good to see you. Thank you. Sarah Kunz there of Clio Capital. On Amazon, check out the move in the pre-market, a big single-name mover for us this morning, down by about 8%. Later on this morning, we'll catch up with Gil Luria of D.A. Davidson. He's got this to say this morning: losing the lead, downgrading the stock to neutral. AWS continues to compare unfavorably to Microsoft and especially Google Cloud. Falling behind also means Amazon has to accelerate investment beyond the $200 billion of CapEx. Amazon may not have a choice but to follow through with a $50 billion investment in OpenAI.
Which raises this question of where all this money is going to, and can OpenAI hold its weight? But they continue to say AWS accelerated by 24%. They posted a 24% gain in their cloud computing unit, whereas Google's Azure, the cloud unit, posted a 48% gain. So they're growing faster, albeit not nearly enough for the market, because the market wants much bigger gains than that.
We'll catch up with Gil at about 8:15 Eastern Time, a little bit later this morning, a few hours away, so look out for that. Coming up on the program, we'll catch up with Bloomberg's Tyler Kendall as Treasury Secretary Scott Bessent spars with senators on Capitol Hill. Plus, Yahira has your morning movers. Stellantis plunging 24% as it reverses course on its EV strategy. Some big numbers, some bad numbers coming out of that company. That story up next.
crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Equities bouncing back. Here's equity futures for you, up 0.5% on the S&P 500, following a three-day slide, the biggest three-day drop going back to November. Compare the S&P 500 to the equal weight S&P. The S&P is down about 2% this week. The equal weight is actually higher. The pain concentrated in places like the NASDAQ 100. The NASDAQ heading for its worst week going back to Liberation Day last April. Switch on the board and get to the bond market. Bond yields at the front end of the curve, lower by 10 basis points in yesterday's session following some weaker than expected data. 347.69 this morning, still close to the lows of the year at the front end of the curve. But check out this in the FX market. This is the story for me not talked about enough. The dollar is on course for its best week of the year, which speaks to just how inversely correlated it was with risk appetite. Best week of the year for the US dollar as the markets begin to sink. This wasn't about debasement. It wasn't about sell America. It was about risk appetite.
Well, it seemed like people, when they did become risk averse, then went back into the dollar. I will note, all the trades that are doing the best are some of the ones that were beaten up, particularly at the end of last year. So it also feels like all of the consensus trades at the beginning of this year got violently reversed, and that's what we're seeing, and the dollar is part of that, and so the Sell America trade coming under question.
It's seen it cascade through financial markets over the past few weeks. Lots of single names out there, including a big move for Amazon and Stellantis. Let's get you more. 3 hours away from the cash open with your morning movers. Here's Yahara. Hey, Yahara.
Exactly, John. Amazon is the latest company getting punished for spending big. Shares are falling 8% in the pre-market as it pours $200 billion into AI infrastructure. It's a move that CEO Andy Jassy insists is necessary, saying that at AWS they are monetizing capacity as fast as they can build it. Still, investors are concerned since the spending is already projected to hit the bottom line. Amazon's forecast for operating income in the current quarter did come in below estimates. Meanwhile, that is creating some winners, and it is in the chip space. We are seeing NVIDIA, AMD, and Broadcom all higher this morning, just as we saw when we got Alphabet's massive CapEx number just this week. But we'll see if they're able to sustain this momentum, because yesterday only Broadcom ended in the green, and only by slightly. I will say NVIDIA is outperforming the Mag 7 this morning, up 3% in the pre-market. And we end on Stellantis. Shares are plunging here, down nearly 25%, as the automaker said it will take a $26 billion hit as it scales back its EV ambitions. Stellantis admitting that it bet too aggressively on EV demand that just didn't show up. It joins the likes of Ford and General Motors, which also took multi-billion-dollar write-downs for the same reason. John?
Yahara, thank you. Painful, and it's been a long time coming. The kitchen sink finally coming from that company, and maybe there's more work to do. As for Broadcom, I'm pleased that Yahara brought that stock up. It's amazing that we're in this situation this week where a handful of tech companies have come out and said they're going to spend $650 billion this year. And on the week, Broadcom is lower. by 6%.
I saw a number of analyst notes over the overnight actually pointing to Avco in particular and saying, look, they should be doing a lot better because ultimately they will be a beneficiary. People don't have a sense of where this money is going to go. Otherwise, you would imagine all the semiconductor stocks would absolutely be ripping because $650 billion is a lot of money. I spent way too much time last night trying to calculate what you could buy for $650 billion. I came up with some really creative things.
What did you come up with?
Well, I'm just thinking to power New York City costs about $15 billion a year. So how many cities would you have to finance? How many nuclear power plants? Maybe $15 billion. What about a spaceship that goes up to space and tries to create some of the potential
data centers
in space? I mean, it just starts getting comical when you start looking at how do you spend this money this quickly in this kind of scale.
I was listening to Guy Johnson earlier on this morning. The German federal budget for the year ahead. How about that? I mean, that's insane. That's the German federal budget.
So this is, you start to wrap your head around this and you think, okay, well, this should be a broadening out. But are they just competing with each other to sort of solidify market share, reserve things that aren't going to really come yet? Is this fictitious or is this actually real? I mean, it's hard to get your head really to wrap around it.
Those numbers are big. On our radar this morning, Amazon adding to big tech spending spree, the retail and cloud giant joining Alphabet, Meta, Microsoft, and exceeding CapEx estimates. The four companies forecasting about $650 billion in AI spending this year. Elsewhere, Anthropic releasing a new version of its AI model specifically designed for financial research and office workflows. This coming just days after the company's expansion into legal services sent shockwaves through the software industry. And finally, Bitcoin finding a floor following its steepest single-day drop since the FTX collapse back in 2022. The world's largest cryptocurrency nearly falling below 60,000 for the first time in 16 months.
This is, to me, a really interesting story under the hood. How much is this part of the violent rotation that we're seeing right now? Bitcoin has lost more than $1 trillion since its peak in October 2025, about half of its value. A question here about how levered this fund, this money was, how much this comes with outflows that aren't coming back, and how much institutional investors are willing to go back into this market. That ultimately is the reason why people find it interesting that there is a floor here. Nonetheless, an existential question of what exactly the role is for Bitcoin at a time where it's not providing an offset to risk appetite.
No, it's trading like a risky asset. And you actually saw this come up this week with the Treasury Secretary. He was asked about this. Could Treasury have the authority to buy Bitcoin or other cryptocurrencies? He says, I don't as a Treasury Secretary, and I also don't as the chairman of FSOC. So basically, that whole idea that there were some Republicans actually pushing for that was dead.
Taking stock of things, it's kind of impressive that we've had these crash level moves in places like crypto, in places like precious metals and software stocks, and yet the index is still within 3% of all-time highs on the S&P 500. That's quite something.
What struck me is the lack of fear this week. We saw these really violent moves. We've seen semiconductors, we've seen software stocks down 30% from some of the highs over in October, and yet not a lot of fear. Some people come in, they say, this is way oversold, we're just waiting to find a place to go in, and it's because of that stability in the overall index. If the economy cracks, that changes. And that's the reason why yesterday was a different story.
Excited about the rotation until a couple of data points. We'll see if that's backed up over the next week. Let's turn to Washington. The Treasury Secretary, Scott Bessent, and the Democratic Senator, Elizabeth Warren, fighting it out on Capitol Hill.
Can you commit right here and now that Trump's Fed nominee, Kevin Warsh, will not be sued, will not be investigated by the Department of Justice if he doesn't cut interest rates exactly the way that Donald Trump wants?
That is up to the president. Can you commit that you will?
I'm sorry.
Can you commit that you will not hold up?
He won't be sued if he doesn't drop interest rates.
Can,
if this was a joke, why not just say so?
It was a joke, and he made a joke about you too, Senator Warren.
Yes,
got a lot of laughs.
Bessent's comments coming after President Trump's joke about suing Fed Chair nominee Kevin Warsh over interest rates. Bloomberg's Tyler Kendall joins us now for more. Tyler, it looked like they were getting along just yesterday.
I mean, John, this was a rather contentious 2 days of hearings for Treasury Secretary Scott Bessent on Capitol Hill. This was perhaps the most heated exchange before the Senate Banking Committee between two people that often spar with each other. But the Treasury Secretary there saying that it would be up to President Trump about whether or not to sue or order the Department of Justice to investigate a potential Fed chair, Kevin Warsh, if he does not drop rates, appearing not to rule out the potential. Now, as you mentioned, Warren's comments were referencing these reports from over the weekend that President Trump had joked about the possibility, though we should say he was asked directly about those comments afterwards by reporters on Air Force One, and the president said it was, quote, all comedy. But still, the Treasury Secretary's remarks came after an equally contentious hearing the day before in front of the House Financial Services Committee, where he declined to express a view about whether or not the president has the legal authority to remove a member of the Federal Reserve Board over policy disagreements, saying that ultimately he's not a lawyer and that's going to be a matter that has to be decided by the courts, though he did go on to say that he does believe that the Federal Reserve is an independent agency. But yesterday, the Fed pick was definitely front and center because this is the Senate Banking Committee. This is that gatekeeping committee that has the ability to block Kevin Warsh's nomination from proceeding to the full Senate floor. And as Senator Tom Tillis has said on this program numerous times, he's not going to let up on his threats to follow through in blocking that nominee until the legal matter against Fed Chair Jerome Powell is ultimately resolved. And John, I actually had the chance to catch up with Senator Tillis yesterday. He told me he's still not backing down on the threats. He told me that he's not in touch with the White House on them either at this point in time, that he has no idea when a potential confirmation hearing date is ultimately going to be set.
Tyler, great reporting yesterday. I also saw you spoke to Senator Kramer, who basically told you this is a waste of time. Do you think more pressure is building from Republicans in Congress on the White House, on the DOJ, to just drop this investigation altogether?
Right, Anne-Marie, we're starting to see almost a theme emerge, a common thread here, because Republicans are trying to thread the needle with going with President Trump's criticism against Jerome Powell, but they're against how it's ultimately manifested in this investigation against him. And I spoke to a lot of Republicans on the Senate Banking Committee, this key committee yesterday, that are saying while they disagree with Powell's stewardship of the Fed, they don't think that his testimony amounted to anything criminal, because we have to keep in mind the DOJ investigation, it isn't necessarily about those cost overruns. It is about whether or not Jerome Powell misled Congress about those cost overruns. I spoke to Kevin Kramer. I spoke to Cynthia Lummis. I spoke to Senator Mike Rounds, numerous who have told me that they don't think that what Jerome Powell said ultimately had criminal intent, and that they want to see this investigation wrapped up as quickly as possible. In fact, Anne-Marie, they say that that actually shows why they are in favor of the president's policies, that they want to make sure that this investigation can go away so that they can get Kevin Warsh confirmed as quickly as possible.
That might take some time. Tyler, thank you. Tyler Kendall down in Washington, D.C. Let's park the legal issues and just focus on the data. Who do you think sounds better right now? Chairman Powell last week. Indicators suggest the conditions may be stabilizing in the labor market. Governor Chris Waller, there is considerable doubt about future employment growth and suggests that a substantial deterioration in the labor market is a significant risk. Based on the data in the last 24 hours, Governor Waller is sounding a lot better than Chairman Powell.
It feels like the market is one big applause audience, and it seemed like everyone with Jay Powell until yesterday, and then all of a sudden it was like, ooh, all right, we're going to head over here to what we hear from Chris Waller. Look, we don't know, and I think that ultimately is the real question, and there's a lot of disagreement on the Fed committee, which is the reason why it is so important to understand which Kevin Warsh we're getting, to understand what the leadership will be to guide what is otherwise an incredibly bifurcated committee.
More data next week. Payroll's Wednesday, I believe. February 11th. We'll be playing that game, so looking forward to it. Let's give you an update on stories worldwide this morning with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. Iran and the United States are negotiating to de-escalate tensions. Tehran saying the talks are the first stage of a longer diplomatic process. The U.S. delegation, led by Steve Witkoff, Iran's by its foreign minister. Toyota shares rising in Japanese trading. The company naming a new CEO, Kenta Kon, who will replace Koji Sato, who will become vice chairman in April. Kon served as Toyota's CFO as well as Akio Toyota's personal secretary for almost a decade. As CFO, he oversaw a period of record annual earnings and worked on next-gen cars and mobility technologies. Brevin Howard Asset Management's Minal Biswal is one of the world's most successful macro hedge fund managers, making billions of dollars. He hasn't had a single down year since he started managing money during the 2008 financial crisis. His fund has scored wins on everything from Korean interest rates to Asian currencies. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Up next, a memory crunch.
The industry is now defined by the availability, the memory that is going to be available for consumer electronics. And it creates you know, a sudden change in how OEMs look at their build plan.
Up next, we'll catch up with Bloomberg's Mandeep Singh, live from New York City. You're watching Bloomberg TV.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a little ball. Put wasabi in the middle. Then my process 1 to 6. 1. This is putting the between the rice air. Then make the 4 fingers curl. Make sushi shape. Then touch this. 2. Then turn. Now that these 2 fingers, top to the bottom, make the sushi shape more beautiful. 3. Then, you know, I'm not, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is 1 to 6.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
So here's the bounce. We're up by 0.6% on the S&P 500. Announced bounce on the Nasdaq as well. Likewise on the Russell. We'll see if it holds following the rout over the past 3 days of the Russell 2000 higher by 1.26%. On the Nasdaq up by 0.75%. The numbers this week, absolutely humongous. Let's go through them company by company. Amazon 200 billion. CapEx intentions over at Alphabet 185. Microsoft around 100. Meta 135. 650. In total. Absolutely ridiculous, Bramo, to try and get your head around.
And when you try to get your head around, the numbers seem even more ridiculous. But what really is getting people off guard is A, these numbers are growing much more quickly than the underlying revenues or profitability. And B, the fact that the numbers keep climbing so much far beyond analysts' expectations. So it raises a question. What is the end point? If you're tripling and doubling every single year, at what point do you start slowing your spending?
Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, imagine a number, then treble it. You know, that's where I'm at right now. I just can't get my head around it all, Mandeep. How are these companies going to spend $650 billion this year? What on?
Yeah, look, I mean, I think everyone highlighted supply constraints and the fact that they didn't have enough capacity, otherwise they would have grown faster. So that sort of justifies the increase in CapEx. But you're right. I think the kind of increases we are seeing, probably Google is the only one who has earned it, because their cloud revenue grew 48%, and the infrastructure side actually was north of 50%. And they're doing it at, incremental margins of at least 30-40% compared to an Amazon where the margins are going down. And yes, the growth did accelerate, but it's coming at the expense of margin. So to my mind, there is this rush going on in terms of securing supply at TSMC. And the bigger you are, I think the chances are you have a better shot at securing supply. But if you add up all the CapEx, which you have on the screen, TSMC cannot make as much in terms of, the needs that these companies are highlighting with their CapEx numbers. So they have to significantly ramp their own CapEx, the semi-cap equipment purchases, to be able to service this kind of demand that they're seeing from the hyperscalers. So it'll be interesting to see what NVIDIA guides to, because NVIDIA hasn't moved. I mean, NVIDIA should be up, right, with all the CapEx increases. So there's something that at least limits right now in terms of what kind of upside NVIDIA may end up seeing because of these CapEx increases.
So Mandeep, here's my question for you. What do you think we hit first, serious supply constraints or the limits of investor tolerance?
I think we are already seeing some sort of investor panic in terms of the free cash flow expectations for this year and beyond if this rate of CapEx continues. Because for public cloud businesses, the baseline CapEx was more around $40–50 billion. Now we are 3 to 4 times that. If that doesn't translate into revenue at the same pace, and yes, you have to invest upfront to bring the capacity online, but at some point, you have to ask yourself, if I'm doing it, at the expense of margins and free cash flow, how long do I sustain? And that's where the questions were asked for Oracle. I mean, there was a pushback with Oracle because everything was tied to OpenAI. I don't know who are going to be Amazon's customers for the $200 billion in CapEx. Is it all inferencing, or is there a big training component? Because inferencing workloads are the only one that translate into cloud revenue. Training is more of a sunk cost. Yes, you're going to get a better model, but you're not going to be able to monetize it right away. So all these questions, I think, will become clearer as we go through probably the next 2-3 months.
Mandeep Singh, breaking it down. Thank you, sir. Bloomberg's Mandeep Singh. Alphabet might be the only company that's earned it. That's my takeaway from that conversation.
And this is something that others have pointed to as well, including Gil Luria, pointing to the 48% gain in their cloud computing business versus the 24% gain in Amazon, raising a question of, are the others just playing catch up?
So here's the take from Vivek Arya of Bank of America, expecting this CapEx boom to keep the party going for semiconductors, writing, despite a wall of worries, chip stocks are off to a solid start, marking the second best January in the past 20 years. Vivek joins us now for more. Vivek, welcome to the program. It is strange to see numbers this large and then look at Broadcom down 6% on the week. What explains that?
Yeah, good morning, John. I think first principles, we have to understand that the companies that we are talking about, right, these companies with billions or hundreds of millions of subscribers, they cannot grow 15, 20, 30% without investing in infrastructure. Investing in infrastructure is the only way that they are able to scale their offerings and provide a lot of value add to their subscribers. Because look, the number of subscribers are not growing 20 or 30% for a Meta or others. I mean, it already has 3 billion subscribers. So how does somebody like a Meta grow 30%? It's by extracting more value. So that's point number one, that you need to invest to extract more value. And AI is that intelligence that helps you extract that value. Now, in terms of what we have seen so far from semis this year, it's kind of a tale of two cities. We have seen phenomenal gains from semi-cap equipment, from memory, from optics, from the analog names. I think we could have the first $1 trillion of sales in semi-caps, in semiconductor sales. But the larger names, the NVIDIAs, the Broadcoms, the AMDs, have not participated yet because, I mean, they're not just great semiconductor companies. They also happen to be part of the mega cap sector, which is under a lot of pressure from rotation. But we think fundamentals are strong. You know, valuations are very compelling. So we think it's just a matter of time before the mega caps catch up also.
Vivek, how much more attractive do you think that NVIDIA and Broadcom and AMD are because they've sold off and because they're getting this infusion of massive CapEx spending from the other mega caps?
Sure. I think part of this is a market call as well. that, these companies are phenomenal execution machines. They are phenomenal growth machines, but they are also exposed to the daily headline noise and narratives, whether it's around OpenAI and funding, whether it's about the relationship between US and China. And to be fair, this isn't the first time, we are seeing this. Remember, last year, the SOX index was up over 40%. Both these stocks did extremely well, despite a year where we started with DeepSeek, then we went to Liberation Day, and then we had so many arrows thrown at them. So these stocks are volatile. There are periods when they, are in the background. But as we just discussed, the fundamentals are exceptionally strong, and these companies are, the S&P 500 index is trading at 1.5 to 2 times earnings growth, and these stocks are trading below 1 times earnings growth. So in our book, that's extremely compelling.
As I was lost in rabbit holes of trying to figure out how to spend $650 billion last night, I was thinking, what's the constraint on pricing power for the likes of NVIDIA? I mean, if everybody wants their chips, or TSMC for that matter, if this is basically locking in capacity going forward, why can't they just jack up the prices? Why can't they double them? Why can't they triple them? I mean, what is the limit that really holds them back?
Sure. See, ultimately, they are selling to a group of customers who are extremely sophisticated, who do have other options, and who have to make sure that the price performance matches the offerings they are able to sell to their end customers. And if I look at generation to generation of, let's take NVIDIA's, Hopper to Blackwell generation, pricing probably went up 30 to 40%, but the performance went up anywhere between 2 to 4 times, right, generation on generation. So what we are getting is multiple factors of performance improvement for 20 to 40% increase in price. But no, the answer to your question is that, yes, these companies have great pricing power. I mean, look, NVIDIA has, 70, 75% gross margins, but at the same time, they have to realize that every new generation of product they put out, there has to be a more dollars of performance per unit price, because there is not just inflation in chips, there's also inflation in procurement of land and power and shell. In our book, actually, those are probably bigger constraints than the chips itself in the rollout. And I think the good thing is with those constraints, it might actually add a lot more discipline into this rollout of AI services.
Vivek, I just want to finish on investor tolerance. I think that's an important topic to end the week with. These companies, these chip players that you cover, are only going to be as rich as their biggest customers. And the spend from their biggest customers rests on the investor tolerance of the investors in those companies. Are we starting to see some real pushback this week that might constrain their ability to spend and ramp up spending in the years ahead?
Sure. What I will also say, John, is that spending is not always offensive in nature, right? You don't always spend to grow. Sometimes you spend to protect your turf also. So, without picking a specific, customer name, imagine, if you have a search empire or an e-commerce empire, right, or a social empire, right, you are the largest player, but now you see a group of these disruptive private companies after you. And remember, these companies are all private when they started, and they disrupted somebody else's business model. So now you have to say, what can I do to ensure that I not only grow at an acceptable pace, that I also protect my empire. And then importantly, I also grab all the eyeballs. I have all the customer relationships in place, and it just takes upfront spending to do that. And in the past, what did we have? We had a lot of cash sitting on their balance sheets doing nothing. And now that cash is being put to productive use, in my view.
Hey, Vivek, appreciate your time. Thanks for jumping on for us. Vivek Arya there of Bank of America on the chip names that should benefit from some massive spending from a handful of companies. Up next, we'll catch up with Priya Misra of JP Morgan, Jeanette Lowe of Stratega, Stefan Slavinsky of BNP Paribas, and Michael Collins of PGIM Fixed Income. The second hour of Bloomberg Surveillance, up next.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view. As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anim, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
It's a strong macro backdrop, not just in the US.
This is still a hottish economy.
I think it is a loosening labor market, lots of statistical issues.
There's a lot of difficulty in reading, I think, the trends.
The data has just held up just so well. We think the data will tell the story.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. Your scores look like this. Has a 3% move ever felt so bad? Equity futures on the S&P 500 up by 0.6, on the NASDAQ up by 0.8. A feature of the market this week. To see that move right there and this move right here. Amazon in the pre-market getting absolutely hammered after a $200 billion capex spend for the year ahead, down 7%. To see that stock down 7%, and the NASDAQ still higher, is kind of the story of the week so far.
Lizanne Saunders had a great quote yesterday where she said, rotation is the new momentum. And ultimately, you're seeing violent rotations underneath the surface. It is notable that we're talking about $650 billion of capex spending. One newspaper said that Amazon, Google, and Microsoft are set to lose a combined $900 billion of market capitalization since their earnings reports. These numbers are almost fictitious at this point. It's hard to get your head around them. The fact that the market has continued to chug along is predicated on the idea that the spending is going to go somewhere and that the economy is solid. If that gets challenged, this story changes.
Is the equal weight just short of an all-time high? The equal weight this week is actually up on the week, even with these kind of moves that we've seen, 10% on Microsoft, 8% on Amazon.
Well, so it's under the surface where all this is going on, but under the surface it's absolutely brutal, especially given the fact that everyone has been looking at these names to continue to carry the equity market. I cannot wait to talk to Gil Loria, because when he talks about Amazon, he's saying the negative reactions relative bigger increases to CapEx than to AWS revenue. AWS had actually pretty good revenue, but it wasn't good enough. And what do we just hear from Vivek? A lot of this spending may be individuals trying to protect the perks that they have right now.
Always find that moves like this bring the best out of Wall Street. Great quote came from Michael Kantrowitz over at Piper Sandler with this to say: I think we're seeing the unwind of a 3-year economic and market bifurcation that's beginning to broaden out.
I love that, especially given the fact that yesterday it was a jobless recovery. It was the jobless expansion. The problem with this is that you need the real economy to participate with some sort of gains if you do get this sort of right sizing of the economic benefits that we've seen over the past couple of years. And yesterday, the trifecta of what we got with challenger job cuts, then what we got with jobless claims, and then what we got with the JOLTS numbers raised questions about just how durable that story is. So right now, the ultimate question is, as we get this violent rotation, do we get the economic boom that so many people were hoping for? Does that $650 billion go to things that we can relate to, or just sort of fibers that go up into space?
If last year tech capex was more than 40%, roughly 40% of GDP growth in America, what is it going to be this year at $650 billion just from those companies?
People are looking at that as being something like 2% of the U.S. GDP, but the truth is, we have no idea where this is going. We don't know if this is land. We don't know if this is promises to TSMC to get them flowers when they give them their chip orders. I mean, how much do we have an understanding of exactly how they're going to spend this in a way that actually will be expansionary?
A lot will go to chip companies. Broadcom, Nvidia, trading positive in the pre-market by 3 to 4% so far. Equities up by 0.7 on the S&P 500. Coming up this hour, we'll catch up with Priya Misra of JP Morgan as Wall Street looks to find a floor. Stefan Slavinsky of BNP Paribas as software stocks shed billions in value, and Michael Collins of Peach in fixed income as weak labor data weighs on investors. We begin this hour with stocks finding a firmer footing after a 3-day tech rout. Priya Misra of JP Morgan writing the market is trying to figure out the AI winners and the losers. Priya joins us now for more. Priya, good morning.
Morning.
Bond market's the clear winner this week, surely.
Indeed, and that diversification aspect, that fixed income, that treasuries, that duration. You know, I think a lot of people sort of stay in the front end. The front end doesn't give you that much. So we've been saying, this is the revenge of thinking 375 to 4.25, sort of that 10-year range. We went above it, sell America, you know, just a lot of supply, the tax refunds, all of that sort of got us above that. We think that's an opportunity, you know, but ultimately I think we're in this point where we don't know. You know, remember when sort of AI capex was all that the market was looking for last year? I think the market's pushing back. The market wants to see there's a bit of a show me. Show me the productive users of that AI capex. Show me how people are using it. I mean, we're using it to sort of reduce the no joy work, as you know, we put it. But is that going to displace us? Is that going to just disrupt us? I think that's what the market's trying to figure out. We're not going to get answers very quickly. This is such a generational transformation. We're going to live in this bumpy ride, and this is why I would say, you know, sort of watch positioning, look at fundamentals, and then make sure that you own those hedges. As the market starts, if the market starts to say that maybe this is overdone, that's when you're going to need those hedges.
You threw some mud at the Sun America trade. At least that was how I interpreted it. So let's get into that a little bit. This was an important stress test over the past few days. How important is it to see that the dollar and bonds is still inversely correlated with risk appetite?
So on bonds, I would say we have a lot more faith there. The dollar still looks a little overvalued. Now, it was very heartening what we saw yesterday, but on rates, so where does that correlation or negative correlation come from? It comes from the Fed reaction function. I think that's still very much there. I mean, we have a divided Fed. Chair Powell said that there's no urgency. But you see a rise in the unemployment rate, or you see a clear sign that we're moving from a low higher, low fire to low higher pickup in fire or high fire, you're going to see the Fed react aggressively. This is not a shy Fed. Irrespective of the chair, I think the divisions will actually go away. I mean, the other thing is, it was AI inflationary or disinflationary? I think that's been another debate in the macro world. I think I'm looking at, as a macro person, I'm looking at price action, and the market's telling you it's disinflationary. Now, we have to see it in the data, and I think we'll see it later half of this year. As inflation starts to get low, I think the Fed's telling you they might cut. So on your point around that diversification, I think bonds tell you the Fed response. With the dollar, we still have to see there's a lot of value globally. We're seeing cyclical pickup. Look at ISM. So there still may be some pockets of weakness in the dollar. But I think, you know, price action like yesterday does tell you this is why you should have a diversified portfolio. And on the sell America, I mean, We're not seeing it in the credit market. I think that would be one that I would look at. The equity market's so much about AI and software. Look at the credit market, and that's where there's incredible calm, as we've had a lot of supply.
There's a lot to unpack there. You just start talking about how a lot of the bond market is trading on the idea of the Fed reaction function. Isn't the Fed reaction function pointing to a pretty negative outcome for the U.S. economy right now, that they're cutting rates for the wrong reasons, which is a slowdown in the labor market, not because of the disinflationary boom from artificial intelligence?
So great point. I think in 2024, the rate cuts were about the labor market. In 25, it was more inflation. And I think we're going to have to figure out these rate cuts. Is it what Kevin Walsh has talked about, this productivity boom with the supply sides kicking in and the Fed needs to cut? That's actually good news for risk assets. I don't know if we see it in the data. Productivity is high, but it's like it's a residual. So I don't know if I buy that. If it is a rise in the unemployment rate, I think the market might cheer that we get lower rates. I would be careful, because if the labor market's turning, it tends to trend, and then rate cuts will take a while. We're going to have to look at fiscal. Do we get more than just the tax refund? So I see your point. Rate cuts, lower rates for the wrong reason is negative for risk assets. But I think if the Fed is aggressive, if we see a small rise in the unemployment rate and the Fed starts to cut aggressively, I think the market might cheer, as it has for the last 2 years. It's how reactive, how aggressive the Fed will be that can sort of impact risk assets.
You said something else, which is that you could see that foreign institutional investors are still going into U.S. credit. They're still liking the U.S. Financing mechanism for, guess what? Some of these big tech companies, which are accounting for a greater and greater proportion of the overall broad investment grade index. Does that worry you? Do you see anyone pulling back and saying, hold on a second, what exactly are we financing?
So, I've joked before that when you call people to the bond party, everyone gets a little nervous. And I think there was some of that late last year. We're going to see it again. How much of this CapEx is going to be financed by the bond market? And how much is going to come from elsewhere? I think the market is the ultimate disciplining factor. And we saw this with Oracle. There was concern, $50 billion in bonds. Well, I'm going to want a little bit more concession there. But they actually issued only half of that. And then you look at the book. So I think when we think about fixed income, people have been very underweight fixed income. When they think of fixed income, they sometimes think about the front end, because they say, well, there's no diversity. We don't know about diversification, and there's not a lot of income. Well, guess what? You're getting 5.5% in high quality fixed income. And this is where I will say, let's look at the companies. We still think these companies, whether it's the software names, they're still tight. So we're not saying that that's very cheap. That's going to widen. I think you look at the fundamentals, look at leverage ratio, look at cash flow. There's still a lot of good value. And I think people look at fundamentals, they see that 5.5%, 6% all in yield, and they buy. So we've still seen, look at the order books, there's going to be supply. As long as these companies don't overdo it and really swamp the bond market, I think we're seeing that demand. Spreads might be a little wider. There's more dispersion, actually. That's, I think this is why we're seeing it in the high yield market. Look at loans versus bonds. I think we're going to see it in the investment grade market as all of this $650 billion starts to get financed. And if somebody overdoes it in the bond market, they're going to cheapen. And this is why active management, fundamentals, we're all over our research analysts every single day, multiple times a day. I think this is the time when, I don't know, it's a bond market, stock picker equivalent time, because there's going to be a lot of supply that's going to come in. We're going to have to pick and choose what we're overweight.
Priya, you mentioned the fiscal impulse. Is any of that inflationary when it comes to one big beautiful bill that you'd be worried about?
So a lot of what was in the one big beautiful bill was extension of the tax cut. So I don't see that as being inflationary. I think there's this talk of tariff, the tax refunds. I think if it goes to the upper part of that K, it's going to get saved. It's going to just expand the K. Where's that income distribution of the tax refunds? There may be some sort of sugar high, but that's for a couple of months. That's for the first, maybe second quarter, if it's not already been spent. So I don't see a whole lot in the one big beautiful bill. Now, if you get tariff dividends, you get something additional. I'm not sure how they get that done, but I think additional fiscal stimulus can be inflationary, not what we're seeing from just the one big beautiful bill.
Should we finish on the yield curve? 2s versus 10s, just off the steepest level since January 2022. What do you think that's sniffing out?
I think the steepening in the curve, particularly what we saw yesterday, is the market pricing more cuts in the front end and sort of keeping the long end here. It's also a global story. I mean, we have the Japanese election on Sunday. along with the Super Bowl. So we'll be watching that.
That is our Super Bowl, Priya. You know that. Continue, please.
We'll be seeing if global bond is that term premium increase in the long end. I think, I think that's well priced. Let's hope for not a lot. I would prefer duration over the curve, but I think the curve is telling you that if the Fed's going to cut, it's likely to impact the front end much more. But I think owning the 5-year, if you don't have a strong view on the Japanese election or how quickly the Fed's going to cut rates, I think duration feels like better risk reward given current levels.
I think there are stronger views on a Japanese election around this table than there are on the Super Bowl, but we'll leave that there. Priya, thank you. Priya Misra of JP Morgan. In the bond market, 10s in a moment, 420, 2s at 348.
I'm just thinking, if Bad Bunny's playing at the halftime show for the Super Bowl,
Takeichi's got us covered, right?
Is it going to be Taylor Swift? Is it going to be, or you think Takeichi's going to do it personally? Wow. Oh, yeah, because she was in a band, so she can actually have her own halftime show.
That's where I was going with this.
Okay, well, that's so good. All right, sorry,
All right.
I blew it.
Let's move on. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. The Search for Today show co-host Savannah Guthrie's mother is entering its 6th day. The FBI announcing a $50,000 award for information leading to Nancy Guthrie's recovery or the arrest and conviction of people involved in her disappearance. The Pima County Sheriff's Department says neither a suspect nor person of interest has been identified in the case. President Donald Trump launching a new website to apparently help Americans buy select medicines at a discount. The president saying more than 40 medications will be available through the site, including Novo Nordisk's Ozempic and Wegovy for $199, as well as EMD Serono's fertility treatment. OpenAI is rolling out a new platform called Frontier, designed to help companies deploy AI agents more easily. The company says Frontier aims to simplify how businesses roll out AI and accelerate adoption among corporate customers. The tool will also allow firms to integrate AI agents from rival firms, including Anthropic. And that is your Bloomberg Brief. John.
Vonnie, thank you. More from Vonnie in about 30 minutes. Up next on the program, casting down on the Powell probe.
Whether he had criminal intent is not my decision.
Was it criminal? I don't think so.
So I would like to see the investigation wrapped up quickly.
Until the investigation is done, I will oppose any board confirmation.
Up next on the program, we'll catch up with Jeanette Lowe of Strategas, live from New York City this morning. Good morning.
Going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Bersetchi. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility. There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays, only on Bloomberg.
Single name price action has been absolutely massive. Amazon down by 7% in the pre-market, intended to spend $200 billion in capex for the year ahead, punished because it's not putting up the same growth numbers that we've seen out of a company like Alphabet. But a feature of the week is this right here. That you can have single name moves of this size, move this much, and the damage is limited at the index level to this. The S&P 500 is higher on the session by 0.5%. And even when it's traded lower, we're down like by, what, 2% on the week? We're within 3% of all-time highs on the S&P 500. This rotation beneath, I know a lot of people are talking about the same thing, but I don't think you can overstate the importance of it, given the price action we've seen so far over the past few days.
And the magnitude of the rotation away from certain areas. You talk about the software stocks that are down some 30% from the highs that they had last October. You look at Bitcoin, that is down about 50% from its high in October. It is violent, but it is a rotation. It isn't necessarily Armageddon. That said, a real question of how much this is predicated on the growth of the economy and how much is this going to be predicated on the use case for some of this incredible CapEx spend.
The price action in the last 24 hours had a different flavor. It wasn't just about software stocks, it was also about the real economy, and maybe just opening the door just slightly to a conversation about interest rate reductions. Under surveillance this morning, casting doubt on the Powell probe.
He obviously didn't tell the truth about the renovations. Whether he had criminal intent is not my decision.
Was it criminal? I don't think so.
I was at the hearing where some have said Chairman Powell perjured himself. And I didn't hear anything that could be remotely considered to be perjury. So I would like to see the investigation wrapped up quickly.
Until the investigation is done, I will oppose any board confirmation.
So here's the latest this morning. Republican senators voicing skepticism on the DOJ's investigation of Fed Chair Jay Powell as President Trump says D.C.'s U.S. attorney will take it to the end. Bloomberg's Tyler Kendall joins us now for more. Tyler, that's some real Republican pushback through this week.
Right, exactly, John. I mean, numerous Senate Republicans told me that they increasingly view this Department of Justice's investigation into Fed Chair Jerome Powell as this unnecessary roadblock that could stall Kevin Warsh's nomination, which they broadly support. I spoke to a lot of members of the key Senate Banking Committee who told me while they broadly agree with President Trump's criticism of Fed Chair Jerome Powell, they don't agree with the investigation that's resulted, because we have to keep in mind the nuance here is that the DOJ's probe is looking into allegations that Powell misled Congress about the Fed's renovations to its headquarters here in Washington. The probe isn't just about the cost overruns themselves. It is about that testimony that Powell gave to the Senate Banking Committee. So all of those members that you just heard from actually heard from Powell in real time when it comes to the testimony in question. And they're saying that they don't think that he had that criminal intent and that there's anything here for the DOJ to investigate. Now, to be sure, a lot of them still told me their criticism of the Fed chair, but they actually say that it is their support of President Trump's agenda that actually makes it make sense for them to wrap up this probe as quickly as possible. Because as you well know, and you just heard from Senator Tom Tillis there, he says he's going to block any nomination until that legal matter is resolved. And they want to see Kevin Warsh confirmed as quickly as possible. John, perhaps the staunchest criticism of this probe came from a really staunch ally of this White House, Kevin Cramer of North Dakota. He told me that he thinks that this is a distraction and a waste of time. The question now becomes, what does the DOJ do? Because as you said, President Trump says he wants to see this investigation taken all the way to the end.
Tyler Kendall, thank you. Joining us now to continue the conversation, Jeanette Lowe of Strategas. Jeanette, if Republican senators, in Tyler's words, are calling this a waste of time, how much more time are they going to waste?
Yeah, it's a great question. I mean, I think that, as Tyler pointed out, this is literally something that the Republican senators are now thinking we need to get this investigation concluded. We need to kind of clear Powell, which is something that Tom Tillis is looking for, because they do need his vote to move Kevin Warsh through the Senate Banking Committee, and they would like Kevin Warsh to be confirmed before Powell's term ends on May 15th. So I do think you'll probably start to see some various senators. Yesterday was really important. Is an important distraction potentially for getting Kevin Warsh ultimately on the Fed.
Movement from who? Is it the DOJ to wrap it up, or for Fed to actually also comply and send the information that the DOJ is asking about in terms of the renovations?
Yeah, so I mean, I think that's a little bit to be determined, right? There could be that maybe the Fed just hasn't responded to the questions yet. Maybe they just need to respond to the questions, and then the DOJ will kind of finalize the investigation and say that there's no wrongdoing here. Maybe it's some other form that needs to take, but there probably is a way that this could be handled relatively quickly so that we can actually move on from this, and then actually the Senate Banking Committee can bring in Kevin Warsh and actually have his confirmation hearing.
You sound hopeful of a quick timeline. If we don't, do you just expect Powell to be chair until how long?
Yeah, I mean, this is a really important question, and obviously there is discussions about what happens if there is no one confirmed to be the Fed chair when Powell's term ends. What happens? Does it become the vice chair? If there's no vice chair, is there a possibility that the vice chair could resign? Those are all things, and then ultimately the board could reappoint Powell. The other big question, obviously, is does Powell stay after his term expires? I think this is a really important question for what Kevin Warsh would like to do at the Fed. Obviously, whether or not the president can get another appointee onto the board of governors. They do want to engage in financial deregulation. Vice Chair Bowman has a proposal that she may announce as quickly as this month. So they do need to actually move forward on that. That's going to be key to Warsh's trying to reduce the size of the Fed balance sheet. But they also need a majority of the Fed board members to vote for the most aggressive plan they could have. Right now, if Powell remains on the Fed, that could limit the ability for them to actually get to that majority. So his staying on or not is going to be a key question moving forward as to how things actually proceed, and also what might happen if there is no Fed chair confirmed before his term expires.
While we wait for the next edition of Bachelor in Purgatory, Jeanette, I am curious going forward. It is a midterm election year, and we are going to expect a number of proposals to try to cater to how people feel, which isn't great and has to do with the affordability issues. We saw yesterday President Trump coming out with Trump RX, trying to lower costs for prescription drugs. What else do you think is in the works for this year as the midterm elections get closer?
Yeah, so I mean, I do think this is going to be a key focus for the midterm elections. You saw it be a key focus for the November 2025 elections to focus on this issue of affordability. And Trump has definitely picked up the mantle of this quite a bit more in the past few weeks. So obviously we had the prescription drug price proposal come out yesterday. We do think they're going to try to do things on housing. Some of that would be related to, again, whether or not, not even necessarily trying to do legislation or anything of that nature, but maybe what happens with the Fed and what happens with the Treasury. Those can be important pieces for the housing market. The other big thing, obviously, is there are these large tax refunds that are going to come out. The tax refund just started last week. We'll definitely start to see more of those come out. That will be very beneficial for consumers. Will it be enough before the election? They probably don't think so. They'll probably try to come up with some other ideas. Presidents tend to be more populist in the second term of their presidency because voters are a little bit sour on how things are going. So we could definitely see more announcements. We'll be looking to the State of the Union to see if stuff comes out there. But I don't think that there's a lot more that is actually going to get enacted. We don't think that there are going to be tariff refunds that are going to come out because you would need Congress to do that. But you might see them try to move things like permitting reform and things of that nature. But I think the president will continue to talk about it, but we don't see a lot of movement for more proposals to come forward.
Jeanette, thank you. Jeanette Lowe there, a strategist. Those final few points, really, really important. The three tailwinds for the economy this year, the tax refunds, the monetary policy stimulus already in the pipeline, and then $650 billion worth of spending from just 4 companies. And if you're an advisor to the president and you sit there and you tell him that, how patient can he be? How much can he rely on those 3 things going into the midterms?
Well, how patient can one person, or how patient can President Trump? Right now, it doesn't seem like anyone's particularly patient, just because the polls are reflecting serious concern. And I have to say, the $650 billion, when I pay my electricity bill, am I competing with Amazon? I'm serious. This is actually a serious question.
I'm really glad you brought this up, because the Michigan Attorney General is actually going back to the utility, saying these data centers, I don't want to go ahead with this just yet. I don't trust these companies. She literally called them untrustworthy when it comes to OpenAI and Oracle.
The pushback is real. It's not a risk. It's happening. Coming up next on the program, Stefan Slavinsky of BNP Paribas on the sell-off in software stocks.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the Dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
So deep breath. Here's the bounce. 3 crazy days. Equity futures on the S&P up by 0.5%, following the biggest 3-day decline going back to November. Over that period, down by 2.55% on the S&P 500. Yesterday, a bit of a different character to things, though, and we've talked a lot about that so far this morning. It wasn't just about tech stocks. It was across the board. Financials, energy, consumer discretionary. Only 2 major sectors in positive territory at the close yesterday. Utilities and consumer staples, and that was off the back of weaker than expected economic data. So switch at the board and let's talk about this. Sell America. We've all read that headline a few times, haven't we, over the past few weeks? Was it a Sell America trade, or was it just consistent with a pickup in global risk appetite? And once that reversed, did the money come back to bonds? Did it come back to the US dollar? That's what we saw yesterday. 2-year bond yields down 10 basis points. This morning up by 3, still sub 350 at 348. And in the FX market, worth noting, the dollar is on course for its best week of the year so far, which would speak to the idea that this wasn't about Sell America. It was about a pickup in risk appetite globally with an AI twist, and when that unwound, the money went back into the US dollar.
There certainly was a reversion of a lot of the trades that had gotten popular earlier this year. With respect to the bond market, it seems like the Fed very much in focus and the possibility that they could cut rates more significantly. With the dollar, a real question about the U.S. economy and how much it can grow despite some of the disruption that you're seeing under the hood. That, I think, is going to be what you have to watch going forward to see whether this is sustainable.
Bond investors, the only people popping champagne this week. The bonds work, and they've been trying to tell people that for a while.
If I ran a utility, I'd be popping champagne too, because I could charge whatever I wanted for electricity. I mean, there are some people who are popping champagne or maybe a box of Lay's, because ultimately that also is gaining some today. But we're looking right now at a market that is incredibly bifurcated, and people are seeing a disinflationary boom under the surface, and that, I think, is benefiting fixed income.
It was an important stress test for the bond market this week at least, and let's see if that correlation, that inverse correlation with risk, sticks for the year ahead. Yields higher by 2 basis points on 10s, 420. Plenty of big movers out there, including Amazon. Let's get to your morning movers with Yahira. Hey, Yahira.
Hi, John. Big Tech's $650 billion spending spree is helping to lift the names part of that build-out, the chip makers. We are seeing NVIDIA, AMD, and Broadcom all higher in the pre-market, though we'll see if we're able to sustain this momentum. As you guys were talking about champagne, this momentum keeps fizzling out, since only Broadcom yesterday managed to end the day in the green, and only by slightly. And as you said, John, all these stocks down on the week. Meanwhile, moving on to Stellantis, where shares are plunging in the pre-market, down now nearly 28%, as the automaker says that it will take a $26 billion hit as it scales back its plans for EVs. Stellantis admitting that it bet too aggressively when it came to EV demand. That just didn't show up, so it's joining the likes of Ford and General Motors, taking multi-billion-dollar write-downs. And we end on shares of Hims and Hers. They are falling more than nearly 9% in the pre-market as it faces FDA scrutiny and a legal challenge from Novo Nordisk stemming from its announcement this week that it will sell a cheaper, unapproved version of Novo's Wegovy pill, which is a drug still under U.S. patent. And yes, at one point, Hims was able to sell compounded versions of drugs since they were in short supply, but that no longer applies since Novo does have plenty of supply. So you're seeing Novo shares up 6% in the pre-market. John?
Yahira, thank you. More from Yahira in the next hour. Speaking of popping champagne, this headline just crossed the Bloomberg terminal. The bonus pool at Goldman, JP Morgan and Bank of America rising at least 10%. So some smiles out there, I'm sure.
Congratulations. You guys also get champagne along with your utility company that's going to be getting some of that bonus check. Look,
these weren't the people worried about paying their utility bill at the end of the month.
I would agree with that. And they probably are the people who also are benefiting from some of the IPOs that could come down the pike from the likes of OpenAI. Let's see what that looks like later this year. But clearly they've been doing well, and you have seen that war for talent really heating up on Wall Street.
The latest on bankers' pay there. On our radar this morning, Amazon shares dropping on plans to spend $200 billion this year on data centers, chips and other equipment. The move bringing total capex for the four largest U.S. tech companies to about $650 billion this year. Elsewhere, Stellantis shares falling as the company announces $26 billion in charges to reverse course on EVs. The write-downs following similar moves by fellow car makers Ford, GM and Porsche. And finally, a clash on Capitol Hill. Treasury Secretary Scott Bessent and the Democratic Senator Elizabeth Warren sparring once again.
Can you commit right here and now that Trump's Fed nominee, Kevin Warsh, will not be sued, will not be investigated by the Department of Justice if he doesn't cut interest rates exactly the way that Donald Trump wants?
That is up to the president. Can you commit that you will?
I'm sorry.
Can you commit that you will not hold up?
He won't be sued if he doesn't drop interest rates.
Can,
if this was a joke, why not just say so?
It was a joke, and he made a joke about you too, Senator Warren.
Yes,
got a lot of laughs.
President Trump joking about suing Kevin Warsh at a dinner in Washington last weekend. Bessent testifying yesterday that Warsh is highly qualified to lead the Fed.
All right. There's nothing that I can say that can actually be more entertaining than that. That's just clearly entertaining. It's kind of like my boys at the dinner table ragging on each other. I mean, that's what it sort of feels like. Whether we're moving toward any kind of clarity on what President Trump's interference or not will be with Kevin Warsh, whether we're moving toward clarity, sorry to throw some cold water on this because it's very exciting, but I'm looking for the news here, and it's that they had a very exciting sparring match that they can both put on their social media accounts and look good.
And they both did, and then I went, chasing after what the joke was. I found out what the joke the president made about Elizabeth Warren, but the joke he did make about suing Kevin Warsh, he already told us on Air Force One reporters. He said, look, it was a roast, it was a comedy. And then he said to NBC News, if Kevin Warsh came in here and said, I want to hike interest rates, no, he wouldn't have gotten the job. So we know where the president stands.
Don't bury the lead. What was the joke?
The joke was Warren got turned away from the alfalfa dinner because she didn't have a reservation. And it goes after what Trump always calls her Pocahontas, because when she ran, obviously a lot came out about how she said that she has heritage back to the Native Americans in America. So that was his joke about Elizabeth Warren. And then Bessent said, look, it got a lot of laughs. He was trying to engage with her, but she was not having it.
He managed to make her smile, kind of, just about. Okay, let's turn back to tech. A single Anthropic plugin providing even more fuel for the sell-off. The S&P 500 software index on track to wipe out $1 trillion in value since the rout began. Stefan Slawinski of BNP Paribas writing, should software companies show stabilization in their core businesses, investors may be willing to live with long-term uncertainty. For now, investors are saying, we'll believe it when we see it. Stefan joins us now for more. Stefan, good morning to you. Are you reassessing the multiple that these companies deserve?
Yeah, so at BNP Paribas this week, we've been helping investors trying to understand what's being priced into these stocks. It's difficult. When you're talking about technology disruption, obviously you're talking about a lack of visibility on long-term cash flows and long-term growth. We've looked at sort of reverse DCFs, and some of these stocks are already pricing in declining growth going forward. And when you look at free cash flow yields, most of the sector's already trading on kind of all-time lows in terms of free cash flow multiples here. So it's difficult, and I think that's the uncertainty that we're seeing. And so what we've seen this week really is a combination of uncertainty, really causing people to doubt their positions, and two is fatigue. It's been 3 years, Jonathan, and we're still getting every single week a whole slew of announcements around AI, and I think that leads to three, which is capitulation.
We've seen some of that in some stocks like Salesforce. Salesforce is down 28% so far year to date, Stefan. Do you think there are opportunities already opening up? And you mentioned your conversation with clients. Are you pointing them in the direction of certain names, and can you share them this morning?
Yeah, absolutely. There is a part of the market. We're starting to see long-only investors who are kind of dumping the sector, which is a problem, of course, because it takes longer to recover from that. But I think when you look within software, if you think that the CapEx pressure is overdone, then you look at a Microsoft. For the first time in 10 years, Jonathan, Microsoft is trading below an S&P 500 PE multiple. And so that's an opportunity for a company where people are worried about the capital expenditures. If you look at SaaS, as you just mentioned with Salesforce, you've got about a 9% free cash flow yield. You have no free cash flow risk. You have no CapEx risk. And you have arguably potentially 2 home run AI products in Data Cloud and Agentforce. So that's one that we would be looking at if you think the SaaS sell-off is overdone. And then if you look at the kind of throwing the baby out with the bathwater category, look at a Snowflake. These are companies that should benefit from AI. AI is actually causing an acceleration of moves to the cloud, what we've been seeing for a decade. And so someone like a Snowflake who actually benefits from that, is also seeing their stock heavily under pressure. And also that company already has a consumption-based business model. So there's no seat-based disruption risk.
Stefan, as we talk about numbers like $250 billion with just sort of a brush of the hand, is there power in scale? Is there power in numbers? Do you agree with Dan Ives that you're going to see some real consolidation in the software space?
I'm not sure how quickly consolidation is going to happen, but we certainly could over time. That's what we've seen in the past during periods of stress. That's what we've seen in the past during periods of transition, of new platforms. The problem is, of course, right now, a lot of the stocks that are under pressure for a reason. And I'm not sure the market would react well to some of the big players acquiring some of those businesses, even maybe if it's the right thing to be doing. I think what investors are looking for is managements and insiders to step up and start buying their own stock. I think that would really kind of instill some confidence rather than just telling investors the sell-off is overdone, maybe launching some corporate buybacks. Management teams need to step up, insiders need to step up, and show the confidence they have in the outlooks of their own businesses.
Stefan, given the scope of the losses, are you surprised at how orderly this process has been, how it hasn't come with broader market losses, and it hasn't come with a broader wave of existential fear?
Well, I think as you pointed out over the course of the show this morning, there are lots of cross currents. This isn't just about software. This isn't just about AI. There's lots happening within the market. We're seeing that impact different asset classes. I think for software, what investors are coming to the realization of is the only thing we know for sure is we're going to get more models, we're going to get more money, more infrastructure, and more uncertainty. So the one thing that we know is that we're going to have Grok come out with new models from XAI. We're going to have Meta come out with their models. They're going to have capabilities that maybe will spook people in other industries. And that's one of the challenges for investors is every week there's a new model that's strong in a new area that's going to spook some of the incumbents. We're going to get more money, as has been publicly reported. Anthropic, maybe $20 billion raise. OpenAI, $100 billion raise. XAI being bought by SpaceX gives them cash flows now to invest more. That's going into the infrastructure. So $700 billion of CapEx now this year from the big five. And all of that's just going to lead to continued uncertainty. And so I think investors are growing fatigued of that. They don't see an end in sight. Maybe some of them are looking to pick up names, but we're not seeing a lot of it.
Stefan, when you say that some of these management companies should step in, basically they should put the money where their mouth is. Who do you think would be right to do that and do some buybacks?
All of them, any of them. I think in terms of the buybacks, we're seeing that already at the corporate level. A company like Adobe, which of course has been under pressure for a couple of years now, trading on a 9 or 10% free cash flow yield, doing a significant amount of buybacks. That's kind of the Oracle playbook. Oracle was dead for a decade. They bought back 40% of the company over a decade. And so we're starting to see that already. Salesforce is doing that. They're taking the share count down. But the second part that we need to see, like I said, is the management teams themselves, the CEOs, the CFOs buying stock. We saw a little bit of that at SAP with the CFO stepping into the market and making $1 million plus purchase of stock. We need to see more of that.
Stefan, appreciate your time. Thank you, sir. Stefan Slavinsky there of BNP Paribas. Some of the carnage we've seen in software. Microsoft, year to date, down by close to 20%. we have lost $671.2 billion in market cap since the start of the year.
Yeah.
What name?
I mean, this is the reason why it's notable that the market, that the overall index isn't down even more. What is the metric for success or for the lack thereof? It is the growth of your underlying cloud business, your growth of the application of these services, paired with the growth of your capital expenditures. Are you spending in order for it to be defensive, to preserve your turf, or is it to be offensive, to win capital market share? And that, I think, is what people are focusing on.
We've got a bit of a bounce so far this morning. On the Nasdaq, we're higher by 0.6%. On the Nasdaq 100, on the S&P, up by 0.5%. With an update on stories worldwide with your Bloomberg Brief is Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Republicans on the Senate Banking Committee are raising doubts over the DOJ's investigation into Fed Chair Jay Powell. Republicans increasingly view the probe as an unnecessary roadblock in a confirmation process for Kevin Warsh. Senator Tom Tillis said he would oppose any Trump Fed nominee until the issue is resolved. Work on a $16 billion Hudson River Rail Tunnel project has come to a halt. The Trump administration decided last year to freeze funding for the tunnel, which was expected to ease congestion between New Jersey and Manhattan. The Gateway Development Commission has sued the federal government in an effort to unlock more than $205 million. Tesla is looking at multiple sites across the United States to start manufacturing solar cells. Sources telling us here at Bloomberg, the company plans to expand production at its Buffalo, New York facility and at another factory in that state. Tesla also weighing Arizona and Idaho for new additions. And that is your Bloomberg Brief. John.
Thanks, Vonnie. Appreciate it. Up next on the program, signs of weakness in the labor market.
It's a complex job market, is a complicated situation and complicated data. You could get a 0 or a negative number, and I think that's where the underlying pace of job growth is running, somewhere right around 0.
Michael Collins of PGIM joins us next.
What's great about it is it's a well-developed gaming ecosystem, right? So, folks know to find games there, but it's also a highly competitive gaming ecosystem. So its developedness gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are going to unleash this with a bunch of creators.
To the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe. I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie. This is your opening trade.
Only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Hazla Amin in Davos, Switzerland, and this is Bloomberg.
No guarantees, there never are, but these are the moves this morning and we'll see if they hold into the open and bell and beyond. Equity futures positive by 0.5, on the Nasdaq up by 0.6. On the Russell, that outperformance again returns. The Russell 2000 higher by 1.23%. There was a different flavour to it all yesterday. We've talked lots about that extensively so far this morning. The weaker than expected economic data putting a bid into the bond market. 2-year bond yields down by 10 basis points. 2-year yields down to 348.31. 10-year yields up 2 this morning to about 420, in the middle of the range of the last few weeks. Under surveillance this morning, signs of weakness in the labour market.
It's a complex job market, is a complicated situation and complicated data. Month after month, people are telling us jobs are becoming harder and harder to get. So I think it is a loosening labor market, lots of statistical issues. If we get a big update to that birth-death model, you could get a 0 or negative number. And I think that's where the underlying pace of job growth is running, somewhere right around 0.
So here's the latest this morning. Jobless claims and challenger job cuts raising concerns about the labour market, with the delayed payrolls report due on Wednesday. Michael Collins of PGIM Fixed Income writing, the labour market is flashing more red lights. The last handful of data points are all starting to hit levels of change typically associated with recessions. Mike joins us now for more. Mike, good morning. Begs the question, is this time different?
You know, I don't know, Jonathan. We've been on kind of a 5-year pattern here ever since kind of the boom in the supply and demand for labor following COVID. We've been on a gradual slowdown, as we've been talking about for months now, if not a couple of years. It seemed like over the last couple of quarters, maybe the labor market was stabilizing at a kind of a weakish level. But certainly the last handful of data points, as you just pointed out, looked like a kind of a re-acceleration to the downside. But again, you know, you need a lot more data to really determine a trend. But the labor market looks weaker, right? And this whole kind of battle that the Fed is fighting, this tug of war between inflation and labor, it feels like the labor market will win out.
Governor Chris Waller doesn't need more convincing. He already voted for a rate cut last week and he dissented. He put out this statement, Mike. I'm going to share some of it with the audience if they haven't read it already. Last year's data will be revised downwards soon to likely show that there was virtually no growth in payroll employment in 2025. Zero, zip, nada. Let this sink in for a moment. Zero job growth versus an average of almost 2 million for the 10 years prior to 2025. And Mikey goes on to say, all of this suggests that a substantial deterioration in the labour market is a significant risk. So Mike, when we're talking about rate cuts this year and the market's around 1 to 2, and we have economists come on the programme say, you know what, we expect 0. What are you expecting?
You know, it's a real tough call. I mean, 1 to 2 still sounds like the right number, but I think the preponderance of risks, Jonathan, is too much more cuts, or many more cuts than are priced in, right? I mean, the market is putting a very low probability on a funds rate kind of in the 2s or even 1s over the next several years, right? The markets have kind of consolidated around this expectation that the funds rate is going to stay kind of in that 3.5% for the next year or two. And then, believe it or not, looking at the steep yield curve, the market is actually technically pricing in the funds rate to go back to 4, you know, over the next 5 years or so. And I think that's where the markets are offsides, right? I think there's a higher probability that we end up with a 2 handle on the funds rate than a 3 or 4 over the next 5 years.
Is, at this point, given what you're talking about in terms of the backdrop, a risk-free rally or a rally in treasuries good for riskier assets, as has been thought for a lot of the past couple of years?
Yeah, Lisa, I know you're talking about the correlation between stocks and bonds, the age-old question, and a lot of our clients and a lot of investors are still spooked by what happened in 2022, where, you know, everything sold off together and the correlation did not work on your behalf. But we've been telling our clients, listen, this time will be different. You've had a reset in interest rates, right? Rates are relatively high. There is a lot of scope potentially for the Fed to cut rates if they had to, if you did have that big risk-off moment, if you did have a deceleration in the job market, if you did have a big crash, let's say, in the stock market as valuations come into question, if you did have a recession, I mean, there's a lot of scope, right? Trump talks about rate cuts, not in tens of basis points, but in points, like a mortgage banker, right? Like rates should be like hundreds of basis points lower, not tens of basis points lower. And who knows where we end up. But I do believe that correlation in a downside scenario, will support risk assets.
Listening to you, Michael, I'd rather buy a 10-year Treasury get 4.2% in terms of yield than go into Oracle debt and get 5.5%. I mean, how much does this crimp the appetite to go into debt that is tied potentially to pretty ambitious projects that are being put out there by some of the largest companies out there?
We have that trade on, Lisa, and I think that's the right call. I mean, the supply of debt is one thing, right? It's going to be massive, and it's just starting to increase. A lot of this CapEx that you've been talking about all morning, had been funded by free cash flow or cash on the balance sheet, and it is increasingly being funded in securitized credit markets, in real estate markets, and in our corporate bond market. So that supply issue is one thing, but it's really the expectations of revenues that I don't think are going to justify this CapEx build, and I don't think it's going to justify potentially the valuations on a lot of these technology companies, and that alone could certainly cause corporate spreads to widen in sync with equities falling, right? So we're very defensive on the credit side.
You sound very bearish when it comes to some of those names. You have this moment in your note I love. The old adage of "don't fight the Fed" is being replaced, basically because you can't fight this presidency. Is that correct, Michael?
Yeah, my new line is "don't fight the triumvirate," right? I mean, you have a president, you have a Treasury Secretary, and I'm watching the debate, between Elizabeth Warren and Bessent, and a Fed chair ultimately, right, who all want rates to be, again, a lot lower, right? And there are tools these folks can use, other than old-fashioned, moving the Fed funds rate around, right? There are regulatory tools, there are issuance tools, right? And there's, balance sheet tools that can be used. So, I think it's dangerous to assume that the funds rate is going to stay at 3.5 and maybe go to 4 over the next 5 years when you do have this, I think, force that want rates a lot lower. So I think it's probably a good move to stay, in the bond market, to stay long duration. That's what we're doing. We've actually been adding a little bit of duration here on this recent backup, toward 430 on the 10-year.
Hey, Mike, it's good to see you. Mike Collins there of PGM Fixed Income. Mike, have a good weekend. Mike usually joins us on Payrolls Friday. No payrolls this morning. We'll get that on Wednesday. And payrolls taking on a little bit more importance, I think, after the data of yesterday.
Given the fact that we got 3 data points, all of them not necessarily the gold standard that typically payrolls are. However, highlighting that this is a weakening labor market and that right now jobs are just not getting created and there is a potential for them to be eliminated.
That put a bid into treasuries, yields down at the front end by some 10 basis points. The first close below 350, I think, since the start of the year, the first week of January. Up next on the program, Nadia Lovell of UBS, Gil Luria of D.A. Davidson, Stephanie Roth of Wolfe Research, and Julia Hearn of New York Life Investments.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the U.S. or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
The
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1-1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
There is a sentiment overhang.
We're coming to a point in the AI transformation where dispersion is much greater.
The AI boom is coming.
Rotation is the new momentum trade.
I think there's a number of narratives going on, and so investors are increasingly wondering, which ones do we want to pick?
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
We're almost there. We are almost there. Almost at a weekend. Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. Equity futures on the S&P 500 positive by 0.5%. Here's the bounce following a 3-day rout on the NASDAQ. We're looking at the worst week on the NASDAQ 100 since Liberation Day week. Back in April of last year, the NASDAQ 100 looking to bounce up by 0.6%. Struggling to bounce this one right here in the pre-market, Amazon, $200 billion in CapEx. That's the intention for the next year. The stock is down by 8% in the pre-market.
Just to give some perspective, this company is spending significantly more than it was initially expected to spend. It was expected to spend some $150 billion, which also was an astronomical sum. Why are they doing it? The why is the reason that people are nervous. It is to catch up to the likes of Google and Microsoft. It isn't necessarily because they have the opportunity to see something that's really good. They don't want to miss something, and that, I think, is what is making a lot of people concerned.
$650 billion is spent across 4 companies. Surely the chip players should be winning the week. They haven't been. They are this morning. Nvidia, Broadcom rallying in the pre-market. In the last 24 hours, we've talked a lot about how the character of this sell-off changed, that it had a real economy flavor to it off the back of the weaker than expected economic data we saw yesterday. Next week becomes more important. Payrolls on Wednesday. Very much in focus. What kind of data are we going to see next week?
Also sprinkled on top of all of this is the fact that Anthropic is coming out and saying, look what we can do for you in some of, last night was about the financial sector. Maybe you don't need as many people. So that is why jobs and payrolls are going to be so much more important, not just about the data we've seen this week, but also what Anthropic is saying about potentially how AI actually might help companies reduce workforce. Not good for the real economy.
There's something Diane Swong said to me from KPMG last week when we were covering the Federal Reserve decision. And she was speaking to Tom and I, and she said that you could see GDP at fantastic levels, but you could see a jobs recession. Just imagine what that's going to look like over the next 12 months, if that materializes going into the midterms in November.
According to Fed Governor Chris Waller, we may have already seen that, because we might have seen actually negative jobs growth last year, or potentially just even flat. A real question here about how this trickles into the politics of this moment, and a real question about how much you can get ongoing risk appetite if you do have this type of pretty lackluster backdrop. I mean, again, I keep going back to what Michael Collins just said. If you have that backdrop, he'd rather own treasuries than Oracle debt or Amazon debt or Google debt or some of these others, given the fact that right now you're getting a pretty good return just on full faith and credit US.
And it's not just the pushback when it comes to individuals and their employment prospects in America. I really was struck yesterday. I thought one of the most important things was the Michigan Attorney General. And what she is saying in terms of these contracts are simply too consequential for the future of energy affordability in Michigan to keep granting fast-track, secret review and approvals to untrustworthy partners like DTE, Oracle, and OpenAI. Massive pushback because consumers are going to be paying higher energy prices and then potentially might not have a job.
On a lighter note, this from Chris Harvey, and I hope that the Harvey family don't read his research. He said the stock market sell-off is not over. Sell-offs are like fish and family. After 3 days, it's over, or it starts going south fast. We do not think the sell-off is over. To us, the market starts looking interesting below 6,700. Thank you, Chris, over at CIBC.
And this is the reason why I don't have fish, because within 3 days, they'd be dead.
Oh, God. Well, I was just going to say, who's his family? I like hanging out with most members of my family. Maybe he's talking about in-laws.
I hope
they're
that the
not
Harvey
watching.
family don't read his research. Equity futures right now. On the S&P 500, firmer by 0.4%. Coming up this hour, Nadia Lovell of UBS Global Wealth Management as the tech rout deepens. Gil Luria of D.A. Davidson downgrading Amazon, saying it's losing the lead in the cloud space. And Stephanie Roth of Wolf Research looking ahead to a key week of data on deck. We begin this hour with stocks steadying following the NASDAQ 100's worst three-day stretch since April. Nadia Lovell of UBS Global Wealth Management writing the following. Sentiment has turned more negative lately. Even though market breadth has improved, we think the great broadening is well underway. Nadia joins us now for more. Nadia, good morning.
Good morning.
Let's get into that last line. I think it's important. What's driving that great broadening, and why do you think it's going to be resilient, sustainable for the year ahead?
You know, I think it's just the overall economic backdrop. Like, yes, we're seeing some sell-off in parts of tech. It seems to be more technical in nature, and it's not a significant shift in the macro backdrop. But reality is there's a lot of pain under the hood across the P&L. And so it does feel, though, that we're starting to approach maybe the end of that sell-off, just given how much valuation has come in, as well as just the overall pullback that we have seen. But I think back to your initial question around the broadening, it's going to be driven by the global growth backdrop, which can actually surprise to the upside. You know, you have spending in the four largest economies in the world, expansion happening. You also have that lag effect from more accommodative monetary policy and a potential for a Fed to further ease. And look, CapEx is going up for these hyperscalers. Yes, we know one person's spending is another company's revenue. And so we think that there's a potential for upside to global economic growth. So that 2.5% that we have for the U.S. might actually prove to be more conservative, you know, and so we think that that will help to broaden it out. We're seeing that broaden out in earnings in the 493, and we think that that's going to help sustain the market as we progress in this year.
Should we ignore the jobs numbers then? What's more instructive, payrolls or the CapEx intentions of four companies?
They're both important, right? And that's going to help the economy on the business investment standpoint. On the labor market, we do have the Fed that will come to the rescue. You know, reality is, like, yes, the data this week, not very encouraging in the labor market. We'll see what we get next week in payroll. But even though we had a hawkish, I would say, press conference at the FOMC last month, Powell did note that the Fed does remain the flexibility to cut rates. And so we think that if you see any weakness in the labor market that flies in the face of that stabilization in the labor market that Powell had pointed to, that would pull forward some of those rate cuts. So we could see another rate cut in March, you know, before Powell actually exits. And so we think that that can give some comfort to this market.
It sounds like you're saying that the rotation has legs because either the economy is strong and that's a great thing, or the Fed's going to cut rates if the economy isn't strong, and that's a great thing for the rotation trade. Is that basically what you're saying?
Somewhat that, Lisa, absolutely. And I think that that's why you're seeing there's more positioning in the cyclical side of the economy. You know, you've been talking all morning about the ISM that we got earlier this week. So there clearly seems to be a cyclical recovery underway. New order growth, we'll see if that continues the next couple of months because there might be some quirks in the data. But I think that that's helping out the broadening trade across some of the consumer. We know that the consumer is going to get some stimulus from tax returns, you know, in the next few weeks, over the next few weeks as well. And also, I think, you know, we are seeing some steepening in the yield curve, and that also is helping parts of financials, particularly banks. And so those are the areas that we're leading in onto the cyclical side. That doesn't mean that we don't see opportunities on the structural side. We think you just have to become more selective in tech, which we've been doing over the last couple of months.
As I hear you talk, what I'm hearing is there's a lot of money out there. And there's a lot of money sloshing in the system. And that's what I keep feeling also with this rotation that hasn't disrupted things, that there is just a massive money where we can throw out $650 billion and say, okay, or $900 billion of market cap losses in 1 week from 3 companies. And people say it can be absorbed. Is there some sort of signal here about how much money there is in financial markets that's going into the real world that could potentially have inflationary ramifications that we haven't yet priced in?
Well, I mean, you know, there is the argument for productivity gain, and that potentially dampens inflation as we go out over the next couple of years. So not overly concerned about inflation right now. I think also part of the broadening out, Lisa, now on that money slushing around is not just the U.S. anymore. I think that we've been talking to clients about increasing diversification, and I think that case has been strengthened, particularly when you see the pullback in tech. So we're also looking at opportunities outside the U.S., particularly in Europe or Japan. You know, this weekend we'll get the snap election in Japan, and we think that the LDP is going to gain seat, and that will help push through the stimulus package and revitalize the domestic economy. So again, for the last few years, you know, investors have been rewarded in the U.S., but we think that the opportunity set has broadened, and that's why we still remain constructive on global equities, because no longer do you have to just focus on the U.S. and what's happening in the U.S. economy. You can look across the pond as well and look at Europe as well as in parts of Asia.
You're very constructive right now, but you do say that when it comes to tech, you're looking at specific names, and maybe the leadership is changing. What do you want to see? What names do you like?
So, you know, when you look at tech, yes, you know, reality is that bleed across software has been happening for months. We know that. It got accelerated in the last couple of weeks. But, you know, I think fundamentally, when you look at even software, still growing, still mid-teen top-line growth, you know? And we also recognize that the fact is, like, these incumbents also fully entrenched in the enterprise. And the enterprise software isn't just about writing code. It's about integration. It's about understanding complex systems. It's about managing governance. And so we do think that some of these software companies still have the edge. But that said, it's understandable why there is a pullback. So within software, what we're more focused on is those companies that are not so overexposed to seat-based models, right? And those that are vertically integrated. And then across the rest of tech, particularly the AI stack, what we're looking at is those companies that are starting to monetize AI, again, those vertically integrated, as well as in semis. It's not just the chips, it's also the memory stocks that we're looking at, that we've been adding to, and those that are involved in foundry as well as packaging. So I think you have to have that diversification, not only across the globe in terms of regionally, but also in sectors and also in these structural themes, and particularly across the AI value stack.
Just finally, year-end target on the S&P, 7,700?
Yes.
Do you think we've got 10% plus upside if software stays in the penalty box?
I think, so it's, can software stabilize here? Feels like we're starting to get there. I mean, we're down. We're in bear market territory at this point. Yep. So it's more stabilization in software. The rest of tech, you know, because that spending is benefiting the rest of tech. And then we have the cyclical parts of the market that are performing well. So when you put all of that together, unless you see any sort of major crack in the labor market or a major crack in growth, and we don't think you're going to see that in the economy. The fact is the data has been coming in pretty okay. We think that you can get to that 7,700, that greater participation will be enough to push it there.
Nadia, this was great. It's good to see you. It always is. Who needs payrolls? We've got Nadia Lovell of UBS Global Wealth Management. Nadia, thank you. It's good to see you. Thank you very much. Let's give you an update on stories worldwide with your Bloomberg brief. It's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. President Donald Trump wants Washington Dulles International Airport and New York's Penn Station to be named after him. NBC News reporting the Trump administration asked Democrat Chuck Schumer to rename the transportation hubs in exchange for the release of the federal funds required to build a long-delayed gateway tunnel between New York and New Jersey. Anthropic is releasing a new version of its AI model designed to perform financial research and other workplace tasks. The company says Claude Opus 4.6 can scrutinize company data, regulatory filings, and market information to come up with detailed financial analyses. And bigger bonuses for bankers. Goldman Sachs, Morgan Stanley, JP Morgan, Bank of America are boosting their bonus pools for bankers and traders by at least 10%. The decision reflects a strong year as the businesses benefited from deal-making and market activity. Collectively, the banks posted their largest annual profit since 2021. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in the next 30 minutes or so. Up next, the Morning Calls Plus. Gil Luria of D.A. Davidson downgrading Amazon, saying it's losing the lead in the cloud space. That conversation up next. Live from New York City this morning. Good morning.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Get ahead of tomorrow's trading on Bloomberg. Next changes everything.
I think what investors are looking for is managements and insiders to step up and start buying their own stock. I think that would really kind of instill some confidence rather than just telling investors the sell-off is overdone, maybe launching some corporate buybacks. Management teams need to step up, insiders need to step up and show the confidence they have in the outlooks of their own businesses.
That was Stefan Slavinsky of BNP Paribas joining us a little bit earlier on. I talk about when moves like this happen, it brings the best out of Wall Street. Some great research out there at the moment. This came from Manish Kabra of SocGen, writing the following. U.S. software stocks are down 17% year to date. They've lagged the S&P by almost 30 percentage points over the last 6 months. He goes on to say, this is the outlier, a sector that has delivered 13% annualized profit growth for the last 3 decades, almost double of the S&P 500, and built its status as one of the market's most reliable defensive engines.
How do you price in something that hasn't happened yet? And the promise that Anthropic put out there is essentially what we cannot price, which is mass disruption. And that's what these stocks are trading on, not necessarily the performance that not only analysts, but also the heads of private investment firms are trying to tell us day in and day out.
The worst relative performance in 25 years. Amazing. That's now from Manish Kabra over at SocGen. Equity futures doing better this morning. Let's check out the price action going into the open in about 1 hour and 13 minutes away. Equity futures on the S&P 500 positive by 0.5. The Nasdaq up, the Russell outperforming, the Russell 2000 higher by 1.26%. That's the price action. Let's get you some morning calls with one stock in focus, Amazon. First up, Cantor Fitzgerald lowering its price target to $250, citing concerns around long-term ROI. Your second call from Evercore ISI, slashing its target to $285, anticipating negative free cash flow for the year. And finally, Wedbush, cutting its target to $300, noting investors need to see tangible returns from high capex. That stock is down by 8%. Let's stick with that name. A $200 billion capex price tag weighing on shares. Gil Luria of D.A. Davidson downgrading the stock to neutral and writing this. With the context of results from Microsoft and Google, we see AWS continuing to lose its lead and now scrambling to catch up through escalating investment. Gil joins us now for more. Gil, welcome to the program. Read the note earlier this morning when you published it. What stood out to me was this. It sounds like you think that $200 billion is starting to look a little desperate. Is that fair?
It is, because they're escalating their capex. So is Google, so is Microsoft, so is Meta. It's just that Amazon is not getting as good of a result as those other companies. Google is investing a lot, but they just grew their cloud business 48%. Microsoft grew Azure 39%, and that's just because of internal allocations. They could have grown it faster. Amazon is only growing that business 24%. More importantly, we look at the backlog that this investment has delivered so far, and we see that Google's backlog is comparable to Amazon's. Google is half the size. Microsoft's backlog is almost twice as high as Amazon, and they're the smaller business. So Amazon is investing a lot. It's just not getting as good of a result as Google and Microsoft. Google is lapping them, and Microsoft still has the lead in terms of delivering AI compute. That's why we're concerned.
Gil, do you think this is a structural disadvantage, a structural hole that the company will ultimately struggle to get out of?
Yes, and it's a result of a couple of things. It's a result of the fact that Microsoft aligned with OpenAI early. It has primacy there. And Google was able to create Gemini as one of the leading chats and AI engines, and that's giving them the lead. Amazon doesn't have either. It had an early investment in Anthropic, but Anthropic wisely diversified and is also getting investments from Google and Microsoft. So Amazon doesn't have the primacy there either. So the leading models are what are leading the race. Microsoft's aligned with one, Google with the other. Amazon is just trying to catch up.
Gil, is there any chance that Amazon could catch up? What are they investing in that could potentially get them over the finish line?
Well, that's why they're investing so aggressively now, not to mention the $50 billion they want to invest in OpenAI in order to get better access there. So they're going to try to catch up, but this race is happening very fast, and up until now, they're just continuing to fall behind those Microsoft and Google.
So, Gil, do you see this really as the reason behind the spending raising concerns for you, the idea of being defensive rather than offensive, and not this idea that the nature of these businesses is fundamentally shifting, where suddenly they are spending exponentially more every single year as they become more asset intensive and more like utilities and real estate managers than the tech companies that they once were?
The business is definitely shifting, and it is becoming a lot more capital intensive. We're not saying it's not a good investment, though. To be clear, Google, Microsoft, and Amazon, the reason they're building so many data centers is that they've booked those 3 years in advance. They have the customers. Let's not forget, combined between those three companies, they have all the customers. All business customers use one of those three. So when they're investing in data center capacity, it's pre-sold. We're not worried about the return they're going to get because their customers want this AI compute capacity, and they're willing to commit to it in advance. What we're worried about is among the three, who's going to do better, And we don't think that looks like Amazon right now. But in terms of the return on the AI investment, those companies are getting the good return. But let's not forget who's really getting all the profits.
But
that's NVIDIA. All three of these companies are now taking all of their cash flow and passing most of it to NVIDIA. And yet right now, NVIDIA is actually trading at a lower multiple than any of them.
Gil, when it comes to Amazon Web Services, though, I understand that potentially it's not doing as well as you're talking about with the other peers, but for them, it's the fastest pace for them in more than 3 years. Doesn't this show that actually when Amazon comes out and is talking about all this money, it is going to a part of the company that is growing within their portfolio?
Yes, again, it's a good investment. They should be making it. They have to make it. They're just not getting as good of a result as Google and Microsoft. That's what we're saying. And again, they're trading at a higher multiple than Microsoft. Microsoft trading at 22 times, with Microsoft Azure growing 39%, Amazon trading at 26 times, with AWS growing at 24%. That means that Microsoft has a lead. It's more attractive as a stock. And again, we think they're going to keep the lead, if not extend it over Amazon.
Amazon's talking about they're spending it on AI, chips, robotics, and low or Earth orbit satellites. Gil, is that the right place to be spending the money?
Well, most of their investment is still in AWS, and a lot of it's in retail, and they're getting phenomenal returns in retail, right? The fact that they can generate the level of profit growing that business high single digits is very impressive. Our concern on the retail side has more to do with how quickly the internet is now changing. The internet used to be person-facing, like human-facing, and increasingly it's chat-facing. It's ChatGPT and Gemini that are increasingly driving traffic to the web. And Amazon has so far refused to allow those chatbots access to Amazon. So even on the retail side, where they're doing really well and getting great returns on robotics and distribution center investment and regionalization, even there, we have a concern that they could lose their lead, because if you're a Shopify merchant, your website is now linked to ChatGPT and Gemini. If you're selling on Amazon, it's not. And these things are changing very quickly. The volume on the web is turning from human to chat at a very fast pace. And for now, Amazon is emphasizing Rufus, which I don't think any of us is using, while ChatGPT and Gemini do not have a direct connection into the Amazon inventory.
Gil, can we finish on Anthropic? It's made a lot of waves this week, and I've really struggled to understand whether they're punching above their weight, whether the waves they've made are justified by their market position, whether a lot of the headlines this week is just the pre-IPO roadshow, or if it's actual real legitimate disruption. How are you framing things for clients?
Anthropic made the smartest strategic decision, which is to focus on code, on STEM, on math, on enterprise, on solving hard problems. And now their models are solving hard problems and are very focused at solving the types of problems that we have in the workplace, where ChatGPT and Gemini from Google have been more focused on consumer interactions. Anthropic has stayed very focused on solving enterprise problems, which is a very big pocket that they're addressing now. Now, I'm in the camp that believes that they're not going to replace all of software, but I do believe they're going to make us a lot more productive. And they're only starting to get paid for the productivity gains they're going to help enterprise customers get.
Gil, thank you, sir. Appreciate it. Thank you. Gil Lurie there of D.A. Davidson on the tech story of the week so far, and what a story it's been. The week isn't over. Equity futures positive by 0.6%. Up next, we'll catch up with Stephanie Roth of Wolf Research after a string of weaker than expected labor prints. Plus, your hire is back with your morning movers. Stellantis, look at this move. Stellantis is down by 23% after a massive EV write-down. That conversation up next.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars.
Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
On the week so far, down 2% on the S&P, down close to 4 on the Nasdaq 100. Here's the bounce so far this Friday morning. Good morning to you. Up by 0.5% on the S&P, on the Nasdaq 100, up by 0.7. The Russell outperforming, up by 1.4. 4 companies looking to spend up to $650 billion in the year ahead on CapEx, and yet still, those tech companies haven't engineered a boom in the chip makers. Nvidia is down on the week by 10%. Broadcom is down on the week by 6%. Those two names are trading firmer in the pre-market. Let's see how they open up with the opening bell just 60 minutes away. Let's get you some more single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. Amazon getting hit hard for being one of those big spenders. Shares are down 8% in the pre-market as it pours $200 billion into AI infrastructure. It's a move that CEO Andy Jassy says it's necessary since at AWS, he says that they're monetizing capacity as fast as they can build it. But the problem for investors is that it is already projected to hit the bottom line, with Amazon's forecast for operating income in the current period coming in below estimates. Meanwhile, moving on to our big mover to the downside, and that is Stellantis. Shares are down more than 23% in the pre-market after the automaker said it would take a $26 billion hit as it scales back its EV ambitions. Stellantis admitting that it went too aggressively on EV demand that just didn't show up. So it joins the likes of Ford and General Motors, who have also had to take big write-downs. And we end on Roblox. This is the gaming app popular with kids, and it had been caught up in this AI firestorm. That's because Alphabet came out with a tool allowing users to create their own virtual worlds with characters, and that's very similar to what Roblox offers, but it came out with a solid earnings report. It beat, so shares are up more than 10% in the pre-market. John?
Yahira, thank you. Thanks for this morning. The broader market doing okay, up by 0.6%. Big week ahead. Payrolls just around the corner after several data points this week so far. Open the door to a conversation about rate cuts. Mike McKee has more. Good morning, Mike.
Good morning, John, from Atlanta, and I'd like to wish you all a happy non-jobs day. The government shutdown, of course, postponing jobs until next week. But that doesn't mean there hasn't been a lot of employment news this week that, as you mentioned, John, has opened the door to more talk of rate cuts, because the news has been universally bad. We saw ADP come in much lower than expected. We've seen the jobless claims numbers come in higher than expected. And, of course, there was that big Challenger miss or report of job losses, the worst since 2009, that came out yesterday. So since that's happened, we've seen Fed funds futures price in a rate cut in June, which would be Kevin Warsh's first meeting as chair, if indeed he is confirmed. Now, it doesn't mean a whole lot because, of course, we do get the jobs report next week. And we also get a lot of stuff next week that is on the other side of the mandate. That's why it is a huge week for everybody. We start with inflation and the New York Fed's inflation expectations numbers. And then we see on the ECI come out on Tuesday, the employment cost index, along with import prices. And retail sales will see some strength maybe in December. Wednesday is the jobs report you talked about, and then Thursday, jobless claims, and then Friday, CPI. So we've got jobs and CPI next week. There's going to be an awful lot for people to process in terms of what it all means for rate moves coming up.
Mike McKee, thank you, sir. Mike McKee down at Atlanta, Georgia. Look out for this interview a little bit later on today. He'll be sitting down with the Atlanta Fed President, Raphael Bostic. I should say the outgoing Atlanta Fed President, Raphael Bostic. He steps down at the end of this month. This is a man who's indicating he thinks they shouldn't be cutting rates at all for the year ahead, on the very other end of the spectrum compared to, say, Governor Chris Waller.
Yeah, and I'd be actually very curious to see what he says in a day like today after we got the labor market data that we got over the past week, given the fact that it points to a weaker than expected labor market. Does he still expect there to be this stabilization in the employment picture, as Fed Chair Jay Powell has indicated?
Especially as Jonathan reiterated what Governor Waller had to say recently, the fact that for 2025, it's going to be revised downward, likely to show that there was no growth, zero, zip, nada. What do you say to that?
Sticking with the labour market, this is what Stephanie Roth of Wolf Research has got to say to that. While the data was disappointing, we wouldn't read too much into the latest prints, nor are we changing our view that the labour market should improve from here. Stephanie joins us now for more. Stephanie, good morning.
Good morning.
Why should we ignore Challenger, jobless claims, and JOLTS?
Okay, for claims, they rose to 230,000. Historically speaking, that's not such a bad reading. There was a lot of weather disruption that week. When we were talking about Challenger, a lot of it was driven by UPS, which had a similar announcement last year. And the Challenger said itself that it's going to be driven by attrition and voluntary separations are the big part of it. Another reason for Challenger was Amazon. So the bulk of the news was coming from either tier 3 data or data that's not necessarily indicative of a labor market that's actually deteriorating from here. We'll have to see what payroll shows. And our sense is that next week we'll learn that payrolls for January were fairly decent. And then, of course, there will be those downward revisions historically.
I'm totally with you. When I got the Challenger jobs cuts, we were all looking at the idea that this was really concentrated in 3 companies that have already announced a lot of these job cuts. Then the jobless claims come out. Yeah, it's at an 8-week high, but ultimately still at a pretty low level. Then JOLTS comes out, and you look at it, and it's saying, look, we're looking at the lowest job openings going back to 2020. I mean, how many of these can you explain off before you start to get a little self-conscious? Wait a second, maybe something else is going on here.
I mean, I think you have to take a step back and reassess your view. But our sense is, one, the consumer path is pretty good. We're going to also have fiscal stimulus that is starting to hit. The momentum seems to be improving. If you rewind just a couple of days ago, we were looking at the ISM, and we were starting to get questions of, is this early cycle? So how can it be both early cycle and late cycle at the same time? Our sense is that we are starting to improve cyclically. There were some negative news from some of these data sources that's probably not indicative of the trend. This happens very frequently, especially in the month of January, where you get some prints, especially associated with layoff news, which tends to be a January phenomenon.
Well, maybe it's early cycle for fiber optic cables, but it's late cycle for humans that are actually trying to enter the workforce. I mean, how much do you glean that some of this weakness truly is coming from less human-intensive jobs that really result from some of the capital expenditures that are supporting economic growth?
There might be an element of that. So we ran some estimates looking at the rising unemployment rate since ChatGPT launched. And we found that about half of the rising unemployment rate was tied to AI, and then the other half was more cyclical in nature. So the extent to which, sure, there is half of it that is structural that will probably continue to rise, but the portion of it that is cyclical might actually reverse this year if we actually do get a cyclical improvement in the economy. So we do think that you could see about 1 to 2 tenths of downward pressure on the unemployment rate this year, just because of economic uncertainty fading, given last year was true peak tariff uncertainty, a modest improvement in the consumer, in which case you could see some modest hiring across cyclical industries.
ChatGPT was launched in 2022, and they're taking 50% of the jobs right now. How does the Fed deal with that?
It's a tough backdrop. I think they have to be thinking about the productivity. It's kind of a call about whether this is a productivity cycle. There's no harm in in waiting at least through the middle part of the year, which is probably what the Fed's going to ultimately end up doing. And then in the back part of the year, they could probably cut a couple more times, and Warsh is going to guide them towards that, because that will be an environment where inflation is also starting to fade. When in productivity cycles, you don't have inflation problems at the same time the growth is strong. So if we start to see that inflation cools down, then it's an environment where they can still cut a couple more times.
What will be the main driver of disinflation? Torsten Slog was out a note today, and he was talking about actually you could see inflation creep higher with things like the One Big Beautiful Bill coming out. For you, what is disinflationary?
So in the first part of the year, I think that's right. We're going to probably see inflation move a little bit higher, in which case that's why we don't think that the Fed is going to be cutting under Powell anymore. However, in the back part of the year, it's going to be driven by the typical disinflationary forces that is tied to productivity, which is lower wage inflation than would otherwise be the case. So first part of the year, I agree. We're going to likely see some pretty hot inflation prints, especially in Q1. That will probably start to fade, and then the narrative will shift in the back part of the year, because that's when you'll start to see inflation cooling, and then labor costs also fairly modest.
I don't expect a precise number from you, but just how much of GDP growth this year is going to come from the tech capex? Not just the 4 companies, but everybody else as well.
Yeah, I think it'll probably be 50 or so basis points on GDP.
That's pretty impressive stuff. This is why it's interesting for the Federal Reserve. They could be cutting interest rates, potentially responding to a labor market at the same time GDP is close to 3. You ever seen that before?
It's a very unique environment, and that's why they certainly will have a tough time cutting in the first part of the year when you see growth actually accelerating. So the news this week, I think, is perhaps a bit of a one-off, and we'll shift to data prints that are starting to surprise to the upside, consumer data starting to pick up, sentiment improve, companies want to invest again because the economic backdrop is a bit better than where it's been, in which case the fears about the economy really decelerating, the labor market crashing.
Well, it's basically what they did do at the end of last year. They were basically cutting interest rates with GDP 3-4 percentage points high because of what we saw from tech capex, even though payrolls growth has totally stalled.
Look, they've been looking through this. They've actually been acknowledging that a productivity boom could come at the behest of an employment market that is sluggish. The one challenge to this, and the one thing that I've not heard people fully explore, is how do 4 companies spend $650 billion in 1 year without causing inflation? Because ultimately what they're buying, yes, it's raw materials, it's land, it's housing, it's all of these different aspects. It's a lot of money. So how do we get that kind of spending without any kind of price distortion on the other side?
Stephanie, how does it show up in GDP? Does it come up through imports, investment? How does it show up?
So the way that we've been tracking it in GDP is looking at only the domestic portion of it, because it gets funky with the imports, because imports end up being a negative on GDP just based on GDP math. So we look at it based on the tech portion of CapEx, the construction, and what we find is that tech-related domestic portion of AI CapEx is about in terms of size, is about 1.5% of GDP. So that compares to, say, housing, which is about 3.5% of GDP. So it is large, it is growing. If Jensen's forecasts are right, it'll grow to 5% of GDP by the end of the decade. I'm not sure I would bet on it being quite that high, but it's an important part of GDP, but perhaps not as big as some of the other major drivers.
Why is it not inflationary in any way?
I mean, I think it is modestly inflationary, certainly offsetting some of the disinflationary forces that are playing out otherwise. And when you think about these typical productivity type of booms, it ends up being modestly inflationary in the near term, and then in the medium to longer term, it becomes disinflationary as you actually see the productivity gains as a result. We haven't really seen much of that productivity gain yet. I think it's coming. So for the first part of the year, you'll probably see those inflationary forces, because there's a lot of positive demand shocks in the first couple of months, which is why I would emphasize the data that we got this week flagging that the labor market is starting to soften is probably not the right takeaway for the next couple months.
What's your guess for next week, just quickly?
On payrolls, 85,000, with some substantial downward revisions to the prior months.
Okay, good to see you. Thank you. Stephanie Roth there of Wolf Research, looking for 85,000. The high next week's 135. That's Citi. The low is -10. That's Standard Chartered. Steve Englander had a lot to say about the payrolls data earlier on this week. Check out that interview if you haven't seen it. The median estimate in our survey is 70,000.
To Steve Englander's point, even Priya Misra said, watch the revisions, because they're going to do a full revision for the prior year and a revision in the methodology, and that could really shift our expectations of what we can expect going forward and what we just saw in 2025.
Payrolls data next Wednesday. 2 days later, CPI. That's the calendar for the week ahead. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. The search for 84-year-old Nancy Guthrie is in its 6th day now. The Pima County Sheriff's Department says neither a suspect nor a person of interest has been identified in the disappearance of the mother of Today's Show co-host, Savannah Guthrie. The FBI is offering a $50,000 reward for information leading to Guthrie's recovery or the conviction of people involved in her disappearance. Brevin Howard Asset Management's Minal Bathwal is one of the world's most successful macro hedge fund managers. Bathwal hasn't had a single down year since he started managing money during the 2008 financial crisis. His fund has scored wins on everything from Korean investment, interest rates to Asian currencies. President Donald Trump launching a new website to help Americans buy medication at a discount. The president saying more than 40 medications will be available through the site, including Novo Nordisk's Ozempic and Wegovy for $199, as well as EMD Serono's fertility treatment. That is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thanks for this morning. Up next, we'll set you up for the day ahead. Plus, Julia Herman of New York Life Investments assessing the big tech sell-off of the week so far. From New York City, you're watching Bloomberg TV.
Crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked, and we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
You got to go company by company, be far more selective, and can't say I'm just going to own the whole lot of them. There will be winners, there will be losers. We knew all along AI is going to be quite disruptive. The question that investors should ask themselves over the next few years, is it disruptive to to more businesses than it is beneficial, or is it beneficial to more businesses than it is disruptive? And I'm still in the latter camp.
Brian Levitt of Invesco is still bullish, joined us a little bit earlier on this morning. If you're just joining us now, welcome to the program. Your scores look like this. Equity futures on the S&P 500 higher by 0.5%, following a three-day slide on the S&P 500. On the NASDAQ, bouncing back by 0.6. We were heading towards the worst week since April of last year. Let's see if that changes going into the opening bell and beyond. Switch up the board and get to the bond market. Two-year yields down 10 basis points in yesterday's session, off the back of weaker than expected economic data. Two sub 350 at 347.49, yields higher on the session by some 2 basis points. The misses we saw on the data yesterday, giving a bit more importance to the data we get next week and over the next week. Your trading diary looks like this. At 10 a.m. Eastern time, we'll get you, Mitch, consumer sentiment. Look out for that. Over the weekend, elections in Japan. On Monday, Fed speak from Waller and Bostic. Wednesday is the main one, the big one, the January payrolls report. On to Thursday, jobless claims, and on Friday, some CPI data.
I just think that if it's not Friday payrolls report, does it have the same importance? Does Wednesday payrolls have the same ring? Look, we're going to get that data point. What does it tell us not only about the month of January, which is noisy and typically highly seasonally dependent, but also the revisions to all of 2025 to get a sense of the momentum heading into this year?
What would the Super Bowl be if it was played on Wednesday?
Right?
Totally with you, Brown. It's just not the same.
It's just not the same. I mean, does it even matter? Does it have the same ring?
No one's going to tune in. The audience is going to drop off. No one wants to see that.
NFP Wednesday, not payrolls Wednesday.
You know,
does it work?
Payrolls Wednesday, 8:30 Eastern time. Tune in. Let's turn back to your top story on Wall Street. Alphabet, Amazon, Meta, Microsoft forecasting a record $650 billion in combined capex for 26. Julia Herman of New York Life Investments writing, capex, once enough to drive AI conviction, now needs to clear a higher bar. Proof of faster monetization. Julia joins us now for more. Julia, good morning.
Good morning.
Feels like this has been building for a number of months now. Is the market starting to push back?
Yeah, absolutely. We're essentially seeing a shift from total focus on the infrastructure layer of AI and big support for how much infrastructure AI is going to need to a focus on the application layer, how it's used. And honestly, I see a lot of impatience in the market in wanting to determine winners and losers in software, in wanting immediate monetization of AI capabilities. But those conversations are 3 to 5 years or more premature, in my view. I think where the market is going to have to come back to, yes, today, but maybe also in the next few quarters, are two key hubs of conviction in AI. The first is, are the core profit centers of these hyperscalers doing well? Those earnings hubs have nothing to do with AI just now, but they enable the second key hub, which is for the recycling of operating cash flow back into CapEx. As an investor, the number one reason I have to believe in AI as an investment theme is because these hyperscalers believe in their own theme. And so we actually see CapEx as a support of this conviction as opposed to a detraction from it.
One surprise we've seen through the week is to see this number, $650 billion, and then see stocks like NVIDIA trade lower. Broadcom trade lower. Those two names are up in the pre-market, but NVIDIA on the week is down by 10%. Does that make sense to you? The semis have struggled this week in the face of spend that big?
Well, you know, I think that sometimes everything is painted with a little bit too broad of a brush. And the reality is that this is a complex supply chain, right? And NVIDIA is in a completely different part of that supply chain than some of the other hyperscalers, Microsoft, Meta, Google, et cetera. And honestly, what I would expect to see from here is a focus on that core profitability. Not just that, but even as leverage enters some of this financing, that is a prudent capital structure decision. That financing has become 175 basis points cheaper on the front end of the last 18 months. So even as more leverage enters this zeitgeist, I would expect to see maybe more of a market demand for monetization, yes, but we should also probably see a recognition that as long as actual cash flow is behind this AI boom, that we can keep going from here, and that money is, again, going exactly where these companies, where their mouth is.
There are a number of investors who are looking at U.S. tech companies and saying, I don't like your business model anymore. I like China tech companies that are looking on building up much more on this asset-light type of model, and not necessarily the infrastructure that is really expensive. Do you agree with that? Do you think that tech ex-U.S. is actually looking more attractive as the U.S. model goes heavily into infrastructure and real estate?
Well, up until this point, international growth equity has actually not been the play. We have actually seen value outperform in those segments. In terms of how early we are in the development of AI, though, I think that all of this competition is a healthy thing, right? DeepSeek early last year was seen as the great threat to AI. But actually, isn't it a really positive development that maybe this can be done with a little bit less energy? And given that we're so behind in the infrastructure that we do need for AI, not just in the US, but globally, further competition, model efficiencies, I think all support the 10-year thesis around AI, even if they create bumps in the next one-year thesis.
At the beginning of this year, a lot of investors were saying that they preferred equity exposure to debt exposure given the potential for growth. Is that shifting? Do you now get the sense that some people are saying, wait a second, maybe the equity exposure is a little less clear based on the spending programs and the debt side looks better? Do you agree with that?
I think that in general, conviction in the AI theme is still there. And I think what's happening in fixed income markets is the proof in the pudding there. We are seeing debt investors gobble up the exact same issuance that equity investors are now saying that they're concerned about, right? And you're also seeing small cap tech do reasonably well. So that tells me that there's still conviction in this overall theme. The jitters that we've seen hit large cap growth, I think are more about valuations and concerns about where allocation has ended up, given that diversification rewarded investors last year.
So you sound very constructive on this, and you think potentially this is going to be a washout, and these are still companies that people should get behind.
Yeah, I do, absolutely. We did a lot of long-term research on this theme, and honestly, our conviction in AI rests on the fact that if you compare AI to historical waves of innovation, it has all the right ingredients. It has public participation, public funding. It has the actual private sector helping the rubber meet the road, and there's also this sense that this technology is universal. One proxy for that would be to measure retail investor participation in the Magnificent Seven, for example. So over the next 10 years, we have incredible conviction. And in the short term, what we're looking for to bolster that conviction is, again, are these core non-AI profit centers remaining strong such that they can enable further CapEx financed by both cash and an increasing degree of leverage in the next few months?
Julia, this was smart. Thanks for making time for us.
Yeah, absolutely.
And welcome to the program, the first appearance as well. Thanks for being here. Thank you. Julia Herman there of New York Life Investments on the AI trade and the rout of the past 3 days.
We've just heard a number of people push back against it and say, hold on a second, there's a lot of value here. Question is, how do you value that, right? And I think that ultimately there will be a lot of discussion about this in the months ahead. Is there a different multiple put on some of these names as they continue to plan spending programs that would take us to the moon?
Also, I've been thinking, they had to come out and announce more CapEx than they did the previous years. What level would have the market liked? Because at some point, if it was too low, we could have also seen pushback as well from investors saying, actually, these companies should be spending a lot more if what they are promising is so big.
You joke, but they are literally spending plans that will take us to space.
I'm serious.
Yeah, data centers in space. Elon Musk and Jeff Bezos want to put data centers in space.
What a week it's been. $650 billion.
We're going to space.
The intentions to spend from these big 4 companies, just amazing. Equity futures up by 0.5% on the S&P 500. The final day of a very, very busy week. Looking ahead to next week, CPI and payrolls on deck. Payrolls on Wednesday, inflation data on Friday. Coming up on Monday to preview the week ahead, we'll catch up with Cameron Dawson of New Edge Wealth, the former Fed Vice Chair Rich Clarida, Jill Carey-Hall of Bank of America, and Austin Kwon of Wells Fargo. From New York City, have a wonderful weekend. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the Dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
We are in such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety, and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a little ball. Put wasabi in the middle. Then my process 1 to 6. 1. This is putting the between the rice air. Then make the 4 fingers curl. Make sushi shape. Then touch this. 2. Then turn. Now that these 2 fingers, top to the bottom, make the sushi shape more beautiful. 3. Then, you know, I mean, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is 1 to 6.
Bringing you up to the minute news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
A little bit of a dip buying Friday, 30 minutes till the start of trading. I'm Matt Miller.
I'm Danny Berger. Bloomberg Open Interest starts right now.
It has been a whole week. Stocks, precious metals, and Bitcoin attempt to come back as dip buyers unite.
And also in that week, it's been a busy one of tech earnings, underscoring massive AI spending plans with a handful of companies set to invest $650 billion just this year.
Yeah, that's the capex from only 4 American companies. Plus, the view from the Atlanta Fed. Raphael Bostic joins us for an exclusive interview with Michael McKee following a string of weak labor data.
I feel like we've been through a battle this week. Like maybe we've come out on the other side, a few scars.
One battle after another.
Yes, a great film, a great film. Anyway, I want to show you what Amazon is doing. Maybe the battle isn't over. Down 8.33% this morning, spending a whopping $200 billion on its AI efforts this year. That is 27% higher than the average Wall Street estimate. The money will predominantly go towards the company's AWS cloud unit. Yeah, you can't just spend and keep spending and get away with it, apparently.
Well, I mean, it's only an 8% drop, right? They're spending $200 billion on CapEx. Stellantis, by the way, says its pivot away from EVs will cost the company a whopping $26 billion. More than Ford, far more than General Motors. It's the biggest EV write-down that we've seen in history. They'll cover cancellation of certain models, compensation of certain suppliers. You can see the stock is down. Stellantis has lost basically a quarter of its value in one session, Danny.
It is wild. We're going to talk about that and Amazon. And starting with Amazon, the CEO, Andy Jassy, says the lion's share of AI demand is yet to come, and they are investing to aggressively change the scope of the company.
I think this is an extraordinarily unusual opportunity to forever change the size of AWS and Amazon as a whole. We see this as an unusual opportunity, and we are going to invest aggressively here to be the leaders, because like we've been the last number of years, and like I think we will be moving forward.
Joining us now is Bloomberg Tech's Ed Ludlow. Ed, I don't know if this market wants aggressiveness right now.
Yeah, aggressiveness is $200 billion, which was a significant delta beyond what consensus was for CapEx. And the sell side are calling it sticker shock. It's the same story we've been talking about, which is the market questioning if the payoff is there and if it will be worth it, right? Matt made a very important observation that combined $650 billion CapEx is just 4 American companies. But the concern with Amazon, and one reason it's down more than 8% in the pre-market, is of those 4, it might enter negative free cash flow, which for Amazon is a pretty severe change of financial circumstances. So the market wanted evidence, right? AWS growth is at 24%, fastest pace of growth in about 3 years. But the operating income forecast, which for the current period at the top end, $21.5 billion, is below consensus. All of those competing financial metrics have spooked the market a little bit. But I would say, look at any corner of the market today, other than Amazon, memory chip makers, the GPU makers, the chip equipment makers, the nuclear stocks, the data center supply chain, they are all higher because they'll benefit from that spending.
And this is a company, Ed, whose stock has underperformed other Mag 7 stocks, and one whose business model doesn't seem to revolve around AI as much as Microsoft's with OpenAI or Alphabet with Google or Meta with Facebook. So it's interesting that they're spending more than any other company in the Mag 7 on CapEx this year, or at least forecasting that.
Yes, but they also the clear #1 player in cloud computing. Now, cloud computing can mean anything from storage through to running any basic level of software just in the cloud. In the AI context, what Amazon has found more difficult is to communicate to the market specific AI-related revenues. With Microsoft, for example, when you look at the Azure cloud growth, the market basically extrapolates more easily and says, okay, we see that that's directly AI-driven. Amazon has given us different metrics. They give us a revenue run rate of AI-related revenues. That can be involved directly of corporate and enterprise customers using AWS. It can also be the specific AI model and other services that AWS sells. One final thought we just pointed out, loads of your audience will be saying, well, I know Amazon as Amazon.com, which accounts for the vast majority of revenues. But the reason that it really matters, of course, is that it's about profit. And the cloud computing business has accounted for the majority of operating income for quite a long time. When you commit to that level of spending and you gave the forecast on operating income that they did, that raises some concerns about the health of your cash cow.
All right, but important to point out the AWS business as opposed to, you're right, Ed, the Amazon.com shopping business or the Amazon Prime video business that we laymen often think about in relation to this company. Bloomberg Tech's Ed Ludlow has a very busy day. Join him at 11 a.m. with Caroline Hyde to wrap the most important tech news of the day, of the week, of the year. Stellantis, by the way, says its reversal on electric vehicles will cost the company more than $26 billion. Stellantis CEO Antonio Filosa blamed his predecessor, Carlos Tavares, for going all in on EVs and failing to respond to shifts in the marketplace. Bloomberg's Craig Trudell has run our autos coverage from 3 different continents around the world. He joins us now out of London. So, Craig, this is much bigger than Ford and far bigger than General Motors. No one has taken an EV write-down to this extent yet. And you could argue that Stellantis has been the most hurt by this, right? I mean, they continue to see a loss in terms of their Jeep business, which at one time was the crown jewel. They've gotten rid of the Hemi only to bring it back. And I don't think a lot of people are buying the Charger EV.
No, I think that's exactly right, Matt. And I think this is partly a story of they had the furthest to go, right, and especially in North America, where they were really behind in terms of investing in electric vehicles and standing up battery plants to feed into those, plug-in models. To have to sort of reverse course after trying to play catch-up aggressively under the Biden administration just was going to mean that this was going to be quite costly for them. I think also just sort of buried within this announcement, they've
tag. And I thought Bloomberg's story today was really well reported and well written because it showed that a lot of dealers too were unhappy about having to ask customers for that much money, or for $5,000 for a set of LED lights and some off-road wheels, or for a couple $1,000s for a sliding roof. And they're going to be able to lower prices and have been doing that.
Yeah, and I think that is helping. That's very much sort of a part, part of the plan for Antonio Filosa, who took over, only less than a year ago. I think under Carlos Tavares, you saw real aggression to try and, move Jeep further up market. That worked for a time, especially when you saw sort of across the industry, everybody was able to take price during the pandemic. But I think, the slow move on Stellantis' part to sort of wake up to the idea, like, look, our consumers are only willing to go so far, left them with way too much inventory in late 2024. That cost Tavares his job, and it's really been difficult for this company to sort of find its footing since then.
Craig, always a pleasure to speak with you. Craig Trudell there, again, who has had a long history of covering autos with a nasty plunge for Stellantis. Also, be sure to listen to Hot Pursuit. Did you know that Matt has an autos podcast with Hannah Elliott that is fantastic? You can listen to it wherever you get your podcasts.
And by the way, we aren't EV averse. A lot of people write in and complain that Hannah and I slam EVs too much, but we really both enjoy certain electric vehicles. Yeah, so
I can confirm that I know you enjoy an EV.
Even the Dodge Charger EV was one that I really enjoyed spending a week driving. So definitely check out Hot Pursuit if you care about cars.
It's a must listen to. Elsewhere in the markets this week, Matt, stocks and Bitcoin, they are rebounding. Have we found a floor? Gold also finding some support, but it was a week that saw investors pull back from the most popular trades. Joining us now is JP Barnett, a senior strategist for Bloomberg News. JP, was this just plain and simply a momentum meltdown this week?
Well, to some degree, it definitely was. I would say like the market is moving through like big topics that are going on right now. The one is like the momentum unwind or deleveraging, whatever you want to call it, from gold to silver and Bitcoin. And I mean, like, honestly, gold and silver should never and have never meant to be a momentum trade. And like the way up was crazy and the way down is now equally crazy. And all the leverage that we have seen from, I guess, presumably mostly retail traders is now getting unwind. And the other aspect of the market, which is like also this week sometimes lets me shake my head and go, what's going on here, is like that AI complex where we weirdly work through like what is working and what is not working in terms of like CapEx spending and reward. But at the same time, we are also already like pricing all the disruption into certain areas, from exchanges to European media companies and most pronounced in software stocks, where I feel like, okay, what the market actually wants here. Now, are we sure now AI is working and we need to price those disruptions? Or are we still figuring out if all the spending is actually worth it? So the whole market sometimes has a bit of a narrative where I feel like a lot at once. And let's not forget all that under the umbrella of like an economic topic, a US dollar topic, a US rates path topic that is still not having its final chapter written. So a lot to digest right now.
JP, thanks very much. Bloomberg strategist JP Barnard talking to us about the trades that have worked and no longer are, like momentum trades have been falling apart. Let's get a look at some of the individual movers on our radar this morning. Reddit gave an upbeat outlook for ad sales after earnings topped expectations. Roblox daily active users were above estimates, and its sales outlook also beat expectations. And Novo Nordisk said Hims and Hers is unlawfully mass marketing unapproved, untested semaglutide pills for $49 a month. Novo called the move illegal and said it poses a significant risk to patient safety. But what is a patient to do who wants to lose weight and can't afford to pay Novo prices?
Also, the problem for me, too, was like they didn't say what the significant risk was. If I were to read that and I was a patient, I'd be like, you're just upset and you don't want them to sell it. Tell us what the risk is, and then maybe we won't take it.
Yeah, it'll be interesting to watch this battle play out. Take a look at futures, Danny. A little bit of a bounce here.
Yeah, have we found a floor? A pretty significant bounce for Russell 2000 futures, up 1.4%, up 0.5% for the S&P 500. But still, we did see the S&P fall for 3 straight days, the worst since November. The software component of the S&P 500, that fell for 7 days. It's now 30% from its October peak into a bear market. Coming up, Bloomberg's Michael McKee is sitting down with Atlanta Fed President Raphael Bostic. An exclusive interview from the Peach State. That's right after this break.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe. I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie. This is your opening trade.
Only on Bloomberg.
Good morning. I'm Michael McKee, the International Economics and Policy Correspondent for Bloomberg, and we are here in Atlanta. Welcome to all of our viewers and listeners around the world on Bloomberg Television and radio. We're speaking with the Atlanta Fed President, Raphael Bostic, who is retiring at the end of this month. So this is sort of your HR exit interview.
Mike, it's always good to see you.
I want to ask you, as you travel around your district for the past year, what's the mood like among companies and consumers? We've seen the surveys show that people are getting very, very pessimistic.
Well, I'd say it runs in two ways. So first of all, what has been true throughout the last year is a tremendous amount of resilience on the part of both businesses and consumers. You know, when April 2nd, when the tariffs were announced at very high levels, that put everyone back on their heels, and there was a lot of uncertainty. And what's happened through the year is people have figured out ways to deal with that uncertainty. So as for today, I think most businesses and most households are not thinking that the worst of the possible outcomes are going to happen. They're not sure they can get to the best ones, but everyone's trying to find a steady state where they can get through. So I think the sentiment is one of cautious optimism, but I'd put emphasis on the cautious as opposed to the optimism. I think people are really trying to wait and see what happens.
Well, what do you think that means for the economy?
Well, I think it means that the things that we've seen for the second half of 2025, we will continue to see through 2026. And you know, I've talked to a lot of folks over the last 6 weeks or so, and they said, you know, we think our experiences in October, November, December are likely to move on. And then there are some reasons why they think it might actually get stronger. You know, the tariffs, people have gotten used to those. And so those effects will have run through by the middle of the year. We see some of the stimulative aspects of the tax bill last summer. Those will be coming on board. And if consumers start to feel like there's more certainty, then I think businesses think there's some upside potential in the economy.
Well, this last week, we've gotten a lot of bad news on the employment front with ADP and Challenger and the other numbers that have come out. Does any of that, you don't have another meeting to vote at, but does any of that give you pause about the Fed pausing at this point?
For me, no. I think we've been in a situation where inflation has been too high for too long. And by many readings, it's been kind of marking time. It's been at a plateau well above our target for the better part of 2 years. That's not acceptable. And for me, I think we can't lose sight of the inflationary concerns. The labor market is very turbulent. right now, and some of it is because there are some big structural things that are happening in the economy. When I talk to businesses, they're reluctant to hire entry-level people at the same ways that they did before, because they think things like AI can replace that, and they can deploy resources for other things. And I'm hearing that kind of reticence. There's also the reality that during the pandemic, a lot of companies ramped up because the demand ramped up, and they've been slower to right-size. We see a bunch of that right-sizing happening as well. And then we have issues around the labor supply and whether the immigration shifts are going to be temporary or permanent. And if they're permanent, then we're going to have a lower steady state job creation. So for all those reasons, I think it's very hard to make a clear statement. And then, of course, we don't have a jobs number today, right? So we're not getting the data in a timely basis. My team tells me it'll be April or May before we start to be able to draw clear signals from the data to really understand what's going on.
Yeah, we wanted to wish you a happy non-jobs day today. You started a long and varied career at the Fed in 1995. Since then, what have you learned about the economy and about inflation?
Well, I think for the economy, one thing that is true is that it is a very complex economy. It's very large. And to understand it, you really have to get out and see all parts of it. And one of the things that's been great in my role here is I've had a chance to do that. I think it's given me a deeper understanding of just how people engage and experience the economy and how they make decisions to move it forward. In terms of inflation, what I've learned is that we really don't want to have inflation. Right? Once inflation gets entrenched in people's minds, it changes how the economy evolves. And it's one of the reasons why I think that we need to keep our policy in a restrictive posture so that we get inflation back to 2%. That's paramount. High prices and the prospect of rising prices really do have a lot of families on the edge. And you all have reported a lot about the K-shaped economy. There are lots of families that are feeling very precarious right now, and that's a source of concern.
Do you think the economy is becoming more K-shaped?
I don't know more. I mean, it's been that way for a while. Just before the pandemic, I had been talking about this, and we were trying to find some metrics to really detail how there's a split. I used to call it the barbell economy, where either you're at the high end or at the low end. The K-shape is the same thing. What I know is that there are a lot of families that are precarious and are feeling very uncertain about their prospects for the future and the prospects for their children, for that matter. And that concern, I think, does underlie a bit of the low consumer confidence that we continue to see being reported. And what we'll need to do is really give people reasons to be optimistic, show them where the new jobs are coming from, and show them how they get the skills to compete for it.
Well, this week, Treasury Secretary Bessent said the Fed has lost the confidence of the American people. Do you think you have lost the confidence of the American people? In your district, do you hear people raising questions about that?
That's not been my experience. As I go around the 6th District, people tell me, we're grateful for what you're doing. You have a very hard job, and we want you to be as data dependent and as open to information so you can make the best judgment that you can. Look, the world is very complicated. It's actually more complicated today than it has been my whole time here. So what I think most people understand that, and they know that we're doing the best job that we can under very difficult circumstances.
Well, you have a unique perspective because when you took office at the Atlanta Fed in 2017, you were the first black president of a regional Fed bank. Looking back now and hearing the criticism that we get from Washington, do you think the Fed was too woke and perhaps the inclusive employment idea was a mistake?
I don't think so. What we have is an economy that needs to work for everyone. And if we're not mindful about the ways that the economy is not working for people, then our maximum employment outcome is going to be lower than it can be, and it doesn't serve the American people as well as it could. So I think the focus on every American and every American's experience is exactly the thing that the Federal Reserve needs to be doing. That's different than saying that is unduly influencing our policy decisions. And I will say, through this whole episode, the whole time I've been here, you can look at the market predictors and the market projections. They, in many instances, were more extreme than ours, right? And so I actually think we've been doing the best that we can, and we've been data dependent in the way we've been for 100 and some odd years. So I don't take on board those arguments.
Well, the new chair designate, Kevin Warsh, says the Fed needs regime change. What does that mean to you?
I have no idea. I mean, you're going to have to ask him what that means. Look, I think we definitely need to be data dependent. Our bank has really taken on board the notion that we need to go out and engage and talk to business leaders, find out how they're engaging with the business, how they're making decisions. And that combination we have found to give us the best perspective on how the economy is performing. I don't think that we should change from that. I think we might need to even lean in more to those non-official data sources as the economy is changing so rapidly, because those are all looking backwards and we need to be looking forward.
Well, he's been very critical of what he calls the Fed's mission creep. Does he have a point?
I actually don't even see the mission creep argument. Like for me, on the banking side, for example, our job is to make sure that every bank that's alive today is alive tomorrow. And so we need to make sure that banks are thinking about the risks that could cause them to need to deploy capital in ways other than in loans. And so having conversations about those things, I think, is fully appropriate, and we should be doing that. We don't tell banks where to lend. I've never told a bank, don't do a loan or don't do that sort of thing, and my examiners don't as well. I think we're asking prudent questions to make sure that financial sector, business leaders are aware of trends that could be introducing risk.
Warsh also says that he wants to shelve QE and significantly shrink the balance sheet and perhaps go back to a scarce reserves regime for managing the interest rates of the country. Could he do that? Would that be a good idea, or how hard would that be?
So I think it's doable. To me, I was not at the Fed when the decision was made to go from the scarce reserves to an abundant reserves regime. I do know there were tensions and a lot of volatility that happened in the scarce reserve environment. And so if you were going to move back to that, I would hope that there'd be a discussion about how to mitigate that volatility, because so much of what we've done is just to make sure there's liquidity in the marketplace, and that liquidity is actually important to make sure that consumers and businesses are not worrying, or can just worry about, is this a good decision, as opposed to whether I can execute on the good decision. That leads to a different kind of allocation of capital that's not helpful.
Tell me about Jay Powell and what he means to the Fed.
Jay has been great. He's a colleague. I consider him a friend, very open and very transparent. And he's led the institution. He's been at the institution for a long time, through a lot of significant periods. I think his legacy will be quite positive. And I'd be sad to see him leave the board if that's what he chooses to do. But it's been a great relationship for me with him, and it's been my pleasure to serve under him.
Do you agree with the sentiments he showed when he made his video a couple of weeks ago?
So I'm not going to talk about the specifics of the legal action from the Justice Department. What I would say is this: it is essential that the Fed perform its duty mindful to its charge, which is stable price and maximum employment, to really focus and create long-term stability and predictability in the U.S. economy. And if you want to call that independence or whatever you want to call it, you can do that. But that's the charge, and we need to stay true to that, even when people with different horizons and different objectives have their views about what we want to do.
There were questions about the Fed and its ethics rules. You ran into some problems, as did others, with those. Was that the rules, or was that the individuals who created the problems?
Well, individuals make the rules. I will say, for me, I thought I was doing the right thing, and I found out that I wasn't. So once I discovered that I wasn't doing that in the reporting side, then I changed them, and I changed our rules. I want to make sure that no one goes through that at all. And I've been grateful that the IG report validated that I wasn't using insider information. And so to me, I think we need to make sure the rules are clear and they draw bright lines so that lay people can come in and use them in ways that allow them to avoid the challenges that I had. And then, there may be some people that have problems, but that's not what I've seen in terms of my experience.
Well, last question. What would you tell Donald Trump, if you had the opportunity, about Jay Powell and about the Fed?
I'd say Jay's trying to do the best that he can. He's a smart man. He understands markets. If you want him to succeed, you should let him succeed.
Well, the Fed itself, do you think it is under threat from this administration?
Threat, I don't know. What I would say is my whole time here, and I think that most of the history of the Fed, there have been people who thought the Fed should do other things and talked about that and called them out. This is another one of those times. And we need to be mindful, and we need to be solid and resolute to understand that that comes with the territory, and with that territory then requires our strength and our resoluteness to stay focused on what we've been asked to do.
Raphael Bostic, thank you very much for joining us. President for another couple of weeks of the Atlanta Fed. I'll send it back to you in New York.
Bloomberg's Michael McKee there, speaking with Atlanta Fed President Raphael Bostic. All right, moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We're looking at futures that are up across the board with dip buying going on after the drops that we saw yesterday, really across assets. Right now, S&P futures up about 0.5%, as our NASDAQ futures. Small caps gaining 1.4% this morning. Maybe that's on some optimism about the Fed. I recognize it's Jennifer Garner. Correct. That's great. Once Upon a Farm, OFRM, I guess, is the ticker there. And also, my mother was her advisor at Denison University.
Oh, I thought maybe we were going to say for this IPO.
No,
that
I mean
maybe
in
makes
college.
more. Yeah, that makes sense.
Which was
very cool for your mom.
Which was a while back. Okay, Spyglass Pharma ringing the bell at the NASDAQ. The important thing to note today is that we have dip buying going on, even after Amazon said it's going to spend $200 billion this year on CapEx. That's what has been hurting Mag 7 companies throughout reporting season thus far.
I say dip buying, but not for Amazon, to be clear. Those shares are still getting hurt, and I actually have a look at them and what they're doing at the open at the moment. I think, there we go, there's today's trade. So you can see it was already down 4% yesterday. It adds to that, down almost 9% this morning. As Matt, as you said, $200 billion on its AI efforts. That is 27% higher than the average Wall Street estimate. The money will predominantly go towards the company's Amazon Web Services cloud unit, according to Andy Jassy. But even after the sell-off, it is clear this market is nervous if you're putting up hundreds of billions of dollars worth of spending, even if it's on AI.
Yeah, a big drop there, to be sure, especially considering, so many people associate the business with other things than AI. Of course, Amazon Web Services, as Ed Ludlow tells us, is the profit center for them, and it does have a backlog in terms of its cloud services of $244 billion. Stellantis says its pivot away from EVs will cost the company $26 billion. The write-downs cover cancellations of certain models, compensating suppliers, and I would hope also bringing back other models. We need to see the 6.4-liter Hemi V8. And they're going to be lowering prices as well across the board, but especially at Jeep for the base price and for options. So look out for that. Joining us now to talk about all that's going on in the markets right now is BlackRock Global Chief Investment Officer of Global Fixed Income, Rick Reeder. And Rick, we book you on every jobs day, but this is yet another Friday when we don't get the jobs report because of a short government shutdown. It looks like we could have another one, partial shutdown, at the end of next week. What do you make of this sort of muddy data picture when we don't get the things we need in time?
Well, so first of all, it hasn't been jobs day in a number of months anyway, because we're not getting any of those. So I think the last 3 months we've had negative, we had a government shutdown, but you still had negative jobs. Listen, I mean, it's a little trickier when you don't get the actual published reports. The markets pivot off it. By the way, the volatility markets, you strike a lot of options in and around those dates. So it does create a little bit of trickiness. That being said, I mean, particularly for jobs, and we've talked about it a number of months on your show, you look at what we got yesterday, you look at the JOLTS report, you look at the Challenger job cuts, you look at the claims data, you look at the ISM services in terms of jobs, there's no ambiguity around where we are in the jobs market. We're having a really tough time. We're watching productivity explode higher in terms of growth being really good, but a job market that's really tricky.
That dichotomy, Rick, is the most fascinating. Well, there's a lot of interesting stuff going on, but it's one of the most fascinating things about this economy, because it's difficult for anyone to say, even with jobs looking very challenging, that we're heading anywhere near a recession, as long as the Mag 7 is spending, what, like 2.1% of GDP on CapEx, as long as a government's running a 6% plus deficit. Is this economy going to be okay, even if the jobs market starts to have some cracks in it?
Yeah, the answer is yes. And I think people don't look at jobs and look at this economy like it was 20, 30 years ago. You have an extraordinarily different economy, service-oriented versus goods-oriented. But you've got an economy that's operating incredibly well, but only on a couple or three cylinders. Today, you've got, like you pointed out, you've got CapEx that is robust, that will continue. You've got consumption that is robust, but it's driven by wealthier, older savers, and it's part of why the interest rate tool is not nearly as effective as it used to be, because that cohort is doing extremely well. Where the burden today is in terms of low income, small business, younger people. And so when you aggregate the data, and I hear a lot of people talking about, oh my God, the jobs market is softening, the economy is going to come under pressure. It's actually, this is an economy that's more asset-oriented than labor-oriented, and that cohort, I don't want to understate this. We have a problem in terms of we need to employ more people, but that cohort isn't that much in terms of aggregate spend. So the economy can continue to motor along, and productivity, I mean, you watch it play out every day. I mean, now the equity market has taken it on about where is productivity manifesting itself effectively. Some spaces, not other. Who are the winners? Who's building a moat? Who's not going to be a winner in this? But at the core, you're watching something play out that's pretty historic.
Anthropic putting out another AI tool, this time for financial analysis. They did earlier this week for legal services, both of them kind of rocking the market. That will affect sales at big companies, I imagine, big and small, as well as the jobs picture, right? We're talking to a lot of people. Yesterday, we were talking to Mike Arrighetti from Ares, who pointed out that, the younger talent, the new hires aren't going to be doing the same work and may not be as plentiful as they once were. In that industry, what do you make of AI changing the way we work, or the fact that we work at all?
Well, Mike's a very smart guy. I would say a couple of things. I chair the board of, we have 14 charter schools in Newark, New Jersey, and we just had a discussion this week at our board meeting about what is our curriculum going forward. How does AI evolve how we teach kids? What are the disciplines we're teaching our kids for going forward? How do we use AI to augment a traditional teaching process? This is all new territory, and this is all new land in terms of where we're going. Listen, I think there's a bunch of things that are, that have been standard operating procedure that, that we used to teach people for, and quite frankly, AI is going to fulfill that function going forward. I still think learning and interacting with people and the core of education will be sincere to what it was. But gosh, there are so many things we got to think about what can AI do that can make the economy more efficient, make people more efficient, and then move people into the zones that are going to be fulfilling going forward. But that is, I'll tell you, Matt, there is no roadmap for this.
Well, what do you make of, I look at BINC, the ETF that you manage very well, and we'll show in a second how you've beaten returns of the benchmarks by a lot. But there's some corporate assets there, right? 45%. And I wonder how you judge whether or not a company has a moat, what that moat would look like so that it can defend itself against AI disruption.
So there is, how do I describe this? By the way, I will take it in a couple of different directions. One that's interesting, you hear the discussion about CapEx, and the CapEx was too high. And I would argue there's some other things at play there. CapEx is your moat. CapEx and R&D spend are the way companies can build their moat, and it's actually data utilization. And the companies that are exploiting data effectively, that are building bigger moats, that is at the core of what is happening. There's something also that's different today. Some companies, the free cash flow generation that's been so robust over the last couple of years, you see some of these big companies buying back a huge amount of stock, Now they're spending more on CapEx. It has real ramifications for the technicals in the equity market that we got to think through. Listen, it's a lot of hard work. Yep, go ahead.
Well, I just want to jump in about the other hard work you do at Bink and how you're thinking about positioning the fund and where on the curve. Yield curve just shy of its 2022 highs, somewhat reversed a little bit yesterday, but some of that steepening continues. Yeah. We have an incoming Fed chief who's been talking about trying to shrink the balance sheet over at the Fed. When you think about the rest of this year, are you thinking about changes to Bink at all? Where do you want to be positioned for the road ahead in fixed income?
So a bunch of changes. Your point about credit, we've reduced some credit, we've reduced some IG, because quite frankly, it's not that fulfilling. We're going to get a lot of supply. The spread's not that interesting. You know, we've cut a little bit of the low quality, high yield. By the way, we're running a bit less high yield than we're running overall. We've added to mortgages, although recently, last couple of months, or no, last few days, maybe we've cut a little bit of mortgages because the balance sheet discussion becomes a little less enthusiastic than it was before. But we still like mortgages. We like EM a lot, and the dollar will stay contained. And so EM, the yield differential between EM and high yield, is as good as it's ever been. And then the key one for us is securitization markets that will allow you to structure the collateral, the covenants, what your attachment point is. So we love the securitization market. But you're right, it's a different expression, a little less credit, a little more EM, a little more in the securitization zone. By the way, Europe killed it last year, and now the benefit you're getting from Europe is not nearly as robust as it was. So we've dulled down a little bit of that, and more Asia in the portfolio. So yeah, we've been moving around a fair amount to keep it dynamic and where we think the best opportunity is.
Hey, Rick, we're going to have to leave it there. Thank you so much for joining us. We look forward to you talking next, not Jobs Friday. Hopefully it will be a Jobs Friday next time we talk. Rick Reeder of BlackRock. All right, let's get a check on your equity market right now. About 10 minutes into your trading day. Have we found a floor? We're up 1% after 3 consecutive days of declines for the S&P, 7 days of declines for the software sector. It's down almost 30% from its high, so we're in a bear market for software. Leading us higher is NVIDIA this morning, and Broadcom and Apple and Microsoft. So some of the rebounds of the things that were hard hit. I guess NVIDIA and Broadcom do well when you get $200 billion thrown out there of spending from Amazon. The banks having a good day. JP Morgan, Eli Lilly, Tesla rounding out the top 10 of the movers. To the downside, it's Amazon. Again, it's those earnings, that punchy spend that was hugely above what was expected. Amazon.com falling 8%. Alphabet has another rough day after yesterday. Google also suffered too. It was down 1.2% today. Julian Emanuel writing in his note, the reaction to Google, despite a double beat, just shows the intensity of this market. If we look at what the individual sectors are doing today, let's get a look at that. Consumer discretionary, that's falling 2.6%. A largely positive day, despite the fact Amazon is dragging things down and Meta and Alphabet are down. That's why communications isn't doing well. Tech is up 2.6%. Industrials, financials, utilities, those also rallying 1%. I guess it's the good old question of, was all of that this past week, was that the worst of it, or is today a bounce of a dead cat, Matt?
All right. Dead cat bounce is one of my favorite Londonisms. Coming up, 4 Magnificent 7 companies have forecast capital expenditures that will reach $650 billion this year. Some are getting punished for it. We discuss with Mandeep Singh next. This is Bloomberg Open Interest.
Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal, with athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies. 1-1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television. Good morning to the dip buyers. Thank you for lifting this equity market up more than 1% for the S&P 500 and the NASDAQ, also 2,000. Check out this outperformance, up 2.25% after already outperforming the index for a large part of this year. Let's look at some of the top calls. Some of the analyst action we're focusing in on. First up, Ares. That gets upgraded at Deutsche Bank, which says recent worries about private credit and AI disruption are overdone and don't change the firm's long-term outlook. I should say that's really exactly what Michael Arrighetti, the CEO, told Matt and I yesterday. Deutsche Bank, for their part, views the post-earnings pullback as a buying opportunity, which Mike also talked about yesterday. Those shares are up 6.8%. Next up, Citi, they upgrade Estee Lauder, saying that the post-earnings pullback also creates a buying opportunity. Lots of opportunities out there. The firm says results were pressured by weaker demand in Japan and Korea, but sees improving outlook in its Beauty Reimagined strategy, driving better sales. Finally, D.A. Davidson downgrades Amazon after the tech giant forecasts roughly $200 billion in CapEx, a figure higher than the analysts there and most of them had expected. The results highlight concerns about how much big tech are spending on AI-related investments and when they will pay off. Those shares down more than 8.5%, Matt.
All right, let's stick with Amazon and AI CapEx with Bloomberg Intelligence Global Head of Tech Research, Mandeep Singh. So, Mandeep, today we get an even bigger number from Amazon than we got yesterday from Facebook. From Google. They're going to spend $200 billion on CapEx this year, and the market is punishing them, almost decimating the market cap of the company. Does that make sense to you?
It does. And look, these are eye-popping numbers, as you said. And when you look at Amazon, even though they had an acceleration in AWS growth, 24% was their best growth in the last 3 years. But, the $200 billion justification is still hard to find because Amazon right now is renting, a lot of the GPUs and the accelerators, but they're not using it themselves the same way as a Google is. So that's where, the market is trying to figure out, is the GPU rental business good enough, for the scale of CapEx that Amazon is talking about compared to a Google as well as Microsoft, which has that collaboration with OpenAI that is going to last at least for the next 5 years. Amazon, on the other hand, has to rely on OpenAI or Anthropic which are also going to rent GPUs from Microsoft and Oracle. So it's not very clear the backlog visibility for Amazon is as good as the rest of the hyperscalers. And when you look at the $200 billion capex number, it's probably the largest one amongst the hyperscalers. So I can understand their reaction today for the stock.
Mandeep, could they have said anything that would justify that amount, or is that insurmountable?
Well, I think you want to see a very steep acceleration in AWS growth. In fact, for Google, we are expecting almost 60% growth in their Google Cloud business, in addition to what they are doing on the search side. So from that perspective, you want to clearly lay out what the AI contribution of the workloads is. And in the case of Google, we estimate it's around 20% of the growth from that 48% came from AI. For Amazon, probably it's 200 to 300 basis points, and they should lay out exactly how it will be in 26 if they plan to spend $200 billion in capex.
In terms of what they're going to do with this money, Mandeep, I mean, I guess they're going to buy land, put data centers there, buy chips, put them in, and serve customers. They have a big backlog, right? $244 billion apparently of cloud backlog. I don't know the significance of that number or that claim, but they're just trying to meet the demand that they have, aren't they?
Yeah, but compare that to backlog of Microsoft, which is over $650 billion, including $300 billion from OpenAI. In fact, Oracle has a higher backlog than Amazon right now because of that OpenAI partnership. So that's where there is not enough clarity. Are they going to use those chips themselves for training their foundational model? If they're going to rent it, who is the big buyer? Because Anthropic is ramping up on Google TPUs. So that's the clarity that's missing in that backlog number. And in terms of their own usage, yes, the e-commerce side will be deploying a lot of these accelerator chips, but it's not to the scale of 200 billion. Maybe that one bright spot is, people are not going to move to data centers in space as quickly as, SpaceX and XAI are laying out. And if that is the case, then some of that enterprise demand will certainly come to Amazon because they're the largest public cloud provider.
And along with the hyperscalers that have gotten hammered this week, the epicenter of the damage still continues to be software. The index in the S&P is up 1.7% this morning, but it's fallen for 7 days. It's in a bear market. As we assess the landscape and what's been selling off in the latest announcement from Anthropic, be it legal work or financial work, to what degree was the reaction overdone, and to what degree was it justified for just how badly software might be hurt?
Well, right now, there is a lot of uncertainty in terms of what are the capabilities of these models in terms of disrupting existing software packages. And that's why the market is reacting the way it did, where it just sells everything indiscriminately. We just put out a note today saying cybersecurity is one of the sectors that is almost impossible to disrupt using these LLMs, because you need a lot of system log data that you're not going to find on the open internet. So from that perspective, you have to find those pockets within infrastructure that are least likely to be disrupted. And clearly, there has been an overreaction on that front.
How do you expect this to settle out, Mandeep? Because if you're going to disappoint the market by spending too much, but also lose ground in cloud by spending not enough, you're kind of stuck between a rock and a hard place.
Yeah, I mean, that's where I think the margins are very important. So in the case of Google, the incremental margins for their AI workloads are above their overall cloud margins, and it's driving a margin expansion, and it's coming with accelerating top-line growth. That's where Amazon has to clearly show its vertical strategy. Are the Trainium chips good enough in terms of getting the same kind of rental prices that NVIDIA GPUs and Google TPUs are getting? And if that is the case, then when will that margin expansion start to show up? Because that's what the street cares about, that they should not be diluting their margins in cloud by, over-investing right now in their CapEx.
Mandeep, thank you for all of your work this week in what we already knew was going to be busy, but ended up being even more insane. So we especially appreciate it. Mandeep Singh of Bloomberg Intelligence. Coming up in the next hour, we're going to discuss Anthropic's AI model for financial research and the impact it will have on Wall Street. Stay with us for that. You're watching Bloomberg Open Interest.
Your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherry-Ann in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about. This is Bloomberg Open Interest. I'm Matt Miller. Let's get a quick check at what's going on in the stock market to end the week. Some serious dip buying going on at the S&P now at more than 1%, but still at 68.76, so 125 points off of the intraday high. The NASDAQ gaining 1.1% after the big drop that we saw yesterday. You can see that NVIDIA is up today more than 5%, and that alone is enough to power this market to gains. Amazon down 8.8%, almost 9%, and that's going to take off a lot of what NVIDIA's added. The software drop that we've seen this week, hundreds of billions of dollars of market cap erased on concern that AI will disrupt software, is being bought now. iShares Bitcoin Trust also being bought back up after it dropped below 61,000 yesterday. The Spider Gold Trust coming back. That's basically and silver as well. That's basically the theme of the day, is buying everything that's gotten crushed so far this week. Danny.
And those ETFs are going to be important to watch because the retail crowd has really added to the momentum of not just the metals trade, but the equity trade, the Bitcoin. They all have become very interlinked. So the fact that flows are starting to come back and that they're in the green today maybe is a good thing. By the way, tune into ETF IQ on Mondays at 12 p.m. noon time. Coming up, your second hour, Bloomberg Open Interest.
tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the U.S. or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
The Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
CBS News on the Hour, your home for original reporting.
I'm Deborah Rodriguez. A deadline in a ransom note has come and gone in the kidnapping of Today Show anchor Savannah Guthrie's mother. Another lies ahead after 84-year-old Nancy Guthrie was abducted from her home in Arizona last weekend. CBS's Andres Gutierrez is in Tucson.
If this deadline comes through on Monday and there is no communication, they're still trying to establish contact with the alleged kidnappers, it'll be likely that law enforcement will end up deeming that this is not a credible note and they will continue on in their investigation.
Nancy Guthrie's son Cameron released a new video plea last night asking for his mother's abductors to get in touch with the family. The search is entering day 6. Iran's top diplomat calling today's brief, indirect talks with the U.S. and Oman a good start. Correspondent Elizabeth Palmer is at the foreign desk.
They were a long way apart to start with. The United States wants Iran to put various things on the table, not only its nuclear program, but also its ballistic missile program. Iran, for its part, has said absolutely not. Missiles are a non-starter. We're not talking about them.
Special Envoy Steve Witkoff and the president's son-in-law Jared Kushner attended today's meeting but have not commented. President Trump is catching heat after he reposted a video that depicts former President Barack Obama and his wife Michelle as primates.
The video claims voting machines were tampered with during the 2020 election. At the end of the video, there's a quick animation of the Obamas' faces transposed onto dancing cartoon monkeys in a jungle. Critics say it's racist. White House Press Secretary Caroline Leavitt says the clip is from a year-old video, which she reposted. It depicts Trump as the king of the jungle and various Democrats as characters from The Lion King. Leavitt wrote, quote, "Please stop the fake outrage." Michael Wallace, CBS News.
People who live in the eastern portion of the country can't get a break from the biting cold. In some spots, harsh winds will make it feel like it's 30 degrees below zero. Meteorologist Craig Allen.
There's the possibility of winds gusting over 50 miles per hour. Wind advisories are now in effect for many portions of the Northeast.
Big news from the big leagues. Here's CBS's Jim Krasula.
Rocchio swings and misses for strike 3. Skubal makes quick work of him.
Tarek Skubal has won his salary arbitration hearing with the Detroit Tigers, and the two-time Cy Young Award winner will be paid a record $32 million this year instead of the team's $19 million offer.
Dow up 679 after a three-day slide. This is CBS News. A decision in a key case against a top ride-sharing company.
A Phoenix jury has ordered Uber to pay $8.5 million after finding it liable in a lawsuit brought by a woman who said she was sexually assaulted by a driver in 2023 when she was 19. Jalen Dean's case was the first trial of more than 3,000 similar lawsuits against Uber that have been consolidated in federal court. The ride-sharing company has maintained that it is not liable for the misconduct of drivers on the platform, whom it classifies as independent contractors, not employees. Steve Kathan, CBS News.
How far will an actress go for her art?
Why did you leave me? Why did you betray your own heart?
Margot Robbie posed for pictures at the London premiere of her upcoming movie Wuthering Heights, wearing an exact replica of the mourning bracelet Charlotte Bronte wore after her sister Emily died 175 years ago. Deborah Rodriguez, CBS.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, we're streaming live on YouTube as well. We're also streaming at Bloomberg.com/videos. That's where Bloomberg is curating all the video product that we put out. Busy Friday. We got some green on the screen here today for once. We got a big bounce back in Bitcoin. We'll get to all that. We're going to talk to Joanne Shu, University of Michigan Surveys Consumers Director. We had some UMich data came out today. Pretty darn good numbers, I would say. Jillian Wolf, Bloomberg Intelligence Global Equity Strategist. We'll get her thoughts on these markets. What a wild week it's been here as we bounce back today. Mandeep Singh, Global Tech Research Head of Bloomberg Intelligence. We're going to talk all things tech, starting off with some of the big numbers out of Amazon and just the cloud and what's going on in big tech as the software companies were selling off hard this week, getting a bounce back today. Poonam Goyal is going to join us. She covers all the retailers, including Amazon.com, so we'll get the latest there. So a lot coming up on the stock front and on some economic data and general geopolitical news in the market. That's all coming up. The next 2 hours, Scarlett Fu and Paul Sweeney with our Bloomberg Intelligence program. Let's kick it off. John Tucker, Bloomberg Business Flash.
All right, guys, this Bloomberg Business Flash being brought to you by IBKR. Financial advisors switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges, no conflicts of your interests. Learn more at ibkr.com/RIA. You mentioned the numbers, Paul. Let's get right to it. University of Michigan, the headline number, the sentiment indicator, more than expected. We're a little more confident, 57.3. The expectation was for 55. It's also better than the prior month. I always go to the inflation expectations. Shorter-term inflation expectations, 1 year, 3.5%. The survey of economists by Bloomberg, that was looking for 4%, so better there. The longer-term 5 to 10-year inflation expectation, 3.4%. That's higher than the prior month and also higher than the expectations. So maybe less of a reason to raise rates. That's why you've seen the immediate reaction in the 2-year, more policy reactive there. That is up close to 5 basis points at 349. Well, the major stock averages, they are higher, risk on today, but there is so much focus on Amazon. Among the worst performers in the S&P 500, shares of Amazon right now down over 9%. Just the latest tech company to test investor nerves with the big AI spending. Sean Simons at UBS Securities has been kind of less enthusiastic about the technology shares.
We still hold it as a neutral in our view for the year. So I do think there's going to be some opportunities within tech, but it's not necessarily going to be the stalwart driver of the overall market.
Yeah, right now the S&P 500 up 60 points. That's a rise of 0.9%, 68.59. The Dow up 771 points. That is up 1.6%. And right now the NASDAQ 100 is up 146 points. We are up right now 0.6%. So the question's going to be raised, did we hit bottom? We check the markets for you all day long. Of course, I'm not going to answer it. Right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Scarlett and Paul.
All right, John Tucker, thank you so much. We appreciate that. Paul Sweeney and Scarlett Fu, we're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube and at Bloomberg.com/videos. Let's take a look at some of the stocks on the move today. We're joined by Bloomberg's Alexander Semenova. Alex, what are you looking at?
So we have to start with Amazon, of course. If you are an Amazon investor, you might want to close your eyes, close your ears, because it is taking a painful move lower today. The stock is down 9%. This is actually the biggest one-day decline since the tech rout of 2022. This is after the company announced plans to spend $200 billion this year on data centers, chips, and other equipment. This is, of course, consistent with the story that we've seen that investors have just been punishing companies that are spending a lot on AI. They're scrutinizing those expenditures a lot more heavily than they did in the past. This is worrying people that these big AI outlays may not pay off for the company. CEO Andy Jassy said that the money predominantly would go toward the company's Amazon Web Services cloud unit. Much of it would be used for AI workloads. And they did say that the spending will weigh on profits. It gave a forecast for operating income in the current quarter of $16.5 billion to $21.5 billion. Analysts on average had estimated $22.2 billion. And of course, we saw earlier this week, Microsoft and Alphabet also outlined heavy spending plans and their shares fell lower.
Yeah, I'm looking at Alphabet shares down now for a 4th straight day. So big tech is certainly getting a rethink from investors. What's next on your list?
So we also have to talk about crypto. Crypto dip buyers are finally wading in after a brutal run. Bitcoin has reclaimed about half of the losses registered during the crypto meltdown yesterday, which, by the way, guys, was the largest since the collapse of Sam Bankman-Fried's FTX. Right. Really, really brutal moves there. That is putting crypto shares into focus today, and predominantly Strategy. It is actually jumping. It is up about 15% right now, even after it reported a net loss of $12.4 billion in the 4th quarter, of course, driven by the declines in Bitcoin, which it holds. It's usually moving in tandem with the cryptocurrency. I saw some pretty bullish commentary from TD Cowen. They say that Strategy can actually withstand further Bitcoin declines without having to sell because they have $2.25 billion in cash reserves. And they said that this feels uncomfortable when crypto is falling, but Strategy is actually better positioned than ever to participate in a recovery.
All right, last one.
And the final one is Stellantis. It is taking a more than 22 billion euro or $26 billion charge, mainly linked to reversing some of its electric vehicle strategy. This is the maker of cars like Jeep and Fiat. Its shares are down 25% right now. This is the biggest one-day drop ever. It is now trading at a 2020 low. A lot of superlatives that we're using today. The write-downs will cover the cost of canceling EV
orders and compensating suppliers. It actually exceeds the write-downs that we have seen from Ford, from General Motors, and some of its other competitors. And the CEO said that these write-downs largely reflect the cost of overestimating the transition to energy.
Okay, this is certainly not unique to Stellantis. All these automakers have been winding it down.
It's unbelievable the write-downs they've all taken. It's
Yeah.
just extraordinary. I mean, you know, tens of billions of dollars. I mean, and I think GM, the stock has actually been a great stock because I think they've signaled to the marketplace, we're stepping back from EVs. We're slowing it down big time. And the street likes that because we're going to build the stuff that actually makes
We're
money
going to
today.
double down on the big gas-guzzling
Yep.
SUVs that American consumers favor right now.
Kevin Tynan, formerly of Bloomberg Intelligence, that was his clear message for years. They're going to focus on what makes them money.
Their
and
bread
the big,
and butter.
And the big trucks make money.
Yeah,
the
well.
EVs don't.
And that platform, you could use it for various things, right?
Exactly.
So he's vindicated then.
He is
All right.
completely vindicated.
Thank you so much, Alexandra Semenova, with our movers to watch. For more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. All right, let's get to that consumer sentiment data that we just got at the top of the hour, which did show that things improved unexpectedly to a 6-month high when it comes to how consumers are feeling. Joanne Shu is University of Michigan Surveys of Consumers Director here with us to give us a little more context on this. So what do we chalk up the unexpected improvement in sentiment to?
So this improvement is very, very small. It's less than 1 index point. It's not, it's well within the margin of error. This should be interpreted as a no change reading.
Okay.
And overall, we're still actually in the bottom decile of readings, historically speaking. So this is still very, very low levels of sentiment. Consumers are very much really emphasizing the pressures on their budgets. So they are both worried about, continuing to worry about weakening labor markets as well as the persistence of the high prices. Really, the gains that we saw this month were primarily from people with large stock portfolios. And I want to note that our interviews closed on Monday. So that's before we had the market drama during the week.
Important context.
You know, I'm just looking at the consumer sentiment index going back like 5 years. If I had to just eyeball an average, kind of in the high 60s, maybe a 70 range, is that a number that reflects a good sentiment out there?
You know, coming into the pandemic, it was more like in the 90s. After the pandemic, it's been pretty low.
Wow.
And so this reading in the 50s, this is not a good reading looking back historically. I'm not sure if sentiment is going to go back to that pre-pandemic level anytime soon, but we want to get out of the 50s. We want to see sustained upward trajectory. We've seen a couple of increases in recent months, but they've, like I said, been very, very small within the margin of error, and overall sentiment's kind of been stagnating.
This is another example, Scarlett, where context matters.
Oh, absolutely.
I just put the GP, the chart of this thing going back to like the 1980s. You're right, Joanne. I mean, this thing was like in the 90s, averaging high 80s over the last 20, 30.
But it also depends on who you ask, right? Because what University of Michigan does is look at sentiment by political party. And what we've seen, Joanne, is that Republicans are scoring somewhere in the 90s, high 90s, in fact, when it comes to sentiment.
Yeah, so we've seen a partisan divide in consumer sentiment going all the way back to the Reagan administration, if not earlier. So it's always the case that if your party's in power, you feel better about the economy than if your party's not in power. But if we take away Republicans and Democrats and we only look at independents, we get the exact same national number. The national number is exactly on the pulse of the independents who aren't really swayed by those wins.
With a 1-year inflation, that's a big step down. The consensus was 4%. The last period was 4%, and it came in at 3.5%. I'm guessing the Fed's going to like that, if nothing else. What do you make of that move?
Consumers are definitely starting to feel a little bit less worried that inflation is going to come surging back. You know, they were expecting a worst case scenario back last April and May. They're not worried about that worst case scenario anymore. You know, 3.5 is still higher than what we were seeing in 2024. So consumers don't think we're out of the woods yet.
And their outlook for long-term inflation, 5 to 10 years, really hasn't changed very much. It's still holding at about 3.3, 3.4%, which is in line with the 1-year inflation outlook. So they don't see inflation getting better either.
That's right. The 3.4% that we see this month, it's still higher than 2024. So it's stabilized, but not necessarily at the level that we'd like to see long term.
All right, very good. Joanne Shu, Surveys of Consumers Director at the University of Michigan. Some good stuff there. I think the numbers look pretty good, but boy, you put them into context going back, and we got to get out of the 50s. She's right. So there you go.
I know. So even though we say it's at a 6-month high and unexpected gain, if you look at the long-term view of the chart, it's still very much bumping along the bottom. So yes, off those lows, but still not back to where it was before the pandemic.
All right, folks, you can explore live streaming news and interviews, all of our Bloomberg TV shows, documentaries, reporter analysis, and more. It's all in one place. Check out Bloomberg.com/videos, and that's where you find it all. S&P up 65.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. 6 of the 11 major industry groups in the S&P 500 are higher right now as this risk-on rally continues. Energy is right up at the top. I'm going to guess that's because the icy grip of winter will envelop a large swath of the nation this weekend, like single digits. And I showed you the picture of the wild turkeys. Yep. They were trying to get into my house. They were so cold.
I'm supposed to do a polar plunging in the Atlantic Ocean Saturday
You're
morning.
rethinking that one, right?
You'll come out like a block of ice.
I don't think that's happening.
Don't do that. Information technology, that's right there as well. That is higher. But, you know, Amazon, that's the story of the morning, not participating. The share is actually declining right now. They're down 8%. Same old story. Investors worried they're spending too much on all that AI stuff. S&P 500, 78 points higher. That's up 1.2%, 68.77 on the index. The Dow Jones Industrial Average up 825 points. And the tech-heavy NASDAQ 100, 258 points higher. That is a rise of 1%. I'll have to do Bitcoin, 8% higher right now. Still $68,000 per token. Remember, it was at what? 125,000 last
in
year?
October,
Anyway.
Then got below 63,000 yesterday, so it's all over the place.
We'll continue. I mean, somebody's going to be along and explain all this to us. We check the markets view.
Price goes up, price goes down.
Yeah, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash, Scarlett and Paul.
All right, JT, thank you so much. We appreciate that. Scarlett Fu, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube and streaming live also at Bloomberg.com/videos. Markets rebounding, as John's been reporting all morning, with the S&P up 1%. But that selling that got your attention in the last 4 or 5 days.
Yeah, and it was sustained for a couple of days, too.
It was with some volume there. So I don't know what's going on here, but we have somebody who does. We pay people to do this stuff. Jillian Wolf, global equity strategist for Bloomberg Intelligence. She joins us here in our studio. Jillian, what did you make of the trading over the last 4 or 5 days? That selling was something. We do have a rebound today. What do you think's going on out there?
It feels like Groundhog Day a little bit because over the past, I want to say 2 years where we've been covering this and the AI volatility, we've seen a lot of these panics, right? We saw this in mid-2024 after TSMC gave some bad guidance. We saw the market get shaky on that. We saw this after DeepSeek. We saw this during 4Q earnings. After each and every one of those periods of shock, the market has managed to recover. It seems like investors are on edge, definitely with anything that can threaten the AI thesis, like Anthropic, like earnings not coming in quite as good as they'd like. But every single time, it's just been shakiness, volatility, and then a rebound. So honestly, on the BI desk, we're not taking it too seriously.
Okay.
We haven't seen any real structural changes in the AI thesis occur just yet. One thing that we do think is interesting is that a lot of these tech stocks are beating consensus estimates, but still falling, which tells us that the expectations are even higher than the consensus is telling us. And it's not just about earnings anymore. These companies have to really justify these insane valuations and have to perform so perfectly across all facets of the balance and cash flow sheet to rise. So definitely volatility to come, but I don't think there's really many structural changes that could cause a shift in that thesis.
Right. As long as their CapEx numbers keep coming in higher than what analysts had forecast, that generates a negative knee-jerk reaction. How are you thinking about the moves in credit? Because oftentimes credit leads equities. Equity investors can stay optimistic for a lot longer than credit investors. And we haven't seen that much panic in credit markets, except when you look at certain really junky loans on the leverage market side. And that is where some of the stress shows up. Is equities leading the rest of the market right now, or is equities kind of following?
Well, one thing we've been discussing is a bit of a breakdown in the traditional relationship between the credit and the equity markets, right? Typically, they're more anti-correlated with one another, but right now it seems like so much of the equity market is driven by the Mag 7 and that performance that it's become a little bit more dislocated from what's happening broadly in the credit markets. And we've seen this really across the globe, not just in the US, that the standard credit equity relationship, you rotate out of one into the other, isn't holding up quite as much in this new AI era. There's a lot more at play here, and we've definitely entered a different regime when it comes to the relationship between credit and equity. I mean, we've seen a big regime shift in the relationship between a lot of assets. We've seen a big regime shift in the relationship between gold and equities, between the dollar and equities. So I think the standard playbook of we normally see certain correlations between one asset class and another, definitely, particularly with the Trump administration and with the AI regime shift, we can't rely on those patterns as much going forward.
You guys buy into, we're seeing a rotation in the market, maybe starting last November, out of some tech, maybe into some of the better valuation stories, maybe into small and mid-cap stocks? Is that what you guys are seeing?
So we're definitely seeing a little bit of earnings rotation occurring. What the expectation was heading into 2025 was that what we call the 493, the non-Mag 7 stocks in the S&P 500, earnings were supposed to accelerate for that group and decelerate for the Mag 7 so that they would roughly be in line with each other by the end of the year. That didn't happen. The thesis has been pushed out to the end of 2026 because of tariffs. But I think the consensus might be more on point this time because we don't have as much of the tariff tailwind happening in our direction, that we could see definitely some catch up in the non-AI stocks. That's at least what the consensus is thinking right now, that earnings are going to pick up in the non-AI space, decelerate, not decline, decelerate in the AI space, and we'll end up kind of on the same footing by the end of the year.
I'm so glad you bring that up because I feel like the earnings story has really moved on from the Mag 7. Yes, we'll be getting enterprise software companies reporting, but they don't move the market the way that the big tech guys do.
Yeah.
And then, of course, we're going to hear from consumer companies as well. And we know that we have a K-shaped economy, so it really depends on what kind of consumer you serve. How do you see that influencing the overall direction of markets and, you know, the appetite for risk?
I think what's interesting about the consumer, and I've been following consumer and consumer sentiment for the past year, is one thing to note is that the consumer is pretty dour, right? Consumer sentiment has been basically near record lows for the past year. There's a lot of concerns about purchasing, but people keep spending and the balance sheets are strong. We had a delay in cash balance sheets for the households in the US because of the government shutdown, but we just got those numbers about 2 weeks ago. And what we're finding is that the consumer is still quite strong and still has quite a decent amount of buffer to spend. I think, again, it's Groundhog Day a little. Every quarter I hear, this is the year that the consumer is going to stop spending and retail sales are going to turn around. It doesn't happen because they're just sitting on so much liquidity and so much cash, and the stock market run has really helped. Net wealth for household balance sheets, so that's total assets minus total liabilities, is at a record high because of the equity run. So it's not just people who hold, let's say, stocks. Those are people that have pensions, and 401ks that are tied to this. So people feel better. They feel like they have this buffer and they can spend more.
Jillian, thank you so much. Really appreciate it. Jillian Wolf, she's global equity strategist for Bloomberg Intelligence. She's on the 10th floor, but she walked all the way down to the 5th floor to Bloomberg Interactive.
On a Friday, no less.
On a Friday, no less. I mean, if I go up to the 10th floor, I'm not sure I'm going to see too many Jillians up there. We'll have to see about that. Jillian, thanks so much. We appreciate it. We got another data point last night in terms of how the market views this tech CapEx. Amazon, they have to take the cake. $200 billion in CapEx. That's well above what the consensus was. Guess what? The stock is trading down today. So let's get a sense of kind of where this tech spending theme is for this sector. Mandeep Singh, he joins us here. He runs all the tech research for Bloomberg Intelligence. For those, Mandeep, that were looking for another data point to say, how does the market view tech spending? Did we get it last night with Amazon and now the stock trading off today?
Yeah, I mean, this was as big as it can get in terms of, you know, a CapEx number out of the hyperscalers, and probably because they went last in terms of, you know, reporting earnings. But look, I think had they not gone that big, the stock would have been up because they posted best AWS growth in the last 3 years. And, you know, sequentially, things seem to be improving. It's just that $200 billion number and the fact that their margins are going down on the AWS side, that's why you see this kind of stock reaction. And there wasn't enough justification to, you know, ramp up CapEx by about 55% to $200 billion.
Mandeep, how long are we going to see these massive increases in CapEx? I mean, this was for 2026 full year. I mean, are we going to see this for another 2 years, 3 years, or have we, you know, is there an end in sight, I guess is the question.
So based on our work, at least so far, we feel this is the peak CapEx growth. You will still see growth, but it's not going to be of the same magnitude. I mean, 2026, we are talking about a year where CapEx from the hyperscalers will grow almost 60%. So, and last year we had 2024 to 25 was also 70% growth in CapEx. So we have gone from $200 billion of hyperscale CapEx to now $650 billion. I think that growth rate will certainly come down, but there's no doubt that, you know, we are still in that part of the S-curve where, you know, there is more demand and everyone has called out supply constraints and they would have grown faster had it not been for, you know, the limited supply they had for AI infrastructure.
So, Mandeep, you talk to institutional investors all around the world here that focus exclusively on technology. where are they? Has their narrative shifted about where and when and to what degree this industry should invest in AI? Has the fundamental view of AI and how this tech industry is going to get there, has that changed among some of those big tech investors that are big shareholders in so many of these companies?
Yeah, I mean, right now you see both, anxiety and some sort of panic as well in terms of, the level of free cash flow that's going to get hurt because of this spend and how fast it's happening. I mean, the cloud market grew almost, 20% plus for a decade, and everyone was fine. You could see, predictable free cash flows. This is a very big upfront spend. And look, it makes sense that you have to spend first to build the infrastructure. But I think you really have to take a leap of faith that all these companies that are putting, $200 billion will see ROIC for their spend. And I think that's where there are question marks that some of them may not have that level of ROIC. So I think that's what's reflected in the panic so far. But there's no doubt that, workflows are changing and there are some real productivity benefits you're seeing out of this spend.
We talk about these numbers and we throw them around like they're gospel. $650 billion from big tech this year, $200 billion from Amazon. I mean, it's kind of squishy at the end of the day, Mandeep, because this is a lever that companies can toggle. So I wonder how reliable they are. Ryan Horan, who's one of our listeners, wants to know, is the risk to higher CapEx from here, or is it more that hyperscalers can pull back on what they say is their CapEx plan?
No, that's a very good point. And look, a company like Apple so far has resisted the urge to spend on CapEx, and now that they are leaning on Google. So that's where, a Google raising CapEx made a ton of sense this earnings season because, one, they saw the steepest acceleration in cloud. In fact, next year could be 60% growth in their cloud segment. And also Anthropic and Apple are new customers, in terms of who will be using their compute. On the other hand, for an Amazon, you have to ask yourself, is OpenAI the buyer for all of the compute that Microsoft is spending on, Amazon is spending on, Oracle is spending on? Because it's going to come down to a handful of, foundational model players. Meta is on its own. It's spending, but it's not very clear OpenAI needs all this compute.
Mandeep, good stuff as always. Mandeep Singh, he runs the tech research thing at Bloomberg Intelligence. It's quite an offering. We've got him all over the world of tech analysts, and it's a big story here. CapEx, do you like it? Do you not like it? The worms turned a little bit, it seems, for these tech stocks. We'll keep on top of it. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom, with this Bloomberg Business Flash. Well, risk on after a really tough week for equities. The major averages all up over 1%. The Russell 2000 of small stocks, small and mid caps, that's actually the best performer among the indexes. That's up 2.5%. Robinhood Markets, best performing individual stock in the S&P 500, up close to 12% as crypto recovers a little, but don't get too excited. That's still down 47% since October. Amazon remains one of the worst performing individual stocks. Amazon shares down 7.5%, so recovering just a bit. Also, time for earnings analysis. 291 companies in the S&P 500 have reported so far. 80% delivering positive earnings surprises. 66% delivering positive sales surprises. Meantime, Priya Misra at J.P. Morgan Chase firmly focused on next week's jobs data.
We did see some data this week that made the market a little nervous about the job market. I mean, we know there's low hiring. If the firing starts to pick up, then the Fed is cutting a lot more than what is priced in. We're currently only pricing in 2 rate cuts this year.
The S&P 500, 86 points higher, up 1.3%, 68.85 in the index. The Dow up 867 points, and the Nasdaq 100, 282 points higher, and that is up 1.1%. Yield space, the 2-year up 5 basis points. That's at 350. The 10s up about 4. That's at 421. And just bringing this headline to you, it's not really unexpected, but the Gateway Commission.
All right, now this is getting serious, John.
Yeah, suspending construction of the new rail tunnel between New York City and New Jersey. I mean, if you live in Des Moines, you're like, so what? But a $16 billion project. It's been going on for a couple of years in the Trump administration, and especially Russell Bullitt at OMB. They don't want to pay for it, so they've canceled it. And, you know, my friends in construction are like, you can't just stop a project and maybe it gets funding, you know, somewhere down the road
That just
and
makes
start
it
it
more
up
expensive.
again. It just makes it more expensive, and you have to go out and bid for this stuff again. So it's a real nightmare. And it's like the stuff deteriorates that you've already built.
I tell you, these workers were cranking along, making unbelievable progress. It's none of this thing where one guy's working and 6 people are standing around watching. These guys are working like crazy.
And for the Northeast, this is a really important, the Northeast, which, you know, generates how much in terms of revenue for the nation as a whole. But
So if you take the Amtrak from Boston to Washington, D.C., the I-95 corridor, this matters to you.
yeah, and it's
if you don't want the tunnel,
one or two tunnels, and they're over 100 years old. But anyway, I digress.
We digress.
We
don't
check
get me
the
going on
markets and other stuff all day long, right here on Bloomberg Radio. I'm John Tucker. We'll have to find some stocks that are related to this. You know, construction companies or something like that. Right here on Bloomberg Radio, I'm John Tucker. That's your Bloomberg Business Flash, Scarlett and Paul.
All right. Thank you so much, John. Well, maybe some of the construction workers were wearing Under Armour under their, you know, construction wear. How about that
I don't
for
know where you were
That's
going
a tough
with that.
segue there.
Okay, well, you know, I'm trying here. Under Armour, one of the companies that reported earnings, and in line with the gains in the broader market, the stock is up 11% right now. This is a company that is still very much in restructuring mode. Poonam Goyal is our senior U.S. e-commerce and retail analyst here at Bloomberg Intelligence, and she's got more on this. So how low was the bar, or did Under Armour knock it out of the park with this latest report that has its stock soaring 11%?
I'd say the bar was very low for Under Armour. There's been a lot of conversation about, will this turnaround take place? Will it be a sustained turnaround in the past few months, especially with the loss of Steph Curry? So I think the bar was low. They did post respectable numbers. I'd still say that I'm still not completely sold on the story. Their biggest region, the U.S., North America, sales were down 10%. They're expected to be down 8% in their fiscal year. So things aren't still, you know, where we want them to be. And I've heard this narrative so many times where they kind of take out the low-hanging fruit, get the inventories right, get back into the right wholesale doors. We're repeating that. For me, it's a wait-and-watch situation still.
When a brand like this loses a spokesperson like Steph Curry, how material is that of a loss? to the financials?
It's material for basketball, right? If Under Armour is trying to make a stake into basketball and really compete with the Nike and even the Adidas or Pumas of the world, which have renowned basketball players supporting their brand, Nike notably so, the loss of Steph Curry is going to be a headwind. We estimate, and what we've seen just by industry estimates, is it's more than $100 million franchise that Steph Curry had with Under Armour. So that's obviously now not going to be there.
So we've also heard that the Warren Buffett of Canada, Fairfax Financial, has disclosed a roughly 22% stake in Under Armour. This came out about a month ago. How does that change how the company operates, how it moves forward? Do we presume that Fairfax is going to be an activist investor or have some ideas on what Under Armour does?
I'm sure they'll have some ideas. Right now, what we're seeing Under Armour do is follow the Retail 101 playbook on a turnaround, which is let's get out of off price. Let's start selling more full price. Let's pick our wholesale doors and let's get product innovation front and center in front of the consumer. The question is right now that they can do that because they have very easy comparisons from prior years. As they begin to recoup and reset the bar, can they continue to grow and compete with the larger players, notably Nike and Adidas, and can they make a claim for their brand without leading sports personnel?
Amazon also reported last night, stock trading off, people not real psyched about $200 billion of CapEx, I guess, but how did the retail business do?
The retail business did very, very well. I think they're continuing to gain share. We saw an increase in online retail sales, low double digits. That was impressive and shows share gains. I think what's really neat about their retail business right now is all the investments that they're making in AI, especially Rufus. You know, it was interesting to me, and I guess I hadn't known this, is that Rufus can now execute an order for you. And that's pretty cool. If I say, I want, this stereo for $100. So watch the price. When it gets to 100, it just buys it for me. That's a new way to shop, and they're definitely leaping forward into AI and making the bets with Rufus and Alexa Plus, which I thought were pretty interesting.
I guess these would all be kind of value-added services from Amazon. Does that mean that they're going to start raising fees for Amazon Prime, for instance?
They've raised fees periodically. They're not ones to raise fees every year. So every several years, do we see a slight bump in price? We have, and the fees have gone up in the last 10 years, 15 years, quite substantially. But I'd say they're also giving you a lot more, right? With Prime Video, with just other things. They make the Prime membership, if you were ever to unbundle it, it's quite a great value that you're still getting. And they talked a little bit about everyday essentials now just being a bigger focus for them. It's surprising and it's mind-boggling actually that it's a $150 billion GMV business for them. That's pretty significant that 1 out of 3 purchases are everyday essentials. That just means that you're going to Amazon for everything. You're going
That's
there
their
for
white
your
label
everyday
brand,
needs.
right?
Yeah.
The everyday essentials.
I don't know.
It's like their supermarket brand.
I think so. So 30 seconds left here, Poonam. Based upon Amazon, maybe some other retailers you've heard from, how's the consumer doing?
The consumer is doing just fine. We have been waiting to see if the consumer will crack. We haven't seen that yet. The consumer is shopping, but they are being mindful and they're watching where they spend and how they spend it. So this is where brands like Amazon and the large retailers that have the power of scale to keep prices low do well.
All right, Poonam, thank you so much. We appreciate that. As always, Poonam Goyal. She is Senior U.S. E-commerce and Retail Analyst for Bloomberg Intelligence here. Coming up, we're going to check in with Randall Williams, Bloomberg Business of Sports reporter. He's out at the Super Bowl.
He's escaped the cold. He's going to be in California for the weekend and for a couple weeks, I think, afterwards.
Because the NBA All-Star Game is also out there, so he's staying for that.
Yeah, so lucky him.
He's doing all the business of sports stuff out there on the West Coast. So we'll check in with him, see what's happening out there. Right now, the markets are just ripping here. Higher, S&P up 84 points. That's 1.25%. The Dow's up 822 points, 1.7%. And the NASDAQ up 255 points. That's 1.1%. So Bitcoin up 9.4%. That's almost $6,000 higher. We're now sitting right at $69,000 per token. And 10-year Treasury yields, they're up a little bit here, up 3 basis points, 4.21% on your 10-year U.S. government bond. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio in New York City, streaming live on YouTube.com. You know how to do that. And now you can also go to Bloomberg.com/videos, and that's where we find a lot of all the live video stuff coming out of Bloomberg, as well as all the archive stuff and all the podcasts and all that kind of stuff. It's all one spot there for you. Let's get out to San Francisco. Let's get out to the Super Bowl. It's really Santa Clara, folks, let's be honest, but all the fun stuff's happening pregame up in San Francisco. Randall Williams, U.S. Sports business reporter. He's out there. We haven't seen him forever. I'm not sure we're going to see him again. He knows what's going on. He's out there in the West Coast, the warm weather. Hey, Randall, talk to us about just the buzz level for the Super Bowl out in San Francisco. You've been to a bunch. How's this one feel to you?
It's high. It's high. It's definitely more spread out, as you said. Santa Clara, San Jose, Oakland, they're sharing this. It's called the Bay Area Host Committee for a reason. But the hype is high. People are having a good time, and so am I.
There you go.
I'm curious as to the deal-making environment at an event like the Super Bowl. The Super Bowl is not just like the game itself. It's like all the people coming in, all the people like gathering. And I mean, there's a lot going on in this space right now. Big-time professional investors in sports as an asset class. What are you anticipating some of the conversations to be like?
There are plenty of conversations. I've run into business people, bankers, all, athletes, agents, executives, all over. They're running around the city like sort of like it's a safari. And we're all just wild animals, having a good time. And, these meetings take place a lot of times in the evenings. I mean, while the way that it's set up is these venues sort of put one floor that's calm, and the higher you go, the crazier it gets. So there's plenty.
Hey, this is big for the Bay Area, big for San Francisco. One could argue.
Absolutely.
Not many major U.S. cities were hit harder by the pandemic than San Francisco. We're now hearing in the last year or so some positive reporting that San Francisco's coming back. What's your view as they stage this huge event?
Yeah, San Francisco has been incredible. To me, it's walkable. The weather has been amazing. Look, I've had great dinners. I've just had a really good time here. I think there's a lot of narratives out there about San Francisco.
Are we paying for this?
All right, go to the.
I'm coming back.
Here's my recommendation. Go to the Tadich Grill, Tadich. That's where you'll go. Get a cocktail, maybe get a steak. There you go. That's where it's old school Wall Street.
Absolutely.
Yeah, put it on my tab. It's open. Don't worry about it.
So it's not just the Super Bowl this weekend, right? Because you also have the Olympics opening ceremony in Italy today, in fact.
Yeah. And also, go ahead, Randall.
No, I was just going to say it's a huge weekend for NBC and Peacock. I mean, they have both the Super Bowl and the Olympics, and that's going to make for either a very fun time or an incredibly busy time for that production studio.
Talk to us about Santa Clara and this stadium, Levi Stadium. It's recently built. I've seen it. I go out to Santa Clara University all the time. What's that stadium like, and are they fired up and ready to host this big game?
Absolutely. That stadium cost $1.4 billion to build. They put another $200 million into it. I think they finished renovations probably at the beginning of last season. So it's a nice building. I went to a food and beverage tour earlier this week. The food was incredible. They had some prime rib. I had one of the best cinnamon rolls I've had in my life. All of this was for a show that I have called Sports City that launched yesterday. So you can watch on LinkedIn, and it's been a lot of fun. Levi Stadium is great. I'm looking forward to it. I just need to figure out where I'm sitting.
Oh.
Well, I mean, I'm sure you have plum seating.
Plum seating.
Absolutely.
Yeah, I'll make a phone call.
And AI is going to be, AI is obviously a big theme here because this is San Francisco, this is Silicon Valley we're talking about. But with that renovation of the stadium, that Levi Stadium, is this idea that they've really infused high tech into the offerings there.
Yep, they've upgraded the video screens, and outside of the tech, of course, they've added luxury suites and more seating. It's all to bring an elevated experience for customers who want to pay a premium price to sit in these boxes. And I think the technology is 100% part of it. They tout, their 4K screens, and they look pretty the other day.
Okay, and also there's a game happening on Sunday. Do we think this is going to be a high-scoring game? Or I mean, these are both like defensive giants, right?
They are defensive giants. I don't think it's going to be a high-scoring game. My prediction is 27-17 Seattle. I think the Patriots are a great team. They're also a little young. Their offensive line has been bleak, and Drake May has not played well in the playoffs, and the Seahawks defense has smothered everyone except for the Rams. And when it came time for crunch time, they smothered the Rams too. So I have the Seahawks, and this will probably be Jody Allen's swan song.
Whose swan song? Oh yeah,
Jody
yeah.
Allen. She is the sister of the late Microsoft co-founder Paul Allen.
That's right.
Who died years ago.
No. To follow on that, we could see a sale of the Seahawks after this game. Then, if they win or if they lose.
I think industry insiders predict a sale, regardless of what happens of the result. And when that could happen, now, if you ask the Seahawks themselves, they will tell you that this team is not for sale, as we've reported, as ESPN has reported, and so many other people. But if you ask people around the league, they will tell you that, look, the Seahawks will be for sale later this year. And so, I don't think there's going to be a battle over, if it's going to be for sale or if it's not. But I do think that Paul Allen had in his will that this team would one day be for sale. The Trailblazers sold last year.
Yep.
And so the signs are pointing towards the Seahawks sale sometime soon.
All right, Randall, have some fun out there. There's a football game. Have fun at the game, too. Randall Williams, U.S. sports business reporter for Bloomberg News. He's out there in San Francisco.
Eating his way through the city.
Yes, eating his way through the city.
Apparently.
It's a great city to do that in, too. I love San Francisco. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Concern about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI play?
Are people just looking for something to worry about when it comes to China?
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Friday morning from the Bloomberg Intelligence team here at the Bloomberg Interactive Broker Studio from Midtown Manhattan. Paul Sweeney and Scarlett Fu with you in this second hour of Bloomberg Intelligence. A lot to get through with markets rebounding. Equities have not erased their losses for the week, at least for the S&P 500 and the NASDAQ, but the Dow is higher for the last 5 days. We are seeing gains across the board. We'll get into that in a little bit, but there's plenty of earnings which is demanding our attention. We're going to check in with Ken Shea, our senior consumer products analyst, to talk about Philip Morris results. Philip Morris, of course, a consumer staple company. That kind of company has done a little bit better in this week's declines. Ken Belson is the author of Every Day is a Sunday, and of course there's a big football game on Sunday, so we'll get his take on the business of sports and the business of the NFL. And it is Munis in Focus Day. We're going to check in with Shruti Singh, our Muni finance reporter, to discuss the latest moves there. And Adam Minter, he's a Bloomberg opinion columnist, talking to us about the Olympics, which also will have their opening ceremony just this afternoon. Olympic crisis is coming for Team USA. So looking forward to that conversation. And my co-host on ETF IQ, Eric Balchunas, our senior ETF analyst here at Bloomberg Intelligence, will wrap things up with his outlook for ETFs. First, though, John Tucker has our markets and Bloomberg Business Flash.
You said the Dow was higher. It's not only higher, Scarlett. It's at a record.
What, really? Wow.
Yes, Dow Jones Industrial Average, 844 points higher, up 1.7%, 49,756. You know where I was when Dow crossed 10,000?
Wearing a hat?
Right here. So, yeah, had a good ride. Are we bouncing off the bottom? I don't know. But after a tough week for equities, definitely risk on today. You have makers of the stuff, the gear used in artificial intelligence computing, rallying after that big spend by Amazon, $200 billion for 2026, far exceeding the average analyst estimate. Those are the spendees like NVIDIA, right now up over 6%. Now, the spender, Amazon, lower, but off the worst level of the session, down over 7.5%. Consumer staples also increasingly becoming one of the prime beneficiaries of investors who try to seek AI-proof stocks. The consumer staples, by far the best performing sector. That's up over 5%. Meantime, Brian Levitt at Invesco says the latest market gyrations, well, they're healthy.
What you're now seeing is a market that's become more discerning regards to who's going to be the software winners within it, but increasingly optimistic about the ongoing build.
And right now, the S&P 500, 89 points higher. That's up 1.3%, 68.87 there. The NASDAQ 100, 302 points higher, up 1.2%. And again, the Dow up 894 points, 49,804. I guess I'll do a Bob update. Bob's Discount Furniture finished the day a little changed. Trading debut on the New York Stock Exchange. They had a market value of $2.2 billion based on the outstanding shares. They intend to use the IPO proceeds to repay a $350 million loan. So,
well, they are owned by private equity, or were owned by private equity. So,
yeah, so
there's some debt there.
Stock up 5% today. So it was kind of steady yesterday on the opening. Rate stayed right at the bid, but then it's trading up 5% today. That's good.
And I'll do Jennifer Garner's snack company. There's an IPO there too.
What's it called?
Once Upon a Farm. How about that? Stock symbol OFRM. I've been following it this morning. What can I tell you?
We'll go to IPO Corner.
Yes.
We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Scarlett and Paul.
Well, let's just finish this up. Once Upon a Farm priced last night at 18. Not open yet for trading. Indications 21.22. So there you go. That could be a good first day trading. It helps when the Dow's up 1.8%.
I'm just looking at the management, and Jennifer Garner is the chief brand officer and co-founder, and not the CEO.
They
John
make
Forker is the CEO.
Kid-friendly pouches of fruit and veggie pure. Oh my God, this sounds disgusting. Puree.
No, pureed is good.
Really? As well as bars, frozen
you don't need
meals,
teeth for pureed food.
and smoothie packets.
You know what my lunch was for 8 years, first through 8th grade? Bologna and cheese sandwich, chips, and like a little thing of milk. That was it.
Yeah.
Look how well I turned out.
The cafeteria at St. Mary's. Yeah, that was not gourmet.
This was Blessed Sacrament, Trenton, New Jersey. That's how we rolled back in the day.
Anyway.
All right, Nora, save us here. Nora Melinda is
Nora left.
I'll see what I can do.
Yeah, she's been listening quietly to all this, wondering how this is going to segue to what she covers. You've got our stock movers. What are we looking at?
Well, let's look at Amazon. This is ticker AMZN. We've been watching this stock very closely. One, because name, but two, because the stock is plunging for its worst day since August of 2024. This is after the company announced plans to spend as much as $200 billion this year on data centers, chips, and other equipment. We've really been seeing a lot of these tech companies being punished for this, but it seems like it's a bit mixed. It depends on the name that you're talking about. I know that we did see Alphabet giving some pressure for this. Clearly, Amazon also seeing the same. We are seeing shares of the stock down about 11% so far this year.
All right. What else you got for us here for the stocks? How about Stellantis?
Yes.
Oh, my goodness.
Let's talk about some automakers. Ticker STLA. Brutal day. We're seeing shares down about 22% right now as we speak. Earlier, plunging as much as 26%. This stock is hitting and falling for its worst day ever, lowest level since 2020. This is after the company said that it's taking more than $26 billion, that's USD, in charges, mainly linked to reverse in the course of its EV strategy. I mean, we've really been seeing a lot of people putting this bet on EVs, and we haven't really been seeing it paying off for some of these companies. Stellantis has obviously been one of those that's been struggling with this. The stock is down 32%. Just this year alone. So really seeing struggling. But I mean, when you look at the numbers too, it is important to note that the stock is just around $7. So you do see these big moves when we think about a percentage basis, but also important to note the value of the actual stock as well.
All right, you're also including an ETF in your stocks to watch. And this is one that I've heard this ticker all week long.
Right. I mean, it's Friday, so I feel like we kind of have to do a little bit of a recap on the week. I've been looking at this ETF that you mentioned. IGV is the ticker there. Software stocks, I mean, there's been so much in play this week. We are seeing a rebound today for this ticker, earlier rising as much as 3.2% for its best day since September, but it's still struggling. I mean, the stock or the ETF is on pace to end the week for its worst week since 2008, losing as much as 12% in value. So, I mean, we have our colleague, Bill Maloney. Of course, he is a chartered market technician and a strategist here who writes for Bloomberg. And he was just talking about the fact that it seems to have notched a short-term bottom after falling just 5%. That was yesterday. But it's interesting because we do see that it did have 2 straight days of record volume with over 40 million shares changing hands in each session.
All right, very cool. Norma Linda, we appreciate that. Norma Linda, markets correspondent for Bloomberg Television. I didn't know Bill was a market technician.
I know. I
cool
saw
stuff.
it at the bottom.
Now it makes sense.
I'm learning a lot.
Now it makes sense. Okay. All right, for more conversations like this, subscribe to our Stock Movers reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. Philip Morris. They had some pretty good numbers, and the stock's done well. Double-digit return this year, plus they got a 3% dividend yield.
It's a consumer staple, and consumer staple is in right now.
Ken Shea joins us, Senior Consumer Products Analyst at Bloomberg Intelligence. Tell us about Philip Morris's and their quarter, and what's their business outlook, Ken?
Yeah, hi, Paul. Yeah, Philip Morris had some good numbers today. Its fourth quarter pretty much came in line. Sales up about 7%, EPS about 10%. Those are pretty good numbers for a consumer staple company. They hit their numbers. Stock is performing well, probably as a result of that. But there's 2 other big takeaways, I think, beyond that today that's maybe helping investor enthusiasm here. The second is the financial guidance they provided for the next 3 years, or I should say through 2028, is also pretty positive. They see mid to high single-digit revenues, around 10% operating income, low double-digit EPS growth. Those are pretty good numbers for big consumer product companies, particularly companies that deliver like this one. And even though those numbers are pretty much in line where the street was already at, nevertheless, I think that should be viewed pretty positively. And the third is the company said today, repeating what they said in December, they're going to start providing more financial transparency behind what they call their smoke-free business from their traditional cigarette combustible business. And I think that's going to help. More transparency is always welcome, by investors in the market. And so I think all 3 things are really what's behind today's action.
So talk a little bit about that smoke-free product line. Where is the growth the fastest, and how much spending, how much investment is needed for us to see that return that investors want?
Yeah, hi, Scarlett. Well, Philip Morris really took a big step before its peers when jumping into the smoke-free opportunity years ago with what it's calling IQOS, IQOS. That's its flagship family brand, I guess you can call it. It's pretty much sold around the world, pretty much in most of the markets that it sells cigarettes. And it's already comprised more than half its sales in some pretty big markets, Japan, South Korea, and some others. So it's really caught on well. And basically what it is, it's a device that you use to get the facsimile of a cigarette smoking experience, but you use little plugs you put in it. So the business is really selling the plugs once the device is in the hands of the consumer. That's doing really well. That's the biggest piece of that business. The second is it's what it calls its nicotine pouch business. In the U.S., people probably know it by Zyn. It's a round plastic can people put in their pockets, and they can very discreetly get their nicotine hit that way. It's been really popular, doing really well. And the third, kind of more of a distant business for them, but one they want to be in, is their e-cigarette business. They call it the closed pod system, sort of like the Juul. Their brand is called Vive. It's kind of a low-end, low price point way for consumers to get into get their nicotine fix. But it wants to be in that business because it wants that brand to be out there as an alternative to smoking.
So just real quick there, is that where the growth is for this company going forward in the broadly defined smokeless part of the business?
That's right, Paul. It's already around 42% of their sales.
Yeah.
Believe it or not a lot of people in the U.S. know about it because IQOS really isn't sold in the U.S. yet. They're waiting for FDA authorization to roll out its Illuma ecosystem. Then people will really know more about it in the U.S. But it's, over 40% of their business. It's over $16 billion in sales. So that's why they're bringing transparency to that business. It's a big business. I think what they're implying, down the road is that maybe they can separate the businesses, that is the combustible business, from its smoke-free, because they have different investment characteristics.
All right, good stuff. When people referring on social media to Zyn, for the longest time, I thought they were talking about Zinfandel. I didn't know I was talking about the Zyn pouches.
The white
there
wine.
you go, learn something. So we appreciate it. Ken Shea covers all the consumer products companies for Bloomberg Intelligence. Want to get back to the Super Bowl. It is Sunday, a big game. Huge media event. It's just become an event. 2 weeks to gear up for it. It's become just a monster event. And here we are, Super Bowl 60. Ken
It's like
Belson
a national
joins-
holiday, by the way.
It is. Well, go to that. Next year, when they go to 18 games, it's going to be on President's Day weekend. That Sunday.
Which
So
makes a
then
lot
we
more sense
Yep.
because most people don't show up to work the following Monday anyway.
Right. Ken Belson joins us, New York Times business and NFL reporter and author of Every Day is a Sunday. Joins us from San Francisco via that Zoom thing. Hey, Ken, I tell you, there's so many storylines here for this game. One of them to me is the Patriots are back. After that huge run they had with Belichick and Brady, now they're back again. I mean, Robert Kraft, that's a pretty good success story right there. What do you think?
Yeah, most owners don't get second chances like that. The Steelers might be one example where you go a decade or two and then they come back. But in NFL terms, their rebuild, if you will, in New England has been incredibly rapid. They're pretty disciplined, I think, in the sense that they obviously picked a good quarterback, but they have a lot of no-name players who play very well. So I think they surprised a lot of people, but I think they deserve to be here.
As an owner, what is Robert Kraft doing that enables the team, the franchise, to be able to be so successful on the field?
Well, this goes all the way back to when he bought the team in 1994. He and his son, Jonathan, have always had a very analytical approach. And they came in 1994 when the salary cap first started. And that's all about assigning value to a player in a very sort of methodical way. You only have so much money to spend. And so they were actually kind of ahead of the curve in terms of having or trying to understand how much cap space they'd have, how much salary, how far they can get it to go, how to stretch it and so forth. So they're very disciplined investors, if you want to call it that. And that was, a lot of other teams, it was mostly based on a hunch, relationship between a coach and a player, GM, so forth. So they were kind of ahead of the curve, and I think that's paid dividends over the years.
Ken, what do you make of the Seahawks this year? They have played so well. I think they're about a 4-point favorite here. What's the buzz out in San Francisco about these Seahawks?
Yeah, it's very much, this may be by the fact that we're on the West Coast, but it feels much more like a Seahawks dominant game. There's many more fans here. You can tell with their jerseys. And, they don't get to the Super Bowl every year. They haven't been there since 11 years ago when the Patriots beat them in Arizona. So there's a lot of buzz. They have a very good defense, the best in the league this year, and a quarterback who seems to have found a second or a third life in Sam Darnold. So they have a lot of great pieces, but, when everybody's betting on one team, it's usually a good bet to take the other team as well.
Yeah, and I'm sure a lot of sore 49ers fans, given how the 49ers did versus the Seahawks this season in the playoffs. Ken, I want to ask you about international, because this has been a huge topic for fans, for the teams, for the owners. The Cowboys will play in Mexico City. San Francisco and LA will play in Melbourne. The Saints will play in Paris. How much further does this go? Are we going to start to see more than just one token game per team overseas?
Well, their goal is to get to that 18th game you mentioned earlier. They're not there yet. They need the union to reopen talks on the contract to allow for an 18th game. But if they get there, they want to go to 16 overseas games a year. They'll be at 9 next year. So they're not quite there yet. They basically want every team to take at least one international trip a year. Melbourne is a long way to go. It's 14 hours from the West Coast here. So in terms of a regular rotation of games, it's, an East Coast team's going to have to fly 5 hours to the West Coast to get to the 14 hours. So there's only so many windows they can get that into. Having said that, they've returned to Mexico City. It's a very good market. There's a lot of American-style football in Mexico, and that stadium had to be refreshed partly for the World Cup. And so the Cowboys, perfect team to go down there. They have a huge following in Mexico. So the NFL is sort of placing teams not just to break ground in new markets, but to really bring the most popular teams. And of course, the Saints in Paris, given their heritage in New Orleans, makes perfect sense as well.
Yep, the NFL knows what they're doing yet again. Ken Belson, thanks so much for joining us. Ken Belson, he's a New York Times business and NFL reporter. He's also the author of the book Every Day is a Sunday. He's out there in San Francisco with the Super Bowl. Markets continue to hold to their gains. The Dow's up 90 points. That's 1.4%. The Dow's up 875 points, 1.8%. And NASDAQ up 310 points, 1.4%. This is Bloomberg Morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. We're brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver information guide and learn how to add metals to your IRA or 401k tax and penalty free, Go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide. Let's start with NVIDIA. This is a stock that benefits when everybody starts spending on artificial intelligence. It is up close to 7%, also among the most active. They have a huge share of the market for AI chips, something like 85 to 90%. NVIDIA is also in the Dow Jones Industrial Average, and it's a leader in the Dow, and the Dow at an intraday record. Right now, up 889 points, a rise of 1.8%, 49,795 on the Dow. And when everybody wants to run and hide from all the volatility this week in tech, they run to consumer staples. Philip Morris is one of those consumer staple stocks. That's up 2%, reported higher profit in the fourth quarter. S&P 500 right now, 96 points higher. That's up 1.4%. It's at 6894 on the index. The NASDAQ 100 up 374 points, and that is a rise of 1.5%. Let me do the yield space because they're higher. The yields 2-year, which is more policy reactive, that's up 0.6%. Right now at 350. The 10s are up just about 4 basis points. That's at 421. And down to Bitcoin, still under 70,000 a token, but it is up 10% today. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash.
Now on Bloomberg Intelligence, Munis in Focus.
All right, today's Focus on Munis is brought to you by BAM Mutual. Put America's strength to work in your portfolio with BAM Insured Municipal Bonds. Protect your investments with an added layer of security and guaranteed income. Invest with strength. Build a stronger tomorrow with BAM Mutual. Big news out there today for us in the metro New York area. New York, New Jersey River Tunnel project, the Gateway project, suspended after President Trump blocked funding here. What does that mean for the municipal bond market? I don't know, but I mean, let's just go do a muni bond. Take some cash and get this thing going again. I don't know. Shruti Singh joins us here, municipal finance reporter for Bloomberg News. She's based in Chicago. Shruti, is the municipal bond market financing any of this Gateway Rail project in the greater New York, New Jersey area?
I think the bigger concern right now is in terms of the federal flow of funds.
Yep.
The difficulty with that is what has halted the project today. A lot of infrastructure projects are funded in various ways, and federal funding for transit projects is actually a very key component. And I'm based here in Chicago. We certainly have questions about federal funding going forward for projects here, but this is today in the New York area is sort of the biggest evidence of some of these challenges.
Yeah, they just basically halted work after 2 years. And just getting it started again is going to be massive.
In about an hour's time, my train's going to go right by this thing as I go back to shore. So I would report in if they're there, but I'm guessing they're not there now.
No, there's no funding.
Okay.
So that's part of it. All right, so Shruti, we're going to go ahead.
Yeah, I was going to say that that's exactly what's on the minds of a lot of people, I think, whether it's in New York or in other parts of the country, is that, how are these types of delays or challenges going to impact commutes for everyday people, right? And so that's what it really gets down to, is that what happens next, this isn't going to be something that's going to impact your daily commute today, but this is part of the longer term sort of effort to fix congestion and figure out how public transportation plays a role in all of our daily commutes.
Absolutely. And we should mention that New York and New Jersey are seeking a temporary restraining order that would force the administration to continue funding the project. There is a hearing set for federal court in Manhattan on Friday afternoon.
Okay, very good.
We'll watch to see if that results in anything. Meantime, Shruti, you have also written about how in your backyard, the Chicago Bears are now the focus of a new push in Indiana's House of Representatives. They're looking at trying to lure Chicago over to the neighboring state.
Yeah, so I've been following the winding road of where the next Bears stadium is going to be for a few years now. Initially, a few years ago, there was questions about whether the stadium was going to be built in suburban Arlington Heights. The Bears actually own a property that's about 326 acres just in the northwest suburb. And initially there was a lot of expectations that that land was going to be transformed into a stadium. Then there was a proposal to build a stadium along the lakefront, not far from where the current Soldier Field is. Then it went back to Arlington Heights. but there has been some challenge in terms of the talks between state officials and the Bears. And then Indiana has come along and now is proposing legislation that the Senate in the state has already approved to create a stadium financing facility. Illinois actually already has something like that. This legislation in Indiana now, like I said, passed the Senate and now is in the House, and it's going to be taken up. There's hearings expected, and potentially there could be a vote by the end of this month.
So, all right, here in the New York area, both our football teams, the New York Jets and the New York Giants.
Don't play New York.
They play in New Jersey. Their practice facilities are in New Jersey. Their offices are in New Jersey. And I think if you ask anybody involved with either team, they would say, not good. But that's the way it is. So, rethink that Indiana thing, perhaps. Illinois Governor J.B. Pritzker is reviving a proposal to fully fund the state's pension system by 2048. How does the math work there?
Well, one of the things that's happened in Illinois over the course of many decades was that pensions were underfunded. And about 5 to 10 years ago, the state of Illinois, along with large cities such as Chicago, started to ramp up their contributions to increase the funding levels for their severely underfunded pensions. The reason it matters is that it is a very large portion of the municipal budgets. In Illinois, for example, $1 in $5 maybe goes towards pensions in terms of the overall budget. So it's a big chunk. Now, this is something that the governor has been looking at since the beginning of his first term. He's currently looking to for voters to return him back to the office for a third term. Now, what he is proposing is that leveling up that mandate from reaching 90% funding in 2045 to fully funded in 2048. To put that in context, these pensions are currently funded at below 50%.
All right.
Good luck.
Yeah, exactly. Good luck with that. Shruti, thank you so much. Shruti Singh is our municipal finance reporter joining us from Chicago with the latest from the muni market. Paul? All
right, very good. We got the Olympics cranking up here, opening ceremonies today. I was watching some of the stuff last night. I'm all fired up for the luge and the skeleton. But there's some issues going on there. So the ceremonies are today, but a quiet crisis is looming due to dozens of Olympic sports being cut from college athletic departments. So what does that mean for the future of some of these sports here in the U.S.? So let's go to our Adam Mintner. He is the opinion columnist for Bloomberg News. He's joining us via a Zoom from Minneapolis. Adam, which sports are folks most worried about here?
It's a range of them that are connected to the NCAA. So swimming and diving, wrestling, lesser, lower profile sports like men's gymnastics, men's volleyball, all sports that have had big time NCAA support over the years. We're seeing schools cut funding for these sports, which previously had been critical to actually supporting them as U.S. Olympic teams.
Paul, I got to tell you a story. My neighbor, the kid won a scholarship to a school down south for swimming.
Yep.
All set to go. It gets a word from the coach. The swimming program's been cut. It's just like, what do you do at that point?
That happened. So, Adam, is this tied to the name, image, and likeness kind of situation where all the money that kind of goes to football and basketball?
Yes, that's exactly it. And since 2021, NCAA athletes have had the ability to earn money. And as of this past season, schools have been paying athletes directly, revenue sharing, to find that money because they can pay up to $20 million a year. Just last season, they're taking money from programs that we consider niche sports that don't make a lot of money. Again, men's swimming and diving, women's swimming and diving. These sports and cutting them. And so you're seeing exactly what was just said. You're seeing athletes cut, entire programs cut, and that cuts off the pipeline, one of the traditional important pipelines for Olympic athletes, both at the Summer and Winter Games.
In your column, you talked to us about curling. They don't have any institutional backing. We have some success in curling.
They do not have institutional backing, and they've done spectacularly. In fact, they're doing really well at this Olympics. Though the opening ceremonies haven't started yet, the men's and women's mixed double team is undefeated, and they look to be pretty close to breaking into the medal round. The way they've done that is they have a system of independent clubs They have a system of independent championships, starting with an under-18 championship, and they have built up their own infrastructure to create elite athletes beside grassroots athletes, and they kind of feed into each other. It's a low-cost method of bringing elite athletes up to Olympic level, and it wouldn't work for every sport. It wouldn't work for luge. I mean, there's fewer than 20 luge tracks, bobsled tracks in the world, but you can build clubs for sports in other places. It could be wrestling, it could be track and field clubs, it could be swimming and diving clubs, and curling has proved it works.
Well, I'm wearing my Duke pullover today, so the model that I'm familiar with in some of these bigger schools is football, and in the case of Duke, basketball, they fund everything else, and that's kind of always the way it's been. Why does that model not work?
Well, it's as we were saying earlier, it was a great model for the years that it worked. It funded everything, as you said.
Yep.
But again, schools now are allowed to pay their athletes revenue sharing up to about $20 million. Next year, it'll be a little bit more. And that's a lot of money. And it's for schools that want to be competitive in football and basketball, that's not voluntary. If you want to be competitive, you need to be offering that money to your football and basketball players. But where that money comes from is the real issue. And it's coming from, swimming and diving programs. It's coming from track and field programs. It's coming from other programs that are not revenue generators, that are negative revenue, as the athletic departments call them. And so for these schools that look at football and basketball as sort of the front porch of their universities, it's a no-brainer. They're going to ensure that that money flows into the big programs that aren't really medal contending U.S. Olympic programs, and it really hurts the development prospects for athletes in lesser sports like swimming.
Is there any solution here being talked about?
There really isn't. I mean, there's been talk of action at the congressional level, giving the NCAA antitrust protections so that they could actually mandate salary caps and then allow for more money to flow into these niche sports. But that's going nowhere in Congress. There's lawsuits. That's a crapshoot. And so, that's kind of why I took a look at curling as a model. Is these clubs have been really successful, and they work as well in track and field and wrestling. Not, there's still robust NCAA programs, but it's an option, and I think it's worth looking at.
Very good, Adam. Really fascinating stuff here tied to the Olympics here. Adam Minter, he is opinion columnist for Bloomberg News. I know at my undergrad, University of Richmond, they made the decision to cut men's soccer so that they could fund men's lacrosse, and it's been a huge success because lacrosse is so popular in many parts of the country, and there's a lot of money behind lacrosse, and a lot of families will do anything to have their kids play lacrosse, and its passion is unbelievable.
And the YMCA has taken up a lot of the slack at swimming. I know that.
Yes, yep, absolutely. So we'll see how that plays out. A lot of changes in collegiate athletics. This is Bloomberg. Good morning.
listening to Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Brokers studio. All right, let's go right to a Bloomberg Business Flash. John Tucker's going to lead the way here.
All right, we are higher, Paul. Renewed wave of dip buying, spurring a rally in tech stocks. Volatile week for stocks, ending with risk on. So much risk on that the Dow Jones Industrial Average is up 948 points, up close to 2%, 49,860 points right now. And Paul, that is an intraday record.
Yeah.
Helping
50,000 watch, by the way.
Well, you know, not too far away. Helping push it higher. Shares of NVIDIA among the most active. That up close to 7% right now. And Amazon shares suffering after announcing that record spend on AI stuff. Meantime, Veronica Clark of Citigroup Global Markets focused on next week's delayed jobs report.
We are expecting seemingly stronger job growth in January. We're at 135,000. Obviously, would have gotten that this morning. Another jobs Friday that wasn't. But I would take that number with a lot of caution. There has been a very clear pattern of residual seasonality around December, January, start of the new year.
And right now, the S&P 500 up 103 points. That's a rise of 1.5%. At 69.01. The tech-heavy NASDAQ 100 up 407 points. That's a rise of 1.7%. Again, the Dow intraday record here, 939 points higher, up 1.9%, 49,849. You know, the ice, snow, bitter cold stressing all of America's grid in recent weeks. But you know what's taking the place when the power goes out for a lot of people?
What's that?
Your car. Electric vehicles have started to fill the void as emergency power sources. This is according to Cox Automotive. Drivers have purchased about 630,000 EVs that discharge electricity at levels strong enough to power a home or an apartment. So you can plug your house into your car, I guess. Anyway, we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flashball.
All right, John, Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube and also streaming on Bloomberg.com/videos here. Bitcoin ETFs finally faced their first real stress test, and investors headed for the exits. Since October 10th crash, U.S. spot funds have shed nearly $7.2 billion, with another $1 billion pulled in January. Wow, as Bitcoin slid below 80,000. Eric Balchunas joins us here, senior ETF analyst for Bloomberg Intelligence. Eric, does that surprise you that gold ETFs were just like everybody else and were selling? I mean, Bitcoin ETFs?
Yeah, I mean, that was James's note. There was a touch of sensationalism in that note. I told him about it. You know, we're trying to get reads, Paul. So
yeah, I know.
Anyway,
I know the game.
So you know the deal. So if you look at the assets, it is a lot. $7 billion is no joke. However, that's only about 6-7% of all the assets. So you could argue that over 90% of people stayed in.
Okay.
Judging other sell-offs that are similar, like one time gold, GLD, went down 40% in 6 months. It lost 33% of its assets. So there's been some, you know, cases where more people leave. Then there's also been cases like ARK where more people actually stay than we thought. So generally speaking, though, it doesn't really surprise me. I think many ETF investors, this is a tiny allocation. This is a little hot sauce on an otherwise very boring Vanguardian type portfolio. For crypto people, it's more brutal because it's their whole deal, you know, it's like their whole life. For the average ETF investor, this is a speculative dash on top of a meal. They probably expected it to go up and down. However, it doesn't take the pain away. You know, you'd rather it go up. So we'll see what happens. But I would say, you know, 7-8% of the assets leaving is pretty good, comparatively speaking. We'll see where, you know, a little more, we could see a little more come out.
And we see Bitcoin, as John's been reporting, up 10.5% today, $6,600 on the upside. Now sitting just below 70,000. Yesterday or earlier this morning, we were at 60,000. So just a huge, huge move there. And so, Erica, is the expectation that most ETF funds, I mean, how sticky in general are ETFs in any particular security? Is it any different than a mutual fund, would you say?
Very different. And I'll tell you why. ETFs, you had to find an ETF. Yep. ETFs do not pay anybody to sell them. So basically, in the mutual fund world over 50 years, brokers were given loads, right? They were given money to put investors in the fund. And a lot of those funds had a lot of costs, they underperformed, and so people kind of had a bad taste in their mouth. ETFs come out, they're all priced at the institutional class level, so they're very cheap, and you have to go find them, right? So typically, if you find ETFs, you're like a with-it investor, and they generally are stronger hands, even in the stock market sell-offs. Like, how about the last 12 months, like with the tariffs, equity ETFs continue to take in money. So they're very hard to perturb these investors. I've always thought they're probably the strongest hands or the wisest investors out there. We could debate that, but the flows show they're pretty sturdy. There are things they will leave though, like thematic ETFs come and go. So it's not everything across the board, but generally speaking, if they commit to something, they're pretty reliable.
If I'm an RIA, what is my incentive to put my clients into ETFs?
Yeah, this is a great point, and this is the reason ETFs are so popular. Advisors used to get paid, they used to get that money from the mutual fund, a commission. Now they scrap that model and they get a percentage of the client assets. So if you get 1% of your client's assets, all of a sudden the fees come out of your money too. So you're on the hunt for the cheapest stuff all of a sudden. So it does put the advisor more shoulder to shoulder with the client, and that's called the fee-based model or fiduciary model. And that is almost perfectly correlated with the rise of ETF assets. And this is, we've tested this across the world because it doesn't happen as much in other countries. But once you get those fee-based advisors, ETF assets will follow.
Hey, Eric, John Tucker here. I just wanted to ask you a quick question about the comparison between Bitcoin and gold ETFs, because a lot of Bitcoin investors said it was the, what did they say? It was the gold,
digital gold or something?
The electronic
digital
gold Bitcoin. What's been the performance difference between a gold ETF and a Bitcoin ETF?
Yeah, well, in the last year, it's no contest. However, let's look at 2023 and 2024. Bitcoin was up 450% in a 24-month period. Gold was up like 20% or something. So, you know, it depends on when you look. Go over 5 years, they're about even. So it's, you know, I always thought gold and Bitcoin are a little like the Michigan-Ohio State rivalry. You know, they hate each other. It's like real angry emotions between the two. And whenever one wins, the other spikes the football. Right now, gold is having a nice run in that sort of rivalry. But I think they're both useful. I always thought Bitcoin is like teenager gold. It's gold is 5,000 years old, right? It's quoted in the Bible, right? Bitcoin is 17 years old. It's literally a teenager. And if you know 17-year-olds, they're very volatile. So that's how I see the two of them. So I would look for anybody who's looking for a debasement trade. They both can work, in my opinion, but one is going to have a lot more volatility, both in the downside and the upside. And I think that's the choice investors have to sort of like weigh.
There's no reason to believe this volatility that we've seen, you know, in the recent months in Bitcoin will impact flows into like the IBITs of the world.
Yeah, it will. I mean, the more something's down, the less fish it attracts, right? If it goes up, it just, I don't know, price informs narrative. And so right now, I just think you want to hope to have like no flows. If it starts going up, you'll probably see some inflows come back. But, you know, as I was telling somebody, you know, the Qs launched in 1999. And Paul, I think you're old enough. I'm old enough to remember. You know, I think you're still in your 20s. So,
sure.
But I'm old enough to remember how bad the dot-com bubble was. So the Qs took in like a bunch of money, was up 100% in its first year, and then boom, that hit, and it went down 50% in a year.
Yep.
Then it didn't return anything in the 2000s. Look forward today, it's like the fourth biggest ETF. It's been up a ton. So I think it's a long road for these things, and I think IBIT with its liquidity, BlackRock, it's going to be here, and it's going to be available for people when Bitcoin's having a good time. It'll take inflows. When it's going down, it'll probably see some outflows. That's been the tradition with ETFs. And I think this will be no different.
I learn something every day, every time I talk to you, Eric. Thank you so much for giving us a couple of minutes of your time. Eric Balchunas, Senior ETF Analyst, Bloomberg Intelligence. Folks, if you want to learn about ETFs or just get smarter about ETFs, and I'm in that camp because this is a new asset class, read Eric's stuff. It is unbelievable. He and his team, they just kind of lay it out for you so you can really understand it and what the puts and takes are for that. Atlanta Fed President Raphael Bostic says it's important to keep interest rates at a level that returns inflation to 2%. Bostic, who is set to step down from his role at the end of the month, adds that he is, quote, cautiously optimistic, end quote, about the economic outlook this year. He spoke earlier to Bloomberg TV's Mike McKee in an exclusive interview on Friday about the economic mood in his district. Here's some of those comments.
For today, I think most businesses and most households are not thinking that the worst of the possible outcomes are going to happen. They're not sure they can get to the best ones, but everyone's trying to find a steady state where they can get through. So I think the sentiment is one of cautious optimism, but I'd put emphasis on the cautious as opposed to the optimism. I think people are really trying to wait and see what happens.
Well, what do you think that means for the economy?
Well, I think it means that the things that we've seen for the second half of 2025, we will continue to see through 2026. And I've talked to a lot of folks over the last 6 weeks or so, and they said, we think our experiences in October, November, December are likely to move on. And then there are some reasons why they think it might actually get stronger. The tariffs, people have gotten used to those. And so those effects will have run through by the middle of the year. We see some of the stimulative aspects of the tax bill last summer. Those will be coming on board. And if consumers start to feel like there's more certainty, then I think businesses think there's some upside potential in the economy.
Well, this last week, we've gotten a lot of bad news on the employment front with ADP and Challenger and the other numbers that have come out. Does any of that, you don't have another meeting to vote at, but does any of that give you pause about the Fed pausing at this point? For me, no. I think we've been in a situation where inflation has been too high for too long. And by many readings, it's been kind of marking time. It's been at a plateau well above our target for the better part of 2 years. That's not acceptable. And for me, I think we can't lose sight of the inflationary concerns. The labor right now, and some of it because natural things that are happening in the economy. When I talk to businesses, they're reluctant to hire entry-level people at the same ways that they did before because they think things like AI can replace that and they can deploy resources for other things. And I'm hearing that kind of reticence. There's also the reality that during the pandemic, a lot of companies ramped up because the demand ramped up, and they've been slower to right-size. We see a bunch of that right-sizing happening as well. And then we have issues around the labor supply and whether the immigration shifts are going to be temporary or permanent. And if they're permanent, then we're going to have a lower steady state job creation. So for all those reasons, I think it's very hard to make a clear statement. And then, of course, we don't have a jobs number today, right? So we're not getting the data in a timely basis. My team tells me it'll be April or May before we start to be able to draw clear signals from the data to really understand what's going on.
All right, that was Atlanta Fed President Raphael Bostic speaking with Bloomberg's Michael McKee on how his part of the world is down there in the Atlanta Fed area. Well, it is here February time, and on Wall Street, that is bonus time, folks. And
you want somebody's attention on Wall Street? Say, bonus.
Bonus, exactly. To be honest with you, having worked on the street for 30 years, the bonus discussions around the water cooler start right after Labor Day. And you start talking about what the bonus pool is, and then you start cornering your manager from September right up until year end, because that's when the bonus pool kind of gets decided. And you say, you put, hey, good deals, good trade, all that kind of stuff. And so it starts working right after Labor Day. That's how the season works. This year is going to be a good year. Goldman, JP Morgan bankers see bonus pools rise at least 10%. That's pretty good. Catherine Doherty joins us, finance reporter for Bloomberg News. This is the big take story, and not surprisingly, it is like one of the most most read stories on the Bloomberg terminal today, because who is our readership? It's the folks that get paid by Wall Street, Global Wall Street. Catherine, talk to us about kind of the bonus environment these days for Global Wall Street.
Yeah, so, 2025 ended on a strong note.
Yep.
And the year ahead looks to be the momentum in terms of deals and trading. Both of those things is feeding into that bonus pool that you talk about. So in terms of the trading desks and M&A specifically, M&A has been, for investment bankers, the tepid environment that payouts have not been terrible, but you haven't seen this double-digit rise in that part of banking in a few years. Really, 2021, 2022 were like the banner years for investment banking. Now we're starting to see more momentum that bankers are getting paid for the deals that they're putting the time and energy into. And for trading, volatility has really driven up revenue across the big banks. They're fulfilling more client orders, and because of that, the trading desks are getting paid for it.
I need numbers. Like, give me an average, and then for a rainmaker like Paul, what would it be?
So average 10%, and we've been reporting for specifically JP Morgan, Goldman, Bank of America. Now, within those banks, there's some variation. We were trying to find kind of the general average. And for the rainmakers, to answer your question, some of those are going up to the 20 to, I had heard some rumors of 30% for the like real
Well,
deal
that's
makers,
give me like a
haymakers.
dollar figure, though.
So, I mean, these bonuses, it really varies by bank. But
Sure.
If you think about the base salary, it's the bonus on top of your base salary that usually is the sweeter part of payout. It's going to depend on what stage of career the banker is in. If they're further along, it can stretch into the millions of dollars. And it's the bonus that could be the millions part and not necessarily your base salary. So again, that's the performance-based. How did your year end up? And then your salary is just the thing that's on the bottom of it.
What has changed since my day was my bonus was 90 to 95% of my year-end comp, my total comp was my bonus. So your salary was like 5-10% of your total ticket. Now that's changed. It's a higher percentage now.
Your salary was your beer money.
Exactly. Yep. It's exactly right. But you try to live on your salary and you save your bonus. That's what. Or if you're other way, you just blow your bonus. But with 4 kids, I was in the save mode. But has that changed? Is there a higher base now these days? Maybe a lower percentage?
I do think that, I mean, that percentage that you just shared, I think the percentages, yes, have grown where bonuses are not 95% of your pay. That being said, the shift is still towards bonus over salary for many of these firms. And again, that is why there's the incentive to work hard, that phrase of eat what you kill.
Yep.
Is the bonus also a retention sort of thing, that retain your talent? You know, you don't want to lose this guy or woman to some other firm.
So that's a huge, that's like the fine line that the banks need to walk, is you want to pay your best talent, but they're also under a lot of pressure to keep their expenses in check. When these are public companies, they're reporting to their analysts and to the investor community and saying, hey, this is how much money that we're making. The profit that the banks made in 2025 was the strongest that we have seen in a while. So presumably they should be able to pay out their people for it, but they don't want to pay out so much that then their expense line is going to be under scrutiny and they're going to be held to a higher standard in future quarters, where they're going to start answering questions like, why is the expenses much higher than you projected or you have talked about in previous quarters.
I'm going to develop an AI model to come up with the calculation for bonuses.
I'm sure that this is something that, they've already implemented for that.
For the junior bankers listening out there and watching, here's the strategy. You go in with your deal sheet. This is the fees I generated this year. You got to pay me. As more important than that is going with the deal sheet for next year. These are my anticipated fees that I think I'm going to bring in. And you don't want to lose me. You don't want to make me unhappy, because this, I think I can bring in.
It's all about the year ahead.
And that's how you do it. So real quick, 30 seconds. The European banks don't pay as much as the U.S. banks, right?
Not typically, but that's just because when you think about the U.S., you have the New York market, so you're going to see higher salaries. And the U.S. banks, I think, are on a stronger foot right now in terms of the profit that they're pulling in. So those are the kind of the things you need to think about.
All right, Catherine, thank you so much. We appreciate that. Again, and Catherine Doherty, finance reporter for Bloomberg News. She knows how to end the week strong on readership. Write a story about Wall Street bonuses. That's how it works. And it's good stuff in this story. It's going to be a good year for the Wall Street folks by and large. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. Your top stories and global business headlines are coming up right now. John Tucker, thanks for your assistance today. We're going to have more Bloomberg Radio coming up. This
is CBS News on the Hour, your home for original reporting.
I'm Steve Kathan. The White House calls complaints about a video posted today by President Trump fake outrage.
The video depicts former President Obama and former First Lady Michelle Obama as apes, and President Trump is king of the jungle in a takeoff from The Lion King. NAACP President Derek Johnson called the video, quote, disgusting and utterly despicable. House Minority Leader Hakeem Jeffries said, quote, Donald Trump is a vile, unhinged, and malignant bottom feeder. While Tim Scott, the only black Republican in the U.S. Senate, called the video, quote, the most racist thing I've seen out of this White House. He urged the president to take it down. Linda Kenyon, CBS News, the White House.
The Obamas today posted a social media picture of that couple dressed up after Obama accepted his 2009 Nobel Peace Prize. Just in, actor Timothy Busfield has been indicted in a New Mexico child sexual abuse case. Now to Arizona and a second video plea from the children of Nancy Guthrie.
Whoever is out there holding our mother, we want to hear from you.
She's 84 years old.
The mother of TV's Savannah Guthrie has been missing since last weekend. CBS's Mugo Odigwe.
KOLD, the CBS station in Tucson, was one of the media outlets that received the ransom note on Monday evening. The station says the FBI confirmed the note offers another deadline of 5 p.m. on Monday the 9th. Authorities have not confirmed if the ransom demand is legitimate.
The U.S. has a Libyan man in custody in connection with the 2012 Benghazi attack that killed 4 Americans. FBI Director Kash Patel.
As a young prosecutor at CTS in the National Security Division, I worked on the Benghazi case. This was very near and dear and personal to me. We lost 4 brave Americans in Chris, Sean, Kyle, and Steve. And we can never, ever, ever forget them.
The man said to be the mastermind of the attack has been in a U.S. prison for more than a decade. Nearly 2 weeks after a massive ice storm in the South, CBS's Allison Keyes tells us a lot of people are still suffering.
More than 19,000 people in Northeast Mississippi still don't have power, and some say they've been told it will be out for at least another week. One family in a town 20 minutes south of the University of Mississippi says it is struggling to pay for propane and boiling water to keep warm.
NFL Hall of Famer Sonny Jurgensen has died at 91 after a long career quarterbacking Philadelphia and Washington. He was a game analyst on CBS.
Look how quickly he throws the ball. Right behind the linebacker, nobody covering.
And later behind the mic for Washington broadcasts up until 2019. The Dow is up 960. This is CBS News. Timothy Busfield, facing criminal charges and just indicted, as we reported, has been replaced in a TV guest role.
Timothy Busfield's shelved episode of Law & Order Special Victims Unit has a new air date and a new guest star after the actor was charged with child sex abuse crimes in New Mexico last month. The Hollywood Reporter says the scenes have been reshot with Dexter star David Zayas in Busfield's previous role as a judge. The episode that was set to air January 15th will now run February 26th. 68-year-old Busfield was released from jail pending trial after he pleaded not guilty in connection with allegations made by 2 child actors. Deborah Rodriguez, CBS News.
A Phoenix jury has ordered Uber to pay $8.5 million after finding it liable in a lawsuit brought by a woman who said she was sexually assaulted by a driver. Steve Kathan, CBS.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
Iran says we're off to a good start. Welcome to the Friday edition of Balance of Power, as Tehran says it agreed with the U.S. to continue talks to de-escalate and avoid a military confrontation. We're going to get the latest in just a moment from Bloomberg Washington correspondent Tyler Kendall with news that construction is now halted on the Hudson Tunnel project after the Trump administration cut off funding. We'll have details with analysis ahead this hour from our political panel. The Department of Homeland Security runs out of money 1 week from today. If lawmakers cannot reach a deal on ICE restrictions, we'll talk that out with Bloomberg's Megan Scully. And as Bitcoin bounces back today, we'll get into it with Bloomberg's Tim Stenovec. It's looking pretty good. In fact, Charlie Pellet will tell us what's happening right now as we start with a look at Wall Street. Charlie, where'd all the bears go?
Very good question. What a dramatic shift from this time yesterday. I got you covered on Bitcoin and the markets down to double decimals. Let's begin with Bitcoin, up 10.57% right now, advancing to 69,757 on Bitcoin. Dramatic turnaround there. Indeed, as with much of the market, a renewed wave of dip buying lifted stocks. We've got the S&P up 103 now, back above 6,900, 6,901 where we stand. That is the gain of just about 1.5%. The Dow up 2% now, up 983 points on the Dow. NASDAQ up 362, up by 1.6%. The Russell 2000 index of small cap shares outperforming, surging 3.3%. The 10-year at 4.21%. With the 2-year 3.50%. Spot gold up $177 the ounce, back at $49.56, surging 3.7%. Silver turning around, up by 8.1%, $76.65 for an ounce of silver. West Texas Intermediate crude up 1.5%, $64.23 a barrel. And Bitcoin now up 10.6%, 69,763. Four of the biggest American tech companies, Alphabet, Amazon, Meta, and Microsoft, together have forecast capital expenditures that will reach about $650 billion in 2026, all in pursuit of dominance in the market for AI tools. Rick Reeder is Chief Financial Officer for Global Fixed Income at BlackRock, and on Bloomberg Open Interest this morning, he said we are in uncharted territory when it comes to this kind of spending.
You know, I chair the board of, we have 14 charter schools in Newark, New Jersey, and we just had a discussion this week at our board meeting about what is our curriculum going forward. How does AI evolve how we teach kids? What are the disciplines we're teaching our kids for going forward? How do we use AI to augment a traditional teaching process? This is all new territory, and this is all new land in terms of where we're going.
BlackRock's Rick Reeder interviewed on Bloomberg Open Interest. Amazon, after last night's earnings report, now down by 7.7%, among other names spending heavily on AI. Alphabet down 2.7%, Microsoft up 0.9%, Meta Platforms down 1.8%. That, Joe Matthew, is a Bloomberg Business Flash.
All right, Charlie. Happy Friday. Charlie Pellet with us for the duration of the program, live from New York, and he'll have more on the markets in about 15 minutes' time. You made it to the threshold of the weekend. Thank you for spending part of it with us. On the Friday edition of Balance of Power on Bloomberg Radio, streaming live on YouTube. Always search Bloomberg Business News Live if you want to find us here in the studio. Watching us live, always on Bloomberg Originals as well. Big weekend. You got your chicken wings and chili ready, I hope. Of course, we're going to start with the Olympics, then we'll resolve to the Super Bowl. The president will not be present for either of them. He's headed to Mar-a-Lago after a signing session in the Oval Office this afternoon. And of course, we're going to be talking about the politics of both of these events. J.D. Vance, Marco Rubio are over in Milan watching the Olympics here, and we're looking at a lot of split screens of the two of them pretending to have fun together. The big party at Mar-a-Lago, Super Bowl party, you know will generate some news on Sunday, and exactly which halftime show is on all of the TVs. It's part of the reason the president says he's not going this year, right? Is the Bad Bunny thing, so he'll have Kid Rock on, I guess. The alternate Turning Point USA halftime show. To which I say the Puppy Bowl gets no respect. Let's turn now to geopolitics.
We've been quite clear in his demands of the Iranian regime. Zero nuclear capability is something he's been very explicit about, and he wants to see if a deal can be struck. And while these negotiations are taking place, I would remind the Iranian regime that the president has many options at his disposal, aside from diplomacy, as the commander-in-chief of the most powerful military.
Remembering Steve Witkoff and Jared Kushner are at the table here, right? Talks in Oman with Iranian officials at what is a clearly delicate moment here. A lot of folks think that flotilla we've got off the coast of Iran is there for a reason. And Donald Trump has a history of using the firepower when he assembles it. So let's see what we're hearing from the White House. Bloomberg Washington correspondent Tyler Kendall is with us here. We're hearing signs of, cautious optimism, Tyler, but then you see the USS Lincoln pointing straight at Tehran. I guess we'll have these two parallel actions for some time. What are we learning about talks today?
Right. So we've yet to get the readout from the U.S. side, but we have been hearing from Iran. And as you framed, they're essentially agreeing to more talks. These were talks about having additional talks. Iran said that they went very well. It was widely perceived as a really positive development. We saw oil prices fall, for example, after soaring this year, in part due to just what has been escalating tensions in the region. But earlier this morning, it almost felt like the bar was being lowered. We heard from Iran that this isn't going to be an end-all resolution. I don't think anybody thought that that was going to happen. They said that this is all about the broader issue. They're not going to get into finer details, which sort of tracks and makes sense, right? Because we actually went into today with, I think it's fair to say, contrasting parameters from each side about what was going to be discussed. First, the venue changed, Turkey to Oman, but then it appears that Iran had gotten what it wanted, which was for this to be bilateral talks only focused on its nuclear program, whereas we know the U.S., as said as such from the Secretary of State Marco Rubio this week, that they want to see those talks really expand. They want to talk about Iran's ballistic missile program. They want to talk about those proxy militia groups that Iran props up in the region. They want our regional partners to be involved in these conversations as well, to talk about some greater stability in the Middle East. And Iran, as of now, it appears, got what they had wanted, which is for this to be framed solely between the U.S. and Iran when it comes to their nuclear program.
Really interesting, Tyler. So to agree to meet again, I guess, is a good sign, but there are questions about timing here as well, and whether the president's going to put some kind of ultimatum on this conversation, knowing that it's directed toward the nuclear program. We're also starting the Olympics this weekend. Does that buy Iran a couple of weeks?
Perhaps. I'm not sure what the calculus would be there, but I can tell you that our analysts at Bloomberg Economics actually describe these talks as a stalling tactic. The White House itself has long said that diplomacy is always on the table, but they have also said there is a range of options on the table. President Trump himself hasn't shied away from that threat that there could be strikes, and Bloomberg Economics right now is forecasting that a strike on Iran by the U.S. is actually likely, considering that we've seen such a buildup in U.S. military assets in the region. Now we've seen this armada, essentially, the USS Lincoln carrier strike group. That doesn't necessarily mean that there's going to be a big attack. There are a lot of different scenarios on how this could play out, but we're hearing a lot of talk about potentially a targeted strike. But of course, none of this has happened yet. We're just sort of forecasting what could potentially happen. But it's important to note that that possibility really hasn't been taken off the table. And in fact, Bloomberg News was reporting earlier this morning, super tanker operators are now speeding their vessels through the Strait of Hormuz on fears that we could see escalation, since earlier this week, Iran had targeted a U.S.-flagged oil tanker in the Strait of Hormuz. No one was harmed. They had backed away. But we know that this is a critical waterway that Iran has previously threatened.
Well, it's something that we're going to be watching through the weekend. And that analysis from Bloomberg Intelligence, I'm really glad that you mentioned, because they are usually right, I have to admit. And they're a really smart team watching this from a lot of different angles. Tyler, we've got a breaking story that's coming out of the administration that we're both learning about here together. White House exploring opening an antitrust probe into home builders. Did this just go red here, James? This is a big one. Exploring opening an antitrust investigation into U.S. home builders as they sharpen a focus on tackling the country's housing affordability crisis. If you're with us on YouTube, you're looking right now at the reaction here. Toll Brothers is holding up, but D.R. Horton, rather, is down 1.5%. Lennar is down 2.5%. And this could just be the beginning if we have an administration that's going to be turning the screws here on home builders. The Department of Justice could open this probe in the coming weeks, according to people familiar with the discussions. This is just now happening. Pulte now turning negative, down to its low of the session, down a little more than 1%. Tyler, this would not be the first time that this administration tried to get to the housing market, having recently proposed, the president at least through executive action, banning institutional buyers from owning single-family homes.
Well, actually, you'll recall the president, through that executive action, actually asked the Department of Justice and the Federal Trade Commission to look into potential antitrust violations when it comes to institutional investors in this space. So this sort of does track. I think it could be fair to say that perhaps we did see something like this coming, could have been in the pipeline. Interesting reporting here, though, to frame this in the context that the White House has been really trying to refocus the narrative when it comes to affordability.
Yes.
And we know that houses, the cost of homes and housing has been a huge focus. We heard it yesterday during the Treasury Secretary's testimony on Capitol Hill. This is an area that the president really wants to focus on. In fact, it's a plank, you'll recall, of President Trump's campaign. There was this whole, rollout of what lowering home prices could ultimately be, and it appears that this is the route that he's trying to take as we head into the midterms.
Really interesting. This is one that's going to be perking through the day. A possible antitrust probe into home builders from the White House. We've got less than a minute, Tyler. I thought we'd be talking about this a lot more today. The New York-New Jersey Hudson Tunnel project is being halted after the White House pulled funding. Is this officially over? This is a $16 billion project with funds already allocated.
Right. So this today was the deadline for them to have that funding reinstated by the federal government. You will recall this is funding from the bipartisan infrastructure bill that was passed in 2021, and President Trump halted it back in October when we were seeing the start of the government shutdown. I know we're almost out of time here, but as of now, President Trump is saying he will not release those funds, reporting he asked for Dulles to be renamed in order
Dulles
to get
Airport.
them named. Yep.
And Penn Station.
And reporting that Chuck Schumer said no. Of course, these are his constituents in New York.
I wonder
that are
when the
being
last time
impacted.
was Donald Trump was in Penn Station. We're bringing Houlihan's back, baby. That's 1,000 jobs. We'll have more on that story. Tyler Kendall, thank you. This is Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. Trump administration officials are said to be exploring opening an antitrust investigation into American home builders as the White House sharpens its focus on tackling the country's housing affordability crisis. Now, sources tell Bloomberg one potential focus is on how information is shared through an industry trade group called Leading Builders of America. Officials are said to have grown concerned that the trade group, whose members include Lennar and D.R. Horton, could be used to restrict housing supply or coordinate pricing. Now, shares of the luxury home builder Toll Brothers, they are remaining higher. Other home builders are declining. Toll right now up 0.7%, but among those home building names that are declining, D.R. Horton down 2.8%. Pulte Home is falling by 0.9%, and Lennar right now, Lennar is down by 1.8%. All of this as stocks trade very close to session highs right now, with the S&P above 6,900, up 102 points. That is a gain of 1.5%. The Dow up 955 points, up almost 2%. We've got NASDAQ up 369, up 1.6%, with the Russell 2000 index of small cap shares surging now by 3.2%. The 10-year, 4.21%. The 2-year, 3.50%. Gold is up $179 the ounce, up 3.7%. Silver up 8% now, 76.63 on silver. And Bitcoin surging now by 12%, 70,681 on Bitcoin. Our Tim Stenovic will have a whole lot more on crypto coming up in just a moment. Briefly, ExxonMobil and Chevron expanding production in nations tied to OPEC. ExxonMobil up 2.2%, Chevron up by 1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. That Joe Matthew is a Bloomberg Business Flash.
Okay, Charlie, just don't tell me it's a dead cat bounce. I keep looking around for headlines. I haven't seen any analysts use that term yet. Seems like a pretty legitimate bounce back here. My God, the Dow's going to be up 1,000 points any minute now. The S&P 500 up over 100 points. We will take it. And as Charlie mentioned, Tim Stenovec's going to join us a little bit later this hour to talk about this incredible recovery that we're seeing. It's an ongoing recovery, I realize, in Bitcoin. My gosh, up 12%. This is quite remarkable, and it feels a lot different than yesterday. The program brought to you by the word cromnibus. And if you're old enough to remember, this is history repeating itself. We spent some time yesterday with Patrick McHenry, the former Speaker pro tem, of course, now free to speak as a Bloomberg Politics contributor, talking about this heated debate over the Department of Homeland Security. You know, it was 1 week ago we were up there in the Senate talking about the government shutting down, and 1 week from now we might be doing that very same thing, unless we're in the House. But the problem is that these 10 demands on restrictions surrounding ICE are running into a wall with Republicans when it comes to demasking and some of these other things. So could we, in fact, have another world in which we're living under a cromnibus? Let's bring back Patrick McHenry from yesterday.
Makes me feel like we've gone back in time.
Okay.
Because when President Obama had his approach to immigration, which was DACA, Republicans in the House said, we don't want to fund DACA. We don't want to fund your immigration policy. So we funded all of government except for the Department of Homeland Security, and it was called the CR Omnibus, the Cromnibus.
Yeah, the Cromnibus.
It's a Wayback Machine,
this is
right?
amazing, yes.
So
it happens
we
again?
are coming back around, and now it's the left saying they don't want the rights immigration policy.
Yeah.
And nothing is new again.
Nothing is new again. The cromnibus is not some sort of hybrid pastry. As Mr. McHenry just described, I plugged it into Gemini, a cromnibus, a $1.1 trillion federal funding package passed December 2014 to avoid a government shutdown. Close your eyes and imagine this next Friday. It combined a long-term omnibus spending bill for most agencies with a short-term CR for, yes, Homeland Security. Megan Scully remembers the cromnibus, and I wonder if they've already written the story for next week. She runs our Capital Influence team here in Washington. The big question, of course, is will Homeland Security shut down next week, or will we have something like this?
Well, first of all, I don't appreciate you aging me on your show. But it is just the Department of Homeland Security, we should say. The rest of the government is funded under the deal that was struck at the very last last minute last week. But I think that Republicans in the Senate in particular are saying the only way to get a deal here is to extend this short-term funding a little bit longer, essentially buy more time. They're going to need 60 votes to do that in the Senate, though, and they're going to need a majority in the House. So they're running up against really fierce opposition from Democrats who see this as their leverage to get their demands regarding ICE, taking masks off agents and such through. So it's going to be hard to see how this really shakes out here in the next few days.
Well, that is a little bit scary, knowing that the two sides seem to be oceans apart on things like demasking. What do you think of this list of demands? What are you hearing from your sources on whether that goes anywhere? Are any of these elements going to be in a piece of legislation?
Well, Republicans yesterday said it wasn't even the beginning of negotiations for them, that they saw this as a wish list, sort of an aspirational goal by Democrats. But, in any negotiation, Democrats are shooting high in their first offering. So Congress is gone. It's the weekend, after all. So they will be back next week, and I think that we will certainly get a better sense of where they are. What we'll be watching, certainly, is where things stand come Monday. We have a lot of, there will likely be protests throughout the weekend regarding, ICE across the U.S., and then you have Bad Bunny's Super Bowl halftime show and the counter-programming from Turning Point that the president will be tuning into. So the fever pitch surrounding this issue isn't going anywhere anytime soon. And whether that is something that keeps the two parties apart or if it's something that potentially fuels a compromise, I don't think we're quite there yet. They don't get to the compromise position on the Hill until they're up against the deadline.
So we'll be meeting here at this time next week.
Absolutely.
I've heard from a number of folks on the Hill talk about maybe there is some sort of offering that Republicans could make to avoid some of these. We have body cameras, as Kristi Noem has already said, offered by the Republican side. What if Kristi Noem was offered? And then we can get to some of these other. Could there be a compromise with a move like that?
We're not seeing any indication that could happen.
Yeah.
The president obviously has put Tom Homan, his border czar, into Minneapolis, which has basically sidelined Noem there. He's stuck with her through this, though, at least publicly. I think Democrats, though, want something in law. Some kind of executive action, be it a change at the top or an executive order. Their signaling is not sufficient. They want something that will withstand the test of time.
Got it. Megan, thank you so much. Knowing you were a young intern when the Cromnibus happened, that makes Megan about 25 years old today, so we appreciate your aging with that. Cromnibus, hashtag Cromnibus. Look it up if you don't remember. I'm Joe Matthew in Washington. Great to have you with us on the Friday edition of Balance of Power. You've been hearing about the bounce back on Wall Street. That includes crypto, Bitcoin. Look at this, up over 12% now. Just about to hit $71,000 a coin. Overnight, it fell to 60. Is that the floor? I wonder if Tim Stenovec is looking at it that way. He joins us now, live from World Headquarters in New York, as not only one of the forces behind Bloomberg Business Week Daily, but he's also the host of the Bloomberg Crypto Show. And so we're seeking wisdom here. Tim, it's great to see you. You were a voice of reason at a very scary moment for a lot of crypto investors last evening. Now it's party time today. Is this a technical bounce? What are you hearing?
Well, that's certainly what it seems like. I mean, because Bitcoin doesn't have any fundamentals, technicals is kind of all we have to go on. And round numbers are kind of technicals when it comes to Bitcoin. So some analysts are pointing to that support that we saw at 60,000 as being that level for a bounce. But look, it's a risk-on day. You were just talking about the equity markets and the rise that we're seeing on equities today, some big names notwithstanding. Maybe people see this as, okay, well, it was sold off enough, and there's an opportunity for us to buy here because we see value in this. But as difficult as it was to explain yesterday's decline, Joe, it's as difficult to explain as today's increase in the price of Bitcoin.
Wow. Well, that's a little bit scary because part of the justification for what happened yesterday, part of the explanation, and you please add more color to this if you can, was that there was a deleveraging on the S&P 500, that people needed to sell stocks and undue leverage on that side to cover their losses in crypto, and that became a vicious cycle. Is that happening in reverse today, or is there in fact a change of sentiment here when it comes to Bitcoin specifically.
Well, it seems like there is a change of sentiment, at least with what you see in terms of buying today. But that sentiment is really across the board with different cryptocurrencies. Ether's up more than 12%. XRP, which is Ripple's cryptocurrency, that's up more than 30% right now. You have Solana up 11.8%. So there's a lot of bullishness happening, but this is coming from a place where there was a lot of selling off, and there has been a lot of selling off. I do want to remind everybody, Bitcoin was, north of $125,000 per Bitcoin. That was back in October of this year. So it wasn't that long ago, and it's still down, more than 35%, close to more than 40% since then. I do have some numbers for you, Joe, about those bullish bets that were unwound. In the last 24 hours, this is according to data from CoinGlass that's cited by Bloomberg News, about $2.1 billion of bullish bets across all cryptocurrencies were liquidated. At the same time, investors pulled $434 million from U.S. ETFs for Bitcoin on Thursday. I'm looking forward to getting the data for today and seeing if, that much was put back in. We'll have to wait and see.
Right. That is fascinating. You think about the folks, Tim, who bought into crypto after Donald Trump got elected, because that was the promise. I mean, even this is what Michael Saylor was talking about on the strategy call last night. This is about President Trump, his embrace of crypto, making America first in the crypto space as America's top regulator. This is something you can bank on. And they're underwater now, having watched this go to the moon and back over the past year. You talked to Paul Krugman about kind of the sentiment behind crypto and this idea of it being a store of value. It's a really interesting conversation on Business Week Daily yesterday. Let's listen to what he said.
A lot of people sold Bitcoin as being the next gold, and it turns out that in the face of doubts about stability, doubts about politics, the next gold turns out to be gold, not Bitcoin. I think it's a big wake up for people that maybe this isn't actually going to be an enduring asset. So. It's really, really hard. If you ask when people make price forecasts for Bitcoin, I always wonder on what basis.
Yeah.
It's not like you could do a price earnings ratio on this thing because there's no earnings, no services. It's all just pure faith. But it does feel like we're seeing a real crisis of faith right now.
So, Tim, if the next gold is real gold, what does that leave for Bitcoin? It simply trades with the NASDAQ?
That's everybody's trying to figure that out right now. I mean, it's not trading with the NASDAQ over the last few weeks. It used to do that, and we would see, risk-off days for Bitcoin when the NASDAQ was sold or oversold, but that hasn't really happened. I mean, we're close to all-time highs on, major equity averages right now. So the identity crisis is something that people have been talking about over the last few weeks, and I guess that's a big question moving forward. What is the purpose here of this cryptocurrency?
Right. Man, if you're asking that, we better keep talking. Tim, thank you. You've been great these last couple of days. Tim Stenevec on the program that follows this one, Bloomberg Business Week Daily, live from New York. Polymarket, 75 chance of Bitcoin hitting 75K in February, an 8% chance of hitting 50K this month. This is Bloomberg.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. Stocks are higher. We've got Bitcoin surging. Home building stocks are selling off. The home builders are lower on word that the Trump administration may be exploring opening an antitrust investigation into the companies amid rising focus on the nation's housing affordability crisis. Right now, we've got shares of D.R. Horton trading down by 1.9%. Pulte Home down 1%. Lennar lower by 1.8%. Toll Brothers now trading a little changed. They are up under 0.1%. We are seeing a renewed wave of dip buying that is lifting stocks, with the Dow Jones Industrial Average up 956. That is a gain right now of 2%. S&P 500 index back above 6,900, 6,902, up 104 points now, up 1.5%. The Nasdaq Composite Index up 1.8%. Nasdaq 100 Index up 1.7%. And the Russell 2000 Index of small cap shares up 3.2%. The 10-year at 4.21%, with the 2-year 3.49%. Gold up 3.6%. $49.52 the ounce on spot gold. Spot silver up 8.1%, $76.65 on silver, and West Texas Intermediate crude up 1.5%, $64.22 a barrel. Bitcoin now surging 12.7%, back at $71,100. Consumer sentiment improved to the highest in 6 months, largely propelled by wealthier Americans who've benefited from stock market gains. Now, that's according to the University of Michigan. Joanne Shu is director of surveys, and she's been looking at the politics of the results.
We've seen a partisan divide in consumer sentiment going all the way back to the Reagan administration, if not earlier. So it's always the case that if your party's in power, you feel better about the economy than if your party's not in power. But if we take away Republicans and Democrats and we only look at independents, we get the exact same national number.
Joanne Shu of the University of Michigan interviewed this morning on Bloomberg Intelligence. Recapping, the Dow pushing higher to a 1,000-point advance, up just about 970 right now, up 2%. The 10-year 4.21. Crypto, specifically Bitcoin, up 13%, 71,280. I'm Charlie Pellet. That Joe Matthew is a Bloomberg Business Flash.
Thank you, Charlie. Sounds a lot better than what we were talking about yesterday, that is for sure. And Charlie will have more on the markets coming up at the top of the hour, 1 p.m. Eastern, as we welcome our global television audience to the conversation. It's a nice-looking market here. Crypto's bouncing back, stocks after a very difficult day yesterday, and we'll see if we can hold the gains as we move into the close. We do want to update a story that you've been hearing about today on Bloomberg by way of some of our newscasts. Some of our shows have been talking about this as well because it sparked quite a bit of outrage in political circles here in Washington. A White House official is now blaming a staffer for what they are describing as an erroneous post. Erroneous is the term here. A racist video clip of the Obamas that President Trump put on Truth Social. This is a video clip, a parody of The Lion King, in which the former president, former first lady are portrayed as apes. This is pretty tough stuff here. Drawing condemnation from the NAACP, Derek Johnson called it blatantly racist, disgusting, utterly despicable. Tim Scott weighing in, and this was kind of a breaking point here today in Washington. Of course, the Republican senator praying it was fake, he writes, because it's the most racist thing I've seen out of this White House. The president should remove it. Pretty stark words from the senator. We heard as well from Congressman Mike Lawler of New York, taking to Twitter, unsolicited here. The president's post was wrong and incredibly offensive, whether intentional or a mistake, and should be deleted immediately with an apology offered. I don't know if there's going to be an apology coming, but we can tell you that that post has been removed. If you continue to hear stories about this, there has been a move from the White House, in fact, responding to this criticism to remove the post. Not the best story of all the stories we're following today, but we wanted to try to bring you up to date on that. We'll have more on the Iran-U.S. talks coming up at the top of the hour when we spend some time with Bloomberg Washington correspondent Tyler Kendall, and Hagar Shamali will bring her insights into this whole process. As the delegation gets moving on to the Olympics, J.D. Vance, Marco Rubio are out there. Nobody's going to the Super Bowl after the president became the first president of the United States to go to the Super Bowl last year. And we're told it's because of the halftime show. So I guess Kid Rock's going to be on the screen at Mar-a-Lago, where the big Super Bowl party is going to be taking place. Democrats are not sure if they should party. Depends which one you're talking to after what took place in New Jersey. Progressives are pretty excited about it. This is a House Democratic primary, Mikey Sherrill's old seat, northern New Jersey, and remains too close to call. In fact, it's narrowed down to about 400 votes from what Megan Hayes just told me. Analilia Mejia on the precipice of a massive upset, having been outspent on a big level by other candidates and groups, was leading former Representative Tom Malinowski again by only about 400 points in this special primary. This is the 11th district, a margin of less than 1 percentage point here. The cross currents and where the money was going in this race is really interesting, because it may be that AIPAC, which put a boatload of money into this race, may end up with the candidate it does not prefer. As we assembled our political panel and two experts on campaigns, Bloomberg Politics contributor Rick Davis is here, our Republican strategist and partner at Stone Court Capital, alongside Megan Hayes, making a rare appearance on the early show. Megan is, of course, former special assistant to President Biden, our Democratic strategist, and great to have both of you here. Megan, how are we looking at this? AIPAC went after one candidate because he was considering conditioning weapons shipments. This is the former congressman, where Mejia was actually calling genocide what Israel was up to in Gaza. Did AIPAC misguide its money and its vote?
It seems like it was a miscalculation on their part, which doesn't bode well for their 2026 plans. But I also think it shows here that special interest really does play a part. But people actually who are voting aren't necessarily paying attention. So it's interesting that a very progressive candidate has rejected someone who used to be a member of Congress, and then also someone who is very well funded by a special interest group. So, you know, they're only going to be in Congress for 11 months. There's another primary in June for the same seat. So it's kind of a moving target here in New Jersey. Obviously, the woman hasn't won yet, but it's really interesting to sort of see that people now are taking much more active note on who is influencing these elections and who they want to win.
Interesting. This is somebody who was endorsed by Bernie Sanders. AOC was on the big speaking tour with them. Could this then self-correct? Are you suggesting 11 months from now, if this isn't exactly what voters wanted?
I think it could self-correct. It also, you know, these special elections do tend to turn out the base. You see that in Republican special elections as well. So it will be interesting to sort of see how this plays out for the primary again in June, and then, you know, who gets to serve the first full term.
Yeah, right. The United Democracy Project, AIPAC Super PAC, Rick Davis, put almost $2.5 million into this special election, attacking Malinowski. Is this just malpractice? How do you read the result here?
You know, look, I mean, you know, sometimes you place a bet and it went right? They put a lot of heat on Malinowski, but in the reaction is they wind up with someone who's probably worse on their issues than Tom will ever be. You know, Tom's got a track record. You know what he's going to get. He's been a congressman before. And as you point out, this is a huge success for, you know, sort of the progressive wing of the Democratic Party. And really, that's the story here, is that here you had a pretty mainstream Democrat and Tom Malinowski, you know, sort of an establishment Democrat. And everyone thought, oh, this is a done deal. And even at 9 o'clock last night, the DDHQ called him and said, hey, you're going to be the winner. And then an hour later, they called him back and said, hey, forget what we told you there. I mean, that is a campaign manager's worst nightmare. They start working on their acceptance speech. I can't imagine. Stop. So, you know, look, I mean, I think this is where the energy of the Democratic Party is. And that's the cautionary note for the midterm. The only thing that can get in your way is to start posting up candidates that maybe have the potential of not winning. The reality is it's not a district a Republican can compete. And so Democrats are going to get what Democrats want. And in this case, unless there's some switch in Morris County where Tom Malinowski's numbers start to improve, which is his base, you know, they're going to have their pick of the progressive on this election.
They did call this early in the wrong way. She posted the old Dewey wins front page of the paper. This is going to be interesting to watch unfold here because it's New Jersey. Just a couple of weeks ago in this gubernatorial contest, people were asking if this was a purple state. How do you describe it?
I mean, I think Rick was saying this is a very safe district for Democrats. So I do think what Democrats are going to turn out, that's a progressive candidate could win here. But I don't think that's a reflection of the rest of the country that we need to be worried about for the midterms writ large here, because I do think that there are going to be a lot of moderates that are in their final races that could beat Republicans in these swing districts. But I do think this is where candidate selection really matters, and this is where the parties really play an important role. And who you put up is really important, because the last thing you want here is for a moderate Republican to come in at the last minute here and then win again in November.
Well, just not too far from the 11th district, there's a tunnel project underway that has been halted. And I'm curious your thoughts on this, a $16 billion project that we've talked about before when the administration pulled funding or froze funding for. This is the Gateway Development Commission, the Gateway Tunnel. This would connect northern New Jersey with Midtown Manhattan. And the whole knock on it was that there was some sort of DEI that was seen as corrupt in hiring practices by the administration. Construction has been put on hold now indefinitely, with federal funding still locked up here. This is deadline time, and work on the tunnel is going to be stopped at 5 p.m. local time if the president does not restore funding that it cut off in October. Rick, I don't really understand the politics behind this, I guess, because I thought infrastructure, this is an already approved deal with monies allocated from the infrastructure law. I thought that was bipartisan. I thought this was something that D's and R's both supported, because the loss of this project will eliminate 1,000 jobs and threaten 95,000 others. How does this play politically?
This is a disaster for those people who have, Republican seats in New York and New Jersey. I mean, there are 3 Republicans in New Jersey and 5 in New York who literally just had their feet cut out from under them. I know that they've been expecting this for some time, but I think the people, canceling or suspending or canceling, I guess, this project understood the politics of it. I would be hard-pressed to make an argument that these 8 congressmen can actually win re-election in a tough election year. I mean, this is such an impact to those states economically, jobs. It's a prosperity issue, just the thing Republicans want to campaign on. And just because of a grudge with these 2 states, the president has completely eviscerated this. So I don't care how many, seats you've redistricted in Texas and any other state, you just gave it all back with this one decision.
So much for infrastructure being a bipartisan affair. There is some reporting after the president wanted his name on Penn Station, maybe in return for this. Like he wants his name on the stadium here for the Commanders. If you need the tunnel, why don't you just put his name on it?
Well, because I think that Schumer's not going to negotiate with someone who's asking for his name on Dulles Airport and Penn Station.
Dulles Airport,
who also, the Penn Station already has a name on it, but that's beside the point here. But I do think that puts people, these members, these Republican members especially, who are running in a really tough spot. Do they defend the president being a total narcissist and only crazy about wanting stuff for himself, or do they defend their people who want this project? So they just got put in a really tough spot if they have to go against the president, because it's very clear the president only wants what's best for him, not the people of New Jersey and New York, or frankly, the members of Congress that are in his party.
I know we've got the Moynihan Hall. I'm not sure who would want to put their name on Penn Station at this point of the game here. Rick, I don't know how much time our audience has hung. I know Rick Davis knows the Red Caps at Penn Station. If that's the way it goes now, if this is the transactional world that we're in, Rick, why not put his name on the airport, the train station, and you get your $16 billion tunnel?
Yeah, look, I mean, that's what every world leader has learned, right? Is that you kowtow to the president. It's got nothing to do with the United States or their economy. It's just to get what they need out of the administration, and that's just a super dangerous thing. I mean, we are in a market economy. We should reward those things that generate value, and these are taxpayers' dollars. This is not Donald Trump's checkbook, and if he wants to give personal funds to put his name on a building in New York, he ought to do that, because Steve Schwarzman, all kinds of people do that all the time, and the recipients are happy to post that up on the wall.
Kennedy Center's the other one. When that is rehabilitated, the name will probably be prominently placed on the side of the building, assuming they do rebuild this. What happens in 3 years?
Well, if a Democrat wins, it will come right down probably at 12:01 on January 20th.
Executive order?
I don't even think it's within an executive order. I think someone just goes and takes it down, because you have to have Congress to pass legislation. It's still named the Kennedy Center. It's
Yes.
not Donald Trump just added his name. So it's all for naught. Like all this stuff is just all fake, and it all just plays into his own vanity.
Some honesty from Megan Hayes. Rick Davis with us as well, our great panel with both sides of the aisle covered here. We'll have much more in our second hour as we welcome our global television audience to the conversation. Seizing on Fed independence, we'll get into this with some new comments from Raphael Bostic, and we'll spend some time as well with Hagar Shamali. U.S.-Iran talks underway today in Oman as they agree to meet again. We'll call that good news for now, and we'll have details straight ahead on Balance of Power, only here on Bloomberg.
From Washington, D.C., this is Balance of Power with Joe Matthew.
We meet to meet again. Welcome to the Friday edition of Balance of Power. As Iran says it has agreed with the U.S. to continue talks to de-escalate and avoid a military confrontation. We'll get the latest in a moment from Bloomberg Washington correspondent Tyler Kendall with insights ahead from Hagar Shamali from Greenwich Media Strategies. Raphael Bostic weighing in on Fed independence, as we'll discuss with Bloomberg Wall Street Week host David Weston, and we'll have analysis from our political panel All after a look at Wall Street. Let's get up to date with Charlie Pellet at World Headquarters in New York. Recovery day, Charlie.
Indeed, we are seeing a renewed round of dip buying. The Dow, the S&P, NASDAQ, all pushing higher. I'm going to begin with Bitcoin because right now we have got Bitcoin surging by 12.1%, back above 70,717 on Bitcoin. All of this as the Dow now surges by more than 1,000 points on this Friday. We've got the Dow up 1,050 right now, up 2.1%, 49,958. Looking at a record on the Dow. We've got the S&P up 116, up 1.7%. NASDAQ up 455 points. NASDAQ is surging by 2%. The NASDAQ 100 index up 1.9%. And people getting back into small caps with the Russell 2000 index advancing 3.3%. Our Mag 7 index has turned around, up by 0.6%. The VIX now at 17. This time yesterday we had a VIX above 20. The 10-year yielding 4.21%, with the 2-year 3.49%. Gold is surging 3.8%. Spot gold 49.62 the ounce. Silver up 9.5%, 77.63 on silver. And West Texas Intermediate crude up 1.5%, now 64.22 a barrel. Again, Bitcoin up 12.1%, $70,700 on Bitcoin. Amazon shares are down 6.1% now after the company last night announced plans to spend $200 billion this year on data centers, chips, and other equipment. And home builder stocks are falling on news that the Trump administration is exploring opening an antitrust investigation into U.S. companies amid rising focus on the country's housing affordability crisis. Among some of the housing names selling off, D.R. Horton down now by 2%, Pulte down by 0.4%, Lennar down by 1.8%, the luxury home builder Toll holding on to gains of 0.7%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. That Joe Matthew is a Bloomberg Business Flash.
Charlie, thank you so much. Almost like yesterday never happened. Charlie will have more on this improved market today in about 20 minutes' time as part of our program. Live from Washington, thanks for being with us on the Friday edition of Balance of Power. As we survey the political landscape here at the threshold of the weekend with important talks underway in Oman. We talked about this yesterday as the venue changed from Turkey, U.S.-Iran talks, aimed at a nuclear deal, or maybe I should say aimed at avoiding military strikes once again from the U.S. White House Press Secretary Caroline Leavitt spoke to this during the briefing yesterday. Listen.
The president has obviously been quite clear in his demands of the Iranian regime. Zero nuclear capability is something he's been very explicit about, and he wants to see if a deal can be struck. And while these negotiations are taking place, I would remind the Iranian regime that the president has many options at his disposal, aside from diplomacy, as the commander-in-chief of the most powerful military.
Remembering that Special Envoy Steve Witkoff and the president's son-in-law, Jared Kushner, are back at the table in this case, back at the table in Oman. And we're waiting for more details on what exactly was discussed or, in fact, accomplished, with Iran saying that the talks had a good start. We're agreeing to meet again. Bloomberg Washington correspondent Tyler Kendall is with us right now with the latest on this. Do we expect a readout, Tyler, or are we just watching Truth Social?
Well, at this point, we haven't heard from the U.S. side, but as you mentioned, we did hear from Iran, which essentially laid out that the talks agreed to more talks to come. They called this very productive, very good talks, in the words of the Iranian foreign minister. You mentioned Steve Witkoff and Jared Kushner. I will point out somebody else was there from the U.S. delegation, U.S. Navy Admiral Brad Cooper, the head of the American military's Central Command. That has led some analysts to say that was perhaps a threat of keeping in mind that military action is still on the table. The fact that such a high-level, high-ranking military official was there in person for these talks, because as you just heard from the White House press secretary, the U.S. maintains that while diplomacy is on the table, there are a lot of other likely actions that could also be on the table. In fact, our own analysts at Bloomberg Economics have said that they see it as highly likely that the U.S. could still strike Iran, even as diplomacy moves ahead. And this was considered to be a welcome sign that we heard from Iran that they went well and they're going to continue talking. But we should also point out that both sides seem to have contrasting parameters heading into today. You mentioned the venue change, but also Iran was able to limit the scope of these talks, according to our reporting. Bilateral talks only focused on Iran's nuclear program, whereas, Joe, we know that the U.S. wanted to expand that out. They wanted to have Iran's ballistic missile program on the table, also talk about their support for proxy militia groups, not to mention that they wanted regional partners in the room, too, to talk about how there could be broader stability in the region.
And I guess the U.S. was urged by a number of neighbors in the region to acquiesce to Iran's demands in this case. Is the fear of a strike that high?
Well, if you look at some of the lead up to these talks, I think that did raise the prospect of fear. We've seen this massive buildup of U.S. military assets in the region. That is actually part of why our own analysts are saying strikes could be likely, because we've already seen this accumulation when it comes to like the USS Lincoln Carrier Strike Group and some more of this armada that is now assembled in the Arabian Sea. With that said, there's still a lot of options on what military action could look like. Just because there's such a buildup of power, that doesn't mean that there could be a large-scale strike. We could see targeted strikes, for example, and that will sort of play with the different scenarios that end up resulting from this, particularly when it comes to the oil market. How big this strike would ultimately be if Iran retaliates in such a way that would hinder the oil market, such as closing the Strait of Hormuz as one example. There are so many different range of possibilities that could happen, but if you ask the White House, as you just heard, diplomacy is still on the table.
It's interesting to think that this started as a conversation about protesters. The president was, remember, help was on the way. He said that if they execute the protesters, the United States would strike. And he told reporters yesterday that we had their back. Are we talking about protests anymore at this point?
Well, so you're hearing the rhetoric from the president, but now it's starting to shift back to this has to be just about Iran's nuclear program. Yes. And we got a preview from an interview that's airing over the weekend with President Trump on NBC News, where he was asked directly, you've said that Iran's nuclear program was obliterated. Why are we still talking about this? And while we know significant damage was made when it comes to their program, President Trump is saying that they have this intelligence that Iran is rebuilding in a different location. And that is why it appears that we've seen this ramp up of escalation and tensions in the region. As just this week, Joe, you know, the U.S. confirmed it shot down a drone that appeared to be headed for the USS Lincoln Carrier Strike Group. We also know that Iranian gunboats were trying to board a U.S.-flagged oil tanker in the Strait of Hormuz. So there has been just so much pressure leading up to these highly anticipated talks today.
Gunboat diplomacy, as we continue to hear. Tyler, thank you so much. Bloomberg's Tyler Kendall with us live in Washington. We're going to be hearing, of course, from the president, as Tyler mentioned, during the Super Bowl. That's part of the annual tradition. And it is expected that we might learn more when he is doing some signing later on today in the White House. There is an event in the Oval Office. We'll see if it's open to reporters. But we want to keep the conversation going here with Hagar Shamali, who knows a lot about this part of the world and has been a voice of reason for any number of conflicts that we have talked about in the last couple of years. Former director for Syria and Lebanon on the National Security Council, CEO, founder, Greenwich Media Strategies. Hagar, it's great to have you back. As we watch the justification for military action evolve and then the parallel path of diplomacy, which do you think is more likely?
Well, I certainly wouldn't discount either of them. Is, you know, and the reporter before mentioned that really is that just because there are diplomatic talks, it doesn't mean that military strikes can't happen. On the contrary, when it comes to the talks that are happening and apparently they've agreed to another round, it's the U.S. side that is much less likely to be certain to engage in a way that is going to get anywhere. And the reason for that is that the Iranian regime has proven time and again that it is not willing to actually negotiate regarding its nuclear program or anything regarding its ballistic missile program, its support for terrorism and its human rights abuses in a way that is actually going to work on a level that is where the U.S. administration needs it to be. I know that in the administration and in Washington, they would like to see nothing more than this regime to go. It just needs to be in a way that paves the path for something stable afterward. They don't want to enter into a situation like Iraq. They also don't want anybody, they don't want them to have a nuclear weapon. I don't love that the focus has become talk about the nuclear program. I think that's actually quite detrimental for a lot of reasons, mainly for the Iranian protesters. But that said, Trump has come out and said fundamentally, and this is fundamentally the issue for them, is if they appear to be rebuilding a nuclear program, if they appear to be intent on building a nuclear weapon, then that's really going to be the no-go for them. So I would expect some strikes. When or how is unclear, but it's clear to me that Armada is there for a reason, and also that if it doesn't happen now and these talks fall apart, those strikes are likely to happen at some point in the future. Just as, by the way, I believe the regime is going to fall at some point in the future because it doesn't have an economic leg to stand on.
Boy, that's really interesting. Where do the proxies come in with all of this, Hagar? Will we be getting Houthi attacks from Yemen if it appears that we're on the march to war?
Probably, but it won't be that different than what we've seen over the last 2 years. And this is why I'm a little bit confused by the pushback by the Gulf. The Gulf leaders who really weighed in heavily to make this meeting happen. It was originally supposed to happen in Turkey. As was mentioned before, it got pushed to Oman. It got pushed to terms that are much more favorable for the Iranian regime in terms of what they wanted. And that's the Gulf leaders that really pushed the U.S. administration on that. And some of that is because the Gulf really prides itself on a general state of stability. And it's why they didn't like when Israel struck Doha, for example, right? They really view that as this is a bastion of stability in this region. This is what has led to our success. And so we don't want this kind of upheaval and instability. But the fact is that over the last 2 years, every time you've had ramp up or tensions that have increased or actual kinetic action, the fact is it's always been very limited. These are limited military operations. There have been threats. The U.S. has very successfully pushed back or prevented those threats or protected against them. And by the way, this comes at a time when the Iranian regime has never been weaker. We and the Israelis literally own their skies. They have no defense missile capabilities anymore. And they also have, if their nuclear program hasn't been obliterated, a large chunk of it has been destroyed. And so to speak as though the regime is in any way in a position of strength, I find very disturbing. And we should certainly not let the regime feel that way. But I do understand the argument that whatever we do in Iran, that we want to make sure that if the regime collapses, that the IRGC doesn't take over, because then it would be markedly worse. And I understand that argument, and I do think that that's something that's manageable. But that's where I see, when I hear that talk, I'm not as worried about those threats. They've come up, we've managed them before. Now would be no different.
We're hearing from Jennifer Griffin at Fox that Iran says the talks lasted 8 hours. Hagar, is that encouraging? And why haven't we heard a readout from the U.S. side?
Well, 8 hours is encouraging. It's not surprising for talks of this kind and the amount, the extent to which they need to discuss. The Iranian regime is showing that it absolutely wants some kind of deal. And the reason is because it does feel as though it's really crumbling. And so now they're desperate. But in terms of a readout from the United States, this administration in particular, the Trump administration, when they pursue their talks, I have found that in general as a pattern, they don't tend to share too much with the public because they don't want the public in general, whether it is the regime that's listening or us sitting in the United States, understanding their next move, analyzing the next move, knowing what it could be. That unpredictability serves in the interests of the administration. And so I don't expect us to get much of a readout beyond what we know now, which is that there will be talks again, that the U.S. reserves the right for kinetic action, that they're going to continue sticking to their demands. But I don't think we're going to get much detail beyond that.
As a former diplomat, I wonder your thoughts on Steve Witkoff and Jared Kushner being at every table, whether it's talking to Vladimir Putin or in this case, face-to-face with the Iranians for 8 hours. Are they the right people to be in this room?
This is the second time I got this question today. The thing is, it's not really my place to decide whether or not they're right or wrong. The fact is that President Trump really depends on them and has given them this mandate, and Steve Witkoff in particular, right? I mean, Steve Witkoff is officially with the administration as a special envoy and has already brokered deals. I mean, the Israel-Gaza one with Jared Kushner, of course, is a success. However you want to look at it, the war ended and the hostages were released. So they were able to achieve success there. They were not able to achieve success yet, at least, on Russia-Ukraine, and actually made some missteps there that Secretary Rubio had to kind of clean up and fix. And so it remains to be seen what they're going to be able to achieve on this one. I will tell you that this corner of the world, understanding the regime, its history, how it came to power, what its foreign policy objectives are, and that it is a regime that will never change its foreign policy objectives. It is fundamental. Pursuing terrorism and its nuclear program is fundamental to the regime's existence. Why? Because when it came to power in 1979, it came to power arguing that they needed to fight the West and the quote-unquote oppressor, and that Islam was the way to do it. And that is why the way they fashion their support for terrorism, their Islamic extremism, their oppression, is literally fundamental to their existence. And that's why no deal has ever changed their behavior. And you do need real experts of the region to understand that. But that said, I also think there's always value in having perspectives of, business people and the way they pursue deals. I do think that can be helpful. At the end of the day, it's, Trump is definitely, he has a lot of faith in Witkoff and has had that faith over the last year or so in these deals. So it'll remain to be seen, but I really don't think it's them alone anyway.
Yeah. I don't mean to sound too old-fashioned, Hagar, but I'm just wondering if there's anything left of the old Olympic truce. Opening ceremonies are taking place today. Doesn't that call for a halting of hostilities around the world for the next couple of weeks?
If only, Joe, we lived in a pacifist world where nefarious actors weren't seeking war all the time. I wish that were the case. I will tell you that the thing that I think is the point that's being missed in what I see in the talks around regarding the regime, regarding its nuclear talks, is really the fact that when I say that this regime has no economic leg to stand on, I cannot emphasize that enough. One of its major banks blew up in December, Ayanda Bank. That is what led to mass inflation, and the Iranian regime absorbed the bank, printed money, led to mass inflation. That is what led to the protests. And there are 5 other banks that are about to implode in Iran. And unlike the United States, when this happened in 2008, we're the United States. We were able to take care of that and fund that. Iran can't. And so this regime could very well fall regardless of kinetic action. And so the conversation needs to be about, what do we do with the day after? How do we ensure that there is a stable transition, that the IRGC doesn't take over? Because when they're not going to be able to pay their own people, that's really when you see the potential for regime collapse. And that is an opportunity for the entire world. So that's the conversation I hope they're having. And I know that the administration is interested in the regime no longer being there. So that it's going to be, we'll see. But that said, sure, all of this leads to peace is what I would say, Joe. The regime falling, however it happens, leads to peace.
The view from Hagar Shamali. Thank you, Hagar. It's great to have you with us as part of the conversation today on Balance of Power. We'll let you know when we hear from the White House on that 8-hour session. I'm Joe Matthew. This is Bloomberg.
It's 121 on Wall Street. We do check markets all day long here at Bloomberg. We are looking at a record for the Dow Jones Industrial Average, pushing higher now by 1,045 points. The Dow up 2.1%, closing in on 50,000. Dow Industrials at 49,955. S&P in a dramatic turnaround from yesterday's sentiment, up 115 right now at 69.13. That is a gain of 1.7%. NASDAQ right now up by 2%. The Russell 2000 index of small cap shares surging 3.3%. The 10-year currently yielding 4.21%, with a 2-year 3.49%. Gold up 3.8%, 49.62 the ounce. Silver rebounding from yesterday's swoon, up 9.5%, 77.67. West Texas Intermediate crude oil up 1.3%, 64.10 the barrel. And Bitcoin, what a story there. Had been up as much as 12%. Bitcoin right now at 69,670. Bitcoin up by 10.4%. JP Morgan Chase, Goldman Sachs, and Bank of America are boosting their bonus pools for bankers and traders by at least 10%. The payouts reflect a strong year for the nation's largest banks, which collectively posted their largest annual profit since 2021. Among those bank names right now, JP Morgan Chase up 4.2%. That is a Bloomberg Business Flash.
Charlie Pellet, thank you, sir. I'm Joe Matthew in Washington. Appreciate your being with us on the Friday edition of Balance of Power. You made it to the threshold of the weekend as we consider another wild week here in the nation's capital. It was only a couple of days ago that Scott Bessent began his testimony on Capitol Hill, and he faced some pretty wild questions. In some cases, he brought his own Oppo research to tangle with lawmakers who were on the other side of the panel. When he got to the Senate Banking Committee, Senator Elizabeth Warren making some news with the secretary, who said it would be up to the president to decide if he wants to sue his nominee to chair the Federal Reserve for not lowering interest rates to his liking. Elizabeth Warren saying, I thought that was the softball. And it generated a lot of news here on the terminal and on Bloomberg TV and radio, with questions about the Fed's mission creep, DEI, and so forth. All of this came up in Michael McKee's conversation with outgoing Atlanta Fed President Raphael Bostic on Bloomberg TV and radio. Let's put an ear and an eye on what they said.
I actually don't even see the mission creep argument. Like for me, on the banking side, for example, our job is to make sure that every bank that's alive today is alive tomorrow. And so we need to make sure that banks are thinking about the risks that could cause them to need to deploy capital in ways other than in loans. And so having conversations about those things, I think, is fully appropriate, and we should be doing that. We don't tell banks where to lend. I've never told a bank, don't do a loan or don't do that sort of thing, and my examiners don't as well. I think we're asking prudent questions to make sure that financial sector, business leaders are aware of trends that could be introducing risk.
What would you tell Donald Trump if you had the opportunity about Jay Powell and about the Fed?
I'd say Jay's trying to do the best that he can. He's a smart man. He understands markets. And if you want him to succeed, you should let him succeed.
Well, the Fed itself, do you think it is under threat from this administration?
Threat, I don't know. What I would say is my whole time here, and I think that most of the history of the Fed, there have been people who thought the Fed should do other things and talked about that and called them out. This is another one of those times, and we need to be mindful, and we need to be solid and resolute to understand that that comes with the territory, and with that territory then requires our strength and our resoluteness to stay focused on what we've been asked to do.
Raphael Bostic, however diplomatic, the Atlanta Fed president's talking with Michael McKee. You can see the full conversation, their full interview, coming up on Bloomberg Wall Street Week, 6 p.m. Wall Street time. And, of course, the force behind that program is David Weston, and our colleague from New York joins us right now. David, it's great to see you. There's been a big, spirited debate, I guess we could call it, here in Washington about Fed independence, but it almost becomes a question of how we define it, because President Trump has changed the rules here, hasn't he?
Well, he says he hasn't, right? I mean, his Treasury Secretary, Scott Bessent, keeps saying, no, the president respects the Fed. And then the president comes out and either posts something on True Social, otherwise talks in ways that perhaps is not so independent. At the same time, this sounds like more talk right now than actual action. I mean, we have to admit that he's appointing somebody in Kevin Warsh that he thinks will do things that he would like to have done. But that's different from telling the Fed president what to do as opposed to appointing somebody who's inclined in your direction.
Sure. Then again, if you're tacitly threatening to sue over interest rate decisions, that could be seen as something different, no?
Well, certainly. And listen, we're hearing a lot of things out of this president I don't think we would have heard from other presidents. But I do note, and you're following this more closely than I am, Joe, you're starting to hear even from Republicans up on the Hill, people like Tim Scott, who are making some noises to say, well, wait a second, let's back off here a little bit. I'm not sure there's any crime that should be investigated, for example, with respect to Chair Powell. So there seems to be a point at which even Republicans on the Hill say that's enough. I mean, I think everybody at some level understands the importance of the independence of the Fed. And thus far, I would say, at least, and I'm not an expert on the markets, but the market's not overly reacting. I mean, you're not seeing the 10-year yields shoot up, and you're not seeing, goodness knows, the stock market today shooting down. So thus far, I think it's been more talk rather than action.
Well, it's interesting. Tom Tillis has become the face of that Republican opposition in the Senate. But you're right. It's not just the retiring senator from North Carolina. We heard from a number of other lawmakers. John Thune's pushed back on this as well, where we really kind of found a line. And I'm wondering what you think that means for confirmation. Will the committee even hold a hearing until this case magically goes away?
Well, there's a good question, right? Because as I recall, Senator Tillis said that was not going to happen until it had gone away. I also wonder what is going on with the Attorney General, who may be feeling a little bit of pressure here, because President Trump at least claimed that he didn't even know it was happening before it happened, this subpoena. And also, Joe, as you know so well, it's a subpoena from a grand jury. It's not even an indictment. I mean, it's a really early stage here. But I wonder what kind of pressure there may be on the Attorney General, Ms. Pirro, to say, well, maybe you better back off of this a little bit, Madam Attorney General.
No doubt. Spending time with David Weston, who, of course, I'll remind you, is not only America's anchorman at Bloomberg TV, but he used to work in a very different capacity in the news business and was president of ABC News for some time. David, I'm just wondering your thoughts on what is happening in the news media, not just the splintering that we've been seeing, but the massive rounds of layoffs. This week, the Washington Post was the example. A third of the newsroom dismissed. David, they even axed the entire sports section while they were at it. There seems to be a major rethink on how journalism is supposed to make money right now.
Boy, Joe, you put your finger on it with the sports section for the Washington Post. I lived in Washington for many years, and that was a really iconic sports section they had at the Washington Post. And by the way, even going back before that, the Washington Post was known for its political coverage, and then you had people leave to form Politico. So a couple of the major franchises of that newspaper, which would have been politics and sports, have really been diminished or even eliminated. I'd have to say, just personally, I think it's all sad. But it's part of a larger piece here with what's happened to American newspapers overall, with a couple of notable exceptions. I mean, you look at the Los Angeles Times, you look at the Chicago Tribune, you look at the Atlanta Journal-Constitution. You've seen this happen again and again and again. And the playbook seems to be, okay, we're going to pull back from print, we're going to go online. But an inevitable part of that is cutting way back on the staff. And you don't want to see anybody lose their jobs. But when you're talking about staff for these newspapers, you're talking about reporters. And that has to be reflected in the quality of the reporting being done. And I at least don't yet see other institutions stepping up to have dedicated reporters, beat reporters on important subjects reporting for us. So I must say, for the Republic, and forget it as a journalist, as for the Republic, I worry about what it does for our democracy.
Well, yeah, think about the number of scandals that have not been uncovered since local newsrooms cleared out their court reporters and their police blotter reporters. David, we're living in a different world here, but I appreciate your weighing in on it. David Weston, the host of Bloomberg Wall Street Week, will be watching, as always, 6 p.m. Eastern Time after Balance of Power. David, have a great weekend, and thanks for bringing that conversation to us. Let's assemble our panel for their thoughts on this and more. Bloomberg Politics contributor Rick Davis is with us, partner at Stone Court Capital, Republican strategist alongside Megan Hayes. a former special assistant to President Biden, our Democratic strategist. Great to have both of you with us. Megan, what does this mean for the Capitol here? This is obviously our city's newspaper, but it's also a global news outlet, one, of course, that is owned by Jeff Bezos, who put a lot of money into the Melania film, and that's what we've been hearing is a lot of question marks about where the spending priorities are in this organization. Is this a disservice to journalism?
I think so. I mean, I think that taking away all of these newspapers' ability to report the news and to have actual stories for people to read is a real disservice. People that live across America don't understand or don't know what's going on because we're not getting the reporting out of Capitol Hill or the White House that we used to. I do think the spending piece is an interesting one and should probably be probed, but I think people saw this coming when Jeff Bezos took over for the newspaper.
How come?
I just think you see his priorities shifting. Yeah. He was with Pete Hegseth just a couple of days ago doing something with one of his other businesses. He's spent $75 million on a documentary for Melania. So I'm not sure that the Washington, and you saw it when they pulled back the endorsement for Kamala Harris last year. You saw his priority starting to shift here, and the newspaper's priority starting to shift.
Well, I don't know your thoughts on this, Rick. Obviously, the Washington Post has its own business matters, its own financial challenges. But you could suggest that we're missing a lot by not having an active newsroom. And I'll add that they pulled back on a number of metro positions as well. This is a time where journalism has been demonized by the administration, and I wonder if people feel the impact of this as consumers.
Yeah, I certainly am very concerned about it. I mean, and they're getting rid of their sports page. I mean, how many times do you look in the sports page to see your team's success or, read about its failures? Some of the great writers, Boswell and others, who covered Washington sports for decades became household names. Look, this has been happening for a long time. Local media outlets all over the country have been failing. You'd be hard-pressed to find a local paper, as you pointed out, either covering town hall or sports or any other activities in their communities. And frankly, what has replaced that is the rise of, single ideology, aggregator websites and things like that, you just really don't know where that news is coming from or what the point of view is. And so I'm less concerned about wealthy people buying newspapers. Wealthy people have always bought newspapers. I mean, the New York Times, the LA Times, Washington Post. I mean, all the great
Chicago Tribune
newspaper families were wealthy families. So what's the difference? Everyone always had a point of view. This isn't the first time we've seen newspapers with an ideology, but at least we had newspapers. Now, that ideology, is that killing the newspapers or what? So lots of change. I think it is a threat to the kind of communications and democracy that we have. So, let's do a big project to figure out how to communicate, how to report news, facts to the American people.
Boy, refreshing ideas from both Rick Davis and Megan Hayes. You guys both anyone get the hard copy Sunday paper anymore? Do you get the Sunday? No, nobody does. They just used to spread it out on the table, spend all morning. Things have changed a lot. Thanks to our great panel, Megan Hayes and Rick Davis. Coming up, we'll have much more here on Balance of Power, live from Washington on Bloomberg TV and radio as we turn our attention to some of the other top stories in town here and get ready for the Super Bowl. Derek Stevens from Circa, live from Vegas, is coming up next on Bloomberg.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. We are 18 points away from Dow 50,000, with the Dow, the S&P, NASDAQ all advancing. Home builder shares, however, declining. This after Trump administration officials were said to be exploring opening an antitrust investigation into home builders to tackle the country's housing affordability crisis. Our Nora Melinda will have a whole lot more on the home builder sell-off coming up in just a moment. Equity markets, though, surging. We are seeing a renewed wave of dip buying. S&P right now up 116. That is a gain of 1.7%. The Dow at 49,981 right now, up more than 1,070 points, up 2.2%. We've got NASDAQ up 436. The NASDAQ Composite Index up 1.9%. Our Mag 7 Index up 0.2%. Cannot ignore the Russell 2000 Index. That is surging now by 3.4%. The VIX with a 17 handle now, the 10-year 4.20%, the 2-year 3.48%. Gold up 3.8%, 49.63 the ounce. Silver is up 9.4%, 77.58 the ounce. West Texas Intermediate crude up 1.1%, 64.03. And Bitcoin, major story there, back above 70,000, 70,159, up now by just about 11%. Carlyle Group shares advancing after the alternative asset manager exceeded its goals for fee-related earnings and asset growth in 2025. It did post fourth quarter results that surpassed estimates, and Philip Morris International reported higher profit in the fourth quarter, helped by strong sales of smoke-free products. Recapping, S&P up 1.7% now, the Dow up 2.2%, the 10-year 4.20%, and Bitcoin at 70,120 up 11%. That's Joe Matthew. Lots going on. It's a Bloomberg Business Flash.
As always, Charlie, we do thank you. Charlie Pellet will have more on the markets coming up at the top of the hour, 2 p.m. Eastern, when Bloomberg Business Week Daily gets underway. We have a quick breaker here. Just noticing on Twitter, another retirement in the House of Representatives, a Republican retirement just announced by Mark Amadei of Nevada, writing, "Serving the people of Nevada has been the honor of my lifetime. Please see statement below." And there you have the announcement of the retirement. Thank you for the honor. Every achievement worth doing began with listening to Nevadans and fighting for our values, threatening the Republican margin evermore as we make our way into this midterm election cycle. Another fascinating turn as we consider the balance of power in the United States House. Incidentally, we're going to bring you to Nevada in just a moment when we talk to Derek Stevens, making his triumphant return here to Balance of Power on this Super Bowl weekend. We're going to get a good sense of what's going to be happening at Stadium Swim, Circa, and the rest of Fremont Street that he owns. But as Charlie mentioned, I just quickly want to delve into what's happening here in the markets with Nora Melinda. This downturn that we're seeing in home builders is pretty severe, and it's coming straight from the White House as a potential antitrust action is invoked by the administration. Nora, this is not playing well with most of the home builders today. What are you seeing in New York?
Yeah, Joe, not really playing well with the home builders. I'm looking at an index, S15 Home, that tracks a lot of the biggest U.S. publicly traded home builders in the United States. And we are seeing shares of that index. We're looking at it down just below flat. So we are seeing it pairing some of the deeper declines that we did see earlier in the session here. But really what the focus is right now for the Trump administration is on affordability. I mean, we know that's what's been on the mind of a lot of voters right now. So you're certainly seeing Trump coming in here, the administration more broadly, trying to crack down on the housing market and find a way to make it a bit more affordable. That's what they're really laying out here. We just had a couple days ago just talking about Trump homes. We've been talking about the 50-year mortgage that was floated not too long ago, but also just thinking about how he can really appeal to voters in this time period and the average consumer, given the fact that we do know that the housing market is really fractured right now. It's actually seeing the highest, most expensive homes in more than decades. But I mean, we do look at the mortgage rate, the 30-year fixed mortgage rate in the U.S. is now sitting around 6%. So not as high as it was before, but still very steep for those who are looking to purchase a new home.
Interesting. You know, it's really amazing when you look at this bounce back today, just broadly here, Nora. I mean, we've made up a lot of ground. In some cases, we've more than made up for the losses that were seen yesterday in stocks. In the broad market, the RSPs of the world, the equal weight S&P 500, sitting at new all-time highs today. It depends on what corner of the market you're looking at here, doesn't it?
Definitely. I mean, we are seeing a bit of a different story here. I mean, what I've really got my eyes on has been the tech space this entire week. I mean, we are seeing a rebound in software stocks because that's where our attention has been much of this week, because we were earlier seeing declines. I mean, we also saw Bitcoin, a brutal sell-off that we saw yesterday, but we are also seeing that the coin is reclaiming almost all of its losses that we did see. This, of course, this plunge was one of the worst that we've seen since Sam Bankman-Fried's collapse of FTX just about 3 years ago. So it's interesting to see the coin recouping its losses, but also just seeing a bit more broad, can we even call it optimism right now? The S&P 500 up about 1.7%, but you're certainly seeing a bit of a turn in the market as we head toward the close of the week.
Let's see if we can hang in there. Nora, thank you so much. Nora Melinda, live from New York. We'll have much more on the markets, as I mentioned, when Charlie Pellet gets back here in just about 15 minutes' time. It's Balance of Power in Washington, D.C., and I've been looking forward to this one as the president gets ready to jump on Air Force One to watch the Super Bowl at the big party in Mar-a-Lago. A lot of people are headed for Las Vegas. I feel bad that producer James isn't out there right now because he's the one who turned me on to Stadium Swim. And we wanted to spend some time, do something a little bit special here with the man Forbes called the last casino mogul to get a sense of what exactly we're in store for on Sunday from the gaming perspective, from the tourism perspective, and a man who knows more about both than most. Derek Stevens, the owner of Circa, Golden Gate, the D, and the other half of Fremont Street is with us right now, live from Las Vegas. Mr. Stevens, welcome back. It's great to see you. This is, well, I guess this is your Super Bowl, isn't it? I'm wondering how you qualify a success this weekend. What is a good result for Circa Sports on a Super Bowl Sunday?
Well, Joe, great to be back. And I think I'm very happy to be back on a day that the Dow's up 1,000, S&P's up, NASDAQ's up 400. I think I've been able to come on with you, and it's always been green. So that's a good start. That's the first part of being a success. As far as the success here in Las Vegas, it really comes down to how the tourism goes and will the city fill up again. I think most people realize that the very best place to go in America is Las Vegas for the Super Bowl. If you're not actually going to the game, there's nothing better than Las Vegas. A great place to go. The home of Super Bowl betting, and we should have I think set some records here this year on legal wagering.
Yeah, well, okay. With regard to that, the American Gaming Association put a number on it. They're estimating $1.76 billion wagered on the Super Bowl this year through legal sportsbook operators in the U.S. How much of that is going through sportsbooks like yours in Las Vegas?
Yeah, I mean, quite a bit. I mean, we just took, Circa Sports just took its first $1 million bet. I'm hoping to have a few more of those here before kickoff. I'm very much hopeful that we break a legal record. And that's in light of the fact that from the illegal side or in the prediction market side, they may do more than just even the legal bookmakers do in 2026.
Wow. Look, I was blown away by this. So you're allowing bets of up to $1 million, $1 million limit on sides to spread the total at the counter in Las Vegas. How many guys do you think show up this weekend and plunk down $1 million before the game?
Well, I'm hoping quite a few. We've had one so far. We hope to get a few more. So, yeah, that's our limit. That's our limit when you walk in at the counter. We'll move the number after that, and we hope to get a little buyback. But overall volume, sports betting volume has been pretty strong here leading up to the game. Now we're still more than 48 hours away, and you're going to get 90% of the action is going to come in the next 48 hours.
Oh, wow. So, you know, I'm looking at the Super Bowl ads, which is, you know, part of the fun for everybody here. And I see Fanatic Sportsbook is running its first ever Super Bowl commercial featuring Kendall Jenner, interestingly. You've got Colin Jost and Michael Che in the DraftKings spot that's going to be on. FanDuel's is going to have an ad-on prior to kickoff that I'm sure they're spending at least 8 figures on. What's your place in the gaming universe when you're surrounded by this crush of sports gaming mobile apps? I haven't even mentioned Kalshi and the prediction markets yet. Where does a sports book like you exist?
Well, I think we all have our own niche areas. I mean, we're known for taking large bets. Circus Sports is known for really celebrating some of the bigger players. Our average bet with Circus Sports in the 6 states that we're up in is far higher than others. But that has a lot to do with the way we book. We run a low hold model, and we think that's something that has a spot within the sports betting ecosystem.
Interesting. You've, of course, got a lot of different properties, though, with different kinds of demographics and different clientele. I guess I'm wondering if you see these services, DraftKings, FanDuel, whatever, as competition, or if all wagering is good for business. And should these prediction markets be allowed to do sports?
Well, let me answer the first part of your question. Yeah. I love the fact that Fanatics has a Super Bowl commercial. I'm a big supporter of DraftKings and FanDuel on their legal side of their operation. And I think that's good because I think that legalized sports betting, it's good for leagues, it's good for players, it's good for players' unions, it's good for states, and it's good for problem gaming issues. So I'm a big supporter of any of the legal operators and what they can bring. It's also great for fans because there's greater engagement, so therefore it's great for media. I'm 100% supportive of the legal sports betting. Prediction markets, no, that's a whole nother story here. I mean, these guys are doing an end around. They're very shrewd, no question about it. But they're not paying any state income tax. They're not paying anything into problem gambling. They're not paying a federal excise tax. I realize there's a little bit of a surge of, let's support prediction markets, but I don't think that's necessarily the right long-term path here. We think about it this way. If someone hijacked a truck that had nothing but big screen televisions and brought that truck into the parking lot of a Best Buy and was able to sell these TVs at half price, would we really be supporting these marauders the way it seems like it is? I don't think so. I think this is short-lived. And I think prediction markets have a great spot in America, in our economy, in our ecosystem. But what they're doing with sports betting, it's a little bit crazy with the amount of taxes that we pay and the amount of regulatory environment that we're in.
Marauders, says Derek Stevens. This is fascinating. Not to mention the taxes that the players are paying. We talked about the Fair Bet Act last time you were here, Derek. This still has yet to see the light of day. I know Dina Titus has been working hard on this to essentially restore the 100% deduction for gambling losses against winnings. What are you hearing about this?
Yeah, I know. Dina's still working on it. The Fair Bet Act is something we still need to get done. We tried to get it done before the end of the year. Dina tried to get it done here at the end of February. We're at the end of January. It's still a top priority. And here's the thing: it's not political. It's just not political. This is something that both sides of the aisle want to do. I'm still very confident that this is going to get rectified. Unfortunately, it hasn't been rectified yet. So I'm hopeful that this gets completed. But, on the tax element, what's amazing to me? I want to go back to this prediction market thing for a second. The state of New York collected $1.1 billion of sports betting taxes. The state of Illinois, $400 million of sports betting taxes. And in prediction markets, those go to zero. I'm a little surprised that the states aren't getting more aggressive. Now I realize we're still early on in this, but I do think the legal sports betting operators provide a lot of benefit to the sports betting ecosystem. And I just think the amount of taxes being avoided by the prediction markets, it's short-lived.
Well, it's really interesting to hear you weigh in on this ahead of this weekend of all weekends. I've only got a minute left. Derek, a lot of the chatter in the media has been tied to a tourism slowdown at the big resort casinos on the Strip. Are you seeing that on Fremont Street, or are people finding a good time to be more affordable at your properties?
I think we've all talked a lot about this K-shaped economy. All tourism destinations in the country, New York, Miami, Las Vegas, Honolulu, is down from international tourism. But overall, Las Vegas is doing all right. I mean, Las Vegas set an all-time record. Gaming revenue set an all-time record at $15.8 billion last year. So it's still pretty strong. The unfortunate thing is it's at the lower end where I think we're starting to feel it a little bit. But yet 2026, all the predictions look very, very solid for Las Vegas tourism.
Fascinating. Leave it to the president CEO of Circa to weigh in on affordability, on the stock market, of course, gambling, and the K-shaped economy. You got to come back for our next Fed special, Derek. It's great to see you. I wish you a lot of success this weekend and all the people who are playing out there. Derek Stevens, Circa, live from Las Vegas, only here on Balance of Power on Bloomberg TV and radio.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And we are up on this Friday. Welcome, everybody, to Bloomberg Business Week Daily. It is Friday, February 6, 2026, and what a week it has been. We're not quite done yet. Today, investors are back. The S&P headed toward its best day since November. Small caps on fire, and Bitcoin, a little bit of a bounce back.
Yeah, up 10% right now, 69,720 is what we're seeing.
I guess everything's okay now?
Everything is awesome. What could go wrong?
Yeah.
Actually, we're going to talk about all of this.
Not everything is higher.
No, because tech stocks, you look at the NASDAQ 100 higher. Amazon, Alphabet, Meta, you and I were talking about this. You look at the Mag 7. These guys are not doing well. They have been selling off, so we're going to get into that. Also selling off, home builders on a possible action by the White House. More on this Bloomberg exclusive and the trade in just a moment.
Our mega cap earnings season roundup. And now look, we got Mark Mahaney stopping by, Senior Managing Director and Head of Internet Research over at Evercore ISI. He's going to be joining us in just a few minutes.
All right, looking forward to that. Looking forward as well to Greg Dacko back with us at EY on how those 3 AI pillars are doing amid the AI spend and impact worries. We're also going to talk, this was supposed to be a Friday jobs report. We'll get that on Wednesday because of the brief government shutdown. So we'll see what he has to say about the labor market as well.
And finally, view from the C-suite. Greg Hart, the CEO of Coursera, is going to be joining us a little later this hour,
Are we a little tired?
I'm good. I'm good.
It's been a week, everybody.
Yeah, I'll talk to you at the end of the program today. We'll see.
Exactly. We'll see how we'll go. Hey, do not go anywhere. Great 60 minutes coming your way in just a moment. Right now, though, a check on the trading session with Charlie Pellet.
Hi, thank you very much. Here's what's going on. Stocks definitely rebounding. What a different tone to this market compared to this time yesterday. Get out those Dow 50K hats because we got the Dow Jones Industrial Average, 49,946 right now, looking at an advance of more than 1,000 points, up 1040 right now. That is a gain of 2.1%. S&P 500 index up 113, 6912 where we stand there, up 1.7%. NASDAQ up 420. Up 1.9%. Our Mag 7 index, little change right now, up under 0.1%. Small cap surging. The Russell 2000 index of small cap names up 3.3%. The VIX, 18 even. 10-year, 4.20%, with the 2-year, 3.49%. Gold up 183, up 3.8%. Silver up 9%, 77.30 the ounce on silver. West Texas Intermediate crude up 1%, 63.89. And Bitcoin, major story there in terms of the rebound, was back at 70,000 right now, 69,915 on Bitcoin, up by 10.8%. Techs, however, many techs selling off. We'll talk about that on Bloomberg Business Week Daily. We got Amazon down now by 6.2%. Shares dropping after the company announced plans last night to spend $200 billion this year on data centers, chips, and other equipment. So Amazon down 6.2%. Alphabet down 1.8%. Microsoft up 1%. Meta Platforms among companies with big capex spending up now by 1.6%. Again, recapping, S&P up 1.7%. Bitcoin up 10.9%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, shares of U.S. home builders taking a hit earlier in today's session at their low today, intraday low, down about 1.4%. They've moved off that level, just slightly lower as we speak. In a Bloomberg exclusive, the Trump administration officials are exploring opening an antitrust investigation into U.S. home builders as the White House sharpens its focus on tackling the country's housing affordability crisis. This story definitely caught our attention.
Yeah, with us is Bloomberg News real estate reporter Pat Clark. He joins us here in the Bloomberg Business Week studio. Congratulations on another exclusive when it comes to the White House and housing affordability just this week. What can you tell us? What are these possible antitrust concerns?
Well, the thing that, one thing that's caught the eye of administration officials is a trade group and their concern that, our home builders coordinating through the trade group. And that's a thing that's been raised, at least internally. I think that's a common concern about trade groups across industries.
Coordinating how?
Well, you're not supposed to talk about
anything.
We're going to set our prices in this way, and right, you're not supposed to tell your competitors how you're setting prices, and I think it's a concern that can come up, which is like you have this trade group where everyone is getting together and talking to each other, or they're talking to some centralized person in the trade group, and information gets disseminated, and this would not be, I'm not an antitrust expert, but my understanding is that this would not be the first time that, there was a probe of, a trade group or some centralized body.
The leading builders of America is the trade group. What have they said? What have the home builders come out and said after this?
They haven't responded. They're keeping their heads down right now. or so it seems. I think, all this goes back to October when the president put out on a social media post that home builders are, he likened them to OPEC and complained that builders are sitting on more lots than ever. And, I think this is, if you go back to the story earlier this week about the builders' pitch for a Trump Homes project, in a way, that's like trying to get on the administration's good side in hopes that, they're not on the bad side. And this is kind of what the bad side might look like.
Just last question. Kudos to you. Two exclusives in terms of what the White House is working on housing affordability. Having said that, they are said to be trying to do anything. Is there any progress, any really move forward in terms of being able to make homes more affordable? Some would say there are different issues at play in order making this work, but in terms of what the White House might be able to do.
Listen, I think this is where we are on home prices. It took 15 years to get to this point. It took a pandemic, to get there in the end of an interest rate environment that had been in place for a decade or so. So, I don't think the standard should be getting to, a solution overnight. But
yeah,
it's in those. Something is going to, people are talking about things. What happens? I don't know.
Is it really a priority for the White House? Just quickly.
Seems like it.
Okay, good stuff. Pat Clark, thank you so much. Busy week or so for him, real estate reporter at Bloomberg News here in our studio. Tim, we're going to stay on the domestic economic state because we did get some data earlier today.
Yeah, that data showed that U.S. consumer sentiment unexpectedly improved to the highest in 6 months, largely propelled by wealthier Americans who benefited from stock market gains. Digging into the U.S. economic backdrop, Federal Reserve Bank of Atlanta President Raphael Bostic reiterated it's important to keep interest rates at a level that restricts economic activity and returns inflation to 2%. He spoke about that and more in an exclusive interview with Bloomberg TV and Radio's international economics and policy correspondent Michael McKee. That was earlier in Atlanta.
In terms of inflation, what I've learned is that we really don't want to have inflation. Right? Once inflation gets entrenched in people's minds, it changes how the economy evolves. And it's one of the reasons why I think that we need to keep our policy in a restrictive posture so that we get inflation back to 2%. That's paramount. High prices and the prospect of rising prices really do have a lot of families on the edge. And you all have reported a lot about the K-shaped economy. There are lots of families that are feeling very precarious right now, and that's a source of concern.
Do you think the economy is becoming more K-shaped?
I don't know more. It's been that way for a while. Just before the pandemic, I had been talking about this, and we were trying to find some metrics to really detail how there's a split. I used to call it the barbell economy, where either you're at the high end or at the low end. The K-shape is the same thing. What I know is that there are a lot of families that are precarious and are feeling very uncertain about their prospects for the future and the prospects for their children, for that matter. And that concern, I think, does underlie a bit of the lower and the low consumer confidence that we continue to see being reported. And what we'll need to do is really give people reasons to be optimistic, show them where the new jobs are coming from, and show them how they get the skills to compete for it.
Well, this week, Treasury Secretary Bessent said the Fed has lost the confidence of the American people. Do you think you have lost the confidence of the American people? In your district, do you hear people raising questions about that?
That's not been my experience. As I go around the 6th District, people tell me, we're grateful for what you're doing. You have a very hard job, and we want you to be as data dependent and as open to information so you can make the best judgment that you can. Look, the world is very complicated. It's actually more complicated today than it has been my whole time here. So what I think most people understand that, and they know that we're doing the best job that we can under very difficult circumstances.
All right, that, of course, is Fed Bank of Atlanta President Raphael Bostic in an exclusive interview with Bloomberg TV and Radio's own Michael McKee earlier from Atlanta. Here to get into the economic macro situation, if you will, what faces the Fed and so much more. Some of the things we just talked about, and great to really have back with us. And it's not a Jobs Friday, which I have to keep reminding everybody, which kind of blows my mind. Gregory Daco, he is chief economist at EY. He is here in studio. Welcome back.
Pleasure to be here.
There's so much right even there, housing affordability, and then kind of the bigger, broader of what the White House does to help the U.S. economy and more Americans. There's Raphael Bostic talking about Fed confidence, 2% inflation, important to make sure that we have inflation under control. What's important, and a Jobs Friday, where it isn't a Jobs Friday, but we'll get that read. When you think about the U.S. economy, what is front and center for you?
Well, I think it's the paradox of having strong growth, but underlying weakness across different sectors and across different stratas of the economy. I don't really like the K-shaped format because it tends to signify that there are two groups of consumers, there are two groups of businesses. The reality is that there is polarization across the U.S. economy. Whether you're looking at certain income groups, not just the lowest income groups, but the median income groups, they are increasingly struggling with high prices. When you look at business investment, there is polarization between those that are focused on AI investment and those that are not. There is polarization between large businesses and small businesses that are struggling more in the face of some of these policy headwinds. So it's not necessarily a K-shaped economy as much as it is a polarized economy within which you're still seeing strong averages. Average consumer spending still doing well. Average business investment still doing well. Average GDP still doing well.
What's that masking, though?
I think
taking the average is just that. It's the average.
It's
there are
masking,
outliers.
yeah.
And so what's it masking?
It's masking an underlying fragility in the fact that you have these narrow pillars of growth that I've talked about in the past. And I think if you bring it back to income, which is really the fundamental pillar of economic activity, that is where there is pressure. The income growth for consumers is relatively low. We're talking about 1% growth for real disposable income growth, while consumer spending growth is at 2.5%. That explains why the personal saving rate has fallen 2 percentage points since April and the early implementation.
There's nothing left to spend, to save, rather.
People are dipping into their savings.
Yeah.
They're using credit. And that's why I'm a little bit more cautious than others when it comes to this notion that there will be a lot of fiscal stimulus during the tax refund season. Yes, tax refunds may be higher, but what is this money going to be used for? Is it going to be used for spending or reimbursing some of the credit and replenishing savings?
Listen, we've talked with you too about the wealthier consumer, and you get into the A pillars or the 3 A pillars. We had consumer sentiment come out today, improved to the highest in 6 months, largely propelled by wealthier Americans who have benefited from stock market gains. So, yay, good. We know the wealthier consumer is very important to the U.S. economy. But I am curious what was going through your mind this week. We were kind of talking about it amongst ourselves with the AI trade a little bit in question and some nervousness around that. We saw that play out. That has been important to stock market wealth, especially among the affluent. So I'm just curious, should we be a little worried that this could come undone this year?
We should be very careful about the potential of an AI bust. This is a real downside risk, and it's interconnected with other potential risks to the U.S. economy. We're seeing a great degree of focus on the fiscal situation. We're seeing a great degree of focus on pressures on the Fed. Why do these matter? Because they can suddenly lead to changes in financial asset prices. And we know how the financial market has been behaving over the course of the past 18 months. A lot of gains on the equity front, but also a lot of movements across different asset denominations, a lot of movements into gold when things are not going well, not so much treasuries and not so much the US dollar. So these are important developments, and everything happens together. And so if we are to see a little bit more of a downbeat sentiment in terms of the prospects for AI, and importantly, the return on investment, then that could metastasize into something that is worse for higher wealth individuals and their spending desires and spending capability if you see a negative hit on financial markets. It could lead to some businesses pulling back on AI investment. We saw just today the 4 largest hyperscalers are promising to invest a lot in the U.S. What if that does not materialize? Is there a downside risk there?
Yeah, Amazon just saying yesterday $200 billion and $60 billion more than analysts thought they would spend in 2026. So when you say we have to be careful about an AI bust, how does that manifest? What exactly does that look like? Because as Carol was referring to, it's been kind of a complicated week when it comes to really just tracking what these companies have done or or the stocks at least have done, because there's this concern about a SaaS apocalypse with the software as a service companies as a result of what Anthropic's Claude was shown to do this week, and then there's also the concern about some of the hyperscalers and spending. So when you say AI bust, what does that look like?
Well, I think we're seeing a lot of pragmatism right now. We're seeing this notion of economics of necessity. What is necessary to drive growth? Where are going to be the next avenues of growth? And I think not many people know, and very few actually know what the situation will be in a year's time, 2 years' time, when it comes to which sectors will be leading the way. We're in the midst of a technological revolution. There are always going to be excesses in terms of upside risks that are taken and downside risks that
So
are
we're
taken.
definitely in the midst of this.
We are in the midst of an AI technological revolution.
And it's interesting because Amazon CEO Andy Jassy told investors he's confident the company is going to see a return on its massive investments in artificial intelligence. Listen, these guys have fiduciary responsibilities, right, when they make these spends. So I guess to some extent, you've got to trust that whatever he's seeing, he feels comfortable enough to say that, right, and doesn't want to put his company or his share price or any of this at risk. But again, people will also say, well, these people are talking their books. I mean, like, this is a big thing for them. So it's a hard thing to kind of weave through to figure out what's really going on.
You know, when I say narrow foundation to growth, one thing that I find really amazing is that the announced investment in CapEx from these 4 largest hyperscalers is worth about $250 billion. Assuming that materializes over the course of 2026, and assuming only a fourth leads to stronger economic activity domestically, so that 3/4 are imported, not necessarily counted in GDP, that would lead to a lift of GDP of 0.2%. That's a significant boost from 4 companies, right? So that is where the narrow foundation to growth is lying. You're seeing a lot of growth that is reliant on a few actors in the economy, wealthier individuals and larger firms. And smaller businesses and lower income families are increasingly struggling. And where I start to worry a little bit is that we're seeing this bifurcation between the prospects for strong productivity growth, but not necessarily the accompanying income growth that usually accompanies a strong productivity cycle, and that's because of this polarized economy.
That's a great point. Like, if we're more productive, where's the income to go?
Usually that's the story. You get more productivity and more real wage growth. You're not seeing that right now.
Hey, just in the last 40 seconds we have with you, on any normal Friday at this time, we'd be talking about the labor
How many
report,
jobs?
right? Yeah. Well, what does your analysis tell you about the health of the labor market right now?
And just have about 30 seconds.
It's in balance, but it's a fragile balance because we've seen a historical negative shock to labor supply from reduced immigration. So we have a break-even rate that's close to zero, but we are seeing labor demand being hesitant. Business leaders that we speak to are very hesitant as to who they hire, what skills they hire for, and at what salaries. And that is downward pressure on income, which in turn will feed into softer consumer spending going into the rest of the year.
Slow to hire, slow to fire. Is that what they say, or what is it? What's the expression?
Yes, low hire, low fire.
Oh, low hire. Yeah. Greg Dacko, thank you so much.
Always a pleasure. Thank you.
Our pleasure as well. Chief economist at EY. Coming up next, we've been talking about the big tech spend as the AI race intensifies. Problem or potential and possible payoff, or winner takes all. We have so many questions. We're going to put those questions to Mark Mahaney over at Evercore ISI. Do not go anywhere. This is Bloomberg.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. I'm on 50K watch. We are just 10 points away from Dow 50,000. The Dow, the S&P, NASDAQ, all surging. S&P 500 index up 113 right now at 69.11. That's a gain of 1.7%. The Dow, though, up 2.2%, up 1,084 points. As I speak, 7 points away right now, 49,993 on the Dow Jones Industrial Average. We've got NASDAQ up 407 now. NASDAQ Composite up 1.8%. NASDAQ 100 index, full of those big tech names that we'll be talking about in a moment, up by 1.8%. But interestingly, though, the Russell 2000 index of small cap shares, it is the outperformer today. Right now, we have got 50K, by the way, 50,000 on the Dow Jones Industrial Average. Big round number, yes, 50,002 right now on the Dow. We've got the Russell 2000 up 3.3%, the 10-year 4.20%, spot gold up 180, up 3.8%. We've got silver up 9.2%, Bitcoin up 11% at 70,048 on Bitcoin. The big story, though, Dow 50K right now, happening as I speak. Dow Jones Industrial Average at 50,004. First time ever, a record. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, super appreciate that. As Charlie mentioned, the Dow hitting the 50,000 mark for the first time ever. It's up about 2.25%. It's not an index that we often kind of focus on, but nonetheless kind of remarkable where we are today. 1.7% higher, as Charlie mentioned, on the S&P 500. And the NASDAQ 100, Tim, up about 1.9%.
Yeah, I mean, and the reason we don't talk about it much, it's a price-weighted index of individual stocks, so the biggest movers aren't necessarily the biggest companies. That said, Caterpillar, Goldman Sachs, JP Morgan Chase, Amgen, and NVIDIA are all pulling the Dow higher today.
Which is kind of interesting, right?
Yeah, three lower in it, Amazon, Verizon, and Visa.
Well, I just want to bring up the Mag 7 because we've been talking about that too, and we have seen that index where some of the usual gainers, especially when the tech trade is higher, but you've got Amazon, nope, not participating in this rally. Amazon is down about 7%, Alphabet down about 2%, Meta's down about 1.4%. They were down a lot earlier in this session. Hey, one of the things we wanted to get to was one of the most read stories on the Bloomberg today. Four of the biggest U.S. tech companies together have forecast capital expenditures that will reach about $650 billion this year, which is really kind of a mind-boggling tide of cash earmarked for new data centers and all of the gear that is housed within them. That is the spending plan by Alphabet, Amazon, Meta, and Microsoft, all in pursuit of dominance in the still nascent market for AI tools is a boom without a parallel this century. No doubt about it, Tim.
Yeah, it's a lot. Okay, it's a lot. Look, we're talking about Alphabet, Amazon, Meta Platforms, and Microsoft. Each of these companies' estimates for this year are expected either near or to surpass their budgets for any of the past 3 years combined. The investors over the past 2 weeks have reacted to the news differently when it comes to earnings and quarterly updates from these companies. We got a great voice joining us, Carol, who studied these companies for a very long time.
Curious to see what he has to say. Mark Mahaney is with us, Senior Managing Director and Head of Internet Research at Evercore ISI, author of Nothing But Net, 10 Timeless Stock Picking Lessons from one of Wall Street's top tech analysts. He joins us from San Francisco. By the way, he's got an outperform on actually Alphabet, Meta, and Amazon, all of them. Mark, how are you? Good to have you back.
Good to see you, Carol.
Hey, one thing I got to ask you before we get into the individual companies, something like 50,000 on the Dow, does it mean anything to you when you think about the overall market trade?
I'm sorry, I was surprised by that number too. I didn't realize that's where we were. So
that says a lot.
I guess if I'm honest about it, no.
Fair enough, which is what we want. We love the honesty. Hey, let's get to what has been a trade. Depending on the company reporting, the AI spend and AI trade, some have been punished, some have been not. Any logic to it in your view?
Yeah, I think so. We're going through a free cash flow desert. So there's no question that the level of investments is higher than we all thought, a month ago at the beginning of the year, and certainly a lot higher than we thought a year ago. Nobody that I know of, and I didn't forecast this amount of CapEx spend by the by the major hyperscalers, the four companies you mentioned earlier: Amazon, Meta, Google, and Microsoft. So I understand the market's hesitation, and what it means is that free cash flow is going to be tested, and Amazon's going to have negative free cash flow this year, first time since 2022. I think Google's going to be positive cash flow. I think Meta is, but these huge amounts of CapEx spend are challenging that free cash flow generation, and investors are right to be concerned. What investors should also, though, focus on is what are they seeing in terms of ROAI? Like, what kind of returns are we getting? So, Google is ramping up its CapEx by $90 billion. That's actually the biggest dollar increase. But what they gave you this last quarter was an acceleration in search growth, was the fastest that they've had in 4 years. What they also gave you was almost 50% growth in cloud revenue and 150% growth in cloud backlog. That is all generated, or in large part generated, by AI. So there's an example here of a return. And by the way, Google had record high operating margins in the last quarter. Amazon just gave you 24% cloud revenue growth, AWS revenue growth, fastest in 4 years, also with very consistent margins, and the backlog jumped by more than they've ever had in a single quarter, something like 40 billion. So I'd argue that there is an ROAI on these for these companies. I can make the same point about Meta, and I think investors just need to be able to work through this free cash flow trough year. If I'm right that it's the trough year and you're going to have accelerating growth that'll take you into 27, I think that sets up these stocks, given their current valuations, very well.
So Amazon right now is down just about 7% as we speak. You've got an outperform rating on the company, $285 price target. Andy Jassy said yesterday that the money would predominantly go to the company's AWS. Most of it would be for AI workloads. He said, quote, "I think this is an extraordinarily unusual opportunity to forever change the size of AWS and Amazon as a whole. We see this as an unusual opportunity, and we're going to invest aggressively to be the leader." Is he right?
Well, he's right that they're investing aggressively. He's right also that almost certainly this is a huge opportunity. I mean, the market certainly thinks so. We wouldn't be going through SaaSmageddon or whatever, this sell-off in software stocks. Yeah, SaaSpocalypse. We wouldn't be going through that if the market didn't think that some of the innovations they're seeing out of OpenAI and Anthropic weren't potentially dramatically negative for these names. Now, the market may be overreacting, but the market is reacting. And then I just, ask you all to step back a little bit here. Have we seen material improvements in the products and the services that we use because of Gen AI? And I think if we're honest about it, the answer is yes. You know how much search has improved, like as a product, as an experience, how much better it is. The things you can do now, this is like your Google moment of 15 years ago. Like, what was life like before Google? It's kind of hard to remember. I think we're going to have that same moment. Like, what was life like before generative AI? When you can, and we're still scratching the surface. Like, we still haven't had the task. We haven't circled to the task like great, you give me all this information about a Hawaiian vacation package, but then put it all together and book it for me too. Like, make that. And then I really want a personal digital assistant. I think we're all going to have one, in 3 to 5 years. By the way, Gemini personal intelligence has sort of become that for me already in a pretty short period of time. And the ability for this to improve people's productivities, their lifestyles, if you will. I just think that these are their ability to educate themselves, train themselves, learn new skills. I think it's extraordinary what we're seeing. And so, yeah, I believe in the cycle. I'm sure there's going to be overbuilding during it, but I believe in this cycle. And I think there's a couple of companies that are really going to come out financially much better because of it. And I think these are 3 or 4 of the companies that can do it.
That's where I wanted to go, because reading in, this kind of winner takes all or winner takes most kind of view out there, and that's why these guys are all doing a mega capex spend. Meta, Microsoft, Amazon, and Alphabet. Are they right about that? And I do wonder, like, will there be one leader, or is it going to be enough that all 4 of these, Mark, are companies we will continue to talk about 5 years from now, 3 years from now, 10 years from now?
That's a tough question, Carol. I think we'll be talking about them. The question is whether they're going to be materially, larger from here or not. The advantage that they have is that they already begin with these massive bases of users and businesses and applications. And so you're taking productivity enhancements, dramatic improvements to, massive retail, advertising platforms, entertainment platforms, and my guess is that these large platforms are going to be a lot better. They're going to be more efficient. They're going to have higher margins. They're going to have higher revenue bases than we would have thought 3 years ago. Yeah, the CapEx in 2026, the investments are greater than we would have thought 2 years ago. If we're honest with ourselves, the revenue bases are also bigger than we thought, and the profit pools, not free cash flow yet, but I think that's going to snap back next year. Profit pools are going to be bigger than we would have thought 2 or 3 years ago.
Mark, we've talked about, where you're optimistic and some of the winners, but where are you not optimistic when it comes to this spend? Who ends up losing as a result of this CapEx spend and of this investment?
Well, companies that aren't able to make this shift. The one set of companies I've wondered about are the travel companies. This is an information-intensive transaction. I think it lends itself to an agentic solution. I think the average person, would have spent 3 hours planning an annual summer family vacation. I'll think about all the things that go into that decision, and then the booking, and then the checking out alternatives and flights and blah, blah, blah. And I think this is a wonderful, opportunity for agentic solutions to really sharpen that, to make the whole planning, booking process a lot better. Booking.com, Expedia, and Airbnb better be effectively and successfully investing in agentic travel and having their own agentic agents on their sites. Because if they don't, then those are companies that I think are going to could be dramatically smaller 3 to 5 years.
And you do cover those. You do cover those three companies too. So you know what are they? Do you think they're doing a good job as of now?
I think so, but I haven't seen the proof yet. By the way, nobody's really put together a great agentic travel experience yet. It's TBD. Yeah. You can use ChatGPT and Gemini, but you come up with great for travel planning, but you can't then you still got to go somewhere to do the booking. Somebody's going to put all that together. I just don't know who's going to do that first, but I think there's a decent chance that Expedia and Booking will do it. But then I step back and think about valuations across these names, and if you're telling me that I'm going to get Expedia at 15 times earnings, Booking at 17 times earnings, Amazon and Meta at 20 times earnings, hey, I'm in. I think those are very reasonable multiples. In fact, I think they're pretty dislocated. So, I think a lot of the fear is already in these stocks.
I was just looking at Expedia. It's down about 17% year to date, and you've got Booking down about 18%. I'm not saying that there's a clear connection, but just putting that out there. Yeah. Hey, Mark, just got 30 seconds. As we go through this, there's going to be stops and starts, right? Because we are very early in when it comes to this AI spend and build out.
Yeah, you're right. Yeah, we are still. We don't. Agentic commerce. There's some interesting examples. I love what I'm seeing out of Amazon with Rufus, but I want to see more Rufuses out there. And Rufus can still improve materially. So I think we're still early, but I want to see people closing the loop. In terms of the information and the transaction. You want agentic task agents. There are not enough of those yet.
It's funny. All I can think about is how many people over the last couple of years are like, you got to diversify away from these big, Mag 7 companies. Yet, as you lay it out, Mark, it sounds like they're going to be just even more entrenched in more companies and more tasks that we do at work, at home, and at play. Mark Mahaney, you rock. Have a great weekend.
You too, Kara.
Mark is Senior Managing Director, Head of Internet Research at Evercore ISI. Coming up next, the CEO of Coursera.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg, and on a day when the Dow Jones Industrial Average crosses 50,000 for the first time ever, we begin with a report that the U.S. Department of Justice is probing Netflix's business practices. Now, this is according to the Wall Street Journal. The Journal says the DOJ is probing if Netflix used anti-competitive tactics. Right now, we do have Netflix shares up by about 0.8%. Warner Brothers Discovery up 1.7%. Paramount Skydance up by 1.1%. Again, these headlines, developing story appearing right now on the Bloomberg. We'll have more details as they become available. The big stock story, 50K. We told you about it on the upside. Right now, we're under 50K at 49,983 on the Dow, up 1,070 points. That is a gain now of 2.2%. We got the S&P rebounding from yesterday's carnage, up 115 points at 69.13 on the S&P, gain there of 1.7%. NASDAQ up 1.9%. The NASDAQ 100 index up 1.8%. And our Mag 7 index up 0.2%. Cannot ignore the Russell 2000 index of small cap shares up right now by 3.4%. The VIX just above 18 with a 10-year 4.20%. The 2-year 3.49%. Gold up 3.6% now at $49.50 the ounce. West Texas Intermediate crude up 0.2%, $63.45 a barrel, and Bitcoin 70,200. Bitcoin surging right now by 11.3%. ExxonMobil and Chevron are expanding production in nations tied to OPEC, including some of the world's riskiest geopolitical hotspots, with help from President Trump's assertive foreign policy. ExxonMobil today on the day when stocks are ripping higher. This Dow member up by 2.3%. We've got Chevron up now by 0.9%. Again, right now, Dow Industrials 49,983. Bitcoin up 11%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks for that update, Charlie. Charlie mentioned it, but just want to reiterate a red headline crossing the Bloomberg terminal. The Department of Justice probing Netflix tactics amid the Warner Brothers Discovery deal investigation. This, according to the Wall Street Journal. The Justice Department investigating whether Netflix engaged in anti-competitive tactics. It's probing the streaming network's proposed acquisition of Warner Discovery Studios and HBO Max streaming service. The department looking at whether Netflix's planned Warner deal could enrich or entrench its market power or lead to monopoly in the future. It's also reviewing Paramount's proposed acquisition.
Yeah, stock off its earlier highs. It just still up, though, about 0.5% here in the Friday trade. Hey, we want to get to Coursera. Company did report earnings last night. Forecast revenue for 2026 with the guidance beating the average analyst estimate. Stock has swung quite a bit today, up about 7% at its highs, off more than 4% at its lows. KeyBank and RBC both lowering their price targets on the stock today. And we just mentioned about this Warner Brothers Discovery, waiting to get this deal done. There is also an M&A story to Coursera as well. It is about a $1 billion market cap company, online education company. It is down about 19% year to date. 12%, Tim, of the float is short.
I want to bring in Greg Hart, President and CEO of Coursera. Greg joins us from San Francisco. Greg, I want to start with the merger. Carol mentioned it in December, an all-stock merger between Coursera and Udemy. What is the status of that right now? We understand it's going to close in the second part of the year. The integration, how does it go? What does it mean in terms of the customer and user experience? And who's the boss?
Thank you, Tim, for the question. So we are going through the regulatory approval process right now. Nothing to share on that front, but we're moving through the paces, and then we'll, hope to move through that and then go through shareholder approval. In terms of who's the boss, first of all, the customer is always the boss. In terms of the actual governance of the company, I will be the CEO of the combined company, and we are excited about that combination because of the opportunity to bring together, two businesses that are really quite complementary. Udemy, the companies are roughly the same size in revenue, so the combined revenue of the companies would be about $1.5 billion for 2025, with about 10% adjusted EBITDA margins pre-synergies. We also announced at signing that we would deliver $115 million of synergies post-close. within the first 2 years. And so a nice improvement in the operating margin that we have as a combined company. We are focused as we go through the planning process on exactly what that integrated company and platform will look like. So how do we think about pricing and packaging and promotions? Of course, how do we think about the leadership team? And then how do we bring the companies together to really drive not only, better margins through the synergies, but also really over time drive much higher revenue growth and do a better job of addressing the massive market opportunity in front of the companies.
Greg, there have been many examples of mergers that have been announced that haven't actually gone through for a whole multitude of reasons. Some of them have been regulatory, some of them have involved other factors. What happens if this doesn't go through?
Well, I'm very glad it will. I mean, we operate in the education, so K through 12, universities, vocational schools. It encompasses the online sector that we happen to be a part of, and Udemy also is a part of. And then, of course, it encompasses all the other ways that people learn today. And increasingly, that is through things like LLMs or YouTube or TikTok. We believe we have a very differentiated offering, but we are a very, very small player within that massive space. And we believe that the combination actually delivers more value to every one of our constituents. To our learners, they'll get access to more content, not only the 375 different university and industry partners that Coursera has, but the 85,000 plus subject matter experts that Udemy's content creator community has. And so it'll bring more choice, more learning opportunity. It'll be better for our content creators because they'll have access to a worldwide learner audience that's approaching 300 million registered learners across the two companies. And it's better for our enterprise customers because we're able to deliver them the breadth of that content coming from that content creator network across Udemy and Coursera.
Hey, listen, one of the things, well, first of all, I have to just follow up on the deal, the combination with you and Udemy. Is it still, though, you said you're pretty confident about regulatory, Greg, so maybe still on track to close this deal in the second part of 2026?
Yes, we've heard nothing that would, change our belief that it will close, by the second half of 2026 and remain confident in getting all the regulatory approvals we need to do so.
One of the things I thought is interesting, I always think about your business. You mentioned university, industry partners, you've got these subject experts. How are people most using it? Is it your corporate partnerships where people want retraining for their employees? Is it people on their own? Is it people who are just interested about different topics? Like, tell us where the growth is. Is it all of it or certain parts of it?
Fantastic question, Carl. So our business as Coursera, an independent company, we are 2/3 consumer, 1/3 enterprise from a revenue perspective. Udemy is the inverse. They are 2/3 enterprise, 1/3 consumer. For both companies, there is a huge focus on and growth in technology, and specifically AI right now. And so for Coursera, last year, we saw enrollments in Gen AI related content at a rate of 15 enrollments per minute. Wow. In 2024, that was only 8 enrollments per minute. And so a real burgeoning interest that I believe will continue in 2026 as well. And we are really focused on delivering not just learning, but delivering skills so that people can advance their careers. 86% of the learners who come to Coursera come here to advance their careers. And so we are very focused on delivering them skills that they can use to advance their careers and that they can demonstrate, real mastery of as they are in the workforce.
Hey, Greg, really quickly, 30 seconds. Are people in it, train, and then that's it? You don't see them again? Or how much of it is return business that the platform is sticking there, constantly coming back to learn more? And forgive me, only about 25 seconds.
Well, more than 50% of our consumer revenue is around Coursera Plus, which is our monthly or annual subscription. It's the best value for learners because they get access to all of that content. And those learners tend to stay, obviously, for longer than a single course learner might.
Cool stuff, as always. Stay in touch. Love talking with you. Greg Hart, President and CEO of Coursera, joining us from the West Coast. Hey, folks, we've got a rally underway. We've talked about the Dow going above 50,000 for the first time ever. It's staying above there. We're pretty much hovering at our highs of the session. A check on the trading day and some stocks on the move when Tim and I continue right here on Bloomberg Business Week Daily.
This is Bloomberg Business Week Daily with Carol Masser and Tim Stenovec on Bloomberg Radio and Television.
All right, everybody, we are getting ready to...
Yes. What are we going to do?
Hello. To kick off that last hour of trading here for the week and for the day. We got a rally underway, pretty strong, up 1 3/4% on the S&P 500. You've heard a lot of commentary around the Dow being at 50,000, above 50,000 for the first time ever. Dow up 2 1/4%. Tim, NASDAQ 100, a gain of 1.9%. I do think, though, for the week overall, we've seen, I think stocks are going to finish probably down for the week. Forgive me, I should have had that up. Yeah, we're down about
barely on the S&P.
0.3% on the S&P.
So we'll see. We'll see what happens. 12% higher for Bitcoin right now. I bring that up because 70,000 is what we're seeing. Almost 71,000. That comes after yesterday's 13% rout. So almost made everything back.
Yeah, S&P 500 on track for the best day since May as that tech stock rout eases. Although some of those big tech cap names, big market cap tech names, still under some pressure. So.